Is going to be front and center. Looks like there's even more funding coming out of the German government. It's not just for German companies. You've got elected Kongsberg, for example, that was named in that story. We've got some potential M&A on our hands. Puma has been moving quite a bit in the last couple of days. It looks like the latest line of this is that ASICS denies report of interest in the acquisition. And then, of course, Delivery Hero, a similar conversation guy.
Okay, so I'm going to try now, Critty, to make the European equity market open sound exciting. I'm going to struggle, I think, because we don't know what's happening in the States. To be honest, there's not much happening here in Europe. We've just seen a French CPI print, which is pretty much in line with expectations, maybe a little bit softer. Does that take some of the story away from Europe this morning? Maybe it changes the dynamic around what we're going to see with rate cuts from the ECB. But the Stock 600 is absolutely flat. Literally nothing to see here. Stock 600, nothing moving there. The FTSE 100 is up by 0.2%, so as anticipated, a little bit of outperformance. What are we going to see on the CAC Quarante this morning? Well, I can tell you it's up by 0.1%. The DAX, you know when there's nothing happening, when I'm still talking at this point and the German market is open. Kind of that's your big signal this morning, that the DAX is open and absolutely doing nothing. The IBEX is doing absolutely nothing. The Swiss, maybe still getting going, but the fact that the Germans are up and running this morning, Critty, tells you, I think, everything you need to know.
It really does, and I don't blame you. I think what's interesting on that board, though, is that of all the regions, the IBEX is actually turning negative. It's a little bit of a mixed picture in terms of the sector story. So I'm going to start with stocks, and then we'll get to the macro in a moment. So when you look at it from a sector perspective, you can actually see that banks are, for example, in the in declining. It's where you see all the weakness as well. You also have a conversation here coming in the basic resources, the chemicals, a little bit of a slightly defensive tilt. It feels like a rotation, though. Right off the bat, I'm looking at Shell, Total, BP. They're your biggest index contributors to the upside, alongside the likes of LVMH. On the surface, to me, that feels like a cyclical bid. To the downside, I'm seeing an SAP and a couple of the banks that have been actually seeing quite a bit of a boost lately. So BNP, for example, on the back foot alongside some of the tech names, UBS joining that front, including even Nestle is on the back foot. So that defensive trade from yesterday has kind of reversed as well. This is a rotation. Is
not a very exciting one, though.
I mean, I'm trying to sell it. I think I did a better job than you. No, I'm kidding.
Okay, fair enough. You probably did. Let's move on to actually some of the data we're getting this morning, which I think is actually more exciting and more interesting than what we've seen in terms of the equity market performance. We've seen CPI data coming out of France, a little softer. We're now getting CPI data coming out of Spain, an economy that is on the front foot and has been for quite some time. So month-on-month data there, 0.2, up from the survey of 0.1, but down quite sharply from the prior number, which was 0.7. However, Spanish CPI is still quite hot, relative certainly to French CPI and certainly relative to ECB expectations. So year on year, the number is now 3%, down a little bit from 3.1, but still quite hot in terms of the average across Europe. And the core number is 2.6. So again, above targets in terms of what we are seeing out of Spain. Retail sales, we've got some data there, softening up a little bit, but nevertheless, this is an economy, this is a part of Europe that is doing quite well at the moment.
It's doing quite well. What's really interesting about the Spanish economy, I'm going to take my moment to nerd out here about all things Spain, is that they are very exposed to the same issues that Germany is. So if you're worried about Chinese overcapacity, if you're worried about weakness in the auto and the manufacturing sector, well, Spain has the biggest or second largest, I should say, market for that, in line with the likes of Milan as well. So you see Spain being really exposed to that. The other piece of this that I continue to see in some of the data is these increases in food prices, and this is really important. You don't make as much money in Spain as you do in other parts of Europe, so the food inflation actually has a bigger read-through into that economy and some of the inflationary and wealth pressures than other countries.
Little tick down in the euro, though, which I think is interesting. Is this the market signaling maybe actually... the Spanish data is a little softer, so relative to kind of... So maybe that's just an expectation story. But is there a signal maybe in here that maybe the ECB is going to have to do more? Is the market just at the margin maybe signaling something around that? This is... The messaging at the moment coming out of Christine Lagarde and co., and I think there's a few of them speaking later today, is that we are fairly stable at the moment. They're comfortable with where they are at the moment. But is there this risk that maybe they go again? And if there is that risk, how does that affect the dollar trade, which so many people are worried about going into 2026? That feels to be one of the wild cards for next year.
And what's so fascinating about that is it's largely a euro-driven trade. The confidence in the strength of the euro right now is fascinating. I've seen forecasts there for the likes of 122 as a high going into the first quarter of 2026. So pretty fascinating. But let's talk about how we should be positioning not in 2026, but maybe just in the last couple of weeks we've got in 2025. We've got the perfect guest for it. Roelof Salomons, Chief Investment Strategist for the Netherlands and the Nordics at BlackRock Investment Institute, joins us around the table. Welcome. We are digesting, we're thrilled to have you. We are digesting a ton of information, but let's maybe start with the near term. We're about to wrap things up, where of course today's a light holiday trading kind of volume, but we're about to wrap things up for Christmas and New Year. Do we just sell into the new year?
No, I wouldn't think so. I think what we've seen, and you just mentioned a few comments on Europe, I think if you look at what Europe has been delivering so far this year, it's pretty resilient. We've seen the best composite PMI since 2 years. You talked about Spain, which is the poster child of Europe. Financials are still doing well, and I think what we've seen so far this year is basically geopolitical fragmentation forced Europe into economic leadership directing. So it's a bigger story, and it's not a story to be selling into year-end.
Is there a catalyst going into 2026? I mean, what is the thing that everyone is watching for or positioning around? Or is it just kind of hedge your bets until Donald Trump tweets?
I think what you mentioned earlier, Germany is announcing some defense spending later today, so that story will continue to build. This is a story that is basically a big change compared to where we've been over the last decades. Fiscal policy is no longer a brake, but it's an accelerator. So I think that's a big change. That story will continue, and I think what the next step will be that people will be focusing on where the next reform is going to be, because we need to get that productivity in Europe up. We need to get that competitiveness up, and that's the next phase.
When does the German fiscal push show up in the data? Because I'm not seeing it yet. When does that happen?
It is not easy to build a lot of infrastructure and to build a lot of new factories. So I think we shouldn't be surprised that it's taking a bit longer. But I think we want to see that in 2026.
Do you think the ECB is going to need to cut rates again?
It's a coin flip. We've said it's a coin flip, and I think they will continue to be sitting on the fence. They're in a good place now. The CPI numbers, as you mentioned, a bit soft on the soft side. So, but it would probably change the probabilities a bit, but it remains a coin flip. They don't need to.
In terms of the way that you should view Europe right now, currencies are a big factor. How do you think about... if I'm a euro investor, I'm flat on the S&P so far this year. I've done well in Europe. Is that a trend that continues next year? Is the euro-dollar rate going to be one of my critical inputs in terms of whether or not I'm going to perform?
I think the two arguments to this. One is for European perspective. I think it's about the domestic growth story. It's about the financials. It's about any sector that gets a boost from all the spending. So there's infrastructure, defense. But if you take the other side from a U.S. perspective, if you are buying Europe, you get an extra benefit of hedging the currency. So I think that's a story that not often people talk about. But if you are a U.S. investor and have been buying European equities in Europe, you've done very well.
How expensive is it to hedge right now?
It's the difference in short-term interest rates, so it's still lucrative to do it from a U.S. perspective, and it's expensive to do it from a European perspective. I think what we've seen on dollar hedging from the clients that I'm talking to, we've seen some increasing dollar hedges. Not selling of U.S. equities, less buying, but increasing dollar hedges.
Let's go a step further. How expensive is it to short right now?
Short currency or short
equities?
It's. I wouldn't advise people to short equities in this environment. This is an environment where you want to be pro-risk. Growth is okay. Central banks are easing policy, so it would be expensive to short.
What about valuations?
Valuations are. Let's be clear. We're not cheap.
Yeah.
We're not cheap, but in an environment where growth is okay, where interest rates are being cut, there's plenty of liquidity.
So interest rate being cut matters. So the Fed has to cut, right, to keep the market where it is.
I don't think they need to cut to keep the market where it is, but I think...
Okay, so they don't cut. Say they don't cut. Where does the market go?
It depends a bit on what the expectations are for next year. I think for next year, people are looking at 2 or 3 cuts for next year.
Yeah.
If that comes into jeopardy, there might be a risk of a bit of less liquidity in the market.
Yeah.
But if they don't cut because growth is okay, then we're all happy.
Okay, so the equity wins either way.
Not with either way, because you need to deliver on the growth numbers. But I think so far any company has delivered on the profit expectations.
Okay.
How much of what we're seeing in the States is what we're going to see in Europe? Are we going to see a divergence between performance, or is Europe just kind of following the U.S. lead?
I think that there's a difference here in the European story, because the European story has been very concentrated in the financials. Financials have been doing really well over the last couple of years already. This year we're seeing it broadening out in terms of the sectors that are driven by the fiscal spending.
Yeah.
I think if we're right and we think that there's incremental changes coming up in terms of reforms, etc., this will spread to pharma, this will spread to other sectors, to more cyclical sectors, and if growth really picks up, then you have a broadening instead of a more concentrated market. And I think that would be good. That'd be good.
But just let's talk about the fiscal spend for a moment. What happened to all the worries about the U.S. over borrowing and all the European economies borrowing and all the spreads blowing out on the long end of the curve and all the conversations we were having in literally 2 years ago, but also over the summer? Does the equity market care about what's going on in the bond market?
The equity market certainly cares. I think the big difference, if you're comparing U.S. or Japan or the U.K. towards the story what's happening in Europe, that it is driven by the countries which have the ability to borrow, call it the Germans, the Dutch, the Nordics, but now also have the willingness to borrow. And I think that's a stark difference compared to the story around fiscal discipline and fiscal issues. So I think people should recognize that.
What's cheap going into next year? What still looks like good value?
I always make the pun that Europe is unheld, unloved, and undervalued. So that's
Europe, basically.
Europe is cheap. Parts of emerging markets are cheap.
Yep.
Anything which is unrelated or not correlated to the AI trade is predominantly cheap. The market is pretty dispersed, so you need to look at areas where things are kind of different compared to just, you don't want to hedge your one trade.
Where do the risks lie going into 2026 for the setup you've laid out?
The risks are predominantly on the geopolitical side, but it's hard to predict.
But the market keeps ignoring that.
Yeah.
Let's talk about that.
The market keeps ignoring it because the guardrails are still in place, right?
Okay. So we can keep ignoring. Are the guardrails going to stay in place?
The guardrails will stay in place because you can't have bond yields rising because you have a debt to GDP.
So we can ignore geopolitics. If the guardrails are still in place, can I ignore geopolitics?
Yeah, I think so.
Okay, fine. If there was peace in Europe, what would that mean for European equities?
That would be a boost for European equities.
Okay.
Because valuations are at a discount, so if there's peace, that risk premium goes out of the market. That'd be good.
But it's not. But you wouldn't. The biggest drivers of the European market have been defense spending. If you start to see the political will or the political urgency around that defense spending change, wouldn't that undermine, just from a pure weightings perspective?
This is not the defense spending, the infrastructure spending, the energy spending. Those are not just pure cyclical and tactical trades. Yeah. These are decisions that have been made under the back of geopolitical fragmentation. We need it. We need to invest in the safety of Europe. We need to invest in the competitiveness of Europe.
All of that's
true. That will continue.
But we know that, and it must be in the price. And therefore, at the margin, if there is a little bit of de-risking on the geopolitical front, don't I have to take that out of the price that I've got over here? Because I already know all of what you've just said. So at the margin, do they become slightly less attractive assets?
At the margin, that you would probably argue for a rotation in the market, which would mean that all the other sectors would continue to do well then.
Right.
So you lift all boats. effectively.
But which sectors would I look at? Is it the consumer would feel better? Would I be seeing, where else would I be seeing potentially, like does the chemical sector, which has been really hit hard by higher energy costs, start to maybe pick up a little bit? Are some of those kind of cyclical, more kind of more industrial sectors, do they do better?
If you continue to invest in infrastructure and energy transition with the aim of lowering energy prices, which are twice as high in Europe as they are in the US, and you deliver on that and continue to invest in that, then these are the sectors that you want to be owning going forward.
On a
medium to longer term.
Great to see you. Thanks for stopping by to see us. Really interesting conversation. Rolf Solomons, the Chief Investment Strategist for the Netherlands and the Nordics over at the BlackRock Investment Institute. What are we seeing this morning in terms of the core six? Quick look at what we are getting. Obviously, some of the defence stocks are going to be in focus this morning. Rheinmetall is a little softer this morning, but not by much. Chips not doing very much. China's up by a little bit. The defensive trade, which on this board is Nestlé, is a little softer this morning. Pharma and luxury having a slightly better day. Is that because we're going out and buying nice handbags at LVMH? I don't know. Maybe that's a line I can draw between one and the other. Anyway, Chloe Melly's here with the details of what else we're watching. Over to you.
Good morning, guys. So Delivery Hero is up quite strongly this morning. We're up 6%. This is a company that is under a lot of pressure from a lot of several big shareholders to sell the company, or at least parts of that business, to streamline loss-making operations and reverse some of the stock decline that we have seen over the last few months. This follows a period of growing consolidation within that food delivery industry, and it seems that Delivery Hero will be a part of that going forward as well. So definitely something to watch going forward. Moving on to Puma, which is down this morning at 2.8%. This follows a really good day yesterday for Puma after reports that it was drawing quite a lot of M&A attention, but ASICS over in Japan has denied any interest in that company, and therefore we are down this morning for Puma. Moving on to Burberry, which is also down this morning. It is down a little bit over 2% after being downgraded by JP Morgan. The company had reported very reassuring, encouraging earnings that had boosted confidence in its turnaround and in potentially a broader recovery in that luxury sector. But it seems that now the lack of enthusiasm from JP Morgan analysts is dragging down that stock, and we are down 2% for Burberry. And finally, let's end with a positive movement for EasyJet, which is up 1.9% after being upgraded by analysts at Bernstein. They said that EasyJet was a really cheap play for investors to benefit from all of the supply constraints that we are seeing currently in the European airline industry, and therefore we are up this morning for that airline.
All right, Chloe Melly from our equities team walking us through some of those early movers. Very light volume day. We thank you so much. Coming up on the program, we go right back to our main story. CME futures and options trading halted after a data center glitch. We're going to look into the market impact. Today might be a good day for it. Could also be a bad day for it. We'll give you the full analysis coming up shortly. This is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Welcome back. You're watching the opening trade. Quietest session underway here in Europe. Very quiet session, obviously, over in the United States. Now it's the day after Thanksgiving. Black Friday, people are shopping, people are digesting the huge amounts of turkey that they ate yesterday. All of those things are true, and they happen every year. But this year, it is also a little bit different. The reason for that is simple. The Chicago Mercantile Exchange has halted trading of commodities futures and options. It's having technical issues. This relates to a data center that is having a cooling issue. Nicholas La joins us now to talk about all of this. Nicholas, just give us a sense of what is happening here. This is a critical piece of infrastructure. What do we know about what's been affected?
So it's a dark Black Friday for the US, and traders who are hoping for a quiet session indeed got more than what they bargained for. It's very clear that this is an unprecedented outage. Now, the last time this happened was 6 years ago in 2019, and even then the outage only lasted for around 3 hours. It's been more than 5 hours since 10:40-something-ish this morning Singapore time when the outage started, and there is still no end in sight. Let me give you some context here. The Chicago Mercantile Exchange covers a suite of asset classes of options and futures. I'm not just talking S&P futures, I mean across a whole set of commodities. WTI NYMEX is traded on CME, agricultural assets as well as metals. So this is a big deal, and it's all happening on a day when most people weren't expecting it.
Talk to us a little bit then about when we're talking about kind of the operations and the resumption of trading. Just walk us through a timeline here. How long does this take? Is this hours? Is this days? Are we going to be back to normal on Monday?
The short answer really is we don't know, but I can tell you what's led to this, and I think that will give us a sense of where we're going. So the short version really is that CyrusOne, a data center provider, now one of their units had a cooling issue, and that's caused the outage that we're seeing on the exchange, right? So it comes down to the hardware. I think it really depends on how soon they locate the outage, process it, and get things up and running. But one more thing I will add to this, even though it is supposed to be a quiet time in Thanksgiving, this is still a major exchange, and everyone is watching. A lot of people have money riding on this, and there's a tendency for things to go one way or the other in very big directions when things resume. And so I think that's a big thing that people will be watching. The pressure is on, and the sooner we get back, the better.
Okay, I think it's going to be really interesting, as you say, maybe that there's the possibility what you see here is a liquidity wave coming through, which is, as you say, could force the market in a kind of slightly unexpected direction, certainly with a significant amount of force. Nicholas, great stuff. Thank you very much indeed for the update and what is happening here. We're going to obviously track this story and bring you the latest, because this is a critical piece of market infrastructure. Nicholas Lua joining us on what is happening with the CME.
Something we're going to be continuing to monitor. One eye on the exchanges, another eye on the sales. I think it is, of course, Black Friday, the unofficial start of the holiday shopping season. Andrea Felsted is all over this, our Bloomberg Opinion columnist. This year, she writes that retailers are trying to rein in discounting to cope with the impact of President Trump's tariffs, while at the same time, many shoppers are under pressure and searching for the best value for their money. Oh, gosh, I hope so. Andrea's here now to talk us about that dynamic. So we should be shopping, is what I'm hearing.
Well, I think it depends which side of the Atlantic you are. I think there's a real divide. I think in the US, the impact of tariffs, one way that you deal with paying high import duties, you don't offer as steep discounts. And we are seeing that. We haven't got any actuals yet, but in the forecast, areas hit by tariffs, toys, electronics, household appliances, we're expecting to have slightly less generous discounts than they had last year, and other areas.
Okay, so let's kind of unpack that a little bit. What kind of a consumer are they dealing with right now?
They're dealing with a very mixed consumer, and we've talked about the bifurcated consumer for years, but that is ever more extreme. We've got, rich people enjoying the gains from the stock market until recently anyway, and crypto. And you've got sort of lower income shoppers really, really pressed and, watching every penny, buying on deal. Generally, everyone is looking for value for money. Yeah. That means buying on discount when you can. And we saw it in July when we had Prime Day, another frenzy of discounts. Consumers were sort of buying household essentials on discount. They were looking to stock up for back to school goods, for household goods. And that really shows you that they're using these occasions not to sort of treat themselves, but to buy the things that they need more cheaply.
Can we talk about Zara?
Yes.
Finally. When I go Black Friday shopping, I go to Zara because the expectation is that you get good quality, made in Spain or wherever in the world, and it looks like it's far more expensive than it actually is. I hear they're going into another side of the business.
Well, they've already been going up market for the last couple of years. Yeah. They've been doing that, quite successfully, which is smart because the luxury brands have moved higher. Yeah. They've priced out a lot of consumers. That's led to aspirational brands like Coach, names like Cézanne doing very well. But it's also been an opportunity for Zara to pick up some of those shoppers that would have shopped luxury and capture those customers.
Inditex has Massimo Dutti.
Exactly.
Yeah. However you say it.
Cut price Cucinelli.
Yeah, they've got tons.
Exactly,
so
but
why does Zara need to do this?
They are thinking that they need to do that to capture this shopper that has been disenfranchised. And I think they have been doing that well. The thing I think that trips them up is quality. You can't, as the luxury brands have found, you can't keep charging ever higher prices without improving quality, without giving people more. Now, a year or so ago, they launched a bag range, a sort of real leather, real suede bags, very nice, but they were quite pricey and they looked good. But that's what they need to do. They need to, if they're going to go up market, you have to have that quality. And I don't think they've yet taken the quality with them.
Quality matters.
I'm learning.
Andrea Felsted, an example. Andrea Felsted, thank you very much indeed. Our high-quality opinion columnist. Okay, coming up, David Hirschman, co-head of Permira Credit, joins us in the studio to talk about deal-making and private equity. It's been quite a year for Europe.
It's been a fascinating year for Europe. This is where the growth sector is. This is a really exciting place. They're filling the sovereign funding gap. It doesn't stick into 2026. That conversation next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. 30 minutes into I'm going to say it's right. 30 minutes into today's session. It's Friday. I'm feeling it. We all are. So are these markets. And I think this is really crucial here. Futures were positive going into it, at least in Europe, were positive going into this session. Can we call it that they've paired those gains? The outperformer is a 1/10% move on the FTSE 100. Guy, rescue me. This is all I have to offer.
This is not an exciting session.
No.
It is the classic post-Thanksgiving session. There is no volume in the market. We are going to wait until Monday before we start to get a clean read on what is happening here. Today is not the day to make any assumptions about market sentiment or anything else. And it's probably even more confused by the fact that we have the CME story, which is basically taking out a significant portion of price discovery from this market. So to be honest, we're struggling to figure out what is happening here. So what you do maybe therefore is look at some of the single stocks, because actually that's an area you maybe do get a slightly cleaner read on what is happening here. I hope you can read all this. Novo Nordisk is up by 1.25. These are basically the gainers within the Stocks 50. Some of the industrials are doing well. Some of the luxury names are doing well. Look at that. LVMH is up by 0.7%. But it's the commodities out of London that I think are maybe the standout story today. So names like Glencore are up. You're seeing you're seeing quite a decent story emerging around some of these metals at the moment. What you're also getting are some decent performances coming through from the oil stocks. Now, remember, we're going into an OPEC meeting. Let's talk about what else we're getting. EssilorLuxottica. Is that a trade on the fact that we're starting to see other companies releasing smart glasses? Alibaba overnight releasing some smart glasses out in Asia. Is that negative for EssilorLuxottica? Maybe. Elsewhere, it's more of the defensive names. The safety trade is off a little bit today. So Anheuser's down a little bit, Reckitt's down a little bit. Some of the insurance companies are a little softer as well today. So there's a kind of slightly negative defensive story kind of in the market this morning. Not defensive, and that's where we're seeing maybe the weakening coming through. So that's the broader picture. But actually, today's not a day really to get a clean read on what is happening with these markets. Credit, what else do we need to know this Friday morning?
There are a couple of other stories around the world. We'll start with the markets one. The biggest surprise I think we got today, and that of course is the trading of futures and options on the Chicago Mercantile Exchange. The CME been halted for several hours due to a data center glitch. That means trades against foreign exchange, bonds, equities, commodities. They've all been affected. A CME spokesperson says a cooling issue at a Cyrus 1 data center is responsible, and they are working to resolve the issue. Let's broaden it out to other things going on in the States. This time in the political space, President Trump is pushing for deeper immigration curbs after 2 National Guard members were shot near the White House. In a pair of Truth Social posts on Thursday, the U.S. president said he would, quote, permanently pause migration from all third world countries. Let's talk about what's going on this side of the Atlantic. Hungarian Prime Minister Viktor Orban will meet President Vladimir Putin in Moscow today. Now, Orban, widely seen as the most Kremlin-friendly leader in the EU, seeking to leverage his ties to Putin to potentially snap up sanctioned Russian energy assets when it comes to Eastern Europe. Now, the Hungarian leader said Russia's war on Ukraine, crude oil, and natural gas supplies would all be on the agenda. Guy?
Great. Let's pick up on that story and get a little bit more detail on what we should expect coming out of this meeting. We're joined now by Bloomberg Russia Economy and Government editor Greg Sullivan to talk more about this. Greg, let's talk a bit about the message that Viktor Orban is going to be taking. Is it a Hungarian message or is it a European message that he takes to Moscow?
Well, it's most likely a Hungarian message. When he spoke this morning, he said that he was going to talk about oil and natural gas supplies. That's hardly surprising because Hungary has continued to source a lot of its energy from Russia, despite the war on Ukraine, bucking the trend of other European nations. He actually received an exemption from U.S. sanctions from Donald Trump. Orban has managed to maintain close ties with both Trump and Putin. But despite energy being top of the agenda, it's also likely that the war on Ukraine will also come up. His visit is obviously taking place amid a lot of diplomatic flurry. Steve Witkoff, the U.S. envoy, is expected in Moscow next week. Putin confirmed that a U.S. delegation was coming and talks are ongoing amid President Trump's push. So that's also likely to be on the agenda when Orban visits today.
Well, Greg, it's a fascinating time as well because we know, I'm curious, and this is what I'm trying to understand here. You said it's a Hungarian-specific issue. Well, Viktor Orban has aligned himself with the leaders of the Czech Republic, with Slovakia, et cetera, a lot of these Eastern kind of European countries. How much of it creates a precedent for some of the other European countries that may be wanting to resume some of the gas supplies, especially as Vladimir Putin says maybe we're not as close to a peace deal as we thought?
Well, Orban, as you mentioned, has been seen as one of the more Kremlin-friendly leaders. He's really bucked the trend there. A bit ago, he also had a previous visit to Moscow, which he styled, it was a self-styled peace mission of his, but it provoked a lot of anger among other European leaders. And there's still a lot of pressure on him for going against the grain on things like sanctions and for not supporting aid to Ukraine. As you said, President Putin recently commenting on progress towards a peace deal and sort of tamping down expectations that, any final deal was near at hand. So there's still a lot of room for negotiations and negotiations that are yet to come here.
Greg, thanks for the update. Always appreciate it. Greg Sullivan on the Viktor Orban trip to Moscow today. It feeds nicely into a conversation that we've been having, obviously, recently about what is happening with the European defence story. If we were to get a peace deal, what would it mean for some of these defence companies? Well, we're going to find out next week. We're going to be joined by the CEOs of Hensoldt and Rheinmetall. It is a busy week when it comes to that narrative, and we've got some great guests to talk about it, Chrissy.
Yeah, it's a fascinating one, and it kind of feeds into this idea of what is the growth narrative going into Europe for 2026, and defense has been such a key part of that. Energy security has been a key part of that, especially when you look at not just the public markets case, and you see that in the likes of Rheinmetall and the way it's moving the stock 600, but in the private market as well. The good chunk of the deal making and the investments in the private space this year in Europe have been energy security, data grids, defense, a lot of the projects that have been backed by sovereign governments. Let's talk a little bit more about that dynamic. I'm pleased to say one of my favorite private credit guests, David Hirschman, the co-head of Premier's credit offering, is here around the table with us. I usually see you in Paris or Berlin or somewhere else. Welcome to the studio.
Thank you. Thank you for having me here today.
We are thrilled to have you. Let's start a little bit broad here. I want to talk just more about the European bull case. I've been interviewing you for years. Every time we talk about how private credit is kind of funding that sovereign financing gap. Is that still going to be the case going into 2026 and beyond as some of these projects and as some of these ambitions come to fruition?
Yeah, I think so. Look, Europe remains one of the most compelling credit markets in the world. Of course, there is political noise in the UK or in France right now. But by and large, the fundamentals are very solid. Policy is easing, inflation is under control. We see it across our portfolio. With the right sector selection and asset selection, we see growth across the portfolio on a consolidated basis of around 8 to 9% at revenue level, the same at EBITDA level. So we feel comfortable with the environment, the macro environment, and clearly there is increasing demand for private debt in the market.
There absolutely is. I think one of the concerns, we have this conversation in the public dialogue quite a bit, is one, how much of that is priced in? And if you start to see a shift in public priorities, i.e., you need to start funding welfare projects more, you need to pull out of some of the promised defense spending, you need to, I don't know, maybe there is a peace plan coming or a peace deal in Ukraine coming, for example, or you find alternative sources of energy, maybe relying on the states. If you start to see those spending priorities shift, does the value proposition of the private credit opportunities that are based on it change?
So I think the reality is we tend to focus on sectors which are not impacted and not correlated with generally public spending. So when we see an increase in the defense spending in Germany, driven by Germany, mainly in Europe today, that doesn't really affect the businesses and the subsectors that we focus on. Mostly business services, insurance services, technology, healthcare services. There is some ripple effect, but by and large, they're not correlated to public spending or sovereign spending in Europe. So our focus is really to continue to remain very disciplined and invest in those sectors where there is very little correlation with either GDP growth or public spending.
Is next year the year we start to see greater divergence between management performance? Up until now, it's been really hard. Private credit's been this kind of thing. And you've looked at private credit, and it's not been obvious kind of who's doing a better job and who's not doing a better job. I'm sure from the inside it may look a little bit different. So I'd be interested in your perspective on that. But is next year the year we start to see maybe the greater divergence in performance, manager performance, being more obvious?
Maybe. And look, you're right. Not all private credit is equal. And we hear about there are cracks in the market, which is fair. I think it's true. I think it remains isolated. It remains confined to a few atypical situations. And these we're talking mostly about complex financing structures, exposure to subprime, asset-heavy business models.
Yep.
And these are where the recent news have come from. So we may see an increase in that, but we think that those are relatively atypical situations. The main risk is not the asset class, it's pockets of the market where the underwriting discipline has slipped. So we may see an increase in that. We're not seeing that ourselves in our portfolio, but there may be a few more cases, and we've seen those in the US recently.
When are we going to know if we've built too many data centers?
That's a great question. I don't know. I mean, the demand keeps growing massively, so it's not a bet that I would make. I'm not an expert.
But it's one of those it's one of those things that everybody's watching for that's going to affect the whole sector. The financing of this space is consuming huge amounts of credit at the moment. And therefore, there are going to be ripples.
Yeah.
And when we start to know the answer to that question, it is going to affect the whole space.
Yeah, true. I mean, look, there's a broader question which effectively is at the center of all our investment decisions, which is how is AI going to impact this industry, this sector? What is the AI disruption risk? And that should be at the center and at the core of every investment decision of every manager, whether you're investing in equity or in credit, because it will have a massive impact. And so beyond the question of data centers and is there enough in capacity, but that, of course, it is one of the key questions, and everybody should have that in mind, definitely.
But to your point on the cracks, and I think that's what Guy's trying to get at in 2026, the cracks aren't as big of a deal if you have the lending growth that is fast enough to kind of minimize the spots that aren't so good, or where the financial discipline, as you put it, aren't so great. We haven't seen that. With the collapse of Tricolor and First Brands, we saw these massive impairment charges on public balance sheets, on the Barclays, on UBS, among others as well. So is the solution to dealing with that issue and the cracks just growing even faster to increase the lending growth? Do you feel like it's happening at a pace that can overtake and can handle cracks?
So the way to overtake and handle those situations is diversification in the funds or on balance sheet if we're talking about banks. What we see is dispersion in the market, not distress. Dispersion means that the way for us to win is by remaining super selective, having funds which are well diversified, such that if there are defaults, and look, we've invested in over 200 companies, you're bound to have some defaults in any fund. A small number, but overall with a very high recovery rate. That's our experience, at least. And having small exposure to any single asset is really the key here. And where I think there have been some issues in the market, it's those either very complex structures, exposure to subprime, and lack of governance or transparency. Do we need to grow to overcome this? The growth comes from the market, from the demand. It doesn't replace, growth doesn't replace the discipline and the core investment strategy.
All right. David Hirschman, the co-head of Premier Credit. Lovely to see you in studio. Thank you, of course, for talking about one of the major topics that are going to happen in 2026. Let's talk about another coming up on the program. That, of course, is the labor market. President Donald Trump is calling for, quote, reverse migration in the United States. Is that something that shows up in the data? Is that part of the Fed's thinking? Should it be? We're going to dive into all those details next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to the opening trade, about 47 minutes into this session, and we're seeing a very light one. The underperformers, the DAX this morning, the outperformers, the FTSE 100, but again, only higher by, we'll call it 0.1%. A lot of this light liquidity is also amplified by the other issue that CME futures and options trading is halted right now. There's an outage emanating from a data center that is having a cooling issue, and that means the contracts listed on your screen right now are halted. We don't have info.
This is taking a long time to fix.
Yeah, this came out at, I want to say, like 2 or 3 a.m. UK time. We're almost at 9 a.m. It's been 6-ish hours. Let's hope this gets resolved, at least certainly before the U.S. Open, when you start to see a little bit more volume perhaps hit the wire.
Absolutely. They need to get this fixed and fixed really quickly. You do wonder whether actually Thanksgiving might be a factor. I guess everybody at their desk are people actually doing what they need to do to get this up and running again.
Yeah, absolutely. A conversation we're going to continue to monitor and bring you the updates. Another conversation we're monitoring is the latest coming from President Donald Trump, who says he will, quote, permanently pause migration from third world countries. In a lengthy post on Truth Social, he said anyone who is not a net asset to the United States would be removed. Now follows the death of National Guard member Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard who was also shot remains in critical condition. We're joined now by Alex Pearson, D.C. breaking news editor, who is actually in Frankfurt at the moment. We appreciate having you on this side of the Atlantic. Alex, a tragedy, of course, in the United States, but I'm curious for a financial audience how the latest comments from Donald Trump actually affect this labor market. Is this something he's threatened before? Is this something you think he would act on?
Good morning. Yeah, it's a good question. So we had this Truth Social post a couple of hours ago that outlined quite a broad immigration crackdown, even by the Trump administration standards until now. And the headline, obviously, is this permanent pause on migration from, as he called them, third world countries. It's unclear which countries that would affect. He didn't list any countries in that Truth Social post. And certainly, though, that kind of policy could have some pretty significant impact on the labor market in the U.S. in terms of specific sectors. So, you know, most migrants from developing countries tend to be lower skilled. They tend to work in, industries like construction, agriculture, hospitality. And certainly we've seen that other immigration policies this administration's taken up until now have caused labor shortages in those subsectors of the economy. And any kind of blanket ban like this that Trump has announced could also have a similar effect and exacerbate those shortages. In terms of the other policies he announced regarding foreigners and naturalized citizens already in the U.S., such as stripping them of their permanent residency or citizenship, or deporting them for not being, quote, a net asset, that's a little bit unclear. First of all, just because we don't know how quickly he could implement that kind of policy. It's not even clear he would have that kind of authority without Congress amending immigration and naturalization laws. So that still is yet to be seen.
Alex, thank you for the update. We're going to watch this very carefully. Obviously, this goes into a Fed meeting where the labour market is going to be absolutely front and centre. Alex Pearson joining us with the latest on that story out of Frankfurt. It has been, in some ways, a quiet week for markets, but a tumultuous week for markets. And it's also been a tumultuous November. What is going to happen in December? December's normally quiet, but it doesn't feel like it's going to be this year. Farah El-Brahari joins us now, leading Bloomberg's EMEA equity markets and macro trends and strategy team. Good morning.
Morning, Guy.
What a November.
Exactly, what a November.
So what happens next? Kind of where are we? I feel like we've round-tripped on the Fed, which has been probably the kind of the most critical factor in all of this.
Absolutely. You look at the S&P 500, we hit a recent low on November 20. You look at the Fed expectations that day, we were around 40% for a cut. So it was still not certain that we were going to get a cut. Next day, John Williams says he's optimistic.
Yeah, perfect timing.
Exactly. Index goes up, swap markets are pricing in a cut, and now we're at 90%. So everyone is pretty certain at this stage that we're going to get it, and the market is still negative for the month, but we're 0.4% away. Let's see what happens with the CME glitch, but how that opens later today. We might erase the November losses, actually.
Is this all about the Fed? Is the equity markets dependent on the Fed being dovish?
At this moment in time, it's a really big factor, Kriti. So we have the AI valuations, obviously, that was a big hit to the market, but they've come back quite a bit. So the Fed continues to be a big focus, but also earnings. I mean, we just came off from a relatively strong season, double-digit growth for the S&P 500. They've beat companies that beat expectations quite a bit. The next year's forecasts are still quite elevated, double-digit growth, but that still continues to be a factor for the market.
So how do you describe sentiment at the moment? Like, it feels like it's taken a few hits this month, and the Fed, I think, is kind of, obviously we've been on a bit of a round trip there, but it does feel at the end of this month that the AI trade has taken a hit. The people are more circumspect, more kind of cautious when it comes to that narrative. Crypto has come back, but not all the way. By no means a stretch of the imagination. So how is risk sentiment?
Well, if we look at the sell-side strategists, it looks quite rosy. Oh, they're really excited. Yeah. They're very excited. They have Deutsche Bank expecting the S&P 500 to go to 8,000. You have even the lowest targets that we've gotten are 7,300. These are still records for the S&P 500. About 8% gains from here. So I would say short-term sentiment has taken a hit, but long-term, or at least over the next year, everyone is still quite positive on earnings, on the Fed, on the economy being rather solid, lifting the market. Expectations for the U.S. continues to be solid. Looking very quickly to Europe, though, it's not as of a rosy picture for the market. Stock 600 targets for next year aren't so positive. What strategists are saying is that the expectations for profit growth are way too high in Europe. We're talking about 12% from analysts. No one is really sure that we're going to get that in Europe just yet.
Is Europe still a diversified trade away from the United States? We're going to find out.
Currency is going to be really important in that, though. If the dollar continues to go down, that's going to be... in some ways, Europe actually doesn't need to do very much to outperform if the dollar is weakening, if you are a euro investor.
I'm having deja vu. This was the conversation earlier this year. I imagine it will be early next year as well. Farah El-Barahi, who leads our Bloomberg equity coverage in this region, thank you so much for your time. I'm ready. I was in the Friday mood when I got on set. I'm ready for the weekend.
Yeah. You going shopping?
No, but maybe I should, though. These Christmas markets, I hear, are open. I hear that there are lots going on in terms of Vienna, Berlin, etc. But there's some sports as well, Guy. There's the Qatar Grand Prix, the Women's Big Bash Cricket, the Australia PGA Championship. I mean, I don't even know where to start.
So there's other news. So the big news is the Kriti. It's not the Christmas market. The Christmas news. The big news... I'm just sort of hiding behind the flowers. The big news is that Kriti Gupta, who has been with us for, 2.5 years?
2.5 years. You got to get you in this shot.
Is these enormous
Thank you for the flowers.
Is leaving to go home.
Yeah.
2.5 years. It feels like that has been too short. It's gone by in a heartbeat. It feels like you've barely been here.
Time flies when you're having fun.
Well, I hope that's true. And we've certainly enjoyed having you on our side of the Atlantic. We're not going to completely miss you because you're still going to be in New York for us.
Absolutely.
But it has been too short. So I'm probably putting you on the spot here, but thoughts of Europe? Do you feel more?
You know, Europe is great. I've gone to nerd out about Spain in a way.
You have.
That I could not have in any other part of the world, which I'm really excited about. I've had an incredible team. You actually were my first, when I was a We Markets correspondent back in New York, you and I were the first time I anchored a show with you. With anyone was with you. So it's kind of a full circle moment that we got to be co-anchors for almost 2 years. We've had an incredible team behind the scenes.
Yep.
We've traveled everywhere. We've taken the show on the road. We've covered elections everywhere.
Yep. Well, that's Europe. Plenty of politics to cover over here.
It is incredible. I think we're entering an era, and we've seen this in the last year and next year. We're entering an era where the world feels like it's getting more pulled apart, less correlated. It means that in Europe, you're going to care more about the United States, and the United States, you're going to care more about Europe. And I'm really excited to be a part of that story, and I've been thrilled.
Well, it has been a great pleasure. You will be missed. You will be greatly missed once you depart. You're packing this weekend?
I'm packing this weekend. That's what I am doing this weekend.
Kriti and her dog are heading back to New York. We have missed you. We hope this is going to be appreciated. Anyway, for Monday morning, you will not be here, and you will be missed. Thank you very much indeed. Kriti Gupta, everybody.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg. Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
European traders coming in after the Thanksgiving holiday have been wrong-footed by a technical issue at the Chicago Mercantile Exchange, halting the trade of futures and options contracts. President Donald Trump calls for a series of potential measures to crack down on immigration following an attack on 2 National Guard members in Washington by an Afghan national. And the Hungarian president is meeting Putin in Moscow to discuss energy supply and Trump's plan to end the war in Ukraine. Happy Friday, everyone. It's been a very long week for a lot of the traders out there. We also have this technical difficulty, which means that we're not getting certain contracts. Now, S&P futures signaling that the benchmark's first monthly loss since April was something that we should have really spent a bit of time on, but then we have this technical outage at the Chicago Mercantile Exchange, and that's really disrupted trading. So never mind, let's get to the European Stock 600, practically flat. We, of course, look at gold to have a good idea of what kind of risk sentiment there is out there, and then we've seen these moves across global equities, pretty much muted. European stocks little changed. Asian gauge is actually tripping gains after a 4-day gain. You can see the CAC, the IBEX, and the FTSE maybe in Italy not moving that much. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, 2 major stories to finish the trading week. President Trump calling for a series of potential measures to crack down on immigration. More on that in just a moment. But first, trading of futures and options on the Chicago Mercantile Exchange has been halted for several hours due to a data center glitch, disrupting trade across foreign exchange, bonds, equities, and commodities trading. Now, President Trump, the other big story, saying he will, quote, permanently pause migration from third world countries. In a lengthy post on Truth Social, he said anyone who's not a net asset to the United States would actually be removed. Now, it follows the death of a National Guard member, Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard who was also shot remains in critical condition. Well, Bloomberg's Alexander Pearson joins us now. Alex, what do we actually know about the specifics here, and how quickly can this be implemented?
Good morning. At this stage, we don't actually know that much beyond what was announced in that Truth Social post a couple of hours ago. As you mentioned, the headline there was that migration from so-called third world countries will be permanently paused, as President Trump put it. And then beyond that, also, there were a series of other policies he announced that were also quite vague in terms of how they could be implemented, but those included stopping federal benefits for foreigners in the U.S., deporting foreigners who are deemed not to be a net asset to the U.S., and also quite an extreme measure, the president saying that he would potentially strip permanent residency or citizenship from naturalized U.S. citizens who were deemed to be not in line with the administration's policies. So in terms of implementation, it's unclear how quickly he can move on some of this. On the ban on third world countries, as he put it, he could move quite quickly on that. He's done similar measures before in the past, and the courts have given him that authority. In terms of the other policies, it's a bit unclear. He doesn't really have the authority to do a lot of what he said. He can't just strip citizenship in that way, and so he'd likely need congressional approval to actually amend some of these laws to allow him to have that authority.
So, Alex, how does this broadly affect the labor market in the U.S.?
That's also unclear at the moment because we don't really have the scope, but because we don't even know actually which countries he deems quote-unquote third world. Once he lists that, we would get a better idea in terms of the flows that would be affected, what kind of workers would be affected. But it's reasonable to presume that if he means developing countries by this term, that there would be fewer workers, lower skilled workers entering the U.S., and that could certainly affect certain sectors in the U.S. That are dependent on that kind of migrant labor. Examples are agriculture, construction, hospitality, and those sectors have already been quite hit hard by other policies that the Trump administration has implemented. There have been labor shortages there, and so this kind of policy could exacerbate those labor shortages and even cause certain price increases that we've seen in those sectors that have been higher than the national average.
Thank you so much, Alexander Pearson, there with the very latest, of course, on what Trump has said in the last 48 hours. Now, for a wider look at the markets, including the CME's outage, Manish Kabra, multi-asset strategist and head of U.S. equity strategy at Societe Generale Corporate and Investment Banking, joins me with Bloomberg's John Stepek, author of our newsletter, Money Distilled. John hasn't slept in 3 days because of the budget. There's just been a lot. You had the podcast, you had the newsletter, and we're still trying to digest the 88 points of the Chancellor. No, you're actually you don't look that tired. Manish, first of all, I mean, look, there's an outage, right? So again, when you look at futures, I don't know, it's just disruptive, and so it makes everyone's life complicated until we really get to the bottom of what happened at the Chicago, Mercantile, and when we're back online.
Yeah, as in how to read this, as in I think it's another one of those places where we have seen, tech is the most important. One has to be, absolutely crucially, be invested fully into this. So I think it's one of those another signs. Tech is literally core part of assets, core part of our lives today.
What's your take overall, Manish, on what happens to equities from here? Again, they've had a good run, and then every 5-6 days there's worries about AI valuations, and so it feels like the sky's about to fall, but it never does.
Yeah. As in, I think our take is bullish. We have been bullish just for the sake if the year is turning, should we change? No, I think the cocktail of events that we have in America is still very solid. We got Fed unfinished business of rate cuts. We got the change in Fed leadership. We have, and what should I say, profit margins expanding beyond tech. We have one big beautiful bill coming out and the front-loaded basis. You just combine a lot of these elements. I find tech is the only sector which is actually ready to take some leverage, and market's going to give benefit of doubt to them. So we quite like hyperscalers. We like U.S. hyperscalers.
What's your take on the markets overall, John? I mean, there's you couldn't make a big difference between what's happening in the UK as we're still trying to digest the budget and everything else rallied by AI and the Fed.
Well, I think it's interesting because, I mean, one thing, I was checking figures before I came on this morning, and so far this year, as a UK sterling investor, you have been better off in literally anywhere else but the US stock market this year in terms of returns. And I think that's actually a very positive development. You've still got the S&P going up. You still have, whether AI is a bubble or not, it's intact, whatever's happening there. But at the same time, you've got this kind of spillover to other global markets, which are finally catching up after years of being undervalued relative to the US market. And again, it's hard to argue that's anything but positive. And obviously the US, we had a wobble, partly over AI, but also because I actually think, I don't know about you, Manish, but I think an awful lot of this is about actually where they think the Fed's going to go next. And the recent bounce this week has clearly been because the Williams New York Fed guy came out and said, well, actually, no, I think we should cut in December. And as long as that's the general tone, then yeah, and I mean, you get a Santa rally, what is it, 18 out of the last 24 years? Probably going to happen again. So,
Certainly if the Fed cuts in December, that's going to be a welcome boost to equities. Do you think the Fed cuts?
We think Fed cuts. We think they cut in December, they cut in April. It's absolutely unfinished business on the rate cuts. The two big macro events that we are watching, one, for sure, there's midterm elections, and then you have the Fed, change in leadership in the Fed. And I think this particular event, change in leadership, will get way more focus for currencies, for equities, for the rates, whether terminal rates needs to be shifted, lower than where it is today. I think all of that comes into a big question mark.
But Manish, how much of this is already priced in? I mean, you have a president that has certainly not minced his words on what he wanted the Fed to do.
Yeah.
And so there's a general assumption
that
actually the next person will just be more understanding of the president's needs.
I think we took one very out of consensus call, which is to sell inflation protection next year.
Right.
And that's based on the thinking, if you have a president who's fully focused on affordability as one of the key factors, food prices, utility bills, energy prices, all the policy uncertainty we had on trade this year, which has reduced to a large degree, which actually accelerates on the reduction side. So I think we're going to get impetus, which is a set of, what comes out of Washington is going to help the Fed and the leadership change there.
And there's no question, John, right, that whatever happens in the U.S. has an impact also on Europe.
Oh, yeah, definitely. I mean, you can't help but avoid it. And actually, it's sort of frustrating when you are looking at markets outside the U.S. Obviously, I've been talking about how the U.K. has been cheap for a long time, and it has come back a lot this year. But one question people always bring up is, but if the AI bubble bursts in kind of the U.S., what's going to happen to global equities? And, you have to accept that, they'll go down too if something does go wrong in the U.S. But assuming that the U.S. does keep going up, and assuming, I take your point about Trump pushing back against inflation in terms of the kind of CPI rate, but I think it's also fair to say that if you get a more dovish Fed, the kind of overarching outlook for inflation becomes a little bit, like monetary inflation. For example, I think we will probably still see a solid bid for gold if we get a kind of dovish sort of like Fed head. But as long as that's a sort of easier monetary policy is on the cards, then I suspect that will just spill out to global assets.
And just to add to this point, as in how we look at the UK, and I think UK is very interesting at this point, for the reason it has no tech stocks, right? As in it's the only one major index with no tech stocks. So anyone looking for beyond, I got enough tech, what do I look for if tech is spending in the old economy? You buy the old economy index, which comes out to be FTSE 100. So we quite like that.
Manish, I mean, a quick question on immigration. Like, again, there was a long message by Donald Trump on how he's cracking down. That must hurt equities in the U.S. longer term. If there's not enough labor in there, and prices will go up.
As in what we are concerned the most and what we find the concern that's a lot is the youth unemployment. And youth unemployment has jumped 80%, just in last 18 months. So, whether it's AI, whether it's lack of small businesses feeling better, I think some of the Fed members have been very clear. You want to help small companies, you want to help young people, you want to help the housing market. It's those part of markets which needs a rate cut. So, as in youth unemployment, big issue.
Yeah, I mean, in terms of inflation, so I loved your Money Distilled newsletter yesterday because actually you're one of the few that see some of the bright side of what the Chancellor put in place.
Well, I mean,
what's the optimistic view?
I don't know if it's me that's seeing the upside, but it was interesting because I was looking at, got a piece from Anatol Kaletsky at GavCal, and his point, which I think is actually a reasonable one, is that because the UK budget is actually so backloaded, so she's spending now, but she's pretending that she's going to get the money back in a few years' time. You've actually got quite a fiscally kind of loose world that we're going into in 2026. And therefore, from a kind of backdrop point of view, that's actually basically kind of bullish for the UK economy and for UK markets. Now, that doesn't necessarily mean the budget was any good, because it didn't address any of Britain's structural issues. It made our incredibly complicated tax regime even more complicated. And it certainly didn't put us onto the road to fixing the fiscal problems, because, as I said, it's all been backloaded. She's just done what every Chancellor's done for the last X number of years, which is say, OK, I'm going to fix this, but I'm not going to fix it today.
Yeah.
But in that case, that means more spending next year.
John, I mean, is there a worry that actually doesn't lead to growth? And actually, if you look at the latest YouGov polls, it's also not popular with voters.
That is a serious issue, actually, because, I mean, the main constraints on the government are, if anything, political just now, the UK government. I mean, it's quite something to win a landslide and then not be able to do anything. But that is the situation that the government's in. Yeah. And at the moment, they've got the Prime Minister and the Chancellor are not popular. I don't think that's controversial. That's pretty obvious from the polls. They're also not popular within their own party, or certainly there's lots of people who would rather have others in there. And so they're sort of clinging on to their jobs. And at the same time, you know, they're having to cling on to their jobs. Yeah. And that means they can't get anything done. And the risk is that the budget falls apart on that basis. So, I mean, there's sort of one key area I can see right now that's the problem is the Employment Rights Act. So Labour's been very keen to push through, when you hire someone, they immediately get all the rights that you would get after 2 years now. And they've just bumped that back to, they were going to do it on the first day, but now they're going to do it for 6 months. So you still get 6 months where you can basically fire someone for no cause. And obviously that's sensible, because as we all know, if you've recruited anyone, it's extremely hard to know if they're any good until they've been in the job for at least a couple of weeks. But the backbenchers are not going to like that. So I think that's a kind of key potential flare-up issue that could derail everything else.
Okay, thank you both. We went through U.S. equities, budget, we've done it all in 15 minutes. Manish Kabra, multi-asset strategist and head of U.S. equity strategy at Societe Generale Corporate and Investment Banking, and of course our very own John Stepek of Money Distilled. Coming up in the week that President Trump said there would be tremendous progress towards peace in Ukraine. We'll assess the state of play with Amundi's head of geopolitics. That's next, and this is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome back, everyone. Now, the Hungarian Prime Minister Viktor Orban will meet President Vladimir Putin as Russia weighs the sale of sanctioned refineries. Orban said Russia's war in Ukraine would also be discussed. Well, let's get more now with Zoltan Simon, Bloomberg's Budapest bureau chief and Eastern Europe editor. Zoltan, thank you for joining us. So what more do we actually know about Orban's visit to meet Putin?
Right, so Prime Minister Viktor Orban is on his way to Moscow, and he's expected to discuss Russian oil and energy flows to Hungary. Orban secured a U.S. exemption from under sanctions on Russian oil. But I think we're also expecting him to discuss potentially opportunities for Hungary, since sanctions, U.S. sanctions, are effectively strangling some of the refineries that are Russian-owned in Eastern Europe. And Orban was in Serbia yesterday, where he said that he would be, quote, happy to take over Niš, which is a Gazprom-owned refinery there. He's likely to discuss that with Putin today.
So Putin also says that Trump's proposals for ending the war in Ukraine could be the basis for future agreements. What more did he say, and what more do we know about it?
Well, what he also said, and what's important to remember, is that it's not a final draft, right? So probably it's all going to be in the details again. We know that the U.S. presidential negotiator envoy, Steve Witkoff, is heading to Russia next week, and we'll see what comes of it. Obviously, Orban is also going to be in Moscow to say that this is what he's been calling all along, for sides to negotiate, and he's likely to propose once again that Budapest host a potential summit for these negotiations.
Zoltan, thank you so much. Zoltan Simon there in Budapest. Now let's get some more analysis with Anna Rosenberg, head of geopolitics at Amundi Asset Management. Thank you, Anna, for joining us. It does feel like there's, some weeks where it feels like centuries, and it just goes really fast because I still haven't 100% understood, if I'm honest, what Donald Trump wants from Ukraine and Vladimir Putin.
I think you're not alone in this. We've seen flip-flopping in terms of Trump's position, right? On the one hand, there is this desire to come to a peace deal and to distance Russia and China and to get this out of the way. And on the other hand, there are U.S. strategic interests which dictate that Russia remains an enemy and you have to support your allies. And we have seen this flip-flopping throughout. And now again, the pendulum has swung in one direction. He would like this to end, but the implications of it ending on the current terms are not good for the U.S. And that's the conflict that he's constantly under.
How do you think, this is impossible to know, but how do you think, this ends?
Our base case is that this war still is going to continue for a little longer. There clearly is momentum now in the negotiations. We have a lot of back and forth this week. We have Witkoff in Russia next week. However, when you compare both proposals, the 2008 peace plan that was put forward by the US and Russia, who knows, and the European response, and you look for overlap, there are certain areas where compromise is possible. But when you boil it down, the sticking points remain security guarantees and what Putin actually wants. Time is still on Putin's side. He has no reason to really find compromise yet. He's not weak yet. He still can go further. So at this point, there's mainly an opportunity cost on losing out on potential business deals, but this was never about business opportunities for Putin. It was always about geopolitics and making, the Russia bigger, and he still can go further.
And what do we know about this corruption scandal? Actually, in Ukraine, it feels big, and it also, I believe, leads to question marks from allies that may think, who exactly are we backing?
Look, this is a war. Wars are never clean. There's always, if you look at history, wars are moments in time when individuals try to amass huge amounts of wealth, right? You've seen this in the Soviet Union, when there's transitions of power. You've seen this throughout British colonial history. So I'm not surprised that there's corruption scandals going on. It is part of the mess that war is. It makes Zelensky look weaker. It erodes the moral high ground, and that is a challenge, and it increases the need for him to compromise, so it makes him weaker. But overall, it's the reality of war as well, and we have to be realistic about that.
What do we know about the frozen assets that many European countries, the frozen Russian assets that they want to use to help Ukraine?
So there are some that think that now that it was part of the 28th point plan, basically saying that the US and Russia are going to divide them up amongst themselves in a simplified way, that as a result you cannot go back to the debate of Europeans using the frozen assets as a collateral for helping Ukraine. I think that's incorrect. It doesn't mean that. Eventually, if the Europeans are forced between a really bad outcome or using that to continue to fund Ukraine militarily, they're going to back it up. And as we speak, there are many creative ways that they're currently coming up and trying to get hold of some of these assets, of finding some kind of extra funding for Ukraine, because ultimately it's still the cheapest way of guaranteeing European security. And we have had many episodes in the past where, in the light of crisis, the Europeans get together and find a resolution, and I would expect this to be the case here too.
And so one of the biggest stories also overnight is the fact that Donald Trump is demanding this reverse migration, right? A sweeping crackdown on immigration in the U.S. And with the team this morning, we were discussing whether this is geopolitics or whether this is domestic affairs to prop up voters and what it does to the labor market. How do you see it?
Well, in the first instance, it is domestic affairs. But what we see is a lot of the policies that the Trump administration has been pushing through are eroding the superpower status of the U.S. One of the key advantages that the U.S. has over China, for example, is attractive demographics. It has younger population. And if you kick out a lot of immigrants that generally are on the younger side, you erode your attractive demographics. And as a result, that doesn't help the U.S. on the big stage either. And again, it creates more distrust with allies, with other countries, and more uncertainty about what the U.S. is still doing.
I mean, does it have implications, for example, for the greatest technological war, which is U.S.-China?
Well, I mean, this still remains to be seen. It depends on how much the U.S. can continue to attract talent. And that is something we have to look at the detail. I would imagine that that's not necessarily a main impact, but again, we have to await the details of what this really means. Is he going to follow through, or is it one of those things that has been thrown out there?
I mean, it's been now 11 months, actually, since Donald Trump has been in charge. Is there an overarching theme that makes sense to you in terms of foreign policy? We kind of know what he wants for the economy, but what does he know, or what does he want the U.S.'s part in the world to be?
So I think the overarching theme for him is increasing U.S. power, but the result is the opposite. We have really transitioned very fast from unipolarity to multipolarity this year, and we're seeing this with how bold Modi, Putin, Xi have come up onto this world. He thinks that business deals are how you conduct foreign policy, but this is not the case. So the idea is increase U.S. power. The result is the opposite, and as a result, we're moving to a much riskier multipolarity. I think there's one key differentiation as well in Latin America, where he's really trying to expand U.S. reach, and that is a game changer compared to previous decades. But all in all, the conclusion is a much messier, riskier world where there's a lot more division and rearming and arms race and technology race.
Who wins in this?
I think middle powers that can, leverage each other. But the big question will depend on how the tech race is ultimately going to play out. We don't know that yet.
Anna, thank you so much, as always, for joining us. Anna Rosenberg, Head of Geopolitics at Amundi Asset Management. Coming up, we'll also talk banking and banking M&A, the use of AI to generate investment returns, and the future of Switzerland as a financial hub with the EFG Chief Executive, Giorgio Pradelli. That's next, and this is Bloomberg.
is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of the, wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make novel style.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European traders coming in after the Thanksgiving holiday have been wrong-footed by a technical issue at the Chicago Mercantile Exchange, halting the trade of futures and option contracts. Well, President Trump calls for a series of potential measures to crack down on immigration following an attack on 2 National Guard members in Washington by an Afghan national. And the Hungarian president is meeting Putin in Moscow to discuss energy supplies and Trump's plan to end the war in Ukraine. So as deal-making picks up in the banking industry, one bank keen to get involved in the acquisition spree is a Swiss private bank, EFG International. Now, the Zurich-based bank made 2 acquisitions this year and hopes for more of the same in 2026. Well, joining us now is Giorgio Pradelli, Chief Executive of EFG. Thank you, Mr. Pradelli, for joining us. So what specific businesses or geographies are you targeting, and how hungry are you for an M&A deal?
Well, it's good to talk about M&A on a Black Friday. Unfortunately, in banking and in M&A, we don't have this kind of days where you can get this kind of discount. No. Look, we are looking for acquisitions in the locations where we are present. Clearly, we are present in the major financial centers across the world, from Switzerland to London, to Luxembourg, to Hong Kong and Singapore, to Miami. So as long as we are present, we would like, obviously, to add some talents and capabilities, and the focus will continue to be that.
Are valuations looking expensive in your world, or actually can you find something reasonable?
Well, look, this is a very good point. I think valuations obviously are important, and generating a return on investment out of the acquisition is very important. But for us, what is critical and actually is our number one criterion for doing acquisitions is actually the cultural fit. And we need the last 2 acquisitions that you mentioned earlier, actually they were like partners coming together. We are probably the best growth story in private banking in the last 5 years. And so people like to join us. And this is what we are trying. We are trying to find partner, to add talent, and to, have a win-win situations.
Giorgio, you have some new targets. I think your return on tangible equity has been upgraded 20%. That's very ambitious. Do you worry about different cycles and the fact that you have to, remain in that no matter what the economy throws at you?
Well, that's a very key point. We have been trying to do well over the cycle. Our strategy, I think, is a true cycle setup and business model. We have done well over the last 7 years. We started this strategy of sustainable and profitable growth in 2019, and as you can see, there have been very cycle. We are already in excess of 18% return on tangible equity. Clearly, we need to maintain and grow further, but we believe that the targets are ambitious, yet realistic.
Talk to me about AI. Yeah. So a lot of the financial industry is trying to integrate it. I know a lot of family offices believe that actually it can change their outlook, or it can change the way that things are done. How much focus are you thinking of AI, and what does that mean for the bank?
Look, AI is going to, I believe, change financial services, like technology has changed financial services in the 80s and the 90s. Now we are we are doing the first steps to be fair, but we have introduced in our strategy for the next 3 years the concept of the augmented client relationship officers. Our clients will still want to have a person, an expert dealing with them, but the integration of one relationship manager with the teams of experts and with tools that will be all powered by AI, this is extremely powerful.
But this is what, 20% extra productivity? Does it cut cost, or is it difficult to
Well, I think it's difficult to quantify. I couldn't quantify at the moment, but I think it's going to be more than only productivity and cutting costs. I think it's going to be also huge in terms of improving the client experience, and this is one of also of our targets for the next 3 years, to improve our brand profile and to improve the client experience going forward.
How much do you worry about Switzerland as a financial hub? I know there's a lot of worries, for example, about London as a financial hub, and Switzerland is going through, U.S. tariffs, more regulation, competition from Dubai, Hong Kong, and Singapore, and at the same time, there's also this higher capital requirements for banks.
Well, look, I've been bullish about the Swiss financial centers also in years when many people were even more, let's say, pessimistic than today, and also, by the way, very bullish about London as a financial centers. And actually, I always talk that we have a two-pillar strategy, because our headquarter is in Switzerland, but also we have a lot of activities done. For example, our chief investment officer is here based in London. Our teams in asset management are here based in London. No, look, I believe that in our business, wealth management and private banking, Switzerland will remain the #1 location worldwide. Clearly, there is a lot of competition. There are many other financial centers that are trying, obviously, to emerge. But it's a bit, since we're in London, it's a bit like tennis, right? I think Wimbledon is still the #1 tournament. I think Switzerland will remain the #1 location. Now that the other locations are trying to emerge, I think that's also not bad. I believe in competition. Makes you better every day.
Okay, so a little bit of healthy competition has never hurt anyone. When you look at strong Swiss franc, again, how much of that is an issue for your profitability?
Well, look, that's a very good point. We have, as EFG, now I'm talking about EFG, we have about shy of 50% of our assets under management in US dollars. Okay. So I look the other way around. Obviously, we have seen a weakness of the US dollar in this calendar year. And clearly that has an impact. But, on the other hand, I've seen also, looking at Switzerland again, if you look at all the export industries, they have had a strong Swiss francs for decades. And the result is that they have improved their efficiency, productivity. Now, again, do I like it? Not really. But, we need to navigate the environment as we find it. I think 2026, maybe there's some headwinds, but for the medium term, the prospects are very good.
So there's not necessarily a natural hedge?
No, I mean, there are financial hedge. Actually, we were hedged this year. Yeah. There is a hedge for everything. We were actually hedged this year, which is good. Now we need to see, as I said, 2026. But yeah, we need to navigate the environment.
Your take on private markets? I'm throwing everything at all the big issues. I'm throwing everything at you.
No, look, I believe that private markets are very important. Our clients like private markets. Actually, as a firm, we would like to do more in private markets. Obviously, again, some people some years ago believed that private markets don't go through cycles. I think that's not right. Obviously, they also go through cycles. Maybe the cycles are a bit softened because you don't have the mark-to-market every day. But no, we are positive on private markets, and again, they have a key role in the asset allocation for our clients.
What kind of private markets? Again, no private markets.
Private equity, private credit.
No.
Yeah. Real estate. Our clients love real estate and infrastructure. I would say these are the key areas where our clients look.
Is there anything that worries you about the markets right now? Again, there's AI valuation. There's just a lot to be honest, to contend with. There's tariffs, there's geopolitics.
Well, when people tell me don't worry, I always say I'm paid to worry. So I worry about everything all the time. Now, I would say that the last couple of years, there has been a lot of uncertainty and volatility, yet the market were constructive. We have not seen a major correction. Yes, I'm obviously concerned that something could go wrong and something that, we have not foreseen is going to come in. Clearly, I'm looking at the bond market. I'm looking, obviously, at the valuations in the equity markets. I'm looking at the bond markets. The level of debt in the developed economies is the highest in a period of peace. So clearly, this is also an issue. I was on a trading floor in 1994 when the long bond went from 6% to 8%, and we had an havoc in the markets. So obviously, we worry about many things, and as I always say, and as I said on Tuesday during our Investors' Day, we try to navigate at best the markets and try to anticipate the trends. But for our business, the long-term trends are actually very positive because I believe in two things. I believe, number one, that entrepreneurs will continue to generate wealth, and at the end of the day, wealth management and private banking is about managing the wealth created. And second, this wealth, given also about geopolitics, private banking is geopolitical risk diversification. Wealth will move to, let's say, calmer harbors, and I believe that a lot of financial centers that we mentioned are, let's say, more of a harbor, shelter for some of these entrepreneurs.
Inheritance tax. So people in Switzerland, voters in Switzerland, will vote on inheritance tax, I believe, this weekend. What does it mean for your clients?
Well, this has been obviously a topic that has been debated. It's obvious that if something like that would happen, wouldn't be good for the way that the country attract wealthy individuals. Now, the polls at the moment say that this will be rejected. We will see. But I don't think that this will change the prospects long term.
Okay. Thank you so much for joining us. We went around the world there in like
Thank you very
10
much.
minutes. Giorgio Pradelli, the Chief Executive Officer of the Swiss private bank EFG International. Now, let's also talk about commodities and oil, headed for the longest run of monthly losses in more than 2 years as traders look ahead to an OPEC Plus meeting on Sunday. Brent on course for a fourth straight monthly drop in November amid concerns of a global glut. This comes as trading of futures and options on the CME stopped for several hours. Now, let's get more from Will Kennedy, Bloomberg's EMEA News Desk Editor. Will, it's nice to have you back talking oil. So what's the extent of the impact of this CME outage?
Very nice to be with you, Francine. Yes, it's quite a significant part of the financial markets that are affected here. Trade in WTI, the main US oil benchmark, of course, is not working, but also trade in lots of other futures markets, including S&P futures, Treasury futures, gold futures, US copper futures. So it really is affecting a lot of derivative markets, a lot of commodities markets, and this would be a day where we wouldn't have much liquidity, being the day between Thanksgiving and the weekend. But nonetheless, the longer it goes on, the more tricky it will be for traders who are looking to take positions in these markets.
I mean, of course, investors watching very closely what happens in Ukraine. How much does that impact actually the oil market?
It's a really interesting question, Francine. In some senses, we've noted over the past few years that the sanctions on Russia, the actions that the West has taken against Russia, have not actually impeded the flow of oil into the global market. That has tended to remain strong through use of the shadow fleet and tactics like that. However, I think there's no doubt in terms of sentiment, a peace deal, especially a peace deal that came with significant sanctions relief, which was part of the US proposal initially, would be bearish for markets. At the margin, it probably would mean more Russian oil could get into the market and would just remove some of the friction from global oil markets. So I think they would put a bearish interpretation on that, and that would come to a market which is already well supplied and looks increasingly well supplied going into 2026.
Will, what are we expecting from OPEC Plus?
Well, because of the outlook, the relative imbalance we see in the market, the bearish balances, OPEC, after increasing production to get back market share through much of 2025, signaled at its last meeting a month ago that it would pause production increases next year and hold things steady. And we don't think there's any reason to think that that would change. Talking to traders and analysts who follow OPEC, their expectation is very much that that policy will remain in hold and that OPEC will have to hold production. I think the question increasingly will be, as we go through next year, is there a point at OPEC feels that it has to cut production again because the market looks so oversupplied?
Well, thank you so much. As ever, Bloomberg's EMEA News Desk Editor, Will Kennedy. Now, China's top diplomat has used a call with his French counterpart to say the two sides needed to support each other, underscoring Beijing's push to win diplomatic backing during a spat with Japan. Well, Wang Yi said Japanese Prime Minister Sanai Takaishi had made provocative remarks related to Taiwan this month. The French President Emmanuel Macron is due to attend a state visit to China next week. Now, officials say Hong Kong's deadliest fire in nearly 8 decades has killed at least 128 people. This, as they say, fresh arrests have been made in connection with the blaze. Dozens of survivors remain in hospital, with hundreds more left homeless as a criminal investigation continues into the cause of the disaster. Our China correspondent Min Min Lo has more.
I'm just standing across from the site of the fire behind me, and we just heard some sobering numbers from the latest press conference. The current death toll stands at 128. 108 of the bodies have already been taken out of the buildings, but there are still 16 bodies remaining in the buildings right now. About half of those people died in their apartments, and there are at least 40 more bodies that are still of unconfirmed identities. And the government has said that there are about 460 cases of missing people unaccounted for, but they caution that there might be some duplicate cases as well. And a lot of attention now is on the cause of the fire. The authorities explained that the netting around the building had caught fire first, but the styrofoam boards helped to spread the fire quickly. And under the intense heat, the bamboo scaffolding had fallen apart, and that helped to spread the fire to other buildings as well. They also investigated the fire alarms, which were not working in any of the buildings, and the authorities said that they will be arresting the relevant people. It's just been an incredibly heartbreaking, not to mention very disappointing thing to hear for the residents here. But over here you can see this is entirely volunteer organized, that sprung up organically overnight. Here you can see clothes that are given out, and there are even pet food over there behind me. And right here you can see, of course, clothes. There are beddings, blankets, tents, shampoos, disposable underwear, everything you can think of that could help you sleep for a night comfortably. And just over there inside the mall, I found people who slept overnight indoors just in the corridors of the mall. And it's, they're all in a daze. I was asking them what are their plans for the coming days. And one man told me he hopes to be able to return home tonight, but that just seems like an unrealistic expectation for now. Min Min Lo, Bloomberg News, Hong Kong.
And of course, we'll keep you updated on the situation in Hong Kong as news comes in. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back, everyone. Now, the fashion retailer Zara may have been one of the pioneers of fast fashion, but with China's Shein and Temu undercutting that market, Zara is now looking to pivot into the high fashion segment. That's the subject of today's Big Take, which also coincides with the retail bonanza that is Black Friday. With us now, Bloomberg opinion columnist Andrea Felsted and Ashley Wallace, head of European Consumer Goods Research at Bank of America. I mean, there are so many questions about what we're buying, what people want in the U.S. compared to Europe. But Andrea, first of all, if we just focus on Zara a little bit, like what are the segments that work? And with the arrival of Temu and Shein, does Zara have any choice to go slightly up market?
No, I think they have been going up market for, I'd say, the last couple of years. And that is the right thing to do because the luxury segment has raised prices so much, it has priced many people out, especially the aspirational consumer. So there's a lot of white space for other brands to go for. We've seen that with Coach in bags, with people like Cézanne in clothing. And Zara has a real opportunity to go more up market and capture some of those sales that would have gone to the luxury brands.
Overall, I mean, what works without talking, about Zara specifically? Are we buying clothes? Or are we buying beauty? And is there a price point that's like the good spot where everybody wants to be in?
Well, actually, quite interestingly, in context to Zara, I think one of the opportunities that they've been able to see over the last couple of years is the fact that we've gone through a world where the dominant fashion aesthetic is called quiet luxury. And so we're in a world where the logo is less present, where it's more about the quality of the material. And that means that from a consumer perspective, you can be in fashion at any price point. So you can spend thousands of dollars for Loro Piana, Brunello Cucinelli, cashmere jumper, but you can also be as in fashion by shopping price points all the way down to Zara for very similar, at least from an aesthetic perspective, product overall. So I do think that the fashion element of quite luxury has probably been quite helpful for players like Zara.
And I mean, are people buying like high-low? So is it pieces from Shein and then Louis Vuitton, or is it Zara and Cézanne?
I think there is high-low. I think Zara is still, despite the best efforts, I think it is more low, where you mix pieces from Zara with more upmarket pieces. You maybe still buy the bag, but you buy all the shoes, but you buy the clothes in Zara. So I think, yes, they are definitely benefiting from that high-low approach.
Actually, where are people spending? I know you had the Bank of America, but Paris conference. Mm-hmm. So what did you learn? Are people, again, travel also comes into this as more people travel in luxury, or maybe we'll book, we'll travel with EasyJet, but then book a really nice hotel. Mm-hmm. So when you look at discretionary spending, how has that changed over the last 2 to 3 years?
Yeah, so in terms of discretionary spending overall, what we are seeing is the consumer shop more and more around these important shopping holidays. So a bigger share of wallet is shifting to Black Friday, to Double 11 in China, to Christmas, and this is where we're seeing demand pick back up, but it's the period in between that becomes a little bit tougher for the consumer overall. In the conference last week, we learned a little bit about Double 11, which has just finished in China, and what we saw there was the beauty category actually do quite well, so with net sales for beauty being up somewhere between high single digit and low double digit, international brands regaining some lost share from the local players, luxury, so premium beauty outperforming mass, so things to kind of point to a more healthy backdrop for consumption across the beauty category in China going into 2026. basics. As we think about Black Friday, which is obviously a very important shopping holiday, especially in the US, I think that there's reasons to be optimistic around what will happen this year. Part of what we've seen in Q4 so far is actually a sequential acceleration in consumption across the luxury category, and that's true for handbags and soft luxury, but also for jewelry, actually being particularly strong. Whilst neither of these categories are necessarily categories you can buy on discount during Black Friday, again, cosmetics is a very important component of the Black Friday week. So actually, this week coming up is 12% of Q4 revenues for beauty companies. So a big proportion of what will happen for the rest of the year is basically determined this week. For luxury, it's a little bit different, actually. What we see in terms of purchase behavior is there's a lot more spend that happens in the weeks leading up to Christmas, which become more material.
And we've talked about this in the past, Andrea, that a lot of these, really high-end luxury, they've just put up the prices too much, and at some point it really bit them. Or we see, they can't really reverse. You can't buy a Chanel bag for $10,000 one day and then they put it down to $8,000. But can they do anything to mitigate that, to accelerate demand?
What they've been trying to do is to move into more accessible categories. So we've seen beauty is very popular with the luxury brands. We've seen small leather goods return. We've got those mini bags that everyone's carrying, bag charms, jewellery. You think of jewellery as you think of jewellery as very high end, but it actually has, one of the reasons it's done well is it hasn't had the price increases that the luxury brands have had, and some brands have even, they're introducing jewellery, but also smaller watches, which you can charge less for. So there are all these ways to try and reclaim that aspirational customer.
Actually, how's e-commerce doing? I know in the US it's probably doing better than in stores, or is it like 50-50?
No, this year, actually, what we've seen through the year is actually e-commerce start to regain some of the momentum that it had lost the last couple of years. And this is also true in the luxury area as well, that there's outperformance of e-commerce again after 2 years of underperformance. And that's quite important because it means that you can address a much wider customer base. And coming back to the point around pricing, actually what we're seeing a lot of the luxury brands do is introduce newness at lower price points. So mix is actually negative, despite the fact that pricing has moved up a lot. That's a way to address the volume issue that exists in the sector. And that's going to be helped next year because we have 20 brands with new creative directors. So there's a whole wave of newness also coming into stores next year, especially around soft luxury. That will help probably encourage consumers back into the stores and into luxury brands again.
So do you have to start a sister line for the lower price point, or is it just a category?
No, it's not necessarily a sister line. It's more about newness. So like a handbag that can be canvas instead of leather at $1,000 rather than $3,000, and that kind of address a different type of clientele. I actually think that some of the companies that have done the best job of this is actually jewelry. So as jewelry brands have been taking prices up, and as you've seen that price increase actually be very much supported by gold rally and raw materials or commodity prices, what we've seen actually many of the jewelry companies do, especially Cartier has been doing it fantastically well, is adding back smaller and medium variations of classic products. And that means you can price segment your clientele in a very different way, and you can still capture that customer that maybe can't afford necessarily to stretch all the way up until where your new pricing is, but allows you to satisfy the volume demand that exists in the business.
So interesting. Thank you both for joining us. Bloomberg opinion columnist Andrea Faustin and Ashley Wallace, head of European Consumer Goods Research at Bank of America. Now, we do have a busy Friday. There's quite a lot going on. Remember, there's this computer glitch over at the CME, which means that some CME futures has been disrupting trading across global markets. If you look at stocks overall, look, Europe is flat. It's very clear that the S&P 500 was, before the outage at the CME, on course for its first monthly loss since April. Up next, Bloomberg Brief, and this is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Estava sitiada.
Nisso eu começo, eu também não sabia o que fazer. Foi a
mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering, and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Good morning, I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A futures outage at the Chicago Mercantile Exchange disrupts trading across global markets. President Trump, meanwhile, calls for a series of potential measures to crack down on immigration following the shooting in Washington. And the holiday season shopping kicks into high gear for retailers and consumers, but consumers showing signs of fatigue. Well, let's get a check on these markets. It was always going to be a quiet one this Black Friday, and it's even more quiet because of this CME outage. So in the absence of S&P futures, we have to look to ETFs. But the indication is that we are going to have stocks continuing higher in today's session. Flip the board over and you can already see what's happening in the European session. In short, a whole lot of nothing. You've got Stock 600 flat to the downside there. The FTSE 100 managing to eke out gains. Euro dollar there at a 116 handle, weaker after that French inflation data unexpectedly held steady. We had Spanish CPI staying strong. And we keep an eye, of course, on the 10-year gilt yield as traders continue to digest that UK budget, currently at 4.44%. But let's get into some of the stocks to watch this morning. Here's Chloe Melly.
Good morning, Lizzie. Let's start with Oracle, which is down today after Morgan Stanley analysts warned that a gauge of risk on Oracle's debt had reached a 3-year high, and that is probably only going to get worse in 2026, they said, unless Oracle manages to reassure investors that are currently quite worried about this massive AI spending spree, and therefore we are down about 1.3% for Oracle this morning. Moving on to SanDisk, and it is the first day of trading on the S&P 500 for that memory card maker, and it's a pretty good day. We're up almost 6% this morning. A lot of that has to do with a report that the US and Japan are considering a memory chip plant in which SanDisk would be a major investor, and so we're up this morning for that company. And finally, of course, CME Group seeing a little bit of weakness this morning on the back of that CME outage, which has disrupted markets across equities, FX, and everything else, and has really frustrated investors, and we can see that reflected in some weakness for that stock, that CME Group stock.
All right, thank you, Chloe. And coming up this hour, BNY strategist Jeffrey Yu on the markets. And we'll hear from Freya Beavish as well, chief economist at TS Lombard. But as you say, Chloe, trading of futures and options on the CME, the Chicago Mercantile Exchange, have been halted for several hours due to a data center glitch. Bloomberg's Kriti Gupta joins us now to explain. And Kriti, I feel like on your last day in London, this is the perfect story for you. We get to talk about the plumbing. Just walk us through the ripple effects of this glitch.
Yeah, you and everyone know I love a little exchange drama here. This one's really interesting. I mean, the argument is this the good day to have a problem like this or a bad day to have a problem like this? Let me walk you through it. Basically, what you're seeing is that the Chicago Mercantile Exchange, which, by the way, is traditionally known, what we traditionally associated with is commodity contracts coming out of Chicago, so things around cattle, wheat, etc. Well, they also do a lot with options and futures contracts, things that help the international audience actually trade American contracts, whether it's early S&P 500 E-mini futures, whether it's NASDAQ futures. So basically, while the U.S. markets are closed, how do you trade U.S. assets? Turns out this is the exchange that runs a lot of them. A data center that they rely on, operated by CyrusOne, seems to be having a technical glitch. They've called it and referenced a cooling issue that is in the works they are trying to solve. But Lizzie, we are now at hour 7, hour 8 of this outage, something that is, to your point, affecting pricing. Traders around the world flying a little bit blind. But again, here's the good news. The good news is it's the day after Thanksgiving in the States. It's light volume. A lot of people who are trading or positioning around any kind of risk events going into the holiday probably did it before or will do it after everyone comes back to the desk. The bad side of that is that when the U.S. markets open, if you do see some sort of bigger risk event between now and 9:30 a.m. Eastern, there may be a little bit of a shock factor when those markets do open.
All right, Bloomberg's Kriti Gupta walking us through the plumbing. We thank you so much. And as we say, stocks losing momentum on the final trading day of the month, despite the growing bets on a December rate cut by the Federal Reserve. Jeffrey Yu, senior strategist of EMEA markets at BNY, has written, despite indications that both equity and bond returns look to set to end the month on a positive note, there is a clear safety bias in play. And Jeffrey joins us now. Good to see you, Jeff.
Thank you.
Kriti just set out everything that's going on with the CME outage. I wonder if you expect to see disruption. Usually we'd be talking about positioning into December.
So it's interesting, and I would agree with the notion that it's actually a good day to have something like this on top of the holiday-related positioning she mentioned. It's also, month end. We've had sort of a later Thanksgiving for this year. So in a risk context, what month-end rebalancing you were looking at, people probably would have done that already. Or if you had a month-end bias, wherever futures would have pointed to an opening, your direction was probably set anyway, because there wasn't any other sort of market-moving news and for you to adjust month-end. So right now we're doing the best for our clients. It's BAU. Some talk about on the trading desk this morning, but again, focus is for our clients.
All right, and I've got to talk to you about the UK budget, because the last time we were sat together on set, do you remember the Chancellor was rolling the pitch to raise income tax? Of course, she U-turned on that. But let's just talk about the market reaction to this budget. I'm looking at the 10-year gilt yield now, flat as a pancake, 4.44%.
Right.
The market was a bit nonchalant, shall we say, initially. Do you expect this focus on the headroom to pivot and actually for traders to focus more on the backloading of the fiscal consolidation at some stage?
So at some stage, yes, but actually that was sort of the talk throughout the day as well after the initial, so slightly earlier than expected release of the headlines as well. But one thing I will say about gilts, though, is still probably biased towards a more positive outlook for gilts, mostly because positioning heading into that was relatively flat. One thing that I'm keen on over the medium to longer term, and here's where the BOE's QT operations, comes into it as well, is the maturity breakdown. We know that the UK has traditionally had very long maturity profile, and that was seen as a strength. But now the market's demand for that, not just in the UK but globally, has softened somewhat. We've seen that in our own flow data as well, reduction in maturity exposures. So from the DMO's point of view, I was actually a bit more focused on that. Where the distribution is going to be a bit more focused on the front end. I think this is something the market will have to absorb over time.
I mean, you mentioned the Bank of England. The budget did less to fight inflation than was expected in the weeks running up to it. For example, lifting the minimum wage. Does it change your view on BOE cuts?
I think the market pricing for the BOE is still a tad more towards the conservative side, and I mean that I think the BOE can actually do more next year because I think the OBR's projections and actually had 3.5% as sort of their baseline. I think we can actually go below that 3.25. I'm not even ruling out 3. Now, on the plus side for the Chancellor is if that shift not just the front end, but the entire curve lower. And if they're going to issue on the front end anyway, it may save a bit more in terms of interest and costs.
Should like the sound of that.
Indeed, but overall, the data is pointing to softness. And when we saw French inflation data this morning, German retail sales, so the German data, waiting for that too. All over Europe, it seems, household demand is softening, notwithstanding the strong wage gains, and I think that's going to support the case for further easing.
But if Reeves has allowed these BOE cuts to happen, and maybe more, in your view, what's the upside left for cable?
Well, I think cable, from the whole market's point of view, why cable didn't react more negatively heading into this was because everyone was sort of bearishly positioned. I would say from cable's point of view, you're sort of running up against more of a dollar view on that point. So given our view on the dollar, is the dollar that easy to buy at this point? I think you have to match the two together. But in terms of relative value, we're looking at sterling against CAD, sterling against Aussie. I think this is where sterling may underperform a bit. Yeah.
And for the Fed, is it a choice between December and January?
I think the market's looking at December now. I know we've been on a bit of a roller coaster, but the positionings are shifted towards that. I think it's heading into next year. For December, how do you actually communicate the views heading into next year? What's the pace? And again, what's the labour market going to look like? That's what we're zeroing in on, especially as data starts to come through again.
Well, speaking of the views, of course, the market reaction to Kevin Hassett being the front runner, apparently, to be Fed chair was not crazy, actually positive. Do you have no concerns there? Does the market have no concerns about Fed independence under his leadership?
I think the market's just looking at central bank independence versus the fiscal concerns in general right now. So, we've had speeches from plenty of finance ministers globally regarding, where they feel rates need to be. So this isn't new at all. I'm looking at Central Eastern Europe, for example, where the language, the pushback, I would say, from the central banks is actually a bit more strident. And this is an area where we've sort of been positive in terms of positioning. So how to manage that? I'm hearing fiscal dominance, this phrase coming through more and more, and I think that is going to be a crucial theme for asset allocation next year, especially fixed income markets, how they manage their bond portfolios.
Just finally, Jeff, if Fed cuts are priced in, what drives a tech Santa rally?
Well, a tech Santa rally, I think it will be earnings, it would be data, and overall, given that, as mentioned, a safety bias, we saw that across markets in November, simply positioning for no new news, both on the individual corporate side and on the policy side. I think that's more than enough, for a brief rally, given how the market's positioning beforehand.
Do you know what? I'm not sure it's going to be a quiet December, but we'll see. Jeff, thank you so much. Jeff Yu of BNY, always good to see you. Well, now to some other top stories trending on the terminal this morning. The Zara chairwoman, Marta Ortega, is trying to push the retailer into the rarefied world of high fashion, nudging it away from the fast fashion industry that it spawned. Zara's winning fast fashion model still underpins it as Shein and Temu reshape the $1.8 trillion global apparel industry. Ortega's eyeing a sweet spot with haute couture brands hiking prices to stratospheric levels. Elsewhere, Russian President Vladimir Putin said that President Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during the talks in Geneva, which can be the ground for talks. According to reports, the Kremlin will be discussing the peace plan next week. And Hong Kong's deadliest fire in nearly 8 decades has killed at least 128. The status of roughly 200 residents remains uncertain. Authorities have arrested 5 people linked to the estate's renovation project. According to the Labour Department, inspections had been flagging risks well before the disaster. Well, those are some of the top stories trending on the terminal. But coming up on the programme, President Trump calling for a permanent pause on migration from, quote, all third world countries. We'll bring you the details on that latest immigration crackdown next. This is Bloomberg.
Used to be, one would say, what's that got to do with the price of tea in China?
when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg. Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Well, President Trump says that he'll, quote, permanently pause migration from third world countries. In a lengthy post on Truth Social, he said that anyone who is not a net asset to the United States would be removed. It follows the death of National Guard member Sarah Beckstrom, who was shot near the White House by a suspected Afghan national. A second guard, who was also shot, remains in a critical condition. We can get the details now with Bloomberg's Alexander Pearson, who joins me now. Alex, good morning. Just walk us through the specifics here, particularly wondering the definition of third world in this context and how quickly these measures can be implemented.
Good morning. Yes, that's the question actually a lot of us are asking this morning after we saw this Truth Social post from President Trump several hours ago. As you said, he has announced a policy of stopping all migration from all, as he puts it, third world countries. But he did not in that post define which countries actually meet that criteria. So it's unclear right now who would actually be affected, what the kind of impact on migration flows would be of that kind of ban. And so we would really be waiting for a proclamation that would, list these countries and then also what kind of legal path forward the Trump administration would seek to try and implement the ban. So it's unclear how quickly he could move ahead on that, although he might be able to move quite quickly if he implemented it in a similar way to his travel bans of the past. And then in terms of the other policies he announced,
Well, I wanted to ask you, Alex, how this will affect the labour market, because, of course, this has economic context.
Absolutely. I mean, migrants from developing countries, if that's what he meant by that term, tend to be lower skilled. And certainly if this were to be implemented and affect migration flows of lower skilled workers to the US, that could certainly have some impact on the labor market. We already saw some of that impact this year in terms of, causing labor shortages in sectors like agriculture and hospitality.
Alex, thank you so much for the latest there. Bloomberg's Alexander Pearson on that Trump's Truth Social post. Well, retailers are heading into this holiday season looking to attract budget-conscious shoppers amid continuing inflation and tariff pressures. Bloomberg's Romain Bostick sat down with the Bloomingdale's CEO Olivier Bron and the Burberry CEO Joshua Schulman to get their expectations ahead of the holiday shopping season.
'Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. all in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, you know, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic Made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by J.P. Morgan shows that consumer demand for luxury goods in the U.S. has largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, you know, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas, so I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
That was the Bloomingdale's CEO, Olivier Braun, and the Burberry CEO, Joshua Schulman, speaking to Bloomberg's Romain Bostic ahead of the holiday shopping season, getting us in the mood for a little retail therapy. Well, coming up on the programme, the AI race heats up. Tech titans amassing multi-million-dollar war chests. That and a look at what else is making headlines on the front news off the pages. This is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to like unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Lizzie Burden in London. Time now for your front page news. First up, on the Washington Post, one member of the West Virginia National Guard, U.S. Army Specialist Sarah Beckstrom, has died after being shot near the White House. In the wake of the shooting, President Trump said that he'll, quote, permanently pause migration from third world countries. The suspect, who's an Afghan national who previously worked with the CIA, will face multiple criminal charges. Next up, we turn to the Wall Street Journal. Billionaires and tech titans are amassing multi-million-dollar war chests for a battle over AI regulation. Donors have already committed well above $100 million.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
It is 5:30 a.m. in New York City. Good morning. I'm Lizzie Burden in for Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A futures outage at the Chicago Mercantile Exchange disrupts trading across global markets. Meanwhile, President Trump calls for a series of potential measures to crack down on immigration following the shooting in Washington. And the holiday shopping season kicks into high gear for retailers as consumers show signs of fatigue. Well, let's get a check-in on these markets. Happy Friday, by the way, everyone. Happy Black Friday. It is the last trading day of the month, and it was always going to be a quiet one, but it's even more quiet because of the CME outage. So in the absence of S&P E-mini futures, we've got to look at ETFs this morning. The indication, though, is that stocks are going to continue higher in today's session. Flip the board over and we can take you to what's already happened in Europe. In short, not much. The Stock 600 flat as a pancake almost. The FTSE 100 managing to eke out some gains. Euro dollar there weaker 0.25% at a 116 handle. We had French inflation unexpectedly holding steady earlier. And of course, we've got an eye on the 10-year gilt yield as traders continue to digest that UK budget. 445 is where we trade right now. And so we are up a basis point there. Not a lot of movement, really. But look, trading is going to resume in the US this morning. For some stocks to watch, here's Chloe Melly.
Good morning, Lizzie. Oracle is down this morning after Morgan Stanley analysts warned that a gauge of risk on Oracle's debt had reached a 3-year high, and they said that things were only going to get worse in 2026 unless Oracle manages to reassure investors that are currently quite worried about the magnitude of this AI spending spree, and therefore we are down about 1.3% for Oracle this morning. Moving on to SanDisk, which is up. It is the first day of trading on the S&P 500 for that company, and it is doing pretty well so far. A lot of that has to do, of course, with the US and Japan reportedly considering a memory chip plant in the US with SanDisk as a major investors. And finally, CME is a little bit weak this morning after, of course, that CME outage that disrupted markets across FX and commodities, and that really frustrated investors. And therefore, we are seeing a little bit of that weakness, not major, but a bit of weakness for CME Group this morning as well.
Okay, thank you, Chloe Melly. Well, trading of futures and options on the Chicago Mercantile Exchange still halted this morning, as Chloe says, due to that data center glitch. We can bring in Bloomberg's Rachel Evans for the very latest. Rachel, any update so far?
Not yet, though we live in hope. It's been going on for sort of 8 hours almost now, and so far we've had very little information beyond the fact that this is some kind of issue at a data center. It seems that there is a cooling problem, whatever that might entail, and I'm sure there are people working very hard to fix it, but for now it means that markets are largely trading in the dark. Obviously we have kind of some of the bellwethers like oil, WTI, we're not seeing at all, but we're also not seeing kind of futures on treasuries or some of the FX futures as well. That makes it very, very hard for people to be hedging in the markets. So we're seeing kind of depressed activity as a result of that kind of across the board.
All right, Bloomberg's Rachel Evans, we thank you so much. Happy Friday to you, Rachel. Well, from that lack of data to a data leak, the Office for Budget Responsibility here in the UK is bringing in a cybersecurity expert to uncover how the details of the autumn budget were leaked early. Freya Beamish, chief economist at TS Lombard, writes of that budget: it was a pointless exercise in shifting borrowing to fit the forecast. The OBR tail continues to wag the dog. And Freya joins us now. Well, didn't hold back there, Freya. I take it you don't see it as a success. I was discussing this with Jeff Wu earlier. Are you surprised that the market is focusing so much on the headroom aspect of this budget and not really on the backloading of the fiscal consolidation?
Yeah, no, I think the government sort of painted themselves into that corner with the fiscal headroom, which is not something they actually needed to do. When we take a big step back here, the UK is actually one of the only major economies that is at least trying to consolidate the budget. I use the word consolidate rather than austerity because, unfortunately, George Osborne ruined the word austerity for everyone in the 2010s. So an actual consolidation of the budget isn't actually the worst thing for the UK economy at this point in time. It's not as though the private sector needs to deleverage. And so consolidation is just the natural thing to do at this point in time. It's just the way in which the government is trying to do it is too, actually, I would say, beholden to short-term bond market moves. And also is the wrong form of consolidation. So rather than sort of tax and spend, maybe we should think about that spending side.
I think that's really interesting because I've spoken to Rachel Reeves a number of times, and my impression is that she is so scarred by the Liz Truss experience. She knows that she's got to keep the bond vigilantes in check, but you're saying that she's got them too much on the brain at the expense of a sensible budget.
Yeah, I mean, the Truss-Kwarteng debacle was not representative, I think, of what a true growth budget would look like. And she came in promising to deliver that growth budget. But when you look at the actual trajectory of government spending and the taxation that has to be raised in order to finance that government spending, what's happened is that there's been a big jump in government spending as a result of COVID. Fine, absolutely normal. But then there's a jump in all forms of government spending, and the trajectory since COVID just continues on the COVID trajectory as opposed to the previous trajectory, right? So there must be some wastage there in government spending. And if we were actually to, maybe an independent review could identify what that was, cut through some of the lobby that is now associated with that spending, bring down spending, and then actually get to the tax side of it. I don't think the bond market would mind that much. It wouldn't be their favorite thing in the world, but that would actually be beneficial to equities. Whereas at this moment in time, you're not helping the bond market, you're not helping the equity market, you're not helping the real economy.
Well, the OBR agrees with you that this budget does nothing for growth. Does that mean that more tax rises are inevitable? She wouldn't tell me that they're coming, but is the truth that they are?
Well, what happens is there's this sort of, and this is the OBR tail wagging the dog element. So you get sort of a downgrade in productivity growth, and then as a result of that, there's less fiscal headroom, and then as a result of that, the government needs to find some way of closing this so-called fiscal black hole, which is just an egregious misuse of physics. But to actually do that, they're doing that through kind of tax rises, but they don't want to do that in the short term. So what happens is they popped up the government borrowing in the short term, and then they just push all of the taxation increase, or a lot of it, into in this case, 2029.
But that's the point. Like, does the market believe that's actually going to happen when, lo and behold, we're going to have an election in that year?
Exactly. I don't think that's going to happen, and I don't think the market thinks that's going to happen. It didn't actually move so much on the day, but we already had the trial balloon, and the market had already moved as a result of the trial balloon. I think the likelihood of this kind of tax and spend policy continuing even within the Labour Party to the general election is not very high because it doesn't actually help anyone. It's not popular with anyone, and Reform is close on the heels and ready to sort of pounce on any mistakes there.
Well, look, Freya, we've got to talk about the Fed as well, because we're also looking ahead to a potential December Fed cut, now priced in by the markets. If Powell pivots on so little data, would that undermine his credibility brackets further?
Right. Now, there is a theory that we've got on this, and I have to give credit to my colleague Dario Perkins. It's an interesting one. I think we had quite a clear signal in October for a normal Fed that they weren't going to cut. We're going to wait a cycle, but not going to cut by any means. These were quite clear signals for a sort of a maestro type of a Fed chair that they weren't going to cut in December. And then we had Williams coming out and saying, actually near term there probably is going to be a cut, which is a good indication that there is going to be a cut, right? So what's the game here? Pure speculation. Forgive me for the speculation, but I think if anything, Powell is trying to sort of undermine the chair position because he knows where it's going.
Right.
And so if you have a more Bank of England type of monetary policy setup in the US, where things are more divided, there's more of an independence in terms of what people vote on and how people vote, rather than just following the chair in a Greenspan type of a way, then that kind of chair position is somewhat diluted. I hope I haven't let the cat out of the bag there.
That is quite the theory, Freya. I also got to talk to you about this announcement from President Trump that we would talk about earlier on migration, pausing third world, quote unquote, migration. What does that mean for the labour market?
Well, we already have quite a serious deterioration in the non-farm payrolls. Break-even's probably down to about 60, just based on the current immigration policy. Just based on if we get the detentions up to 1,200 per day, that means an NFP break-even of about 60. So already with what's in the system, we're already going to have quite a lot of supply disruption. I don't know, how much of what Trump has said recently actually comes into practice. It could just be a sort of an on-the-day reaction type of a thing. Probably most likely that's what's going to happen. But any form of further supply disruption is going to reinforce our case for a strong inflationary problem next year. We're talking about a positive fiscal impulse that's going to benefit the middle income section of the distribution, probably some more that's going to come through in terms of rebates benefiting the lower income section of the distribution. We've got the Fed cutting into that reacceleration. And against that, we've got a quite severely disrupted supply side with regard to the labour market and the goods market. So that is a recipe for inflation, to my mind.
Now, we also got to talk about the Eurozone economy, finally, Freya, because we had that French inflation data earlier this morning and Spain. Where does it leave cuts for the ECB? Which way do you see the inflation risk skewed? Is it cuts that we should be talking about, or is it actually hikes?
Yeah, I think as we go into next year, and particularly in the second half of next year, I think that sort of bias will shift more to a tightening bias. Whether that's premature or not from a macroeconomic sense, maybe, but they're always going to be focused on what is the kind of the reflationary prospect from German fiscal policy. I see that as quite a benign reflationary prospect for the bloc as a whole. I don't think that's priced into equities at this moment in time. But from the ECB's perspective, they're always going to kind of do what they perceive to be their job and protect the economy from that inflation. And from a euro standpoint, that makes us positive on the euro in the kind of the risk-on environment that we see for the first half of the year, as the communication gradually shifts towards more of a hawkish bias, protecting the economy against inflation, while you have that kind of pro-cyclical demand-led story that you have emanating from fiscal policy and probably the capex response from the private sector as well.
All right, well, great to see you, Freya. Thanks for coming in on a Friday. Freya Beamish there of TS Lombard. Now, I want to take you to some breaking news, and this is that talks for the UK to join the flagship EU Defence Fund have ended in failure. The negotiations have been ongoing. This is according to sources speaking to Bloomberg. Despite the talks between officials that have gone on this week, the two sides remaining far apart, according to these officials, on the financial contribution that the UK would have to make. And this is to stay in the Security Action for Europe programme, known as SAFE. And they've been speaking to us on condition of anonymity. But this is a €150 billion fund. It's meant to help Europe rapidly expand its military forces in the face of Russian aggression. But as we say, the talks appear to have ended in failure. So that's the latest there. But let's get you some other top stories trending on the terminal this morning. China's top diplomat has used a call with his French counterpart to say that the two sides needed to support each other, underscoring Beijing's push to win back the diplomatic backing during a spat with Japan. Wang Yi said that Japanese Prime Minister Sanae Takaichi had made provocative remarks related to Taiwan this month. French President Emmanuel Macron is due to attend a state visit to China next week. Elsewhere, Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. TSMC has sued Lo Wei-jen, alleging high likelihood that he shared sensitive information with Intel, something that the US company denies. And Hong Kong's deadliest fire in nearly 8 decades has killed at least 128 people. The status of roughly 200 residents remains uncertain, and authorities have arrested 5 people linked to the estate's renovation project. According to the Labour Department, inspections had flagged risks well before the disaster. Well, those are some of our top stories coming up on the programme. Black Friday kicking off the holiday shopping season. Up next, how retailers are handling President Trump's sweeping tariffs. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Lizzie Burden in for Vonnie Quinn in London. And it is, of course, Black Friday, the unofficial start of the holiday shopping season. And Bloomberg opinion columnist Andrea Felsted writes that this year retailers are trying to rein in discounting to cope with the impact of President Donald Trump's tariffs, while at the same time many shoppers are still under pressure and searching for the best value for money. Andrea's with us to talk about that dynamic. Andrea, it's payday. The West End awaits us. Yeah. The deal's going to be good this year.
They are. I mean, I was really talking about the US in that piece that you showed. I think they're very good in Britain this year. There's been a lot of uncertainty in the run-up to the budget, so people were very cautious, and we saw that in retail sales. We also had some warm weather at times. We had a few cold snaps, but for long periods it was warm. Lots of coats and boots have got money off, and beauty is the other area where the discounts, I mean, I haven't done this systematically, but just looking at what's coming into my inbox, they look a lot deeper than last year. And a lot across the board, we've got a lot of blanket discounts, which is never a good sign.
Okay, and so is it a similar story in the US?
I think in the US, the retailers are really trying to control the discounts because of tariffs. So one way, there are a couple of ways you deal with tariffs. One is you're very selective in when you put up prices. So you put up prices in the nice-to-have items, but you keep the things that people really need every day. You try and maintain price as much as possible. The other way is to be less generous with your markdowns, and that's what we've seen. I got some research, and it showed that in areas that were more hit by tariffs, the discounts were still there, but they weren't quite as deep as last year in things like electronics, household appliances and toys, 3 areas that really have been hurt by tariffs.
It's like a Mexican standoff, isn't it? Who blinks first, shoppers or retailers?
Exactly.
So if it's a bad Black Friday for retailers, is it a good Black January for us, the shoppers?
Definitely, I think so. Yes, I mean, I think in Britain we have got some good deals already, and I can't see a lot of retailers going back up to full price between now and Christmas. I think in the US we're just going to have to see. Shoppers are under pressure. We'll see what they buy. What we saw in Prime Day was actually that it was a very good Prime Day, but it was because people didn't treat themselves. They bought things for back to school. They bought things for household essentials, which was, you know, showed the sort of distress they were under.
Now, going the other way, pricing upwards,
Yes.
we've got to talk about the story on the terminal today about Zara. It's really a fascinating read. You basically got the heir to Zara trying to take the company in a different direction.
Exactly.
But is this going to work? Is the quality good enough to justify it?
Well, they already have been doing this for a couple of years. They've been gradually, you know, moving the range upwards, and that's a very smart thing to do because the luxury brands have raised prices so much that you've got all this white space. The aspirational luxury, particularly, sort of, you know, the not super rich, the sort of merely comfortable. A lot of those people have been priced out of luxury, so they're looking to shop somewhere else. So you've got the brands like Coach that is quite well priced, but also done a great job with Gen Z, doing very well. Ralph Lauren, which has some sort of lower, you know, more premium than super, although it has the high end too, but some of its brands are more premium. You've also got, you know, people like Cézanne doing well, filling in that white space. So this is perfect area for Zara to go into. My issue is I don't think they've elevated the quality.
That's my point.
To match. I don't. So I went to this store when I did my piece about Zara a couple of years ago. I went to this beautiful store in just off of Sloane Square. Absolutely lovely store. But there was a jacket and had a bit of thread hanging out of it. And, you know, you're asking people to pay more. You've got these beautiful stores. You can't have a jacket with a piece of thread hanging out of it. Just a simple thing you should be getting rid of.
Well, yeah, that's the thing I wanted to ask you. Are you going to still have the fast fashion, I know they don't want to call it that, but the fast fashion range and then have the high-end range all on the same floor?
I think you will, what you will do, they will still want to keep some of those prices at entry because you've got people like Shein and Temu taking more of that. But they will increase it. I think they'll segment it. So some of the new stores are really beautiful. Things like underwear, they have like their own sort of little shop for underwear, and sort of underwear that, you know, lace is very lace trim, sort of lace trim tops, things like that. You know, you can have those too in it. But this beautiful sort of area that wouldn't have looked out of place in a, you know, an upmarket store in a nice department store. So I think you'll increasingly see the store design having a bit of segmentation, but you will still have your, you know, your entry price level there because they can't afford to lose those. They can't afford to make the same mistakes as the luxury brands and lose those more, you know, entry-level shoppers.
Well, you heard it here first. Get your undies from Zara. Look, we've got to talk about Gucci as well. So first of all, you had Kering poaching the Renault CEO, Luca Di Maio, to do a turnaround. Now you've got Gucci naming a former Renault exec to be a CFO. This is the cars to fashion logic, are they leaning too heavily into it?
It was inevitable he would make people changes. I mean, it's one of the things we've all been watching. He's already done some reshuffling. So I think this is inevitable. My own view is that Gucci and Kering, you know, as a whole, is very different from a car maker. You know, okay, you've got to do things like strengthen the balance sheet, cut costs, get the debt down. But what's different in a luxury brand is it's that creative spark that makes a difference. Yeah, so you've got to do all this while like hugging the creative so that they can do their best work and create products that people want to buy. And that's a really difficult balance. So we'll have to see whether he manages that.
All right, great to talk to you, Andrea Felsted from Bloomberg Opinion. Happy Friday. Well, coming up on the programme, we'll get you set up for your trading day, so don't go anywhere. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
This is Bloomberg Brief. I'm Lizzie Burden in London. Now for a look at what's ahead today. Of course, it is, have we mentioned, Black Friday, the traditional start of the US holiday shopping rush, with sales to surpass $1 trillion for the first time. Plus, it's a shortened trading day with US markets closing at 1 p.m. Eastern. And speaking of which, let's get a check in on these markets, because normally we look at S&P E-minis to gauge what will happen in the trading session, but we can't because of the CME outage. So here's the ETF picture, looking pretty positive into the open. And if we flip over to what's already happening in Europe, these are thin volumes, but not a whole lot of movement on the Stock 600. The FTSE and the DAX slightly outperforming, if you can call it that, but really small moves, up 0.2% in London. You've got euro dollar on the back foot, 116 where we trade at the moment, and relief for Chancellor Rachel Reeves post-budget. Gilt yields steady. 445 is where we trade. But that does it for Bloomberg Brief. Surveillance is coming up next. Stay right here. This is Bloomberg.
How much does the geopolitical volatility emanating from the United States perhaps undermine the bull case for Mexico? Is that a scenario you've plotted out?
Structurally speaking, we do still have a very positive view in Mexico. On the macro side, it is a very attractive investment geography for the U.S. Mexico is hugely competitive in terms of costs. The wages in Mexico are much more competitive than the wages in China. So why would the U.S. companies not take advantage of that?
And this structural cost advantage is going to lead Mexico to continue to contribute to the growth of U.S. as well. The value chains, the supply chains are so integrated that Mexico has to play a continuing role in the further development of the U.S. And U.S. is growing very healthily, very nicely. It will benefit Mexico. This way or that way, it will benefit Mexico.
Mexico for BBVA is, a source of resiliency of earnings, and it generates and complements the diversification that we have from the footprint. But there's another topic that is very important, which sometimes we don't focus a lot about, and why we're so convinced that Mexico is going to continue to do well, which is the leverage in the country. Because the leverage in the country is only 33%. And when you've seen Mexico grow and BBVA grow in Mexico, structurally speaking, the leverage is so low that just a little bit of growth in the leverage is going to be able to support that bull case in Mexico. So that's why we're structurally positive in Mexico.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation. Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City, for our audiences worldwide, good morning. This is Bloomberg Surveillance. I'm Romaine Bostick, a raspy Romaine Bostick, alongside a very pertinent tart Caroline Hyde on this Black Friday in Today for Team Surveillance, with a close eye here on the Black Friday holiday season, but more importantly, a close eye on that futures outage at the Chicago Mercantile Exchange, trading across global markets disrupted. And we're going to kick off the all-important holiday shopping season with consumers feeling anxiety about the economy, plus from ongoing tariff uncertainty to Ukraine peace talks. Investors remain on watch for rising political risks. But Caroline, we do have to talk about some of the price action today here on the final trading session for the month of November, a trading session that has been massively disrupted. Crude oil, gold futures, dollar futures, and even treasury futures now either halted or severely constrained by that.
We just go off Bitcoin as a sentiment gauge?
I would never go off Bitcoin as a sentiment gauge, but it is trading, by the way, so freely.
24/7, unlike
data center impacted mercantile exchange, commodities, assets across the board. We have got more news coming from CyrusOne. Of course, this is a key player in the whole generative AI data center world. The fact that we're going to have to get yet more and more cooling equipment, yet more and more ability to plug the world in on data centers to be able to generate the data that we want to come out and spit out a ChatGPT. But right now, if you want to have spitting out prices from your mercantile exchanges, you need CyrusOne to be actively responding to the cooling system issue. They say they are, and they restarted several chillers at the limited capacity.
And that is something to keep in mind as we check the markets here on this Friday morning. While U.S. equity futures have not been severely disrupted by the outage, we always say take everything today with a bit of a grain of salt. Remember, the day after Thanksgiving, traditionally the third lowest volume day of the year, only sort of bested by the 2 days surrounding the Christmas holiday season. Volume typically light here on a holiday shortened session, a session that for U.S. equities will end at 1 p.m. Eastern time. Take a look, Caroline. You got Brent crude, which had been disrupted earlier in the session. The dollar had also been disrupted, but you get modest moves right now, one to the upside, one to the down.
And it's been a pretty brutal month, pretty brutal year if you're looking at what's happening in oil more broadly. So it doesn't seem to be boding well when we're looking for sentiment checks as we do garner what really traders are going to do to end this December. November has been pretty woeful in terms of volatility. It feels as though that's not going to go anywhere anytime soon.
And November really shaping up to be quite a barometer here for risk sentiment. We talk about the first, or really those 6.5 months from the those lows in April to where we were towards the end of October, a 38% run up in the S&P 500. That came to a screeching halt. We're basically unchanged for the month of November, and it does look like some investors, you tease about sentiment with regards to Bitcoin, but that has been a huge barometer for broader market sentiment right now. And of course, Bitcoin still subdued around that 90,000 mark.
It is, and look, just looking at the NASDAQ on the course of November, only down 2.4%, but at one point, Romain, it was off by 7.75%. We saw such sell-off of the big winners, the AI names, but as you mentioned, the more volatile, more riskier edges that we saw, the quantum names, the momentum stocks, that really has been taking a hit.
The story of the year has, of course, been what's been going on in AI, and sort of fitting as we come up on the 3-year anniversary, Caroline Hyde, when ChatGPT was unleashed to the public. I don't know if it was for better or for worse, but it certainly consumed everything in the markets and to a certain extent the economy.
And it's 3 years since I started the tech show, so jumped on board at that exact time. Romain, 3 years since we were together doing the close, and now we come up bright and early to talk about what on earth these markets are doing more broadly as well.
The Caroline Hyde Index now 3 years running and well solidly in the green. A little bit later here on Bloomberg Surveillance, a conversation with Max Kettner over at HSBC as Wall Street's tapping the brakes on the final trading day of this month. We're going to talk retail, the Black Friday holiday shopping season with Jill Standish of Accenture, who's really going to talk about some of the challenges out there right now, not just for retailers, but really the consumers. And then Kali Kohu over at Jefferies is going to talk a little bit about the global toy industry. I guess if there's any part of the retail sector, Caroline, that holds up every holiday season, it's going to be the stuff we have to buy for our kids.
It is, and is it food too? I wanted to get a real sense on how this particular day of celebration yesterday hold steady, with people actually still wanting and needing to be spending on items that have become ever more expensive, really. It feels around the table, people having to go for the necessary items. What are we going to splurge on when it comes to the unnecessary? And how much is this just a K-shaped economy? Is it going to be the fancier toys that do particularly well? Is it the ones on the lower end that still we're looking to be hit by tariffs in some way?
Yeah, well said here, and we're going to get back to that story in a second, but we do want to get to the top story here on this Friday morning, and that is a major glitch on the Chicago Mercantile Exchange, the largest derivatives market in the world. Millions and millions of contracts typically swap hands on any given weekday, but today, most of those contracts at one point were effectively halted. The issue disrupting markets across equities, across foreign exchanges, bonds, and commodities. Let's go out, well, to the UK, Caroline Hyde, where you should be, but instead we have Kriti Gupta. Kriti, great to see you. A long time no speak, and we speak here on a day where looks like the CME is trying, and more importantly, as data center operator, trying to get things back on track. What do we know?
Very, very little. And this is an outage that's been going on for almost 9 hours, Romain. This is a very long outage. When you've seen similar instances of outages with like CrowdStrike, for example, or Cloudflare, they haven't taken 8 to 9 hours. And this probably just speaks to just how enormous the effect actually is. I have to say, if there's a day to have this problem, it's today where, as you and Caroline pointed out, you have plenty of light volume and light liquidity, but we don't actually know why this happened, why there aren't backups in place case, this is, as Caroline was mentioning, a data center cooling issue that seems to be affecting not just the CME futures, but trading options as well, extending all the way to the Pacific, to the Atlantic, even exchanges in Malaysia, for example, feeling it. Just for our international audience to understand what these contracts actually mean. We're talking about S&P 500 E-mini contracts. We're talking about bond futures contracts. We're talking about commodities contracts. If you looked up a quote on NYMEX crude right now, you can't have one because they are halted. You have seen the exception, of course, being European stock futures, so that has kind of given the indication that maybe stocks are just floating higher. You're also getting some of the pre-market indications, but net, we are flying blind. The investors around the world are flying blind.
Greedy, CyrusOne has responded in terms of saying they are actively responding to a cooling system, but actually it's the CH1 data center facility that's impacting the greater Chicago area more broadly that's actually had multiple cooling unit issues since November the 27th. There's going to be a lot of questions asked of this privately held company.
There absolutely are. And this, I mean, you were making the example of just the need for more cooling equipment as well. This brings me back to kind of these structural and infrastructure questions that we had dating back to COVID when we were talking about vaccine distribution and ultimately talking about how do you refrigerate them as you see more and more data connectivity, not just from the United States and the exchanges there in the Chicago area and across major metropolitan cities in the United States, but internationally, that dependence on those data centers are going to be even bigger and bigger. And this is where some of the risk lies. It's a conversation we've been having all morning here about just how reliable some of this infrastructure build out is.
Kriti Gupta in London as we keep an eye as CyrusOne tries to get everything back up and running. That CME outage disrupting some of the price action that we're getting on this Friday morning. But quite frankly, if you want to read on what happened for the month of November, you already got it really over the past 4.5 weeks. Here's the view from Wall Street right now. Stocks losing momentum here on the final trading day. Some valuation concerns out there as we head deeper into December. And more importantly, a look ahead into 2026 with Matt Kettner over at HSBC writing the big concern with regards to that big AI trade is when CapEx starts to drop. Worries about higher tech debt, outlook for productivity gains, or monetization potential, just too long term to matter for the near term. Max joins us right now to talk a little bit more about that. And Max, we talk about investor sentiment. Investor sentiment had gotten a big boost over the past few months because of the sustainability of that AI trade. We saw a bit of a rethink, though, of that over the last 4 weeks. Is that a rethink or the end of it?
No, I don't think it's the end of it at all. Actually, when we look at the last couple of weeks, the biggest shift I think that we've seen and the biggest change was really an investor sentiment. Whereas I would say August, September, and in large parts of October as well, in lots of our client conversations, at least lots of clients were saying, look, we're waiting for the dip, we're ready to buy the dip. That's completely changed in the last 4.5 weeks over November. But really, most investors have been saying, no, this might actually be the end of it. This is threatening the overall OpenAI universe. It might only really benefit Google. So is that the end of the entire NVIDIA trade, the entire hyperscaler trade? And the biggest shift really was in the last 4.5 weeks in terms of our positioning indicators. When we look at that, even systematic positioning, so the likes of CTAs, but particularly risk parity and volatility target strategies, momentum signals, that were flashing some sort of warning signal in August and September. On our measures, that was above the 95th percentile. Even that has come off to the 50th percentile. Right. So even within already light positioning, the one warning sign we had, that has all but disappeared in November.
And so the catalyst to really recover, Max, is that the December Fed decision?
I don't think so. I don't think it's just the December Fed decision, because let's be honest, for risk assets overall, I don't think it matters greatly if the Fed says in December, look, we're not going to cut, but we are wary of what was in the beige book this week. We are wary that labor market conditions are tightening. So if they then say there may be near-term cuts, i.e. a January cut, I don't think, equities, credit spreads, the dollar, EM assets, I don't think they will greatly care whether a rate cut comes in December or January. Likewise, if it happens then in December and they say, well, but don't confuse that for an overall rate cut cycle all the way down below neutral, like the front end is pricing right now. Again, if they say that in December instead of January, that's not going to move the needle an awful lot. I think what matters much, much more in terms of the catalyst for not only the next month, but really the next 2-3 months is once again earnings. When we look at the earnings expectations,
we've only just had them. I mean, we've only just had NVIDIA earnings, and that gave us no resiliency, even though they beat and they guided. to the better expectations of the entire market?
Yeah, Caroline, I mean, we could argue that, but we could also argue that's been basically or what's been overshadowing the earnings from NVIDIA was the concerns around OpenAI. And we can also say that when we look at investor positioning, if you've got the mix of, once again, more subdued investor positioning, but on the other hand, overall an earnings season that has once again been much, much stronger. Let's remember that the earnings beat rate for the third quarter has once again been the best one since COVID, since 2021. And now we're facing a setup for the fourth quarter earnings season starting in January, where once again consensus has actually in the last couple of weeks been downgrading expectations. Bear in mind, consensus now says quarter-over-quarter sequential earnings growth for the S&P from the fourth to the third quarter is down 1%. If you exclude tech, we're talking about net income expectations, bottom-up expectations for the S&P of minus 8%. Minus 8%. 8 of the 11 sectors are expected to report a sequential decline in earnings. That is such an uber bearish setup that I do fear that once again people have been cutting perhaps or taking up hedges in November too much, and they're not going long risk enough in what I think could be a proper melt up in the next 2-3 months. Earnings driven once again.
Well, with regards to that earnings driven though, Max, I mean, strip out some of the tech stuff and all that big cap stuff. I mean, we actually saw a relatively strong earnings season for a lot of the small and mid caps, at least here in the United States. And there has been some optimism that if we do see those names have some sustainability in some of those earnings reports for the fourth quarter and beyond, that actually might be a much, I guess, stronger bit of fuel for this market than just the big cap tech stocks.
Yeah, I do think that is true. And in fact, when we look at even the year-to-date performance, I keep getting asked, look, when is the broadening finally happening? And I do think sometimes people define broadening a little bit wrong. In my mind, it's a bit like, well, do I buy tech or do I buy the other stuff? And for me, broadening is, well, I'm still buying tech because I do think the CapEx incentives in the big, beautiful bill are really positive for AI CapEx, but I'm also buying some of the other stuff. And that has happened really year to date as well. Look at industrials, look at healthcare, look at financials, even energy, despite the lower oil prices, all of those are up sort of 6 to 14% year to date. So the broadening really has been happening, not only in earnings, but already also in performance.
Max, always great to catch up with you. Max Kettner over at HSBC, kicking us off here on Bloomberg Surveillance this morning. Caroline, we should just mention for our viewers that the CME is now saying that its EU and its U.S. broker operations are back and active, according to its words. I assume that means they're up full and running here. Just running a quick search of some of the various assets out there. It does look like we are getting more up-to-date pricing.
Key as we continue to try and understand how we tie up this month of volatility, this month when we have to really get a sentiment check on what investors are feeling. Interesting that Max really feels that actually we could have quite a significant melt up here and people are perhaps a little bit too bearish going into the end of the year.
Absolutely. Here, we're going to get back to markets, but we do want to update you on some stories going on elsewhere around the world. Let's get to Lizzie Burton in our Bloomberg Brief.
Hey, Romain. President Trump called for reverse migration in the US and outlined measures to crack down on immigration. He said that he would permanently pause migration from all third world countries and denaturalize migrants who undermine domestic tranquility. On top of that, he'll end all federal benefits for non-citizens. Trump offered no details on how he would implement those policies. Elsewhere, Russian President Vladimir Putin said that US President Donald Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during the talks in Geneva, which can now be the ground for talks. According to reports, the Kremlin will be discussing the peace plan next week. And at least 128 people died and dozens were injured in a blaze at a Hong Kong high-rise complex. The operation is almost complete as firefighters enter all units in the 7 buildings to ensure that no one else is trapped inside. Police have arrested 3 senior figures from an engineering company on suspicion of manslaughter. And that's your Bloomberg Brief. Romain, back to you.
Our thanks there to Lizzie for the Bloomberg Brief there. When we come back, shopper stress may be intensifying. We're going to get a read on consumer sentiment on this Black Friday. Jill Standish over at Accenture going to be joining the big program in just a second. Stick with us. This is Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Retailers looking to the holiday season to attract, well, budget-conscious shoppers and continuing a lot of those concerns here about inflation and tariff pressures. Right across from us here at Bloomberg World Headquarters is the flagship store for Bloomingdale's. I had a chance to catch up with the CEO of the Bloomingdale's brand, Olivier Braun, as well as the CEO of Burberry, Joshua Schulman, about their expectations for this holiday season.
'Tis the season for holiday shopping. And despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, you know, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas, so I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
The CEOs of Bloomingdale's and Burberry about their optimism for the holiday shopping season. That's the anecdote. Let's get right to the data. Jill Standish joining us right now from Accenture. And Jill, I mean, you guys have done a lot of research here about what your expectations are for this holiday season. What are those expectations?
Well, first of all, I'm hearing that 9 out of 10 are saying they're going to spend more. But that's a little bit tricky here because, honestly, that's because prices are higher. So there's a little bit of, prices are higher, consumers said they're going to spend, but their confidence is a little bit down.
So how does a retailer respond, particularly on Black Friday, Jill?
There's so many choices out there. I think a couple of things that really make a big difference. I like to say that this is the era of recommendations. It's interesting that 85% of consumers said they're so stressed out about so many choices that they're going to abandon their cart. So what can a retailer do? There's a lot of tools out there like Gen AI that can say, hey, listen, let me give you some advice. So it's the era of recommendations, whether that's online or even store staff. What should I buy you for Christmas? Get that recommendation engine going.
But Jill, the recommendation engine, the generative AI chatbot, does it need to be owned by the individual retailer, or do they start to feed into ChatGPT a little bit more?
Yeah, you know what? There's 3/4 of consumers are saying that they're going to tools like ChatGPT, like you said, or Meta. So what a retailer needs to do is be found by these tools. So allowing these tools to actually find you, find your website, find your prices, find your inventory, and then recommend back. So that top of funnel doesn't need to come from the traditional search. Now it needs to come from this Gen AI search or recommendation engine.
All right, Jill Standish over at Accenture, the global retail lead there. As we start to look at those trends, one interesting thing, Caroline, that I saw in that data was this idea that fewer people are actually going to be using social media, to something like only 4% to actually do their shopping.
So no longer Instagram, we're just going to ChatGPT, Gemini. We're using generative engine optimization, not search engine optimization.
Oh, wow. That sounds so loving, caring, and warm, Caroline. When we come back, we're going to talk to Ross Mayfield over at Baird. Plus, we're going to check in with Lizzie Burden on your morning movers. A lot going on here on this Black Friday trading session. This is Bloomberg Surveillance.
We have two crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something. Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Starting to see a little bit more stability in the price action here on this Black Friday. A big outage at the CME, the world's largest derivatives broker out there, trying to get things back online. You're taking a look right now at the S&P E-mini futures. They are higher by about 0.3%. We'll get a better read right around the top of the hour here with regards to CME futures pricing. But Caroline, you are seeing a bit of a slump on the day, modest slump on the day, we should say, in Brent crude, a slight uptick in the dollar.
What's been extraordinary is how much you've seen the dollar fallen below its 20-day moving average, how much the technicals have been at play for that particular element of things. Also, we've got to look to Japan as to what the pressure on the dollar is really going to be signaling as well. But to your point, when we're looking at these reads for the S&P, you're having to depend on ETFs as we currently stand. But we're potentially on track for the best 4-day streak we've had since May.
Yeah.
It certainly hasn't felt that way, but suddenly the dovishness coming from the Federal Reserve has started to outweigh the AI anxiety that had been brewing more broadly in tech.
Yeah, and a good reminder here that at one point for the month of November, the S&P was down almost 5% on a month-to-date basis. Right now, it's basically flatline, unchanged here. So that gives a testament, and most of those gains were really over the last 4 sessions. So a real testament here to how much sentiment has shifted as people try to claw their way back into this market. That's a look at the broader market. We are 3 hours away from the cash open here in the United States. Let's take a look at some of the individual movers right now with Lizzie Burton.
Will remain, of course, the CME outage dominating the headlines this morning. Lest we forget, it is a publicly traded company. BrokerTech US actives and BrokerTech EU are now open, but other CME group markets have been halted still because of that data center cooling issue at CyrusOne. So you're looking at CME shares down 0.7% in the pre-market. And my next stock is also more bad news. We're watching shares of Oracle. This after Morgan Stanley warned that a gauge of risk on Oracle's debt reached a 3-year high in November, and things are only going to get worse in 2026, according to this report. The share's down 1.4% in the pre-market. It looks like they really need to get a grip on that anxiety around the AI spending spree. Finally, we take you to Tilray. Ironically, in the red, not the green, down nearly 14% right now. This after the cannabis company announced that it's going to implement a 1-for-10 reverse stock split of its common stock. I thought we were all going California sober for Thanksgiving, Romaine, but look, in the red for that cannabis stock. Back to you, Romaine.
Our thanks there to Lizzie Burton with some of the individual movers on this morning. Also on our radar, keeping an eye on Washington and President Donald Trump calling for a strict crackdown on immigration. A pair of Truth Social posts, the president saying he would, quote, permanently pause migration from all third world countries, end quote. This comes following the shooting of 2 National Guard members in Washington just a couple of days ago. Meanwhile, back in markets, we're taking a look at oil heading for the longest run of monthly losses in more than 2 years. This coming as traders look ahead to the OPEC Plus meeting this weekend and try to gauge U.S.-led efforts to end the conflict in Ukraine. And that data center fault that we've been talking about all morning that forced the CME to halt futures and options trading for several hours. BrokerTech US actives and BrokerTech EU are back up and operating according to the CME. Facility operator CyrusOne saying they're restoring cooling, having restarted some of the chillers and deployed temporary equipment that had gone down and led to that outage.
I mean, this is your neck of the woods.
Yeah.
This is Illinois. This is Chicago. This is where you're born and raised. 16-acre campus that CyrusOne has over there, 45 minutes southwest of Chicago O'Hare International Airport.
Yeah.
And it truly is a dependent source, they say, not only for CME Group, which is where they really have the role of the main area data centers for the trading platform, but they're also particularly benefiting energy, enterprise, fintech, cloud customers. I wonder who else is really being affected by this.
Absolutely.
For us, CME front and center.
Absolutely, and if you really want to go down the rabbit hole, you'll find a very amusing story about why that data center is exactly where it is out there near O'Hare Airport. By the way, fun fact, Caroline, do you know O'Hare Airport is really the only non-continuous city in the entire United States? I'll come back to that in a point. Yes, thank you. I'm full of Chicago trivia if you want it.
Few, light relief on this day, Romain.
I doubt any of our viewers care. I'm not sure our next guest does either. We're going to talk to him about markets. Let's bring Ross Mayfield into the conversation over at Baird Investments. He's writing in his latest note that recent relative weakness in tech stocks is a viable hiccup among the broader AI-driven bull market. Healthy corrections needed along the way to reset sentiment. Ross joins us right now to talk a little bit more about that. Ross, great to have you here. And I think a lot of people looked at some of the ructions that we had at the start of November, those first 2 or 3 weeks where it really looked like the bloom had come off the rose of the AI trade. But Caroline was mentioning this heading out of the last break here. What we saw really over the last 4 or 5 sessions seemed to be a ratification that AI trade, while maybe hobbled, is certainly not done.
Yeah, 100%. I mean, the momentum we've seen over the last 4 days is really only rivaled this year by the post-Liberation Day bounce. Obviously, buying the AI dip, there's a bit of irony there since it's already gone pretty much. But I think that along the way, even in a bull market driven by intense optimism around a new technology, sell-offs, questions around that technology, the funding sources, all those questions are good. It's good to be skeptical about this. It's I'm of the opinion that we're not in a bubble until all that skepticism is tossed out the window. But yeah, I think sentiment and positioning reset a little bit. Things were getting a little frothy, and so I think we're in a good place heading into year end.
Ross, what gets everyone's sentiment and, as you say, cynicism out of the window when it comes to AI? What more can these companies say? What more could have NVIDIA said, apart from we've got line of sight on $500 billion worth of demand coming our direction over the next few quarters, and you are seeing productivity gains in the applications that we help foster?
Yeah, well, NVIDIA's demand, I don't think was a question for the market. We know the CapEx plans, the spending of the hyperscalers. We know that the demand for NVIDIA's chips is basically endless. The question is, what's the ROI for the companies that are plowing hundreds of billions of dollars into this, and particularly now the ones that are utilizing, debt or special purpose vehicles, off balance sheet things to fund this. And so investors, I think, are going to keep looking for, right or wrong, the killer app, the AI app that really changes the opinion about the potential profitability down the line for all of the money that's being sunken into the ground today. We have so many historical corollaries of excitement leads to overbuilding, leads to stocks underwater for a decade. And so I think, the next step is going to be seeing that killer application that really assuages investors that this spending is going towards a profitable purpose.
From your perspective, what makes this different from the 2000s?
Well, right now, this could ultimately be a story that very much mirrors the late 90s boom in dot-com stocks. I just don't think we're there yet. Right now, we have a healthy bull market driven mostly by fundamentals. Earnings season has been tremendous. And that was the same in the late 90s, up until about late 98 when the market went parabolic, went vertical, sentiment went through the roof. So I don't see the euphoric sentiment yet. I see a lot of skepticism around AI, and we haven't seen the parabolic price move, or at least even a move that doesn't broadly track the fundamentals. So right now, I think we're in a healthy bull market, but one that could become a bubble because of the massive build out that we're seeing that really only rivals a few other times in U.S. history.
With regards to that bubble, with regards to that build out, and more importantly, with regards to investor sentiment, Ross, a lot was also tied to this idea of potential stimulus coming down the pike here in the United States. Fiscal stimulus, largely as a result of that budget bill passed months ago, that starts to kick in next year. And more importantly, the idea that most traders seem to be betting on continued continued Fed rate cuts, including now almost a near certainty for a Fed rate cut at the next meeting on December 9th and 10th. How much does that actually complicate the situation rather than help it?
Well, I think it helps it more than it hurts. Obviously, over the last 3 or 4 weeks, I think a big part of the weakness in equity markets was the repricing of that December cut from basically 100% odds down to as low as 30% before we've had some Fed speak in recent days that has boosted it up to, as you mentioned, a near certainty. So I think this volatility in the equity market is as much about a hawkish Fed or an unexpectedly hawkish Fed versus expectations. But ultimately, I think the Fed cutting next year helps. I think there's a floor to how much they'll cut with the market at all-time highs and the unemployment rate, while higher, still in the low 4%. So I think there's a limit to how much they'll cut, but certainly the stimulus story, both from rate cuts, the ending of QT, which I think is a little under-discussed to help some of the plumbing in financial markets. And then, as you mentioned, a lot of the stimulus coming down the pipe from the One Big Beautiful Bill will hit in 26 and 27 before it starts to flip in the back half of the decade. So there's a lot, being laid at the stimulus at loose financial conditions to help this rally continue. That's for sure.
This gets to the idea, and particularly I'm glad you brought up the idea of QT effectively, I don't know if we say halted, but certainly paused for right now. And the Fed does seem to be clear that they don't intend, at least in the near term, to do anything more with regards to drawing down that balance sheet, Ross. But it gets to this idea as to whether financial conditions were indeed restrictive. This was a big debate that we saw, at least in some of the Fed minutes over the last few meetings here, that there was a lot of discussion and a lot of disagreement on just where financial conditions stood. Where do you think they actually stand?
Yeah, it's a good question. I would say modestly restrictive right now at best. Obviously, it's hard to argue that they're very restrictive or anything close with the market activity that we've seen, until recently, the tightness in corporate credit spreads. The financial plumbing, there have been some issues with SOFR but largely contained. I would say modestly restrictive. But look, you zoom out, Fed has a dual mandate for price stability and maximum employment. The labor market is clearly weakening. So I think the debate around financial conditions is valid. I think if it helps, again, keep a floor under how low the Fed is willing to cut. But I think you look at where they view the neutral rate, you say we're above that, and you see a weakening labor market. To me, that's all the evidence that the Fed will need to at least cut rates a few more times to get closer to that vision of neutral for them.
How strong, therefore, Ross, at the moment, is the consumer? Is the health of US individuals right now who are fearful of their jobs and who are seeing more statements coming out about immigration and the like?
I think it's stronger than the consensus would belie. I agree with most of the discussion that's been around the kind of K-shaped recovery in the consumer. Certainly everything we see suggests the higher income cohort is doing far better than the lower income cohort, but even versus that historical spread, the renter class versus the homeowner class, even within that group who bought before the pandemic and potentially refinanced in the pandemic. But in aggregate, I think things are better than the narrative around the consumer has been. One, we see the initial claims data starting back up, still historically low, despite the headlines about layoffs that tend to pop up every now and then. By and large, people are just not getting fired. And if people are working, they're spending. Now, there might be some anxiety about the labor market, and we can see that in the consumer sentiment surveys. But in general, the hard data suggests people are still working. The discretionary stocks have recovered over the last 4 days in a way that we haven't seen in years. The equal weight discretionary has popped aggressively. I think that shows the market's view of the consumer is not as bad as the consensus narrative. Certainly, we're seeing it in the luxury stocks. Some other stock groups are really reflecting the strength of the higher income cohort. By and large, I would say okay, not great, will benefit from some of the stimulus, but better than the consensus narrative.
Ross, really appreciate it. Ross Mayfield over at Baird here, a closer look here on where markets may go over the next few months. And, Caroline, I just have to pause for a moment, and I really have to tip my hat to Lisa Abramowitz, Anne-Marie Hordern, and Jonathan Farrow. I have no idea how they do this early every morning. I'm still just, we're an hour into this show, 45 minutes into this show.
Brain is still waking up.
I still haven't woken up. I don't drink caffeine, but I may have to make an exception today because this tea or whatever you Brits do, this ain't it.
You need something stronger than a herbal mint tea, Romain.
Yeah, I know.
Get yourself a little injection of caffeine. I've got an iced coffee on the go.
Yeah.
I've got a beautifully made by Joel cup of English breakfast tea.
All right,
That's what gets you through on about 3 hours sleep.
Yeah, I'm gonna get one of those IV drips around the corner after the show. I should have done it before the show here. Get a little shot of B12 or something here. Kind of interesting though too. We also talk about where this market is going, and obviously a market that's been on the back foot all month, but it's kind of found its mojo heading into December.
And I think that mojo has almost gone unrealized because of the extent of the volatility. All we've seen is this whipsawing, the 20% sell-off by an NVIDIA, which has basically led this market higher. But still the gains are significant for the rest of the year. And you're looking at an S&P 500 that is basically just below its record. I don't feel like that's the sentiment of the market at this current state and time. But yeah, we're about 1% off that record close.
Yeah, good point. And we should just remind our viewers today is a truncated trading day. Bond market closes at 2 p.m. Eastern, the stock market at 1. Meanwhile, other stories going on out there around the world. Let's check in with our Bloomberg Brief and Lizzie Burton.
Hey, Romain, it's nearly noon here, so I'll wake you up. President Trump called for reverse migration in the US and outlined measures to crack down on immigration. He said he would, quote, permanently pause migration from all third world countries and denaturalize migrants who undermine domestic tranquility and end all federal benefits for non-citizens. Trump offered no details on how he would implement those policies. Elsewhere, Russian President Vladimir Putin said that US President Donald Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during the talks in Geneva, which can be the ground for the talks. According to reports, the Kremlin will be discussing the peace plan next week. And at least 128 people have died and dozens were injured in a blaze at a Hong Kong high-rise complex. The operation is almost complete as firefighters enter all units in the 7 buildings to ensure that no one else is still trapped inside. Police have arrested 3 senior figures from an engineering company on suspicion of manslaughter. That's your Bloomberg Brief. Romain, back to you.
Coming up next here on the program, a big day for holiday shopping, Black Friday. We're going to talk about toys and toy makers and how they're navigating the tariffs here in the U.S. Jefferies Consumer Equity Research Analyst going to be joining us right after the break. Stick with us. You're watching Bloomberg Surveillance.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape the more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Shares of Build-A-Bear. The stock has soared over the past 5 years. Recently, Bloomberg caught up with the CEO, Sharon Price John, who revealed just how she transformed the iconic mall shop into a multi-platform brand.
The actual experience of building a bear can be equated to what it takes to be successful in business. You're picking something that you really like, you're stuffing it with the exact things that you need, and then you're willing to put your heart into it. You're going to increase your level of success for sure. We went through a process of pivoting the company from what was a mall-based retail stuffed animal store for kids to a branded intellectual property company that just happened to have vertical retail as one of its revenue streams. When you can monetize a feeling, that's a much more diversified approach, and that creates a much more resilient approach to business. Build-A-Bear is a pioneer in experiential retail, so we were doing that back in 1997, and really there isn't anyone that does exactly what we do.
What is your read on consumer discretionary spending on the current economy?
We are not recession-proof, but toys are often very recession-resilient, particularly during the holidays. There you go. Thank you. And when you think about how we're kind of in this crosshairs of the nostalgia economy, there's adulting, DIY, and we're sort of mashing a lot of that stuff together. We actually doubled the teen and adult business to be 40% of the total sales. And I'm hoping that we'll be able to enjoy that trend for a while.
Sharon Price John there, the CEO of Build-A-Bear. Of course, the only thing probably more iconic than Build-A-Bear is Mattel. The CEO of Mattel shared his outlook ahead of the holiday season, and he's told Bloomberg the company is well positioned for the quarter.
What we're seeing is that companies have mitigated for the cost impact. Consumer demand for toys is growing, has been growing every quarter in the US and overseas. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year. But seeing that there is demand, there is consumer demand, people are buying product at retailers, we expect to see a good holiday season and a strong growth quarter for Mattel.
Ynon Kreiz, the CEO of Mattel, and joining us right now to talk a little bit more about the holiday shopping season and specifically the toy market. Kylie Kohu, consumer equity research analyst over at Jefferies. All right, Kylie, let's get right to it here. Do people really hold back on spending on toys? I mean, if you have kids and they want a certain toy or something, most people, if you have the capacity, you're going to find a way to get it.
Hey, thank you so much for having me on. And you're right, people will consistently spend on their kids, especially during the holiday season. But what we do see sometimes is people trading down within the toy category, especially as inflation hits these other categories. They will end up, say, as opposed to buying a $30 toy, now you're buying a $20 toy, or maybe instead of buying the $150 Barbie Dream House, you're doing much smaller gifts, but more of them. So we're definitely seeing the consumer being more choiceful and very sensitive to these price points.
Kylie, it's interesting. You think of maybe the older millennial, younger millennial, maybe even Gen Xers a little bit in that category of buying the toy scenario. How do they, as a generational divide, currently stack up in terms of sentiment?
overall, we're actually seeing, adult and teen collectors and toy buyers growing. They're actually, one of the biggest growing segments for toys. So that's exciting. They have more discretionary income. They're becoming fans earlier on in life and then staying true to these brands later on in life. So that we're also seeing a good growth patterns there. And overall, it's really helpful for the industry as a whole, especially as we see, birth rates declining a little bit.
Let's just get to tariffs, Kylie, because how much has that impacted individual types of toys? How is that going to change the way in which we purchase this particular holiday season?
So what we've seen so far is really tariffs have impacted prices on really the higher priced items, right? So when I'm talking about the large Barbie dream house, we're seeing, sometimes $40 year-over-year increase in a same item SKU. But what we're actually seeing is in those low cost items is that they're really trending more flat year-over-year. And in fact, some of them, I was just looking at Amazon data, and some of those SKUs are actually lower year-over-year versus Thanksgiving last year. So we're really taking surgical pricing so that way these toy companies can preserve some of their margins.
So what does actually inventory look like, Kylie? And I mean that not just from the tariff perspective, but also from the discounting perspective. I've heard sort of mixed things, the idea that a lot of these companies are sitting on enough inventory not only to satisfy the demand this year, but have also sort of been constrained enough that they're not going to have to necessarily mark down things in a larger way than normal.
So I think that mixed signal makes a lot of sense because what we've seen is inventory levels right now are lean across the board. So when I'm thinking about the balance sheets of my toy companies, as well as retailers, both what they reported in Q3 with their balance sheets, then also just what I'm seeing in the stores themselves. It overall looks lean, which is leading to lower promotions year over year, which is good for both the toy companies and the retailers. What we are seeing, though, is that retailers are taking inventory closer and closer to the time or point of sale. So that means that as opposed to taking inventory in Q3 and anticipating for holiday, that gap is getting closer and closer. So it really is going to depend on, is the consumer showing up really starting now on Black Friday through the rest of the year, when we're thinking about, inventory and just like where that's going to set in the supply chain.
Kylie, great to catch up with you. Kylie Kohu, an analyst over at Jefferies. She covers the big toy companies like Mattel's, like a Hasbro, Caroline Hyde, and I was trying to look at sort of what the hottest toys are this year. I mean, my child is a little bit too old for toys, if you will. It's all, video games.
Gaming toys.
I think she just wants money at this point. He's just like gift cards and cash so he can buy God knows what. But it gets to this idea. I mean, you have younger kids. I mean, are they still looking for those physical toys the way maybe that we did when we were children?
I don't think there's the significant must-have in quite the same way that there used to be. There is when it comes to getting a Switch 2 or what latest game you want to have on a console. But my daughter's like making stuff up as far as I can work out. And she's like, maybe she wants me to go and generate it on some AI app and create my own toy, but it seems to be like very specific, very nuanced, and ultimately potentially not done by Mattel.
All right. Lego's still hot, I'm told. So are Hot Wheels, which was, of course, a favorite when I was a child, and quite frankly, still as an adult. Coming up here on the program, Sarah Coates over at Clio Capital going to be joining us, Terry Hines over at Evercore ISI, Stacey Widlitz also, and Danielle Loria. A lot coming up on Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
We are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insights with Haslinda Amin, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City to our audiences worldwide, good morning. This is Bloomberg Surveillance. Romaine Bostick alongside Caroline Hyde in for John Farrow and company on this Black Friday. And of course, we start the day, Caroline, not so much about what's going on in the retail sector, but what's going on with the plumbing in financial markets. A red headline crossing the Bloomberg terminal right now. The CME is now saying that on the heels of that outage, things are getting back up and running. Now saying that the EBS platform, that's the main platform that deals with foreign currencies, that now is back up and running, or will be back up and running, excuse me, at 12 Greenwich Mean Time. And we should also point out, of course, that the broker tech operations apparently are also coming back online. We take a look here at what's going on in the futures market, or we should take a look right now, Caroline, I think of what's going on with regards to the ETFs that track the main indices here in the U.S. S&P-Y, which tracks the SPX, that now does appear to be up. There you go, by about 1/4 percentage point. The triple Qs, Invesco triple Qs, Caroline, up about 0.4%.
Yeah, keep an eye on tech. Keep an eye on where more broadly sentiment is as we head towards the end of what has been a tumultuous month, to say the very least. The fact that some of these indices have been down as much as 7% on certain innings. We're now down, I think, about 2% more broadly on the NASDAQ. S&P 400, in fact, only a percentage point off of its record close. We are still down ever so much, but if it closes down, actually up for November, it will be the largest intra-monthly drop erased since the yen carry trade unwind of August last year, and hat tip to our own favorite Dan Curtis for that stat.
And we should point out, too, I guess it's kind of a good thing this happened on this particular day, which at least certainly here in the U.S. is a very low volume day, one of the lowest volume days of the year here. So much better than if this happened on a big day where there are a lot of mergers, a lot of economic data, or something else here. So it gives the CME maybe a little bit of cover to get things back on track.
And cover they've needed, because it seems as though CyrusOne, the data center provider, which had the cooling equipment issues, they've had multiple cooling unit issues since November the 27th. So this has been a several-day issue where they've been trying to fix the chiller plants, in particular in the facilities over there in Chicago.
And I know we're going to talk a little bit later about AI, but obviously we should point out you're normally the co-host of B-Tech. I'm normally the co-host of The Close. But on B-Tech, you guys talk a lot about this data center build-out that's been going on. But a big sort of component of that, and I think something that doesn't get talked about, are the power demands, and more importantly, the consistency in those demands. And this could become a much bigger issue as we get sort of more data centers online, straining our grid.
If you speak to Andy Jassy over at Amazon, his issue isn't whether or not he can get GPUs or indeed his own inference or Trainium chips that he's designing. It's whether or not he can get power and electricity. And I think you told the story so well, how political this is becoming, how much this is impacting people from an inflationary perspective as well.
We saw it come up in the most recent election here in the United States just a few weeks ago. A lot of voters in local elections going to the polls on affordability issues, and specifically on the issue of affordability of electricity and gas. A lot of folks have seen their bills go up here as those data centers start to kind of crowd out.
Meanwhile, we can't really see what oil's up to. So who knows how we're doing on the energy price spectrum, but it's been limited, of course, because of the CME outage.
Absolutely. And just that is just a reminder to take all of the price action today with a bit of a grain of salt between the CME outage and what is traditionally a low volume day on a truncated trading day here in the U.S. because of the Thanksgiving Day holiday. Your price action might be a bit distorted here on the final trading day of November. We're going to catch up in just a second with Sarah Kuntz over at Clio Capital to talk about her outlook for stocks going into December and into 2026. We're going to talk politics with Terry Haynes over at Pangea Policy, particularly on the heels of maybe a renewed immigration crackdown. And of course, we're going to talk the holiday shopping season. Stacey Woodlitz over at SW Retail Advisors going to be joining us in just a bit.
But we kick off first with the talk about tech. Look, stocks currently, as we know, tepid on the day, but the NASDAQ, if you dig into that index, is on track to end a 7-month winning streak. Sarah Kuntz of Clio Capital writing, I'm a bit leery of names like NVIDIA, where I like the company, but think some of its underlying customers are likely not going to be able to make good on their purchase commitments. Sarah joins us now. When the customers are actually financed by NVIDIA, $100 billion going towards OpenAI, for example, Sarah, how are they not good for the money?
I think the question is, do the customers have that money, right? It is one thing to say, hey, look, if you're OpenAI, I would love to buy this stuff, but what money are you using to buy it with? And I'm not going full Michael Burry here, but I do think that there are questions for those customers about where they're going to get that revenue, because we're just not seeing AI pay off in enterprise or even really consumer to that level.
You are an Alphabet, though. Google having a spectacular month of November, basically spectacular time since mid-October, and you are starting to see from their business chain, it's starting to pay off. No, the vertical integration, the fact that they build their own chips that then feeds their own model, then we're applying it to you and I using it in Gemini AI, also in AI mode, and more broadly, maybe even in the hardware that they make.
Absolutely. The thing I like about Alphabet, and I'm generally pretty bullish on them, is that they have this massive integrated ecosystem. They don't have to ask you necessarily to subscribe to their AI, because you are using them for many people as your default search engine, and they can put AI in that. They don't have to go figure out a sales business, because they have an ad sales business that they can sort of bake into Gemini, bake into their AI products. They have the enterprise business in terms of their sort of Microsoft Word competitors and Outlook competitors. So they already have a lot of that stuff. And if you pull back and look at sort of that original team at OpenAI, who sort of, where they came from, a huge number of them came from Alphabet. They were one of the first, they were the authors on that first paper years ago that really helped sort of spark this AI revolution. Most of them have since left AI, not back to Google. Most of them are now running their own companies. But I just think that Alphabet is in a very unique position here, where they both sort of wrote the book on AI, and they don't actually need the money in the short term.
I am curious, though, Sarah, there does seem to be a bit of a divergence right now when it comes to the outlook for what AI should actually be or should look like. And you talk about some of those departures. Some of those departures seem to be tied to that. There's also the issue of what's been going on overseas with regards to a more open model, if you will, for building out AI. And I wonder if we have to start thinking, as far as from an investment perspective, not just about maybe following some of these U.S. tech companies, but the idea that maybe some of the companies over in China and, dare I even say, Europe, could actually maybe potentially outpace those in the U.S.
Yeah, I mean, DeepMind, right, which is sort of the engine inside of Alphabet, that is a team that sits largely in London, and that's a team that was founded by people who are not Americans, right? They're not British either. And so, certainly this talent is going to come from everywhere. If you look at the people who are really doing foundational work, I'm a bit leery of believing that the DeepSeek moment in China this year was quite as cheap as they said it was. But I also don't think that a lot of these models are as expensive as the sort of open AIs say that they are. I think that it works well if you want to raise a lot of money to say, hey, look, we need all of this money to build things. And so I think the truth is somewhere in the middle, and that for the end consumer, the answer is it's still kind of a toy that they're not paying much for.
Then I am curious where you look for new opportunities in the AI space. Obviously, I think over the last, we just go back to that 3-year anniversary, which is coming up in a couple of days for ChatGPT, and it was a kind of a no-brainer trade, going after some of the chip stocks, particularly NVIDIA, going after the hyperscalers like an Alphabet or a Microsoft, or even going after some of the cybersecurity companies as well. Has that trade broadened out? And if so, Sarah, where are you looking beyond some of those obvious names?
I mean, I would hope that the trade starts to broaden out, right? We can't have 7 companies running the entire global economy, right? That just doesn't feel sustainable, and we're starting to see cracks in that. On the AI side, names that I have always liked and I feel tend to be a little bit underappreciated, Taiwan Semi. I think that there's a disconnect in understanding how vital they are, especially to NVIDIA, and how much of the global AI market they underpin. So that's a name I continue to be bullish on, though I think it's pretty well priced right now. And then, on the private side, where I spend most of my day job, I really like cybersecurity right now. I think that, we just underestimate how much of the world grinds to a halt when the internet doesn't work and when people don't feel safe using the internet to transact. And we live in a time where it feels like every day there's a crazy ransomware happening. Individuals are getting hacked, so that's an area where I'm really starting to look on the private side.
What's interesting is on the public side, we're reminded quite often about our dependence on Cloudflare. Just 10 days ago, when they had they're a cybersecurity firm, they had an outage. They say it wasn't a particular hack of any particular sort, but it took down significant numbers of operations, whether it was trying to get in for New Jersey Transit or whether you're trying to be using ChatGPT, Sarah. So we all have that reminder. I'm interested more broadly of that reminder that we have today on our dependence on data centers in the here and now to get our trading numbers, the CME having this issue because of cooling equipment over in Chicago. How much more vulnerable do we become as we start to see the data center build out?
We're wildly vulnerable, right? We know that we are on an infrastructure side. If you track Europe, especially a lot of the smaller European countries, you're seeing this pretty consistently, that there are sort of nation state actors who often are attacking grids, who are attacking, sort of large swaths, just shutting down entire companies for days and weeks at a time. The wild part is a lot of times this isn't happening from PhD masterminds. It's kids that they're teenagers that they're recruiting off of Discord to do little pieces of this. And so the entire sort of global, whether it's financial infrastructure, airways, transportation system is just so incredibly fragile, both to just sort of natural errors, natural disasters, things like that, but also to specific bad actors. And I don't think that there is enough sort of understanding of that until things start to go wrong, and then everybody kind of panics, and then it gets fixed and you hope that it won't happen again. But the reality is it will happen again. It'll continue to happen. We've seen crazy amounts of ransomware happening around crypto, and as the price of Bitcoin continues to stay pretty high, we're going to see more and more of that. It is sort of dangerous on certain times, but we tend to not think about it until we're sitting around the Thanksgiving table and our grandma says, oh yeah, I lost $20,000 right to a scam, and then that feels like it's N of 1, but it's really not.
Sarah, many might have been sitting around the Thanksgiving table discussing $91,530 is back where Bitcoin is. But tell us about whether they were sitting around the table, and going back to your Michael Burry comment and understanding the depreciation of GPUs at this moment. I mean, that was what the anxiety all suddenly hinged on, was ultimately whether we're understanding the building blocks of the valuation of some of these companies, like an Oracle, like a CoreWeave, like some of the key users of this infrastructure that we really don't understand how long it lasts.
Absolutely. You know why? Because understanding GPU depreciation is one of the most boring topics you could ever have to become an expert on, right? And it seems sort of obvious when you start to dig in, but it turns out that actually the difference between a GPU lasting 3 or 4 years, which is what the experts tend to think, and closer to 6 years, which is how these companies are marking the depreciation, can mean massive swings when you're talking about some of the biggest companies in the world who are driving most of the value appreciation in the global markets. And so, you know, people have to decide what they're comfortable with. They have to decide, you know, where they want to underwrite these companies. But it is a little bit nerve-wracking that this is a 3 to 4 year asset, not a 6 to 7 year asset. And there has to, at some point, be some agreement in the market, I think, on what happens in, you know, that all-important year 5.
Sarah, always a pleasure. Sarah Kuntz over at Clio Capital, a closer read on the markets, a closer read on the AI trade. And now we take you around the world for other stories floating around this morning with our Bloomberg Brief and Lizzie Burton.
Hi, Romaine. President Trump has called for reverse migration in the U.S. and outlined measures to crack down on immigration. He said he would permanently pause migration from all third world countries and denaturalize migrants who undermine domestic tranquility, and end all federal benefits for non-citizens. Trump offered no details of how he would implement those policies. Elsewhere, Russian President Vladimir Putin said that US President Donald Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during talks in Geneva, which can be the ground for the talks. According to reports, the Kremlin will be discussing the peace plan next week. And at least 128 people have died and dozens were injured in a blaze at a Hong Kong high-rise complex. The operation is almost complete as firefighters enter all units in the 7 buildings to ensure that no one else is trapped inside. Police have arrested 3 senior figures from an engineering company on suspicion of manslaughter. And that's your Bloomberg Brief. Romaine.
Coming up next year on the program, Terry Haynes of Pangea Policy, a closer look at the renewed immigration crackdown by President Donald Trump on the heels of that tragic shooting in Washington just a couple of days ago. This is Bloomberg Surveillance.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. Reduce the opportunities. That allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
U.S. Commerce Secretary Howard Lutnick says the European Union needs to change its digital regulations in order to set a deal to lower steel and aluminum tariffs. Lisa Abramowitz and Danny Berger caught up with the Commerce Secretary earlier this week.
That kind of decision sits right on the desk of Donald Trump, right? He's got Jensen from NVIDIA who really wants to sell those chips, and he's got a good reasons for it. There's an enormous number of other people who think that that's something that should be deeply considered. And the benefit that we have is we have Donald Trump in the Oval Office. He is going to weigh those decisions. He understands President Xi the best. He will decide whether we go forward with that or not. That's on his desk with lots of different advisors. The president loves to hear lots of different voices to make those kind of decisions, and he'll decide whether we sell those chips or not, and then we will go execute it however he decides to go forward.
There's a bigger question here, Secretary Lutnick, about what national security is. Is it more of a national security risk to give China some of these high-powered chips, or is it more of a national security risk to not have U.S. tech in China? Has your view on that changed?
Well, that's the question, exactly as well put and in front of the president, which is, do you want to sell China some chips and keep them using our tech and our tech stack? Or do you say to them, look, we're not going to sell you our best chips. We're just going to hold off on that, and we're going to compete in the AI race ourselves. So that is the question. It's in front of the president. He's going to decide. It's a really, really interesting question. He's got all the information. He's got lots and lots of experts talking to him, and he's going to decide which way he wants to go forward.
Secretary Lutnick, meanwhile, use of IEEPA for tariffs is in front of the Supreme Court. The feedback has been skepticism so far from many of the justices, conservative ones included. As this plays out, can you walk us through how you'd prioritize the different alternatives should the administration's use of tariffs via IEEPA get struck down?
So I was in the Supreme Court. I sat through the whole argument. The justices were tough on the beginning on the Department of Justice's, our person. But then they were much tougher on the other side, much, much tougher. So I left that day feeling very confident that we and the president was going to prevail on these IEEPA tariffs. So I think, you're hearing it from me, I think I was there in the courtroom. I heard it all the way through. I didn't sort of write my story halfway through. I sat all the way through to the end. The president's going to win that case because that makes sense for him to win. But I want to remind you, the president has lots of other authorities. He has 232s, he has 301s, he has 338s, he has a whole variety, 112, 122. He's got all sorts of other powers. And tariffs are going to be part of this administration going forward, but I don't think they're going to be necessary because the president's going to win the IEEPA case in front of the Supreme Court.
Part of our conversation with U.S. Commerce Secretary Howard Lutnick from earlier in the week, and it takes a closer look at the president's policies. Of course, the president inaugurated just 10 months ago. Trade was a big pillar of what he campaigned on, and trade has been, of course, a big pillar of what he's implemented. Another big pillar of his policy positions has been, of course, immigration. And we're learning just over the last few hours that President Trump plans to ratchet up some of those restrictions, calling for an additional crackdown on immigration in a pair of Truth Social posts where he writes that he would, quote, permanently pause migration from all third world countries. This comes following the shooting of 2 National Guard members in Washington on Wednesday. Joining us right now is Terry Haynes, who heads Pangea Policy. And Terry, I do want to start with some of the president's comments and rhetoric over the last couple of days on the heels of what we should point out is a very tragic shooting that we saw on Wednesday of those 2 National Guard members. 2 National Guard members sent there effectively by the president from West Virginia, or at least on his orders. And now the fallout from this shooting, which seems to involve a suspect with ties to Afghanistan and, quite frankly, ties to the U.S. government as well. What does an immigration crackdown, if at all, accomplish?
Well, I think what's happening here, Romaine, is the president, as he normally does, is taking an immediate position that's very action-oriented and kind of very clean and pure, and doesn't get down into the second and third order issues that involve implementation or anything else. What I found in the middle of the rhetoric and what will happen, I think, immediately here is there will be some kind of a freeze. But the most important thing to take from the president's statement yesterday, I think, is that the status of a lot of these things are under review, and in Washington, review is usually code for we're going to take a step back and take a more nuanced look at this. So I think what's going to end up happening is you're going to have some immediate action by the president on a temporary basis, but that they will take a much closer look and a much more case-by-case look going forward at a variety of different cases. And I think also it's worth mentioning that I'm sure the Afghan community in the United States, particularly those who came here since 2021, feel very much a threat this morning. And I'm sorry about that. And at the same time, I think what will end up happening is that what will be found is that the vast majority of people who have come here, whether from Afghanistan or other countries, have done so legally under proper process. Let's not also forget that Congress is heavily involved in this, and Congress has the ultimate authority over immigration policy. So I expect some coordination with Congress as well.
Is there a sense here, with regard to the immigration policy, it's one thing to say we're pausing any sort of new entry of folks, but you mentioned obviously the Afghan community here, and we've seen with at least past immigration policy positions by this president this year that sometimes those things fanned out, not just so much to the people coming into this country, but people who are already here. Do you think we are going to see, I guess, an additional sort of level of deportations because of the issues that transpired over the last couple of days?
I think as a practical matter, that's unlikely, Romaine. You've got to say a couple of things. First, let's remember that the administration already makes much out of the fact that illegal immigration into this country is basically stopped. So there's not much more to do there on that front. So what needs to happen now is they need to kind of cull, parse, understand better who's in the country and who might be a threat. What's been found very generally from a lot of these immigration sweeps is that the vast majority of these people have not had criminal records, have not had not be seen as a threat of any kind. If that's any indication of what they're going to find from these reviews, I think the vast majority of people who have come here are going to be okay.
Yeah. Terry,
it'll take a while.
Yeah, briefly, we know that he sharply reduced the refugee admissions cap. We understand that there's been a focus on migrants from several significant countries. But the H-1B visas as well, just briefly, how much is this impacting the economy more broadly, do you think?
I think it has some impact, sure. Largely because, Caroline, what ends up happening is just like in any other sector or industry, companies that have been comfortable with the existing system now find themselves jolted. And in a situation like H-1B, where they're relying on these highly skilled folks to come in, these specialists, if you will, that provides a particularly larger jolt. So you've got a situation where all of a sudden, not only can't you rely on a talent pool that you might have been able to rely upon a year ago, for example, but you got a situation where you've really got to scramble to figure out exactly how you're going to manage your business going forward.
Terry Haynes over at Pangea Policy, a closer look at the situation in Washington. When we come back, we turn back to the markets and we turn back to the retail space here on this Black Friday, the unofficial start of the holiday shopping season. We're going to catch up with Stacey Widlitz over at SW Retail Advisors. Plus, Lizzie Burton will be back with your morning movers. This is Bloomberg Surveillance.
We're coming to you live from Kuala Lumpur. The whole world is
The
here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning to our viewers worldwide from our New York headquarters. This is Bloomberg Surveillance. I'm Romaine Bostick alongside Caroline Hyde. We do want to check in on what the futures market is doing here on this Friday morning. Well, they're not doing anything, Caroline. We should point out one of the reasons why we're showing you the ETF activity right now instead of the typical Dow, S&P, and NASDAQ futures is that CME outage, which began to unfold just roughly about 12 hours ago. It happened Thursday night, a bit of an outage at a data center out in Illinois. That actually shut down futures activity across the board. We have seen some things come back online, including some FX trading, as well to some degree some European equity trading, but at least for right now, no equity futures activity right now at 7:30 a.m. Eastern Time.
It was only back, technical error back in 2019 was hours-long outage for the CME, but this is really lasting a long time, and it all goes back to the CyrusOne, that data center provider out in Illinois, as you say, that seems to have a cooling issue. But marked from the 27th, there are traders out there, Bloomberg interviewing them, saying, look, it's flying in the dark at the moment. We haven't got enough sentiment check. As you've mentioned time and time again, though, this is a low, thin volatility day. Many people did their books on Wednesday before they went out for the holidays. So probably if you were going to pick a time for this sort of outage, it's going to cause the least damage on a day such as this.
A good point. Here in the U.S., typically 3 days tend to be the lowest volume days, and those are basically the sessions right around the 4th of July, right around Christmas, and right around Thanksgiving, either the day before or after. And today does not appear to be any different. The volume likely going to be even much lighter when we get to the cash session in about 2 hours, partly because of futures, at least for right now, still being constrained. This is the final trading day of the month, and we will talk a lot about the big sell-off that we saw earlier this month, and more importantly, the big rebound that we saw towards the end of the month. Let's check in, though, on some of the individual stocks that are moving here on this Friday morning with Lizzie Burton. Lizzie.
Hi, Romaine. Well, of course, we are keeping an eye on CME shares in the pre-market. They're beginning to gradually restore operations after that hours-long outage that disrupted global markets, as you've been discussing. But don't forget, this is a publicly trading company. So CME shares down 0.8% in the pre-market. Also keeping an eye on shares in Oracle. Morgan Stanley warning that a gauge of risk on Oracle's debt reached a 3-year high in November, and things are only going to get worse, they say, in 2026, unless the database giant can assuage investor anxiety about their massive AI spending spree. So you're looking at those shares down 1.8% in the pre-market right now. Also watching Tilray shares down after the cannabis company announced that it's going to implement a 1-for-10 reverse stock split of its common stock. So down 14% almost in the pre-market. Romaine, back to you.
All right, also on our radar this morning, keep an eye on President Trump and his latest call for a strict crackdown on immigration. A pair of Truth Social posts has the president writing that he would permanently pause migration from all, in his words, third world countries. This comes following the shooting of 2 National Guard members in Washington, a suspect in custody said to be an Afghan national. The president also saying he may substantially slash or completely cut out income tax over the next few years because of revenue generated from global tariffs. Trump made the comments to U.S. military service members on a video call on Thanksgiving. Now, the biggest shopping day of the year, well, is already here. It's Black Friday, and retailers are trying to rein in the discounting to cope with the impact of those tariffs. At the same time, shoppers are feeling the pressure and searching for the best value for their money. Stacey Woodlitz is president of SW Retail Advisors, more than 20 years of experience analyzing global brands, retailers, and all of the trends. And she says retailers are actually emerging this year stronger than before. I want to talk about that, Stacey, because the last few years, let's just say the last 5 years, basically since the pandemic, retailers have really had to contend with quite a bit. Is that kind of behind them right now, or are they just dealing with a different set of problems?
Well, right now they're dealing with a completely different set of problems, right? Because we've had certainly the tariff fears about we have to raise prices and consumers won't pay, but we're seeing quite the opposite right now. The numbers that just came out in the last week have been incredibly strong. And we've also seen that price increases have been passed on when there's innovation and really there's a reason for the consumer to buy. Best Buy has talked about that the consumer is willing to spend on upgrades to computers and when there's really exciting product. So I think, in this environment, companies have really been forced to take a look at their inventories and say, we need to keep it lean. And as a result, there's not a lot of extra inventory this season. So I think you need to get out there and take advantage of those blanket promotions today, because by the time Christmas rolls around, I don't think you're going to see those type of promotions again.
Stacey, I'm interested as to what else these companies are trying to do to protect their margins, because many would say companies have stomached most of the price pain, maybe passed it on some of the higher end goods, the PCs and the like. But more broadly, are they having to reduce middle management? And goodness, we've seen that over at Amazon, for example, in the corporate area.
Absolutely. So you're seeing three things. They're increasing prices somewhat. They're pushing back on vendors to take some of the pain from them. And of course, they're using tools like AI. Best Buy has talked about reducing touch points with the consumer by almost 20%. So it costs them less to communicate with the consumer. The consumer's happy because it's more consistent and there are fewer returns. So I think you're going to see more and more of the innovation that has the ability to cut out a lot of those extra costs so that the tariff impact is eased somewhat.
What's so interesting is, of course, you're advising more of the hedge funds, mutual funds, actual investors, private equity. But when you're thinking about a private equity play, for example, and they're advising their own retail portfolio companies, how are you helping them think about navigating generative AI? Because I'm thinking about Amazon, which has Rufus as an offering. I'm able to type within it. It doesn't particularly want me using ChatGPT, or dare I even say it, the likes of other offerings out there, the Gemini AIs. They don't want to be interacting chatbot on chatbot. So how are these retailers remaining in control of the relationship?
Well, I think how they're really using it right now is demand forecasting and inventory, and that's really the key, right? Because that's where retailers at the end of the season really get stuck with the markdowns. So now using AI, there's the forecasting is just so much better, and they're keeping inventories in line, and that's such a huge part of what we're dealing with for uncertainty. And of course, it's communicating with the consumer and being able to predict what they want. AI is now able to tell you what you want before you know it. So there's a big part there too.
But Stacey, I don't want it to tell me what I want. I want what I want. I don't want the robots taking over.
I agree. I agree.
I mean, anyway, in all seriousness, though, it gets to the idea, too. I am just curious if we could just kind of go back to maybe some of the individual retailers that you actually do see maybe potentially winning out this holiday season. I know you guys kind of put out your own list of those potential winners and losers, and I was looking through them. There were a couple names on there that kind of surprised me.
Okay. No, I think if you look at this season and who's winning, Walmart, it sounds boring, right? Own Walmart, but Walmart is capturing the higher income consumer. Most of their comp is coming from there. They're gaining share from Target, from Kohl's, basically from everywhere. So you've got the two giants, Walmart and Amazon. And, the higher end consumer is not afraid to shop there anymore. So they're seeing this huge shift. And, I'm looking at other names. We upgraded Urban Outfitters before the company reported because the Urban brand has had such a turn and they've completely eliminated promotions. That's usually your first sign that things are working. So that's another one. And I would say another underdog that we had a sell on for 2.5 years, Nike, we upgraded recently to a buy. We're finally starting to see inventories rationalize and lower percentage of items on discount year over year. So I think that could be the underdog turnaround of 2026 here.
Yeah, the Nike one intrigued me. We had a chance to catch up with the CEO a couple last month, and the idea of them sort of getting that inventory back under control after what was a huge buildup under the previous CEO. The question, though, is, I mean, Nike normally isn't known for doing heavy discounts, and once we get past this holiday season and whatever discounts are sort of forced to do to keep pace here, does that sort of inventory drawdown, does that potential return to meaningful sales growth, is that a 2026 story? Is that a long-term story, or is this just something temporary?
I think it's two things. I think they've cleaned up their DTC. So they were throwing promotions years ago that was 20% off and 25% off. They're just not doing that anymore. Also, the amount of stuff on discount is lower now. That's DTC. But if you look at wholesale, Foot Locker, their biggest partner that they kind of turned their back on years ago, is they're back together again. Foot Locker's obviously got a lot of cleaning out to do. They talked about on their last call, they have to clean out the garage. So there's still some cleaning out to do. But once those two channels get healthy and clean again, then the brand resets. And we are actually seeing some of the innovation out there that consumers willing to spend on some of the higher AUR tickets. And we've seen also a little bit of weakness in Adidas in the USA. We've seen some more promotions in the US from Adidas. So I think there's that share shift is actually, there's some movement there.
What's really interesting is the innovations of old that we saw in the way in which we want to spend money. I think of Urban Outfitters. I actually think of Newly. Now, I'm a complete addict to Rent the Runway. And how are people wanting to show up and be more thrifty and more eco-friendly with the way in which they're purchasing? Is that even a sentiment check particularly anymore, Stacey?
We've been talking about sustainability and eco-friendly for years, but I don't truly believe that drives the consumer decision making. I think it's a nice extra. What drives the consumer is innovation, fashion, newness, and differentiation, and of course, price. So, we're certainly seeing consumers right now, particularly in the middle and the lower end, still very price sensitive. So, you're seeing, again, the Walmart winners, you're seeing the Ralph Lauren winners at the two different bifurcations here, because the luxury consumer has the money to spend. We've seen this mass wealth creation that we've never seen before, and that is absolutely working for the higher end. But again, that middle and lower end, they're still getting squeezed, which is why you're seeing a Kohl's and a Macy's still struggle, and Target is just flat out losing share because of execution.
Stacey, Ralph Lauren, LVMH on some of your best ideas lists. How much are they baking in that basically this wealth creation, this wealth effect, this desire to purchase often has to do with the price of your assets, and often that has to do with the price of the stock market, which has been under some duress?
Sure, but I think, if you look at Ralph Lauren, for example, again, they went from a brand that was discounting heavy, and they just cleaned it up. They stopped discounting. They elevated their product. Their average selling price is still up double digits, and it's been doing that for several years. So, and you look at a company like Coach, same thing. Their average selling prices are up 30 to 50% since COVID, and the consumer's buying it. They're growing double digits. So again, it's about product, and it's about where strategically can you pass on price as you reposition your brand from that middle customer or the low-end customer, pushing up the spectrum to luxury, and that's where the spending power is.
All right, Stacey. We'll catch up with you again soon, I'm sure. Stacey Woodlitz over at SW Retail Advisors. You're a real person. I've tried to figure out real.
Real or Rent the Runway? I'm Rent the Runway. I'm not a real.
Oh,
I've sold one pair of shoes on Real, and I think I got all of $4 back.
Wow. Where'd you spend it all?
I think you afforded me one ice cream for one child.
Yeah, that doesn't even buy you a movie ticket, doesn't even buy you popcorn or anything, Caroline. Let's get an update on some stories going on elsewhere around the world. Our Bloomberg Brief and Lizzie Burton.
Hi, Romaine. Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. It signals an escalation in the government's criminal investigation into the high-profile dispute. TSMC has sued Lo Wei-jen, alleging a high likelihood that he shared sensitive information with Intel, something the US company denies. Elsewhere, Zara chairman Marta Ortega is trying to push the retailer into the rarefied world of high fashion, nudging it away from the fast fashion industry that it spawned. Zara's winning fast fashion model still underpins it as Shein and Temu reshape the $1.8 trillion global apparel industry. Ortega is eyeing that sweet spot, with haute couture brands hiking prices to stratospheric levels. And it was a day full of feast and football on Thursday. The holiday slate kicking off with the Green Bay Packers downing the Lions 31-24, the Dallas Cowboys defeating the Kansas City Chiefs 31-28, and in the nightcap, Joe Burrow returning for the Cincinnati Bengals, throwing 2 touchdowns and beating the Baltimore Ravens 32-14. And that's your Bloomberg Brief, Romaine.
Thank you, Lizzie. Caroline, you're a big American football fan, aren't you?
Massive. I might just cling to soccer knowledge in some way, shape or form and still call it football, but NFL, not my vibe. The shows, I'm all about the halftime.
Yeah, all about the halftime shows. Well, maybe you're all about the movies here. We're going to talk about the box office over this holiday week, we should say. Zootopia 2, that's good for the kids. What about Wicked for Good? That also did well, too. That's leading the holiday box office charge. A conversation when we come back with Daniel Loria over at the Box Office Company. This is Bloomberg Surveillance.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute energy news whenever and wherever it happens. I'm Joanna Bersecci in Vienna, and this is Bloomberg.
Disney's entertainment division, well, it's facing challenges heading into the new year. The company said that its new Avatar movie and other blockbusters will actually weigh on results in terms of marketing spend. My Bloomberg Tech co-host Ed Ludlow and I spoke with Disney's CFO, Hugh Johnston, earlier this month.
I thought it was a good quarter overall, and frankly, versus Wall Street, we beat expectations by 6 cents. So, as you noted, the experiences business did very, very well. 6% revenue growth, 13% OI growth was terrific. Sports did very strongly while we were launching the new DTC product, which is off to a great start. And then in terms of the entertainment business, it was largely just the overlap of the film slate that drove the numbers. I know the linear business looked a little bit soft, but that's primarily due to the fact that we had India in the numbers last year where we made $84 million and wasn't in the numbers this year. Take that out. Apples to apples basis. Overall, I thought the quarter was good. And it actually allows us to end the year with a lot of momentum. As we think about where we are right now, we grew EPS 19% for the year and 19% CAGR for the last 3 years. And that's why we both guided to double-digit EPS growth in 26. And on top of that, doubled the share repurchase and increased the dividend by 50%.
Hugh, good morning. On that momentum, the focus for a lot is streaming, right? And you have the confidence to say streaming is going to continue to be profitable through 2026. What are the factors behind that? What allows you to have the confidence to have such visibility into how that streaming business is going?
Well, of course, streaming always begins with the quality of the content that we have and the quality of the slate that we have going forward. So if you think about the film slate we have right now, number one, we obviously have Zootopia 2, followed by Avatar, followed by The Devil Wears Prada 2, followed by Toy Story 5, Moana, and then we've got an Avengers movie as well. So if I look at all of that playing its way into the streaming service, certainly feel good about those tentpole events. In addition to that, our TV side continues to perform very strongly. The ratings are great. The number of hit shows are great. And then on top of that, we're investing in the product in a significant way, creating a unified app. And in addition to that, improving our recommendation engines and improving the navigation within the DTC app. Put all of that together, and what we really see is just a huge opportunity for growth. We aspire to grow that business double digits, along with the double-digit margins we expect to achieve this coming year. And as a result, I think we're going to continue to see that business do really well and be a real growth driver for Disney.
That was Disney CFO Hugh Johnston there on the back of their earnings. Look, let's just talk a little bit more about Zootopia 2. It's leading the charge at the holiday box office right now. Let's talk more about the box office with Daniel Laurier, Senior Vice President of the Box Office Company. It's always great to catch up with you at this time of year. And Daniel, what are we seeing in terms of extent of demand compared to this time last year, where it was all about Moana 2?
Well, last year was the highest earning Thanksgiving weekend on record. I don't think we'll get there this year, but we'll get quite close. I think we've got a couple of titles really driving the box office. You've mentioned Zootopia 2 from Disney, but we've also got Wicked for Good from Universal, which is also really performing very well. Likely a #2 finish for the Universal picture.
And in terms of just people wanting to rush out and actually consume this in the theatre, in the cinema right now, how is that sentiment compared to wanting to consume at home, given the amazing backlog that we've been seeing and put out across Netflix and the like?
Well, we just heard from the Disney CFO, Hugh Johnston, on this program right before I came on, and he said it himself. Streaming is driven by titles that are theatrical first. There were no streaming first titles mentioned when he was talking about the great performance of Disney Plus right now. So you just have to look at why Disney is taking its best product, its product that's most in demand, and giving it a full theatrical exclusive release window in theaters. And that's because it's not only the most profitable platform for their best product, but because the audience demand is there. Right now, Zootopia 2 is not only leading the charge here in the US, it scored the second highest Thanksgiving Wednesday on record with 39 million. But it also did fantastically well overseas. China right now made $34 million in its opening day. That's a record for an animated title in the marketplace. We're likely looking at the second Hollywood release of the year from Disney, hitting that $1 billion worldwide mark in Zootopia 2. The one before that was Lilo and Stitch, which came out during Memorial Day weekend.
It's kind of interesting, though, Daniel, just with regards to the theatrical release debate here. I mean, what is that transfer with regards to the release in theaters, the pickup that it might get on the streaming services, and more importantly, the time frame. I mean, when you say a release, is it just release it for 1 week and then you put it on streaming, or does it need to sort of be out there for, you know, a month or so?
That's a great question. And I think Disney is probably the best company to look at when we look at how companies have experimented with that release window, with putting movies on their streaming platform in shorter time periods. In some cases, during the pandemic, Disney went simultaneous in the release date with Disney Plus and theaters. They experimented with a premium video on demand model on Disney Plus. If you remember, Scarlett Johansson, the star of one of their films, had strong opinions against that, ended up taking them to court for that very fact. So Disney's the type of company that has all that data, knowing what they can gain from going maybe with a shorter window theatrically, maybe with skipping theatrical altogether, as we saw during the pandemic. But right now, 5 years out, we see Disney doing fantastically well, and it's by going back to that exclusive theatrical release window of nearly 90 days in theaters before these things hit premium video on demand or Disney Plus. Disney has all the data in front of them to make that decision, and there's a reason why they went back to the model that worked for 100 years before the pandemic.
Well, I'm going to play devil's advocate here, too, because it is working, but it's also working primarily with those gigantic, big-budget, blockbuster, franchise, IP types of films. I mean, you go through the list of the top-grossing films of the year in theaters. I mean, basically the top 20. There's really only a couple of movies that could even be described as independent. I think Sinners is near the top, somewhere up there, and that's kind of an outlier. And it raises the issue. This has kind of come up with all the concern about the potential bids for Warner Brothers Discovery, and whether the companies that are bidding do really want to sort of stand by some of the theatrical release schedule that a Warner Brothers would have. James Cameron wading into the question as well. And I do wonder, Daniel, if there is more of a future that might actually be sort of streaming first, platform first, rather than theatrical first.
To be a viable industry, not a viable company, we've seen individual companies do well with a strategy like that, but to be a real industry, a viable industry that creates jobs and sustains employment, not only in Hollywood, but in movie theaters all over the world, we need to be theatrical first. We need to have a long and robust theatrical window. I think the data shows it. I think nearly every studio experimented with shorter windows, with a streaming first strategy during the pandemic. And with the exception of Netflix, which makes 100% of its revenue through Netflix subscriptions, every company has backtracked on that streaming first strategy since they went head in 2020. And I hear what you're saying about the independent films. I think that's definitely an issue to look at. But when you look at the box office performance, even in the record years between 2015 to 2020, even back then, a lot of those top 20 titles were the big blockbuster titles. A lot of the independent movies aren't made to be billion-dollar movies. They're made to be $100, $200 million movies. And we need more of those. We've seen that model work. If we look at a company like Sony a couple of years ago, they had a romantic comedy like Anyone But You really break through the box office and become a hit at that level. So we still have those instances, just not as many as I think we would all like.
Daniel Loria over at the box office company as we keep an eye on the broader markets. A headline crossing the Bloomberg terminal that the CME outage that had disrupted U.S. equity futures. Those equity futures will resume in about 30 minutes' time.
So I know from owning a sports team that only one team takes a lot of energy and time.
Tell me about it,
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the two teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only two teams that was independent.
So now you have two soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Feminine is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies. 1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
From New York City to our audiences worldwide, good morning. This is Bloomberg Surveillance. Romaine Bostick here with Caroline Hyde here on this Black Friday, the day after Thanksgiving. In today for Team Surveillance, John, Lisa, and Anne-Marie have the day off, but we do want to start with some breaking news, Caroline, and that has to do with the CME outage that began to unfold just about 12 hours ago, and we're now learning that it may now finally come to an end in just about 30 minutes' time.
Yeah, global futures options markets will pre-open right about now, in terms of Central Time, 7 a.m., 8 a.m. here in New York, but it's going to open fully 7:30 a.m. Central Time, according to the update on the website. So stay glued for some price action.
Yeah, and we should point out the price action traditionally on the day after Thanksgiving is relatively subdued, volume low. Markets close early, 1 p.m. on the equity side in the U.S. Eastern Time, 2 p.m. for the bond market. So that distorts the price action a bit, but it's going to be an interesting end to what has been a relatively volatile month. We came into this month with a huge sell-off over the first 2 to 3 weeks. And then, I don't know, something really happened over the last 4 or 5 sessions here. I guess people maybe found bargains and just decided that the sell-off was way too much.
The Fed happened.
Yeah.
Fed got a little bit more dovish and came in to give some stability to this market. We could see on the S&P 500 the biggest turnaround on a monthly basis, basically going back to the unwind of August of last year. This is almost a 4% shift that we've seen in terms of rallying back higher as we started to shake off the AI anxiety and instead put all of our hopes and prayers once again in macro policy and the Fed.
And it's interesting you bring up the Fed because there was a lot of hawkish commentary that scared investors earlier this month. And then, as you said, it kind of flipped to dovish. We should point out that starting tomorrow, the Fed has to go into its traditional quiet period. So assuming none of them are giving speeches today, which I would assume on the day after a holiday, they're not, you've basically heard all you're going to hear out of them. And we have to going to wait for that December 9th and 10th meeting, the decision on December 10th. And of course, that press conference, 2:30 p.m. time with Fed Chair Jay Powell. Coming up here on the program, we're going to get a read on where markets might go next, particularly in light of Fed rate cuts. Margie Patel over at Allspring Global going to be joining us in just a second. Lindsay Newman over at G0 Policy to talk about some of the latest changes to immigration policy coming out of Washington. And Janine Sticker over at BTIG going to be joining us to talk about the holiday shopping season.
You buying anything?
You know, I've done a lot of shopping because you know what? Those Black Friday sales, I feel like they started like in early October or something. I've been getting like 20, 30% discounts on things. So we'll see what kind of discounts we see later today. But I traditionally don't shop on this Black Friday. No. I either do it before or I wait till the last minute. So.
Why follow the crowds?
Yeah, why follow the crowd? Yeah, I don't know. I mean, I feel like everybody in my life has everything they need. I mean, what do you buy the person who has everything?
Experiences remain.
I don't know, that sounds expensive. All right. Well, we're going to begin with this hour with stocks here. Flat on the day, but more importantly, flat on the month. And that's actually, believe it or not, a good thing. The S&P is on course for its first monthly loss since April, but it could have been a heck of a lot worse. Just a couple of weeks ago, it was down almost 5% on a month-to-date basis. Now, basically flatline as we hear on the final trading session of the month. Margie Patel over at Allspring Global Investments out with a note writing that we expect a strong finish to stocks for the rest of the year, especially companies with exposure to data centers, electric power, and aerospace and defense. Margie joins us right now to talk a little bit more about that. Happy Thanksgiving. I hope you had a wonderful day yesterday, Margie. And we talk about what's going to transpire here over the next month. And we get this idea here of what the big rally was over the first, 6 to 8 months of this year. That was big tech. It was a lot of aerospace and defense companies. And, of course, it was the power companies. Are those the leaders going into 2026 as well?
I think they will, because when you look at the economy, we've had a moderate growth, a little under 2%, give or take, and we may see the Fed make another cut. But I think those trends are going to continue. Those are the strongest industries, not just cyclical, but also even secular because of the change for the data centers and artificial intelligence. So I think those are trends that we'll see continue for all those industries.
And this gets to the idea, Margie, about the idea of what actually drives that. I mean, this is less about the Fed and rates and more about earnings and, I guess, more importantly, that top-line revenue growth that a lot of these companies have been posting.
Yes, that's right, because a lot of people thought that, well, with all the uncertainty about tariffs, that would hurt corporate profit margins, it might hurt demand, might be some chaos in the economy. And yet it's astounding listening to companies that have just finished reporting their third quarter earnings. They seem to have been very capable to adjust for any little uncertainty they had relating to tariffs. So the main thing I think that we should look at is, are companies going to be able to maintain those high profit margins? And the answer looks like yes, they will. They've been able to pass on price increases. And I think you see that in this above average inflation rate. To me, that shows me that companies have pricing power, wages have a little bit of pricing power, and those are good things for the economy. They're really good things for the market going into next year.
Margie, therefore, just reflect on what's happened in the last 4 trading days of this shortened week. It looks like it's going to be one of the best 4 trading days since we've had since May of this year or so, Margie. So is there a view from your perspective? Was that Fed-driven, or was that, a buying opportunity because the valuations got so bitten up?
Well, it turned out to be a very short-term buying opportunity. And I think it's just really, after what's been a pretty good year for many investors, a little nervousness about, is it all over for big tech, which I don't think it is. And so I think you just see the short-term trading mentality saying, let's take some money off the table. You saw the reaction to the Meta and Alphabet agreement. The market sort of panicked as if that meant the end of Netflix, the end of NVIDIA's business. So we think that it's just a little bobbing around here, but we think December will be a strong month, and we think it'll carry over into the new year because, if anything, we should see the economy actually accelerate a little bit next year. So that'll be good for all the stocks.
Stocks, go a little cross-asset for us, because what's been building the anxiety in some of these AI plays has been the amount of debt these companies have been putting on. Now, no one thinks suddenly Oracle or Meta are going to go broke, but there is an element that we haven't seen this wall of corporate financing done in the debt markets and the bond markets in years with these big tech names. Does it drown out others? Does it force pricing up higher? And do you want to be buying at these sorts of levels?
Well, I think there's a tremendous appetite still for fixed income securities, for income that's above the money market rate. And I think that's a trend we're going to see. So even though there's been a big growth in supply, it's been more than met by ample demand. And a lot of these companies are borrowing not because they are short of cash, but simply as a strategic move to build up their liquid assets. Certainly the big tech names all have huge cash flows that look as if they should basically maintain. If they cut back on their capital expenditures, they'll still have ample cash flow to do their business. So I think it's just really corporate decision-making about the best way to deploy their balance sheet, and not a sign that it's all over for the tech sector.
I am curious, Margie, if you can talk a little bit more about the direction of rates, not so much just the Fed funds rates, but obviously a bit of stasis that we've been seeing in the Treasury market. And I know some of that stasis is tied to uncertainty about what the Fed does next. But of course, it's also tied to a lot of the longer term issues that we've been talking about here earlier. Does that shift at all in 2026? Do we see a more definitive move, either higher or lower for yields?
That's an interesting question. So far, the enormous amount of debt that we've issued has not had any effect on rates. And if you look at, say, the 10-year, it's at 4%. Inflation is maybe 2.75%. It's really pretty difficult to say that that interest rates are going to move up, or that there isn't a demand for these kinds of securities. So we think that so far so good, that even though we have an enormous amount of debt, we still have a much stronger economy than all the other countries that are also issuing massive amounts of debts to cover their own deficits. So certainly the deficit is a problem, but it still looks as if it's down the road and not something we need to worry about going into 2026. It looks like there'll still be enormous demand for the best quality debt securities, which is U.S. Treasuries or well-regarded U.S. companies. And you're even seeing in the high-yield bond market, yields are very much near their all-time lows. Spreads are narrow, maybe a 5.5% to 6.5% for most high-yield bonds, 2 or 3% more than Treasuries. So that's a market that's really almost starved for supply rather than ready to tip over and have spreads gap out.
All right, Margie, great to catch up with you. Margie Patel, Portfolio Manager over at Allstring Global Investments. It is Black Friday, and of course, this day gets that moniker, the day after Thanksgiving, because traditionally it has been the day when retailers who typically operate in the red for a good chunk of the year finally bump into the black as the holiday shopping season gets underway. But budget-conscious shoppers and a lot of concerns about the economy could complicate things. I had a chance to catch up with the CEO of Bloomingdale's as well as the CEO of Burberry. I got their expectations, and, well, surprise, they're a bit optimistic.
Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're refocusing on right now, is bringing experiences, not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, you know, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand in plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, you know, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas, so I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
Olivier Braun, the CEO of Bloomingdale's, and Joshua Schulman, the CEO of Burberry, their outlook for the holiday shopping season. Let's get you caught up on some other stories going on around the world. Bloomberg Brief with Lizzie Burton. Lizzie.
Hi, Romaine. President Trump has called for reverse migration in the U.S. and outlined measures to crack down on immigration. He said he would permanently pause migration from all third world countries and denaturalize migrants who undermine domestic tranquility. And on top of that, he'll end all federal benefits for non-citizens. Trump offered no details of how he would implement those policies. Elsewhere, Russian President Vladimir Putin said that US President Donald Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during the talks in Geneva, which could be the ground for the talks. According to reports, the Kremlin will be discussing that peace plan next week. And at least 128 people died and dozens were injured in a blaze at a Hong Kong high-rise complex. The operation is almost complete as firefighters enter all units in the 7 buildings to ensure that no one else is trapped inside. Police have arrested 3 senior figures from an engineering company on suspicion of manslaughter. And that should be my brief. Romaine.
Our thanks there to Lizzie Burden with that update. And just to update you once again on that outage at the CME, we are awaiting the reopening of futures fully in just about 15 minutes time at the bottom of the hour. When we come back, we're also going to talk about some of the policy changes coming out of Washington. Lindsay Newman over at G0 Policy going to be joining us specifically to talk about that immigration crackdown by the president. That's coming up next here on Bloomberg Surveillance.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
President Trump calling for a strict crackdown on immigration. In a pair of Truth Social posts, the president writing he would permanently pause immigration from all third world countries, posting that yesterday. This comes following the shooting, of course, of 2 National Guard members in Washington. Let's talk about this with Lindsay Newman, geopolitical risk expert and columnist at G0 Media. Lindsay, third world, a very open term, a nondescript term. From your perspective, how did you read into these posts?
Yes, absolutely. Thanks for having me on. This language that he is using is yet to be defined by the president or the White House through any sort of news release or executive order. And so that's, that will be something that we're watching. But what the attack Wednesday did was really put this issue of domestic security, domestic threats, national security, and immigration back to the top of headlines, why we're talking about it today. In his first remarks following Wednesday's attack, Donald Trump explicitly called the attack a terrorist attack. And he said, in fact, immigration is the greatest threat to national security in the U.S. at this time. We know from polling itself that Americans agree they still see immigration as a top 3 issue area. And the Trump administration is ideological about immigration. They care very deeply about who is allowed to enter the country, who is allowed to stay in the country, and enforcement. And they have a playbook for this. So this is not surprising. These posts on Truth Social yesterday should not be surprising. They're not surprising to me as an analyst and watcher of the U.S. The administration feels very strongly that it knows how to tackle immigration through everything from day one, the so-called travel ban of the first administration. This language from yesterday sounds very reminiscent of that. But even on his first day in office this time around, he had an executive order pausing the refugee program. So this is all very much in line with the longstanding policy of this administration.
Of course, the context to what occurred was the attack by an Afghan national on the eve of Thanksgiving holiday in Washington that led President Trump to really amplify this anti-immigration policy. You say it's clarity really coming from the administration in terms of at least what we've heard in prior administrations and indeed at the beginning of this administration, Lindsay. Is there clarity enough for those that are either seeking asylum themselves. I mean, there's 190,000 Afghans who've come to the United States since 2021, but also those who are working on behalf of them or those who are looking to employ those that are already here. And this is called a reverse migration policy.
Yeah, I mean, the big phrase here is political risk, right? That's what I do for a living. This is a political risk issue now. Immigration is a political risk issue in the U.S., and we know that the U.S. has become the greatest exporter and manufacturer of political risk worldwide. So if you are looking to come to the U.S. as a refugee or just as an immigrant yourself, the policy of the U.S. administration, the U.S. government is changing, is constantly fluid. And I would say there is a chilling Trump effect on immigration levels. If you look at U.S. border crossings at that southwest border, just a year ago in September 2024, there was more than 100,000 attempted crossings. In September of this year, it's only about 11,000. So since Trump took office in February, immigration attempts at the southwest border have fallen off a cliff. That's the Trump effect for you. And so we will certainly expect that there will be further statements from the administration itself in a more official capacity than what we saw on Truth Social in coming days. But it is a fluid and constantly changing situation. And what I would just point out is what was very interesting in those truth posts yesterday is Trump actually connected immigration to this issue of affordability and economic gains. He says in the statements itself that because of immigration, it has eroded U.S. economic gains and prosperity. Trump knows that the issue of affordability will be the issue that comes up. That's the top issue for the midterm elections in 2026. He actually won in 2024 because he asked Americans, are you better off today than you were 4 years ago? And the majority of them said yes. They're going to be asking themselves that question in 2026. And Trump and the administration think maybe immigration is the throughway to how they can help voters feel as though they have some sort of direction on that affordability issue.
Yeah, it'll be interesting to see if they can thread that needle. I'm not sure I see exactly how they sort of connect that dot, certainly from a practical standpoint, maybe from a political one, Lindsay. But as we get sort of deeper into next month, in addition to some of the issues around immigration, of course, this is an administration that is also trying to deal with the situation in Ukraine. And I know looking ahead to next week, some high-level talks among the Europeans and the Ukrainians about trying to bring an end to Russia's war with Ukraine. Should we actually expect anything out of this? I mean, based on what we've heard about that quote-unquote peace plan that's on the table, at least for right now, it seems like both sides are still very far apart.
Yeah, thanks, Romaine. I mean, I can very confidently say this is the closest we've been in 3.5 years to a peace deal, but that does not mean that we're going to have a peace deal. We know that the U.S. administration is very motivated to see this war brought to an end. Trump sees himself as a unifier and peacemaker. They've had these conversations with Russia, the 28-point plan that received a lot of blowback, we all know, about being too pro-Russian because of the ceding of the requirements that Ukraine would cede territory, restrict its military, would never enter NATO. I would say there were some provisions that really did protect Ukraine in that 28-point initial plan, including security guarantees, a lot of funding for rebuilding, but that's sort of been swept aside and lost in the broader narrative around this deal being pro-Russian. There was subsequently conversations in Geneva between Ukraine and the U.S. And as Putin said yesterday, that deal has plan has sort of moved into four groupings, 4 areas. We haven't really seen that language yet about what those 4 areas exactly are. And next week, as you say, U.S. envoys will be traveling to Russia. But the big question is what's in Vladimir Putin's mind? And nobody knows his reaction function.
All right, that meeting with European leaders set for Monday, and then later in the week, you get more NATO members meeting as well to talk about that issue. Lindsay Newman over at G0 Media. When we come back after the break, a conversation about the Fed, a conversation about December rate cuts. Simon French over at Pan New York joins us next.
technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Welcome back to Bloomberg Surveillance. Keeping an eye right now on the potential opening of equity markets here in the U.S. The cash session starts in about 1 hour, 9:30 a.m. Eastern, and normally we keep an eye on those futures out of the CME, but the derivatives market suffering what has now been roughly an 11-hour outage of some degree or another. So, Caroline, we have to take a look right now at the ETFs, 0.4% across the board. Though we should point out the CME did say we would see a resumption of U.S. equity futures trading at the 8:30 mark, and looking at my Bloomberg terminal right now, it does appear those numbers are starting to come in, and they are relatively in sync with what we're seeing with ETF futures right now. S&P futures up about 0.2%, NASDAQ futures up 0.3%, Dow futures up by about 0.1.
And the 0.2%, look, it's not going to move the needle, particularly on the S&P, but it's worth reminding ourselves, it's only about a percentage point off a record high. So amid the volatility of November, and this is the last trading day of that month, we are seeing quite a phenomenal reversal in what had been dour sentiment to kick us off at one point. Now we see maybe a reclaiming of some of those record territories. NASDAQ, as we see, up about 0.25%. We might as well remind everyone, liquidity is going to be thin, trading volumes barely there. We are on a day after a public holiday, which is why you and I are sat here since 6 in the morning.
And that's right. No other place I'd rather be on the day after Thanksgiving than right here in our very chilly Bloomberg Surveillance studios. Also an interesting month too, Caroline, because we talk about the market being on the back foot. And you look at the big winners, the individual winners, you're not going to find a big tech name at the top of the leaderboard. It's Albemarle, Eli Lilly, Merck, Kenvue. Akamai appears to be the only tech name in the top 10 in the S&P 500 on a month-to-date basis.
Probably doing rather well after Cloudflare had its outage, and Akamai, a key competitor there. But healthcare, top sector, nearly 10% gain, just shows you that reversal of maybe the spreading, the diversification that we've all been promised about.
Yeah, and I think that is actually could be a net positive for the market as people shed some of their profits out of Oracle and Palantir and the likes here and start to look for some other opportunities around the horn. That is a closer look at what happened on the month. For a closer look at what's happening in the pre-market, let's take a look at some of the individual movers, our morning movers. There's Lizzie Burden. Lizzie.
Hi, Romain. Well, you talk about the CME outage, and its shares are in focus. Remember, this is a publicly listed company. Yes, they're restoring operations after that hours-long outage that disrupted global markets, but still, in the pre-market, the shares are in the red, down 0.3%. We're also watching shares in Oracle. Morgan Stanley warning that a gauge of risk on Oracle's debt reached a 3-year high in November, and things are only going to get worse, they say, in 2026, unless the database giant can assuage that anxiety among investors about their massive AI spending spree. So you're looking at those shares down 2.6% in the pre-market. Finally, let's look at Tilray. Shares down after the cannabis company announced that it's going to implement a 1-for-10 reverse stock split of its common stock. They're down 13.7% right now. Romain and Caroline, back to you.
Lizzie, thanks so much. Look, also on our radar this morning, the CME, as we're just hearing from Lizzie, is actually restoring most operations after hours-long outage crippling key parts of the financial markets. The trading halt was caused by a cooling system malfunction, we understand, at a data center in the Chicago area, according to facility operator CyrusOne. President Donald Trump, meanwhile, is calling for a strict crackdown on immigration in a pair of Truth Social posts. The president writing he would, quote, permanently pause migration from all third world countries. This post yesterday comes following the shooting of 2 National Guard members in Washington. And investors, well, they are betting that the Federal Reserve will cut interest rates again in 2025. Policymakers set to meet next month. Well, actually, just a day or so is when we turn to the next month. Markets pricing signaling now roughly 80% certainty of a quarter-point move. Let's talk about the Fed. Let's talk about what's happening in the UK a little bit more as well. Simon French joins us, Panmure Liberum, Chief Economist. Now, I know you've been really focused on the budget, but I do want to focus a little bit on what's happening in terms of central bank and macro policy here in the United States. Is 80% reasonable for the amount of chance we have of a cut come December?
Yeah, morning, Caroline. Look, absolutely. And I think the weak data that we've had this week on the US consumer, US retail sales has taken us back to where we started the month. It's been a case of the odds moving out on a Federal Reserve cut, which we've thought actually all month was likely, underscoring the US consumer. But it looks like this week's data has taken us back to the market agreeing with that position. I think the more interesting question for asset prices is the degree to which it is one insurance cut or whether actually it's followed up in January. And I think that is much more, we'll have much more data. The FOMC will have much more data. And I think that's where the sort of market question marks that could move quite a lot during the month of December in the run-up to the Fed meeting.
It gets to the question, too, about the balance of that dual mandate, Simon. I know traditionally labor market concerns typically trump inflation and concerns, but we're talking about an inflation rate that has been elevated above the Fed's target for going on 4 years now. Meanwhile, you have a labor market, while showing cracks, has actually been kind of outperforming some historical averages over the last couple of years. Where's the balance?
Well, I think it's the privilege that the US has, perhaps in contrast to European central banks, of having a symmetrical dual mandate and being able to pivot. I mean, there is very little likelihood, for example, if the ECB was staring down at the same combination of consumer confidence and inflation, that it would be considering a cut. But the Fed is not in that place. I think, personally, if FOMC members, which have consistently thought that neutral is close to 3%, perhaps just below 3% in terms of the Fed funds rate, they can afford to thread the needle and say, look, we're still in restrictive territory, we're still leaning into inflation, and yeah, it doesn't need to lean in to quite the same extent with the Fed funds rate where it is close to 4. We can tack down to closer to what we think is neutral, and let's be honest, we're all guessing, including the FOMC, where neutral is, and still have a credibility in the marketplace of saying policy is restrictive.
Is there any concern that you have as an economist about the lack of synchronicity that we're seeing right now with regards to monetary policy across the world, at least among the major economies?
I think it's a really, really important question. And FX markets telling you that they're not quite sure whether, while explicitly the Federal Reserve has that dual mandate, whether other central banks will then, if you like, follow suit. And to some extent, you're starting to see that play out in some of the sort of dollar cross rates. I think dollar-euro at the moment is telling you that we're not sort of convinced that the ECB will have further easing to do in 2026, and therefore that strength of that cross rate against the dollar. In terms of divergence of funding costs for the underlying economy, though, actually we're seeing, if you like, corporate spreads across the world matching, Fed expectations, actually not so much, if you like, smaller central banks, smaller, more local central banks, perhaps policy stances.
Let's talk about your local central bank, to the policy stance taken by Chancellor Reeves this week. I mean, many feeling extraordinary data coming out of YouGov just showing how negatively, overwhelmingly negatively, the British public are reacting to this, feeling that most feel it's unfair. Half of those surveyed feel it would leave them and their family worse off. Most think the economy is going to get worse over the next 12 months. What does the BOE do with that, Simon?
Well, the BOE probably cuts in December. I mean, you talk about 80, I think in your intro you said the Fed at about 80%, Bank of England's at 95% for a December rate cut. Why? Well, it was a 5-4 vote to hold earlier this month. In that scenario where the governor, Andrew Bailey, had the casting vote and he said, I want more information. Well, although it's unpopular information, and that YouGov poll you mentioned is illustrative of how that is polled with the electorate, from the perspective of Andrew Bailey having more information, he now has that. Again, it's more of interest for markets how that is followed up in the new year. There's probably a narrow window as a result of the budget, which is quite a disinflationary budget, to get a further rate cut out in Q1. But the UK still has a stubborn inflationary problem, courtesy of its energy market, courtesy of its labour market. Inflation has averaged 3% over the last 15 years. That's 100 basis points higher than the Bank of England's mandate. It has arguably more of a long-duration credibility problem.
What about the credibility that we're looking at with Japan right now? And how much is that more of a dictator on what's happening with the US dollar vis-a-vis, well, actually what's happening with the Fed?
Yeah, we're going around the world, aren't we? And I think the long bond yields in Japan are perhaps the element that is driving a lot of spillovers into pricing at the long end of the curve around the rest of the world. What I struggle with as an economist is looking at inflation expectations, long-dated inflation expectations in Japan, and going, well, this is purely a measure of, an expectation the last 30 years and no longer illustrative of where inflation is going to go. I think it's much more structural around a shift out of the Japanese insurance and pensions industry away from huge demand for long-dated debt to much more modest demand, a shift away from defined benefit pension schemes and defined contribution schemes that don't have it, much more like the 401k culture in the United States, which doesn't have a big demand for long-dated debt. We've seen in the US, we're seeing in the UK duration issuance move towards the short end. I think what you're seeing in the bond market in terms of Japan is also quite a big and rapid structural change in the demand for long-dated debt in that domestic economy.
I am curious, though. So when you look at some of the policies, at least the proposals out of Japan, and then for that matter, whatever the heck you guys are doing over there in the UK, should investors really be looking for meaningful, structural, broad shifts in, I guess, how these economies are actually managed, or are these things more just kind of filling in the gaps, if you will?
Depressingly, honestly, I think policy making here in the UK is filling in the gaps. Some big structural changes on the flexibility, the nimbleness of European economies, Asian economies, to make them more analogous, perhaps, with the dynamism and the nimbleness, the productivity that has been squeezed out of the US economy. There are little signs around the edges. Taken on a multi-decade view, do I think, perhaps a controversial comment, that Donald Trump, maybe Vladimir Putin are the best things that happen for the European economy? It forces investment into defense and technology that should yield productivity improvements. But you're seeing that as a glacial shift in the allocation of investment, not at a kind of pace that is going to affect sentiment towards growth, productivity, risk assets quickly.
This is going to be a little bit of a loaded question, Simon, but it also gets to this idea of economic mobility and the idea that there are a lot of people that look at these policies and say this is going to, force companies and the wealthy to look elsewhere. This isn't just a UK problem; it's a US problem. It's a problem for a lot of countries, and I do wonder if that mobility argument is a bit of a red herring, or are we going to see maybe the true financial centers and true financial capitals of this world maybe shift away from what has historically been our leaders?
Gosh, there's so much to that question. I think, with this morning in the UK, the story that JP Morgan are going to build a £3 billion complex in one of the financial areas, Canary Wharf, is running entirely counter with a lot of the media that suggests that actually the UK is closed for investment, closed for business. So there's countercurrents in terms of the narrative. Normally when that happens, I go, well, I'll go back to the data. It's kind of what the economists should be doing is, well, what do we know about emigration of, let's say, high net worth individuals, investors, founders? And unfortunately, the data, as with so much in the economy right now on the labour market, both sides of the Atlantic, is a bit of a fog. We have a lot of anecdotes about, investors, high net worths moving around, if you like, arbitraging their opportunities. But it is largely anecdotal rather than backed up by firm economic data. What seems to be going on is there is competitive arbitrage between jurisdictions, but you're getting flows from, three-dimensional flows coming out of the United States for people who are uncomfortable with the Trump administration, maybe coming to London, but people then in London going to the Middle East. There's a lot going on. It's quite difficult to have a definitive story to this because the data just isn't there to support.
All right, Simon, great stuff. Simon French over at Penn. And Caroline, I mean, you are transnational, right? I mean, based on your accent, you're not from Westchester, but you've lived in the U.S. for a long time, worked in a long time, and of course you are British by nationality. But it gets to this idea that two of the kind of pillars of the financial world, London and New York. I mean, there's been all sorts of talk about how it's over. Certainly here in New York, because apparently we have this democratic socialist taking over, and everyone's scared that everyone's going to leave. But it just seems like talk. No one really leaves.
The anecdotal evidence argument happening in the UK is phenomenal of the amount of people who are moving to the Middle East. And then we see the just boundless amounts of money that want to come into the US private market companies. I mean, where are the big AI giants turning to? They're turning to the Middle East. Are we seeing money moving out to Florida, if it's not moving out to the Middle East from New York? But as you say, the data is foggy and it's trying to understand from a case-by-case basis how many people are moving. It's interesting that Ken Griffin is teaming more with Ross on the East Coast, East Coast, to talk about this whole sort of golden tech coast that they want to be building from Miami down to Palm Beach. Look, ServiceNow have built an enormous set of offices. It's not their technical headquarters, but they're certainly putting boots on the ground in Palm Beach. Wonder how much more money moves there.
I mean, you've seen the activity. Anyone who's been down into that area lately, you can see the construction. Of course, a lot of concerns about, why you would build on that particular coast, but that's a whole nother conversation. Let's go back out to London, where Lizzie Burden standing by with our Bloomberg Brief.
Hi, Romain. Russian leader Vladimir Putin said that US President Trump's proposals for ending the war in Ukraine could be the basis for future agreements. Putin said that the 28-point plan was rearranged into 4 parts by Ukraine and the US during talks in Geneva, which can be the ground for talks. The Kremlin will be reportedly discussing the peace plan next week. And at least 128 people died and dozens were injured in a blaze at a Hong Kong high-rise complex. The operation is almost complete as firefighters enter all units in the 7 buildings to ensure that no one else is still trapped inside. Police have arrested 3 senior figures from an engineering company on suspicion of manslaughter. And Taiwanese prosecutors have searched the homes of a former TSMC executive suspected of leaking trade secrets to his new employer, Intel. It signals an escalation in the government's criminal investigation into the high-profile dispute. TSMC has sued Lo Wei-jen, alleging high likelihood that he shared sensitive information with Intel, something that the US company denies. And that's your Bloomberg Brief. Caroline.
Well, Romain, you, me, both of us.
Either one of
Lizzie,
us.
thank
Hey,
you.
we're a team. Thank you, Lizzie. Thanks for sharing the love here. Caroline, you know what we're going to do next? We're going to talk shopping. Of course, the Black Friday holiday shopping season is already here. A lot of concerns about the health of the consumer and the health of the economy. That conversation with Janine Stichter over at BTIG. This is Bloomberg Surveillance.
crises, two essential crises, and for both it's now or never, democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Black Friday gives us an excuse to focus in on the health of the consumer and the health of consumer companies. It's been about 1 year since Nike CEO Elliott Hill took over the helm of the world's largest sportswear company. I had a chance to speak with him and 3 key players in Hill's offensive strategy for exactly how the retailer is looking to put its best shoe forward once again.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
More than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab.
This is the home of the dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new Chief Innovation Design and Product Officer. They are 2 of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. It was a tenure that saw annual sales begin to drop in 2024.
We're going to obsess sports. I think that's been since Elliott returned. The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. Honestly, today is just a more modern, sophisticated incarnation of what Bill Bramman was doing in his lab, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka.
It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
And that was my conversation with the top executives at Nike as they try to turn around a company hobbled by years of discounting and higher inventory. And of course, that is a big part of the conversation heading into this holiday shopping season, not just for Nike, but really all of the apparel makers and retailers, how to navigate a very complex environment. Janine Stichter joins us right now, Managing Director of Consumer Retail and Lifestyle Brands at BTIG. And Janine, we've talked a lot before here about whether it's tariff concerns, whether it's about the capacity of consumers to spend, or even their willingness to spend. Does this holiday season, though, become an exception? Is it the idea that people will still go out and buy the things that their loved ones want to have? Or are they indeed going to maybe be a
spending? I think it comes down to exactly that. What we've seen over the course of really the last 2 to 3 years is consumers shopping around events and catalysts, and when there's a reason to shop, they find the way to do so. And holiday is really the prime example of that. When you're talking about gifting to your loved ones, people are finding a way to still continue to spend. So we're looking at holiday spending being up. Estimates would suggest around 4% this year. It's actually pretty similar to last year. Certainly there's some bifurcation there with the upper income consumer probably holding it a bit better, the lower income consumer struggling a bit more, but at the end of the day, they're still finding a way to come out and spend for the holidays.
It seems to defy gravity, Janine, in this way. We talk ongoing nature about the K-shaped economy, but we're also talking much more about more layoffs. We've been obviously having to turn to more private data on that, challenger data, for example, but we are starting to see people losing their roles, people either blaming technology and AI or whether it's AI washing. Why is that not showing up in people's ability and willingness to spend?
I think what will be the ripple effects potentially of this is we'll have to see how this shows up in consumer credit data. We have seen consumers leading more into spending on credit. Also, one thing that became really popular over the last few years during holidays, installment payments. Companies like Klarna and Afterpay that give consumers the ability to make that purchase, but then they have to deal with it later on. So that'll be something we'll be paying close attention to post-holiday, to the extent that consumers are dipping into additional spending capacity to make these purchases.
All right, Janine, great to get some time with you this morning. Janine Stichter over at BTIG, a closer look at the holiday shopping season. And Caroline, we should just update our viewers here on that CME outage that began about 11 or so hours ago. Now a redhead across the Bloomberg terminal, with the CME saying that all of its markets are now open and trading. Of course, the world's largest derivatives dealer out there here. It really disrupted our read on futures pricing across the board for equities, commodities, and FX.
And the idea that was many probably had shut up their books, or at least done the trades they needed to do before they went away for the Thanksgiving holiday. But this is the end of the year. Coming to the end of the year, it's certainly coming to the end of the month. There are likely to be some contracts out there that need to be tied, bow-tied, and we're seeing, particularly in the equity derivatives trade desk, I mean, there was about, what, $600 billion worth of notional derivatives that from a value that were set to expire today. Will that activity start to pick up a little bit?
Yeah, keep an eye on the cash session when it starts at 9:30 a.m., a shorter cash session that will end at 1 p.m. As Caroline pointed out, there are some loose ends that need to be tied up, and that could distort the price action. Meanwhile, Team Surveillance will be back on Monday with another big lineup. Alistair Pinder over at HSBC, a conversation with Amanda Lineman over at BlackRock, Seema Shah over at Principal Asset Management, and Abigail Watt of UBS. Romaine Bostic here alongside Caroline Hyde. We thank you for watching this morning. Happy holidays. This is Bloomberg.
Some people travel to see the world. I travel to question the forces that shape entire nations. How was it possible? My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
NYK sustainability efforts have produced a breakthrough. The tugboat Sakigake is the world's first ammonia-powered vessel in commercial use.
LNG can decrease emission of the carbon dioxide compared with the heavy fuel oil, the 25% more or less. But ammonia, 95% decrease can be achieved.
According to Bloomberg NEF, ships powered by LNG and other alternative fuels make up nearly 40% of the global shipping order book.
This is funded by the NEDO, so-called Japan agency, and also the NEDO has the kind of the GI funds and the Green Innovation Funds. And also the Japanese government is supporting the usage of the ammonia as the purging fuel.
It's more expensive than normal standard fuels.
Yes, it is. And at this moment, and the supply of the ammonia volume is very much limited compared with the LNG and also the heavy fuel oil. But in order to promote ammonia as a marine fuel, together with the other industry players, and we can have the kind of the mass production, then the cost will be decreased. Then the next 10 years, we try to increase the number of the vessels powered by the ammonia.
In case you missed it, on Bloomberg Crypto.
Overall, when it comes to regulation, SEC Chairman Paul Atkins has said that there's a lot the agency can do without Congress to regulate crypto. Should the agency move forward on its own in this way, or should it wait for congressional action, do you think?
I think it should do both. Part of the problem, Scarlett, in the last administration, you had companies getting heavy fines through enforcement action and fined for rules that didn't exist. I'm very pleased that Paul Atkins is taking the approach at the SEC that there are things they can do now. So companies, while they're waiting for legislation, can move forward with their plans. This is a fast-moving industry. It's a very large industry now, and the sooner they have clear rules of the road, be they at the SEC or through law, the better.
Don't miss Bloomberg Crypto live Tuesday.
In case you missed it, on Bloomberg Open Interest.
Well, if you're worried about inflation, maybe buy gold. If you're worried about tariffs, maybe buy gold. If you're worried that markets are too overvalued with the equity market and with credit spreads incredibly tight, buy gold.
What people are not talking about that they should be talking about is every major currency in the world is collapsing relative to gold. It's been going on for decades.
Don't miss Open Interest live weekdays.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Conan in Paris, and this is Bloomberg.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
The president wants lower interest rates from Chairman Powell.
How long can bull markets last? Give us a sense of where we are.
With Lisa Mateo on markets.
President Trump's tariffs really rock global markets.
And Michael Barr with news.
SpaceX's Starship rocket deployed satellites.
The best in economics, finance, investment, and international relations. This is Bloomberg Surveillance on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Lisa Mateo. We welcome all of you across the way you listen to us on Bloomberg Radio, on YouTube. Subscribe to Bloomberg Podcast, and we welcome Bloomberg Television worldwide, particularly the evening of the Pacific Rim and over to India. Thank you so much for joining us today. Sweeney with makeup. I have no makeup.
No.
Ed Yardeni said I'm not wearing makeup.
No,
in this hour, Mr. Yardeni in studio, a gift for you from Team Surveillance, Dana Telsey on Retail America, Julia Coronado. To me, the key thing with the Fed is not are they going to cut rates, but are they going to do it 2, 3, 4 times? Major mystery.
I'm looking at the work function here. Got an 80% chance of a rate cut here in December. That's good enough for, I think, the market. We'll see what they do in the new year.
Futures up 11 now after the CME soiree that we've had this morning. The VIX, I still don't have a good print.
A good VIX quote there, Tom.
Yeah, we'll have to see. We'll see if we get under to a 16 handle. Oliver Chen on Madison Avenue Luxury here coming up as well with TD at Cowen. Right to it from the Interactive Broker Studios for you worldwide. Lisa Mateo.
You said it. Futures, advancing on this day after Thanksgiving, but it's an early close. Don't forget the stock market closes 1 p.m. Wall Street time. The bond market open until 2 p.m. Wall Street time. S&P futures rising 0.1%. Same for Dow futures. NASDAQ futures up 0.2%. Over to the yield space, the 2-year 3.47%. That's little change. And the yield on the 10-year 3.9%. 0.99%, and that is little change. The Bloomberg Dollar Spot Index, not much movement there. Bitcoin up about 1% at just above 92,000. A few stocks to check in with: Alphabet up more than 1%, Amazon up nearly 1%. Black Friday shopping moving into full swing. That is your Bloomberg Business Flash. Paul and Tom.
Lisa Mateo, thanks so much. This is our Thanksgiving gift to you, and it is not only the question of nailing this bull market. Ed Yardeni, lonely. I'm going to give Ralph Van Campora joy as well. A few Octobers ago, saying get on board, but it is someone who's taken Yale economics and folded it into his strategy for participating in the American experience. No one has done this in the last 3-4 years post-COVID like Edward Yardeni. We're honored he joins us in our studio today. Are you here just as an excuse before shopping?
Shopping.
Are we shopping afterwards?
No. I came just for you, and not only that, I figured it wouldn't be much of a traffic jam on the Long Island expressways.
True.
So it's a combination of your request, and it's a perfect day to commute.
How do you extrapolate? The first question for Global Wall Street is to say, Yardeni has an audacious call that everyone's catching up to. SPX this, Dow 53,000, whatever. What is the Yardeni process to extrapolate out?
Well, I think that what we've gotten right over the past few years is the resilience of the economy, which is then, of course, related to the resilience of the consumer. And I think I sort of had inside information. I'm a baby boomer, and I'm seeing all my friends retiring. And then I'm looking at the data from the Fed, and it shows that the baby boomers have $80 trillion of net worth. It's the wealthiest generation ever to retire.
Thank you.
And, I guess some of them intend to spend it all because the kids didn't listen, they didn't clean up the room, whatever, but it's a lot of money. And I also see a lot of my friends helping out their adult kids with mortgage down payments, with mortgage payments, and with the kids, after school activities. So there's a lot of trickling down going on, and I think the consumer's been resilient. I've also been talking about the digital revolution with the technology boom. I mean, it was back in 2020 that I started to posit that this could very well be the roaring 2020s, and so far, so good.
So far, so good. And on that front, I've told my kids the last check I write is going to bounce. So, get to work. So, Ed, given that backdrop here, what is your view of this economy here? I mean, the labor market, people are a little concerned about the labor market. How do you think about that?
Well, one of the reasons we talked about the roaring 2020s is we anticipated that there would be a slowdown in the availability of labor. Baby boomers would be retiring, and we also would find that as a result of that, companies would be under a lot of pressure to increase their productivity, and perceive that there are a lot of technologies that existed not too long ago in 2020, and that we did spotlight that AI could be an important technology. Never expected it would just come out of the blue in 2022, but it did. And so we think that technologies are there to increase the productivity of workers. And we're seeing that just even now. I mean, second and third quarters looks like real GDP is up almost 4% each of those quarters. And at the same time, the BLS has been reducing the forecasts in anticipation of what the labor force will be. That adds up to tremendous productivity, which is great for real purchasing power of consumers, by the way.
Ed Yardeni with us, folks. The celebration is Friday after Thanksgiving. We welcome all of you. Paul, help me. 1 p.m. is equities close, 2 p.m. bonds.
Right.
It's nuts. Why do they do two separate times?
I don't know who's in charge of this stuff.
We welcome all of you across the surveillance nation on all the ways you listen to us on YouTube. Subscribe to Bloomberg Podcasts. And, of course, we welcome Bloomberg Television worldwide. A special good morning. Jemana Bersetchi in Dubai.
She's pretty solid.
Killing it on Horizons. Good morning in the Middle East on this special day for America. Futures up 11, Dow futures up 48. Ed Yardeni with us as well. I want to describe this, Ed, because I think it's important. James Tobin came out of Harvard studying under Schumpeter. Basically, the Nobel Prize this year, folks, was the Nobel Prize Schumpeter never got. Went down to a school in New Haven, Connecticut, and under him was Willem Bouter, Edmund Phelps, a young lady, Janet Yellen, as well.
Willem and I were there at the same time getting our graduate degrees.
It's just really, really austere. In the heart of Tobin and his wonderful eclectic economics of the 20th century was pay attention to nominal GDP. To me, the great missed call here to bring it over to corporate is animal spirit. Does your bull market extrapolation hinge just simply on nominal GDP?
Well, it does. Certainly, nominal GDP runs profits, and profits run nominal GDP.
And runs revenues.
And runs revenues.
At the top of the income statement.
Right. And, profits typically lead to companies expanding their operations in both labor and in capital. In the current situation, as we just discussed, there's a shortage of labor, so we're seeing a lot more spending on capital to increase the productivity of labor, and it's all good. Productivity is like fairy dust. It makes everything better. It makes real GDP better.
Right.
It makes inflation lower, and so you still get an increase in nominal GDP, but it's the right mix.
Let me get one more in here because Paul's got like 8 questions. With that said, when you look at Mag 7, which you have nailed, they're not under the same microeconomics of traditional corporations, are they? Discuss that.
Well, they have, some of them have moats around them, and it's kind of like Game of Thrones where, one is rising and another one's falling, and it's a very dynamic situation. But they do account for 30% of the market cap of the S&P 500, but they also account for something like 25% of the earnings.
Paul, can you see Zuckerberg going, cue the dragons?
Exactly. So, as we think about what a lot of people have called concentration risk in this marketplace, is that a risk to you? How concerned are you about it?
Well, it's not a concern to me because these companies are earning a lot of money and they have a tremendous amount of cash flow. And they also basically have internal investment banking departments where they are able to find small companies that they can leverage up in their businesses. I think it's one of the reasons that mid-cap, small and mid-cap managers have been frustrated because anytime that they put in the next Microsoft in their portfolio, it gets bought out.
Exactly. Well, how about for the small and mid-cap investors out there? Presumably lower interest rates should help those companies. Is that enough?
I think we can see it in the way things trade. Whenever there's expectations that the Fed will lower rates, the Russell 2000 does better. The problem is the Russell 2000 has something like 40% of companies that don't have any earnings. That's a little bit of a problem. But when people are excited and risk on, they're willing to buy those kind of companies. But my preference is I call them the impressive 493. Everybody's focusing on the Magnificent Seven. There's 493 companies in the S&P 500 that are benefiting from what the Magnificent Seven are creating. These companies, the Magnificent Seven, aren't going to continue to do well unless their products really do improve productivity for the 493. I think that's happening, and I do expect that the market will broaden out.
What is our Federal Reserve going to do here? I think the market's saying December we're going to get a rate cut. After that, not sure.
Well, the Fed really frustrates me. For the past few years, every now and then I've written that I would be more than happy to do what the Fed does for half the price. And my condition is I continue, if they allow me to work from home. I wouldn't do regulation or supervision, just macroeconomic policy. But a year ago when they started cutting rates, they're down 150 basis points since September of last year. I said, I don't think that's a good idea because the economy's doing pretty well and inflation's still above 3%. But they just wouldn't listen to me. They did it anyways. And you know what? The bond yield went up last year. Remember? They cut the Fed funds rate by 100 basis points. My friends, the bond vigilantes, took it up 100 basis points.
So Taylor rule with plugins. I can go 8 ways here, folks, on the plugins of Taylor rule. I'm going to say this, Dr. Yardeni, as clearly as I can. With the pandemic and with this original productivity experiment we're working, they're flying blind.
They're flying blind.
They're making, I mean, you know, with me, Pharaoh, Bramo, sitting on the set, the Fed decides we're making it up as we go.
Well, they basically admit as much in their dot plot. In the dot plot, you know, when you ask what is the neutral rate, so on average we think it's 3%. But then when you look at the dot plot, it's somewhere between 2 and 4% is the kind of range you get. So they have no idea what the neutral rate is. I think you have to look at the neutral rate ex post, after the fact.
I got one final question. Kurt Soup is out in Indianapolis for Creative Financial Group, and he's writing up these brilliant mistakes you make in retirement tweets. Real value add. Kurt Soup, S-U-P-E. Can't say enough about how he gets you thinking. How is Ed Yardeni saying we should invest if we're all going to live forever?
Well, I think the baby boomers especially were raised by Spock, and I know Dr. Spock had some influence on our mothers, but Spock from Star Trek basically told us, live long and prosper, and that's what we've been doing. So I think, you know, all investors should assume they're going to live long, and along the way, they should let the magic of compounding really make their retirement very prosperous.
Michael Barr emails in. He's already on the way back to pick up the pieces after the Lions loss. Ed Yardeni, ask him about his dog. Did you bring your dog today?
No, you know, we have 4 King Charles Cavaliers, and Max always likes to take a snooze on my couch in my office. So Max is very, very famous.
I watched the dog show yesterday.
Did you?
Great stuff.
Yeah, that was great.
Yep. So, some beautiful dogs.
Which dog shined?
Oh, I knew one Best in Show. I forget.
I
did
forget.
See that, yeah. But it was a
but
amazing
it really is true. If you want a friend, get a dog.
I bought puppy sweaters from Canine Styles Manhattan yesterday. I had to remortgage the middle child.
Yep.
They're expensive.
They are expensive.
It's outrageous.
If you get a dog, make sure you get health insurance.
Sure.
Yeah, well, with kennel fee, it's hopeless. Ed Yardeni, thank you for joining us worldwide today. Just a real treat after Thanksgiving. Again, worldwide on Bloomberg Television, on Bloomberg Radio. This is Bloomberg Surveillance. Good morning.
Some people travel to see the world. I travel to question the forces that shape entire nations.
No, is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio. I'm Lisa Mateo. We've got futures on the rise. That's after that technical outage at the CME disrupted trading. Checking with CME shares, they're down just under 0.5%. So let's get to futures. NASDAQ futures up 0.2%, 73 points. Dow futures rising 0.1%. Same for S&P futures. The 2-year yield 3.47%. That's little change. The yield on the 10-year 3.99%, and that is little changed. COMEX gold up about 0.5% at $4,226 an ounce. Brent crude at $63 a barrel. The Bloomberg Dollar Spot Index, little change. Few stocks on the move. Tilray Brands are slumping 12% after the cannabis company announced it's going to implement a 1-for-10 reverse split on its common stock. And Oracle shares down more than 3%. Morgan Stanley said a gauge of risk on Oracle's debt reached a 3-year high in November. And finally, shares of Burberry dropping more than 2% in London. That's after JP Morgan cut its rating to underweight from neutral. That is your Bloomberg Business Flash. Paul and Tom.
We're going to rip up the script on that one. Lisa Mateo, thanks so much. What a joy to go from Ed Yardeni with Yardeni Group over to Dana Telsey's The Way We Roll. Yes, we welcome all of you on Bloomberg Radio, Bloomberg Television worldwide this morning. The treatment for this is simple. Dana Telsey, more than anyone I know, owns the fabric of retail in America, the storied mile of Madison Avenue and Fifth Avenue, her heritage with a small shop called Bergdorf Goodman, and we're thrilled she could join us. After stopping at Macy's today, they were the first ones that said, let's put things on sale Friday. What did you observe today in the 2025 Macy's?
Couple things. First, thank you so much for having me, and hope you had a great Thanksgiving. What I saw at Macy's, it's a different type of Black Friday than it was in the past. The reason why? Crowds and traffic, the buzz doesn't kick up until later in the day. And that's for a lot of retailers. Macy's opens at 6 a.m., but others open later. What did I see at Macy's that was different? 40% newness. Labubu is the hottest thing out there.
Still hot.
Still hot. There's a Pop Mart in-store shop at Macy's. The other things that are new and different at Macy's, different brands also. Whether it's cosmetics brands, they have a bunch of new cosmetics brands that are different. Whether it's also the engagement with newer brands, like the Donna Karens of the world that are there, Rag & Bone that's there. It's been exciting to see the formation of it, but it's always promotional. And all the tracking we've done, we're not seeing a much different link between the level of promotions this year versus last year so far.
So, I mean, retail analysts like Dana Telsey, this is arguably the most important day of the year.
Super Bowl of the year for me.
Super Bowl of the year for Dana, and clients are calling her and texting her all day, what are you seeing? Because they know she's out at the stores, and they want to know what she's seeing out there. How do you expect this holiday season to be, and just in terms of dollars for the retailers? Are the retailers optimistic here?
I think they're cautiously optimistic. You really have a bifurcated consumer. I mean, that high end is spending. Obviously, you've seen the benefits of the stock market, the wealth effect that Ed just talked about. On the low end, the pressure points, obviously prices have gone up. Retailers are striving to make sure that opening price point items stay as close as possible and no increases. But you are seeing consumers search for value, search for more promotions in order to drive conversion. And that's why what the theme of Holiday 25 is, newness and value. Offer something new, offer value, and you'll get conversion.
Ed Yardeni, one top strategist on Wall Street. Dana Telsey, top retail analyst on Wall Street. What do they have in common, Tom? C.J. Lawrence. What is it about that
You were at
place?
C.J. Lawrence.
I was at C.J. Lawrence.
I didn't know that.
I loved it. I didn't like it there. It was an awesome place. Great people.
The best research on Wall Street
It
back
was
in the day.
like religion, folks.
Crazy.
Those of you younger don't understand this. You used to get things on paper. And there was that green ink of C.J. Lawrence, which had an authority like no one.
Dana, is there one category that is going to drive this year's sales, or is it more broadly based, do you think?
I think it's always about outerwear when it gets cold. It's about apparel. But you got some other new things out there. The Aura rings are very popular.
See, I told you, Lisa, you got to get the Aura rings.
Meta glasses are very popular.
Really?
And what about the Labubu dolls?
Oh, man.
For all ages and income levels.
In the time we've got left, I want you to talk about your heritage. Fifth Avenue's getting blown up. Prada bought a zillion square feet. You got the whole Louis Vuitton with the rebuild with the carriage out front. And all that. You as a child, standing in front of the Bergdorf Goodman windows, what was it like to be 4 and 5 years old. Nothing's changed, right? It's still the same
Bergdorf
magic.
looks still the same, but it's still the aura. And having that snowflake above 57th Street with the Empire State Building in the background with different colors off the top, there's nothing in the world like it.
With troubled luxury, will we see mergers this year?
I don't know if you see mergers. I think you see more companies opening more of their own stores. You've seen some divestitures. You look at, obviously, Versace was sold to Prada. You've seen that. Let's see what happens with Giorgio Armani, given his passing.
I got to give you the same question I gave the wonderful Steve Sadov, who was with us in the last hour. What would you do with Gucci?
Oh, I think basically you need to bring Gucci back to its heritage and be able to update it and modernize it, whether different colors, different fabrics. You need to tell a communicative story virtually and visually and have brand ambassadors that everyone wants to follow.
Do we have enough stores, or are we still shrinking the footprint of stores in this country? Where are we in that?
Store footprint is basing out. We've already closed a lot of stores. If anything, stores may be smaller. There's new engagement, certainly with buy online, pickup in store, and their activations. You've seen it in luxury with the Christian Dior store that opened, with Hermes that opened, but you're even seeing it with other stores too. Check out Aritzia. It's a destination.
Well, that's how you pronounce that.
Aritzia.
I see that.
Mateo's all in on that, right?
Oh, I love their jeans. I just went shopping. I went to Soho with my daughter.
Well, what about puffer jackets? It is cold outside.
Yes.
Puffer jackets?
Wait, did the interview just get taken over?
Lisa Mateo's in charge.
I think so. Paul mentioned this the other day. Still, for the haves, it's Summit. What's it called? Summit Hills Mall.
Short Hills.
Short Hill Mall.
Yep.
In near Summit, New Jersey. Chestnut Hill Mall in Boston. Those Highland Park, whatever, in Dallas. Where are they in 10 years?
They're going to be even more curated. They're going to have more special brands, and they're going to have more food and activities because people are going to want to gather there.
That's what Jamie Dimon did. You listen to Danny Tulsi put food and activities at the JP Morgan building. Your single best buy here. We got to make some money.
I think you're still going to see TJX do well. I like Steve Madden also.
Steve Madden, please discuss that. He's
Brown
back?
suede boots. They're back. They also have a Kurt Geiger acquisition that's going to add to sales and margins. Very exciting for 2026 and beyond.
Did you get all that, Lisa? I saw you taking notes over there.
I am furiously.
Steve Madden, I mean, that's the up and the down, and all of a sudden Steve Madden's up again?
They're up again, and they're on trend.
Right.
See, I think being a retail analyst is the hardest one on Wall Street because, A, you have to be right about the stocks and the financial analysis, but you also have to be right on, like, fashion stuff. Who knows that? How do you do that?
Well, yeah, you got to pick the winners. Who's the small luxury brand that's up and coming right now? Who's executing best?
I mean, you're seeing some handbag brands like Goyard is still small and happening to do very well. There's some other small brands like Aimé Leon Dore that basically is doing some interesting things out there. Kith is opening more stores, and the collaboration between streetwear and luxury continues to be very fascinating.
Streetwear and luxury.
Yes.
Streetwear and
is that streetwear?
What do you call it? Newness?
Newness and innovation.
What in God's name is newness? Is that like pulling
something
spring
you
forward?
didn't have last year? Look what's happening on denim jeans with embellishment on denim jeans. And it's at all different price levels that it's appealing.
And we now go to fashion correspondent for Surveillance Worldwide, Lisa Mateo. Are you buying the jeans, Lisa, that are like 7 inches wide? You mentioned Popeye. They look like Popeye jeans from 50 years ago?
You have to go with the wide. See, I have like the wide ones on because the skinny ones I told by my daughter, they are out. You can't do it. Mom, you're uncool. So yes, the wide.
Which is the boot this season? That's the way we always end the interview.
Brown suede tall shaft boot.
Okay.
There you go.
Boot to have.
Tom. You asked.
Okay.
Is this James Chu? Are they the ones doing it?
I think you see a bunch of players doing it, but you have to have that style.
Brown, what happened with black? Brown is the new black, seriously.
I like black, but I basically am different than others. But in fashion today,
Who decided brown was this color?
It was last year when the fashion shows for winter came out.
Like in Milan or someplace?
Yep.
Okay. Thank you so much for coming. Where do you go next?
Oh, basically, I'm going to New Jersey to Garden State Plaza.
There we go. Dana Telsey, the Telsey Advisory Group, and Joe Feldman. Big Box will do with Dana next time. And for your Black Friday shopping, have a safe and wonderful time. Across the nation and worldwide, Bloomberg Television, Bloomberg Radio.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver. We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day, now at our new time. Only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
In case you missed it, on Balance of Power.
Congressman, do you believe President Trump when you hear him praise Mamdani and say that he wants to help him succeed? And if that's the case, doesn't this blow a big hole in the Republican campaign in the midterms in which they wanted to use Zoran Mamdani as a bit of a scapegoat here? And now President Trump says he's ready to move back to New York.
I think it's a fair point that, the Republican political structure was really trying to set up Mamdani as the scary point of attack, essentially, for the American people. And if Trump is signaling and actually saying that maybe he's a good guy and we're going to work together, I think that does make it much more difficult for them to try and go forward with that. But ultimately, I think, as I mentioned a moment ago, it's really going to come down to the prices of what it costs to live here and who's trying to do what to fix it. That's the key, I think, for the next cycle.
Don't miss Balance of Power live every weekday.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo with your Bloomberg Opening Bell Report. So how are we going to end off this trading week, a day that started with an issue at the CME that disrupted trade across treasuries and equities? Action did kick back in at 8:30 Wall Street time. Before the markets open, a few things to remember. Stock market closed at 1 p.m. Wall Street time. The bond market open until 2 p.m. We are open for business. The S&P 500 up 0.1%, 11 points. The level, 6,822. The Dow up 0.1%, 53 points at 47,478. And the NASDAQ up 0.3%, 80 points at 23,291. We have the 2-year yield, 3.47%. That's little change. And the yield on the 10-year, 3.99%. And that is little change. To commodity, spot silver hit a new record, surpassing its October peak. We have COMEX gold up about 0.7% at $4,232 an ounce. Brent crude, $63 a barrel. And when they have the Bloomberg Dollar Spot Index is little change. At the open, checking in with the Mag 7. Right now, leading the gains is Google. Yes, up about 3%. That is your Bloomberg Opening Bell Report. Paul and Tom.
3% lift.
1%, sorry.
Okay, 1%. We'll take it. 1% lift.
Google's had such a run this year. I kind of thought they might be at risk from just the whole AI thing and how it impacts search. Boy, I was wrong on that.
Okay, but let's take it back to April, like when the Red Sox hit hope.
Yeah.
I mean, the bottom line is Google, they're terrible. They're never going to make it. Yep. Apple, they're terrible. I mean, there's some things that people have really been wrong on this year.
Big time. I mean, Google market cap, $3.9 trillion, up 70%, 70%. Think about the wealth that's been created just in that name.
On Bloomberg Television, Bloomberg Radio, the way you listen to us, the way you watch us. We say good morning, a special Friday edition. Good evening on the Pacific Rim and over to India as well, on the continent as well. Thank you to Daniel Curtis in London at Queen Victoria Street.
Good.
Really,
his notes
really giving us leadership this morning. Futures were down in Chicago for those of you just joining. And of course, we've had this horrific news out of Washington this morning. Michael Barr reporting on that earlier. Joining us now, I'm really anticipating this with the Dow up 100 points. Julia Coronado was iconic at BNP Paribas during the crash, where she said, no, GDP isn't going to be as good as it's going to be. She nailed that call. Now with macro policy perspectives, one of our most astute Fed watchers as well. Julia, is the next thing we're going to get wrong the certitude that it's one and done on a rate cut? And what we really need to think about is sequential rate cuts into next year?
Well, Tom, I think actually the possibilities are fairly bimodal. So if you look at the market and what it's priced for several rate cuts next year. But I think either we're going to get one and done because things are stabilizing and growth is going to be okay, and the AI story has enough legs to power the economy, or we're really starting, we're in the early game turning of the labor market. And the Fed's going to have to cut not just to neutral, but through to neutral to an accommodative stance. So it's one or the other, it feels like to me.
You're so good at gaming GDP. My head is spinning. Paul Sweeney's head is spinning over nominal GDP. I got a 4% Atlanta GDP now. Maybe it's 3.8%. I got half of America flat on their back. What is the Coronado call for 2026 real and nominal GDP?
So first, if we start with the second half of this year, we have a read on Q3, and by all indications, it's very solid. But early indications are Q4 is that it's kind of squishy. The consumer auto sales have dropped. I'm not sure what Dana told you on the holiday season, but people seem to be price sensitive, price conscious, budget conscious, not hunkered down in a corner, but not booming. And so I think we're going to see strong Q3, subdued Q4. On average, we'll see an economy that is downshifted from last year on balance in 2025. And one of the reasons this is happening is structural. We've chosen a restrictive immigration policy that means basically no labor supply. So no labor supply, no jobs, less growth in paychecks and income, and a slower economy. And I think that will prevail into 2026, a lower trend growth rate for the U.S. Even assuming some solid productivity tailwinds, you're still looking at growth with a one handle, maybe a low two handle, not a three handle.
Julia, so what do you think is receiving the priority from the Federal Reserve these days? The labor market, the inflation environment here? Is there one thing that's front and center for the Fed here today?
Well, it depends on who you ask, doesn't it? So there are a lot of people. There's 19 people on the committee, and they all have very different views of the world. It looks like the leadership, Chair Powell, President Williams, are coalescing around one more rate cut this year, an insurance rate cut, because you're highlighting the tension they face. You've got inflation that's not soaring or even necessarily accelerating in a meaningful way like we saw in the pandemic, but it's too high. It's running at closer to 3% than 2%, and it's not making any progress, and we don't expect any progress in the foreseeable future, or at least not next year. Not much progress, given the tariffs are still coming through. And that's a worry. Not that inflation's getting out of control, but it's going to get embedded in the economy and people's behavior and people's psychology, and we'll get stuck at 3 and not get to 2. On the other hand, the unemployment rate's been creeping higher by 1/10 each of the last 4 months. Usually when we see this kind of movement, we get a break higher in the unemployment rate. The labor market cracks, we reach a tipping point, and all of a sudden we're looking at a recession.
Can we do a Friday Audible?
Sure.
On television, on radio, worldwide with Julia Coronado. A surveillance audible. Okay, Julia, you're defined at Dallas Fed. Dallas Fed owns the southern border. I am as guilty as anyone of ignoring Mexico and focusing on Canada because I need the Montreal Canadiens to find an enforcer. Julia, help me with Mexico and the tariff. What's the dynamic right now with Mexico given tariffs?
Well, you know, Mexico had been poised to be a beneficiary from this friendshoring or these reglobalizations or deglobalizations, in the sense that it's, you know, right next door. It's one of our largest trading partners. But the Trump administration has, you know, gone after our closest trading partners, Canada and Mexico, you know, really kind of trying to ensure that some of that that channeling of trade by Chinese companies through Mexico doesn't sort of sneak in the door. But of course, that leaves Mexico really struggling. Mexico's doing okay, but they just put out their growth forecast, and it's pretty subdued for next year. So the trade wars, the immigration policy, the frictions between the U.S. and Mexico are not great for the Mexican economy. And are not great for Texas, to be honest. Texas is okay, but usually Texas is a bright, shining star. I'm living here in Austin, and you know, the Texas economy it's okay, but it's not the bright, shining spot it used to be, because all of these things, the trade wars, the immigration policy, really do hit Texas hard too.
Interesting. We're talking about the unemployment rate. It's at 4.4%, I believe, right here. Is there a number, Julia, where the Fed just says, oh boy, we've got a labor problem?
Well, I think, you know, we're above their longer run estimate of 4.2%. I think once we start heading north of 4.5%, and it's not just the level matters. So I think we're at a level that's a little worrisome. When we saw the unemployment rate rising last summer, we were rising from such a low level that it was kind of hard to worry too much about it, right? We were going from 3.4 to the low fours. That was sort of more of a normalization in conditions than a weakening. Now we're at the low fours. We're at sort of neutral or longer run, and we're rising from here to a labor market that's clearly loosening. If you look at, like, say, the Conference Board survey of consumers, consumers are getting gloomy about the labor market. If you look at nominal wage growth, the Indeed wage tracker is what we have on a most timely basis, showing wage growth decelerating below the rate of inflation. These are indications that the labor market is not just balanced, but weak.
She's got me going here. Tom Porcelli's over at PGIM. Do you know, even in the cold weather, he takes the Hinckley picnic boat.
Does he?
Down the Hudson River to go to PGIM in Jersey City. Okay, you just said it, Julia. The real wage is flatlining, declining, however you want to describe it as well. You're telling me the Fed is going to look at that and ignore it to worry about inflation dynamics? I don't buy it for a minute.
No, and you shouldn't, because if this continues, then the Fed will cut, and it will cut in December. It's poised to cut in December for exactly that reason. When we saw the September labor report, we said going in, the most important number is the unemployment rate. Forget payrolls. They're overstated. They haven't been benchmarked, blah, 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 seasonal noise. Look at the unemployment rate, and it went up, and nobody expected it to go up. So that was the news. The news was the labor market is weakening, the Fed is a go. And that looks to be where they've landed. And yeah, I think, Tom, that the trick is the committee is in such a hawkish mood because the GDP tracking is so strong and the economy seems basically okay. The stock market's at the highs. So what's the big deal? Meanwhile, I've got an inflation problem. But if this labor market problem keeps creeping in, and those cracks keep deepening, of course the Fed is going to pay attention to that.
Dow up 91. John from Coventry emails in and says, don't quote the Dow. I said, no, I'm going to quote the Dow.
Yes.
Dow up 93 points right now. Julia Coronado with us. Julia, everybody wants to know this, and this is great work off Axios and the Texas A&M Transportation Institute. Julia, the traffic in Austin, the traffic in Houston, the traffic in Texas. Why is Texas this great mecca if you can't turn left at 4 p.m.?
The traffic in Texas is terrible because we have no public transportation. We have no trains. It's the thing I miss the most about New York, is the ability to skip traffic and get on the subway or get on the Metro North and go home. So yeah,
okay,
the
so
traffic
what are
is
you
pretty
going to do?
terrible
Come
here.
on, what are you going to do about it? You've been shortlisted for all sorts of wonderful Washington titles. What is the entrepreneurial GOP spirit of Texas going to do with that gridlock?
I don't know. You know, we did pass the Austin area did pass a big bond that does build in some public transportation. It broadens what is now a very limited train system. But being Texas, we also are just kind of expanding the highway yet again. So if you come down to Texas, Tom, you can choose many multiple lane highways to get around on. It's really something, the highway system here.
Julie, the only reason we had you on was Hullabaloo Canuck. Today, 7:30 p.m.
Yeah.
The number 16 Texas Longhorns greet the number 3 Fighting Texas Aggies of College Station. Julia, are you going?
I am not going to the game. No. But I am a Longhorn, Tom, as you know. We have not had the season we had hoped for. But, you know, we had a great last game, and hopefully that momentum continues into this one.
Very good.
Here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of that.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Beirut, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Bloomberg Interactive Broker Studio. I'm Lisa Mateo. Right now, we have the NASDAQ and the Dow right now up about 0.2%. We have the S&P 500 rising 0.1% or 12 points. Let's head to the IMAP feature of your terminal. Of the 11 major industry groups, the biggest push is coming from communication services. We click through, it goes to media and entertainment, then interactive media and services, and at the top is Alphabet. Yes, Google. Those shares are up this morning about 0.6%, and that's followed by Meta. Meta is up more than 1%. If we look at the Mag 7, right now seeing a decline is NVIDIA. Their shares down about 1%. Let's go to the yield space. The 2-year yield, 3.48%. That's little change. The yield on the 10-year, 4.0%, and that is up about 1 basis point. The Bloomberg Dollar Spot Index, that is little change. And the Japanese yen right now, 156.36 against the dollar. A few stocks on the move. Tilray Brands, their shares down 18%. It announced that it's going to implement a 1-for-10 reverse stock split of its common stock. And Oracle down 3% after Morgan Stanley said a gauge of risk on its debt will have reached a 3-year high in November. That is your Bloomberg Business Flash. Tom.
Lisa Mateo, thanks so much. Greatly appreciated. Good morning to all of you around the world. A special edition of Bloomberg Surveillance. It's Friday after Thanksgiving. A huge, for those of you internationally, a huge retail fixture for America. We did it right with great conversations with Steve Sadoff. He gave you the word exclusive at Saks Fifth Avenue years ago, now with MasterCard as a senior advisor. With Dana Telsey, whose literally family grew up with Bergdorf Goodman. She's on her way out to New Jersey to look at mall traffic. And now we finished strong in this hour with Oliver Chen, definitive at TD Cowen. I can't say enough about his acuity over the years. Oliver, I remember the day a pair of 501 Levi's became more than $9.99 a pair. You feature in your research note Levi's. What is their strategy given Amazon and given 2025 retail?
Well, Tom, it's a pleasure to be here. Happy Black Friday as well. Levi's is an iconic brand with dominant market share at the premium end of the market. Also, as we think about what's happening now in product execution, it's about classics with a twist. It's about getting great value as well. And denim fits really nicely into these themes. What Levi's is doing specifically is more direct to consumer, basically opening their own stores globally. And consumers are looking for value. It plays quite nicely with quality. As you know, 501s last forever, and you shouldn't wash them either.
We turn to surveillance. Oh, tell me, yeah, I get that lecture at home. We turn to surveillance fashion correspondent Lisa Mateo. Lisa, Brandy Melville is on the Mateo target, isn't it?
Oh, okay. So yesterday I received my daughter's 7-page PowerPoint presentation for her Christmas list. My question to you, Oliver, is are people going to be spending as much as they did last holiday season? That's what I want to know, because I put a budget out there.
Yeah, Lisa, first of all, I want that deck, please, to me. Second, we are seeing spending. We're seeing a consumer that does have plenty of anxiety, that's looking for great deals. That being said, the consumer still has money, wants joy. We're forecasting up 2 to 3%. Keep in mind, inflation and pricing will be about 2 to 3%. So your units are flat, and there's a bit of a struggle. On the one hand, consumers want joy and wellness and gifting. On the other hand, they're feeling anxious. So we're watching both, and there's a bunch of cross currents, but don't bet against the U.S. consumer. It's been solid.
Worldwide, Oliver Chen with us, TD Cowen, and we continue. Oliver, are we going to get out charge cards or like the Affirm buy now, pay later kind of thing? How are we going to acquire our Christmas, our holiday 2025?
Well, we're going to be using both. What's still happening is mobile is in the new mall. So we're seeing increased rates of mobile use, but a bit of everything from buy online, pick up in store to curbside pickup to delivery is being used so much. And then I like the good old fashioned way. It's just thrilling to be in the stores this morning and across the country and earlier this week. So it's all happening. And certainly these new ways of payment and the future of payments is very different for younger customers too.
Oliver Chen on luxury right now. Kevin Gordon is in the French Alps at that hotel Audrey Hepburn was in Charade with Cary Grant. He emails in Oliver with a great question. This is Kevin Gordon of Charles Schwab. Bottega Veneta blew it up and is doing better with the British type Louise Trotter. The fashion heads of different luxury brands, they still really matter, don't they?
Yeah, what's happening is lots of change. The creative matters. I'm really creating desire, having new design, and we're seeing a lot of newness at Gucci and others. And Bottega has been doing great. The themes for luxury continue to be quiet luxury in terms of what's happening with less focus on logos and a real emphasis on quality and materials. So Bottega Veneta fits nicely in that trend. As you know, Brunello Cucinelli, Loro Piana. And I'm a personal lover of Gucci, so I want to see them win. We're watching some creative change there at Tom Ford, too.
Right, we've seen that. And Lisa, you mentioned today Burberry, a little bit off the mark. They've been hugely promotional. Lisa Mateo
they have.
with us with Oliver Chen.
Now, also on the luxury segment, I'm going through the Wall Street Journal this morning, and it has this article that says jewelry is outperforming the rest of the luxury world. Are you seeing that?
Yes, we are. We love Cartier. So there's definitely a barbell and bifurcation where more pressure at the low and middle, and then some real strength at the high end. And Cartier Richemont Group is outperforming Van Cleef as well as Cartier. Customers are gravitating towards gold, jewelry, real stores of value, and the prices here are compelling because handbag prices have gotten extreme. So the Love collection at Cartier, Love Unlimited at Cartier, the Maison, really enduring value and timelessness. And overall, the jewelry growth rates have been in the high single digit, and we've been struggling to grow in handbags.
Will we see M&A this year? I mean, in so many other industries, we talk about mergers and acquisitions, and Wall Street's on fire with a boom economy. In the Oliver Chen world, do they gobble up the weak providers in luxury or frankly in other markets as well?
Yeah, Tom, I think what we'll see is selective M&A. Beauty is always an M&A orientated sector in terms of large players acquiring brands that have been developed by founders. Skincare, longevity, niche fragrances, those are big opportunities. In luxury, it'll be selective. There are some assets that have sold, and we'll see. But the market's getting better with the consumer on more stable footing. So M&A is totally possible, and we're watching the IPO market too.
Oliver Chen, your single best buy, please.
We like Walmart. We like the AI story. We like the value story. We like delivery, curbside pickup, marketplace model, digital advertising. That remains a favorite for us.
Oliver, I got a PE of 43 on Walmart. You got to be kidding me. How is that possible?
There's a lot ahead. Digital advertising for Walmart is in the $5 billion range. Think about Google, Amazon, and others that are 50 plus. Furthermore, their capabilities, it's themes about the big getting bigger and reaching more and more profitability online, in part because of digital advertising as well as the marketplace. In addition, it's defensive in that it's a leading grocery business with 60% of the revenue being grocery. So we're excited about all these things. On the offense, on AI, as well as delivery and micro-fulfillment, on the defense, as well as the everyday low price. And that's what consumers are looking for today. Finally, they're getting higher household income consumers as well, and they're serving the middle and low well too with that everyday low price. I grew up in Louisiana going to the Walmart Supercenter, and it's a real community-driven retailer as well.
Oliver, thank you so much for having us finish strong in retail this Black Friday. Mr. Chen is with TD Cowen. I can't say enough. We protect the copyright of all of our guests. For Oliver Chen, please go to TD Cowen to get his brilliant note. You heard it there, Walmart. Single best buy. Again, we welcome all of you to our simulcast this morning on this Black Friday. Moving forward, Paul Sweeney and Vonnie Quinn will be beginning here in moments, and then into the afternoon. Vonnie Quinn and fashion maven Carol Masser. Lisa, Carol gets out of the car today, like on Lexington, and you know her help there. She's got so many bags,
of course,
from shopping down from the manse. Like she stops here on Madison and there on Madison.
She takes a break, grabs a coffee.
Goes over to Fifth Avenue, goes into Beyond, and gets a break of some cheap coffee at Beyond, and then she power shops further. Vonnie Quinn, Carol Masser, 12 to 2 this afternoon as well. Thank you, Lee, and thank you, Juan, for just amazing guests today. For all of us at Bloomberg Surveillance, a wonderful weekend to you. Good morning.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, I'll still be driving some.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Why would you want to be chairman of the Fed? Are you sure you want that job?
If the president asks me to be Fed chair, then I'll do it. If I'm not Fed chair, don't be disappointed for me because I love the job that I have.
In case you missed it on the opening trade.
Here, I've got a present for you. I know you've mentioned it a couple of times. We've got a coffee for you.
Hang on a sec.
By the
Coffee
lovely Tara.
coming. There we go.
Thank you.
So my question now is how much froth is in there?
See, you can't tell when you look at the top. That's okay. You've got to drink it to find out.
Absolute genius. You got to take the lid off before you even figure out what's going on.
Don't miss the opening trade. Live every weekday.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube and we're also on television. Vonnie Quinn, that is multimedia, I believe.
We are back together, Paul.
We are back together.
Yes.
I was saying we worked together for a while in radio back in the day, but we're back here. For the next 2 hours, we're going to bring the markets to you. We finally got the futures markets open, so that's good. And we've got some things going on in the marketplace. So we got a lot of good guests coming up for the next couple of hours. We've got some green on the screen here. I'm going to just call it out. The S&P S&P 500, I like what I'm seeing. It's up 14 points. That's 0.2%. I'm going to call out the Dow for John Farrow. Because John Farrow does not like the Dow Jones Industrial, so I call it out for him. Up 145 points, NASDAQ up 60 points here. The NASDAQ, which has been leading this market, folks, let's be honest here. It's been a tech-driven rally here in these markets for the last couple of years, and that's up another 0.3%. I like to call out the 10-year yield sitting right at 4%, Vonnie. Does that mean we can refinance our mortgages here?
If you're lucky enough to have one, you can refinance, Paul.
Oh, nice.
I'm looking at the 10-year as well because it dipped below 4% on Thursday. Isn't that interesting? So those rate cut bets for December really basically almost fully priced in at this point.
I think so. You look at the WIRP function, Vonnie, WIRP Go on the Bloomberg terminal. It shows about an 80% chance of a rate cut in December. And I think beyond that, though, all bets are off. I'm not sure people have conviction much at all on
Is that the end of the easing cycle or what happens into next year? And then, of course, the blackout period starts tonight. So if we don't hear from any Fed speakers today, which there's nothing on the calendar, then that's it. That's all we get.
That's all we get here. Looking at the commodity space here a little bit, we always call out gold. And, of course, that's still above 4,000 an ounce, up 60%. But spot silver, I saw a red headline across the Bloomberg terminal earlier this morning, hit a record here, and we're up here at $55.20 an ounce, up 91%. I'm not sure what drives silver other than, is it just kind of trade off of gold?
Silver has uses that gold
does.
doesn't have. Gold is definitely a store of value and so on and so on, but silver you can actually use in things. So I'm sure that is adding, at the margin, some dollars to this price.
Yep, and I always call out WTI crude oil because I do fill up my car every weekend. WTI crude oil, we're still below.
Your car, your SUV?
It's a BMW X thing. I don't know. It's not electric. It's the old-fashioned gas. So, but $59 a barrel. I watch Landman on TV on Paramount Channel. So now I'm an expert on all things oil and gas.
All things combustible?
Yes. So now I consider myself an expert, and I know that their cost of production is like $55 a barrel, something like that. So at $59, they're not making much money. They would like it to be, I think if you talk to the people in the oil patch, they'd like $75 a barrel.
Certainly Saudi Arabia, very, very touchy about putting more barrels back onto the market, but that's essentially what they've been doing all year.
Absolutely. All right, the CME has restarted most of its trading after an outage left investors in the dark most of the morning. Joining us now is Bloomberg's Adam Linton. He's in London, Adam. Adam, what happened to our friends at the CME this morning?
Yep, so around about 9:40 p.m. Eastern Time last night, an outage was reported in a data center in Illinois. And basically, this knocked off CME trade for futures and options in asset classes such as equities, fixed income, commodities, etc. And, these outages do happen from time to time. There was a similar one in 2019. The difference here is that this has lasted for much longer, and it took place during a time of relatively low liquidity. Of course, yesterday was Thanksgiving. A lot of people will take this as a long holiday, and therefore this is already going to be a low liquidity event, particularly when there's no Tier 1 data to speak of, no Fed speak. And the real issue for markets is, of course, other than these not trading, is if you're a cash trader, there's no accompanying futures markets, then essentially you are flying blind.
What was fascinating was that it was a cooling issue. Are there any lessons to be learned here about energy use and data centers and whether we'll have enough to power the AI trade and beyond?
There's going to be an investigation launched into this. It's unclear exactly whether those two things are correlated. The cynic in me thinks that obviously it's Thanksgiving yesterday. They may have had a bit more of a skeleton team, and if things were more market normal conditions, this may not necessarily have happened. But again, I'm sure there'll be an investigation, and we'll learn more details in the coming days and weeks.
Yeah, this kind of thing can't really happen. If I'm trading billions of dollars, it can't really happen.
You're going to be so frustrated. And think of all those currency traders that couldn't trade until 7 o'clock this morning, and then you didn't even have an indication for futures properly until 8:30 a.m. Eastern.
Yeah, my recommendation right around 7 o'clock in the morning to Tom Keene was just turn it off and turn it back on again. Isn't that what you usually do? All control delete, something like that?
Yeah, and it's already sort of difficult trading on a weekend, and when there's options expiring, and when we've had a holiday.
Yep, absolutely. So, but the good news, back on here. Bloomberg's Adam Linton, thank you so much. We appreciate getting a couple minutes of your time here. Let's get to these markets here because we do have a little bit of green on the screen here on this Friday after Thanksgiving. Jeff Chang joins us. He's the president of Vest Financial. It's great, Jeff, to have you here. I'm looking at the S&P 500 year-to-date, up 15%. I've got the NASDAQ up 20%. Boy, that is solid performance. I don't care where you are, who you are. What do you do for 2026, do you think?
Yeah, great to be here. I still think the biggest driver of growth is going to be AI. It's also, what's interesting enough, is also going to be the greatest source of volatility. I mean, you can even see today with the CME and data centers, like this is really going to be what's going to be driving the market overall into the next year. I think also, on a larger basis, you're kind of weighing between kind of the macro factors, cooling inflation, AI, but also, earnings catching up to valuations, what we've seen today, with multiples being on the higher end of the spectrum.
Yeah, so this AI trade, I mean, it's definitely changing. There's rotation involved, right? I mean, do you still stick with the NVIDIAs, or do you start looking at some of the other companies like the Alphabets now that are very involved with their TPUs?
Yeah, I think there's definitely growing competition, but I think when you look at NVIDIA, it's still the bellwether for AI hardware. From there, because when you look at AI and the foundational parts of it, you're looking at, compute, data centers, networking, and cloud, and cooling is in that as well. But I think when you look at NVIDIA, it sits very kind of right in the center as far as foundational parts of AI, given that one thing is that they've also, if you look at the numbers and forward guidance, has been pretty strong. I do think where you start to see a little bit of volatility is the idea that competition is coming in. And so if you start to look at, the likes of Microsoft really plant the flag in cloud, and then, like you said, Google and Alphabet coming into the AI chip space as well. So we can see some volatility there, but mostly the dominance of NVIDIA we'll see is going to be pretty strong into 2026.
Vonnie, I think I'm 0 for a lifetime trying to call the top of a bubble. I just never
Why would you possibly want to even try doing that, Paul?
I was selling stock, cranking out IPOs March of 2000 with a vengeance and no idea. And then like 5 minutes later, it was over. So how do investors in general, Jeff, how do you think about a bubble? And are we in a bubble? Are we at the top of the bubble? How do you think about that?
I don't think, as far as you've probably seen recently in the news of SoftBank and the likes of Peter Thiel selling their positions in NVIDIA. I actually don't think that's an indication of people getting out due to a bubble. I think, sure, are the AI stocks and hyperscalers expensive? Yeah, you can make an argument for that. But when you're thinking about AI and the idea that it might be a bubble, this is very different than something like, if you were to look at crypto, I would say that this is a structural shift. Now, selectivity matters where you're actually going to be in AI, but I think what we're seeing is a generational shift as far as, because AI is going to diffuse into Main Street as far as anywhere from logistics to enterprise software, healthcare, defense is going to go everywhere there. I think where you're seeing a lot of people misunderstanding is, and we've seen this story play out before, is the idea that, okay, we've seen a huge amount of investment into AI, in hundreds of billions of dollars, whereas in the actual earnings, you're talking to 25, 30 billion in actual earnings. But this is where you start to, if you pull back the curtain a little bit, keep in mind, earnings is based off of accounting depreciation, which tends to front load your expenses, and it doesn't account for the earnings potential over the long term. We've seen this play out before. If you look at going back, like fiber optics, there were billions of dollars on front end investment, but we hadn't seen the trillions of dollars of earnings potential that came out in many years afterwards. So, like they always say, history doesn't repeat itself, but it does rhyme. I think what you're seeing here is kind of a fiber optic internet type situation. We're really fundamentally changing, how we do business going forward.
So you say the foundation of long-term AI is sound, but where do the revenues come from? And what are you projecting out in terms of revenue for these companies that are spending a fortune on AI?
Yeah, so like I said, selectivity matters. So if you're talking about, the Microsoft Metas, the Googles, and the NVIDIAs of the world, those they are going to touch every part of AI, whether or not the earnings are going to be generated from industrials, whether, industrial automation, whether it's going to be generated from healthcare. They're going to be at the center, given that the core foundation being cloud, compute, data centers, and networking. So that's really where, if you're looking as a long-term investor, where the earnings are more sustainably and more higher probability of actually realization is being looking at kind of that center. I think where you start to get a little bit dicey is trading on the hype, going for these types of moonshot type trades where you're looking at small cap stocks and maybe in small robotics or so on and so forth. That's where you start to get a little bit dicey as far as will we see that earnings realization to justify the valuations.
You know, Vonnie, I remember the beginning of this whole AI discussion, maybe 3 years ago, Gene Munster from Deepwater Asset Management, who to me is one of the best technology analysts on Wall Street, he said, hey, think about a continuum of what's important. Let's put electricity, like from 0 to 100. Electricity, he puts at 95. The internet, he puts at 70. AI, he put it like 90. Right there. I mean, so every time I think about, geez, maybe we're kind of in a bubble.
Listen to him, Paul.
I know. He was so right. So, Jeff, where do we go from here? What's the next way to play it? If I've played out my NVIDIA trade, maybe I've played out my Microsoft trade on AI, what's the next leg, do you think, for this whole investment thesis?
Yeah, so this is very similar to, let's say, in 1999 and 2000 in the tech boom, that a lot of these publicly traded companies, people were taking kind of bets here and there. I actually believe if you then really kind of fast forward the tape, you'll notice that the real winners, the companies that really won kind of the internet boom, the Facebooks of the world, the Netflixes of the world, the Airbnbs of the world, they weren't around. They were in startup mode. So I think a lot of folks that are trying to play the AI trade, a lot of the Facebooks in AI of tomorrow are going to be in venture. They're going to be in early stage or middle stage startups that are really being able to innovate, move fast, kind of break things kind of mentality. I think, like I said, the next wave, it's not publicly traded, especially in the AI space. I think, like I said, the foundational parts, like, the hyperscalers and the NVIDIAs of the world are publicly traded, but I think a lot of the next wave of software and usage cases across all industries are actually in private markets right now.
All right, well, Jeff, we have to leave it there, but thank you so much for joining us today, and I know you're in Las Vegas, so if you're putting anything, put it on black today. That is Vest Financial President and co-founder Jeff Chang. So coming up, we're going to talk holiday shopping. What else, Paul?
Yep.
Kicking us off?
Yeah, we had Dana Telsley in Bloomberg Surveillance this morning, and again, to me, she's the top retail analyst out there. And what she does on these Black Fridays, she just goes to different malls all around the metropolitan area.
There is no substitute for going and seeing with your very own eyes, right? Especially eyes that are as experienced in this as Dana Telsley. We were talking the other day. She set up her shop about 20 years ago now. Can you believe it?
Yeah, it's amazing. And I'll tell you what, it's very rare for an analyst to leave a big shop, set up their own place, and actually have it be successful. Literally, it's a handful at max, and she's one of them.
And no turnover, all the same people. It's wonderful. All right, we are going to talk holiday shopping, kicking off as Black Friday is underway, of course. Up next, we're going to speak to the CEO of Daydream, Julie Bornstein, about how her AI-based shopping agent is helping consumers, as if we need more help. Do stick with us. This is Bloomberg.
On Bloomberg Open Interest.
It's Netflix versus YouTube.
100%. I do think in the world of more AI slop, people are going to look for destinations where they really want higher quality, curated, high production storytelling.
But YouTube is crushing it. I mean, I have both.
Absolutely.
But one thing YouTube has is, like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent. Consumer product is consumer tech.
Don't miss Open Interest live weekdays.
In case you missed it on Bloomberg Insight.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. Our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data.
Countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Don't miss Bloomberg Insight live weekdays.
Bringing
to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
Watching Bloomberg Markets and listening to myself, Paul Sweeney, which is the other person, and me, Bonnie Quinn, on this Black Friday when we are seeing markets higher. You know, marginal gains, I would say, but we've had a pretty good week so far, Paul, after a very volatile.
Yeah, we had that pullback. We had that pullback over the last few weeks on a little bit of concern on AI, and was it a bubble in AI? And that was a little bit of an issue. We had a little bit of a rotation out of tech into some other areas, but the market's found its footing here, and it looks like, again, the market's Bonnie's discounting at 80% rate. We're going to get a rate cut December 10th.
VIX back below 17. I mean, it's just a good day for the markets, even after that outage earlier. So let's bring in our next guest to talk a little shopping. We have Julie Bornstein. She is the CEO of Daydream, which is an AI agent for fashion retail in particular. Julie, thank you so much for joining. First, just explain a little bit what a fashion agent for retail can do for me when I go online.
Yes, well, ultimately, the goal is to be a personal stylist in your pocket. Today, what we do is we allow you to let us know what you're looking for using whatever you want to say. You have a Christmas party with your office in a bar in New York City, and we can help you find what you're looking for. We make it easier to shop, and we also allow you to post a picture, and then we can help you find something that looks like that.
So, I don't know where to go here, Julie, but 42% of shoppers say they're using AI tools for holiday shopping. That's according to a Harris poll for MasterCard. Are retailers, are they ready for that? Are they trying to take advantage of that? How are they performing here?
It's early days for the retailers, but they are starting to learn how to both appear through some of these, different chat surfaces, and they are also trying to figure out how to use AI to make the customer experience better on their sites. Some of them are doing interesting things, Gap, H&M. They're also participating with us, Daydream. So because we're sort of the first AI shopping platform, they can partner with us, and they show up as customers are explaining what it is that they're looking for in a whole new way.
Julie, we always hear when it comes to AI that it's all about the prompt, right? So what are customers doing, and how should we prompt better?
It's a great question. I mean, we see prompts that are everything from I'm going to a wedding and I want to wear a pink dress but not look like a cupcake, to I'm going to a wedding and I want to wear a revenge dress in the vibes of Saltburn. So we have lots of different kinds of
I want to see what the hallucinations are for those answers.
Yeah, exactly. What the cupcake dress looks like. People are very creative, and the truth is that consumers are just learning how to prompt, and so part of what we do is also give them ideas so that if they're starting to look, and then once they get used to it, people will write very long things with very descriptive details of what they're looking for.
I've seen some technology, use some apps on the iPhone, take a screenshot of something, and then it brings you right into a shopping environment. Talk to us about where that is right now, where that's going.
Yeah, that's going to just get better and better. I think the idea of being able to screenshot something on the new iOS allows you to instantly, you don't even have to open an app, bring up results from any of the apps that you have already downloaded. So if you have Daydream downloaded on your phone and you screenshot anything from Instagram, or as you're walking around and you see someone wearing something you like, you have the ability instantly to pull up the results that are closest to that product. And if that product still exists, you can get that exact product. So it's pretty cool, and it's a pretty quick way. And what we're seeing is younger generation, Gen Z, is very higher use case for that. They're just used to being able to snap anything and then be able to find what they're looking for.
So if I screenshot something, it sends a whole load of information into the background of my phone. Is that right? That sounds a little dangerous to me. It means I should probably stop screenshotting things.
No, it's really if you choose to then use the search mechanism for it. So in general, screenshots are not, nothing's happening with them until you decide to do something with that screenshot. So, if you're looking for a product, it's pretty safe.
So, all right, how about this? Warm but not bulky coat under $300. Where is the AI thingamajig going to take me?
Well, on Daydream, it's going to take you to a set of results that match that kind of query. And then you'll see lots of results from around the web. And we will, once you find what you're looking for, you link out to the brand or the retailer that sells that product. So similar to the way Google works, we're basically sort of a search and discovery platform that then helps you find the retailer to buy from.
All right, well, in the world of search, it's search optimization type thing. Is there a similar type of thing here in the world of AI?
So it can depend on what the business model is. In our case, we are totally focused on finding you the best product for you that matches both the query and your personal preferences as we learn about you. And so it's not an issue of whatever, whoever pays the most gets the way to show you what their product is. But in some cases, there's an ad-based model. Ours is not.
Julie, OpenAI and Amazon both made headlines this week with shopping launches. How are their products different to yours? Are they compatible to use together, or how are you dealing with that competition?
We're really excited about it. I think in general, shopping, this is the first season where AI is really going to improve the shopping experience, and it's only going to get better. I think the fact that they're both doing this is very validating to us. They're separate, but ours is totally focused on fashion. And so if you go to either of those platforms, you'll find that they work kind of generally across all categories, but a little bit less focused on a single category. And so shopping and fashion is so nuanced that Daydream is better for that.
So, Julie, what are your clients telling you here about this holiday shopping season? What's the level of optimism? Because there are a lot of economic cross-currents out there.
Yeah, that really are. I think that this year is going to be bigger than last year, but probably not by a huge amount. What we're seeing is that there's a lot of excitement for all of the sales that are going on this week for Cyber Week. And so what we have is a Daydream broadcast it's a broadcast channel on Instagram where you can actually see all the brands and all of the offers that they're giving you. What we know is that a lot of people are saving the things that they want to buy and coming back today to go see if they're on sale.
You have a lot of experience raising money and bringing companies to market and so on. You sold your previous company to Pinterest, actually, and you've been on the boards of, Sweetgreen, Redfin, Weight Watchers, so much experience. What is the environment like now for consumer companies and raising money?
It's interesting. It's a very strange environment because the role of AI has kind of thrown everything off. And so I think everybody who has an interesting angle with AI is definitely able to get conversations going. I think that if you're not doing something with AI right now, it needs to be a very unique proposition. It is a very AI-focused fundraising environment. Doesn't mean that there aren't other ideas that are great and out there, but certainly the fact is that AI can help pretty much every aspect of building a business right now. And so you want to be able to show how you have an advantage leveraging AI that other people don't have. So you have to figure out what your moat is.
Julie, is partially the reason it's such an AI type of fundraising environment because all these, dollar donors are invested in AI themselves?
No, I think it's more because everyone believes it's going to shape the future, and it's still early, so it's hard to know exactly how. But if you're not actually taking advantage of it, it seems like a really missed opportunity because it will change the way everyone does work, from the way employees work to the way products are made, to the way supply chains run, to the way consumers experience AI.
So what's the next step here for AI, do you think, Julie? Is there another natural progression?
I think that there will be a lot of evolutions in the models. I also think we'll start to see over the next year or two a lot more consumer experiences changing. So we haven't seen a lot of that yet, other than going directly to some of these new chatbots. But if you think about all the things you do in your day-to-day life, things will get a little bit smoother and smarter as a result of AI, and there will be new businesses that come along, like Daydream, that just make shopping, for example, easier, smoother, and more personal.
All right, great stuff. Thank you so much. We really appreciate it, Julie Bornstein. She's the founder and CEO at Daydream. And you're right, I was just going to add a resume, Vonnie. She's had great experience with starting out in retail, but then doing a lot of startups and successful startups.
And not just that, but she was Chief Digital Officer at Sephora.
Yes.
And you know how much Sephora has, right, Paul? You shop at Sephora regularly.
Well, here's my Sephora story. During the lockdown of the pandemic, Sephora was open across the street, packed every day.
Yeah.
I mean, people have to get their stuff.
But we were all buying,
exactly.
Cleansers.
You have to invest in your face, somebody once told me, and John Tucker and I missed that. Coming up, we're going to talk about the consumer pullback and its potential impact on earnings and the company going in and the economy going into the new year. So a lot coming up. This is Bloomberg. Good morning.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Some people travel to see the world. I travel to question the forces that shape entire nations.
How is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findtreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
What we're seeing is that companies have mitigated for the cost impacts. Consumer demand for toys is growing, has been growing every quarter in the US and overseas. What we have seen is that retailers have postponed their decision in making orders to the very back end of the year. But seeing that there is demand, there is consumer demand, people are buying product at retailers, we expect to see a good holiday season and a strong growth quarter for Mattel.
All right, that was Mattel CEO sharing his outlook for the holiday season. Joining us now for more on the state of the consumer on this Black Friday is Andrea Varnado, a seasoned business leader and board director in consumer brands and retail. Andrea, thanks so much for joining us here. What's the mood of retailers here going into this holiday shopping season? There certainly are a lot of economic crosswinds out there.
The retailer is actually quite optimistic, especially compared to where they were last year. At the beginning of this year, we thought tariffs and tax cuts would drive consumer behavior. And while tariffs still remain a big concern, consumers are also absorbing something much more subtle: the ripple effects of a shutdown, fewer government services, a cold housing market, and large company layoffs. So frankly, the economy feels contradictory, but spending is holding. As we've just seen in Q3 earnings reports, they are holding. Households are more cautious, but customers are still spending in a really selective way.
What are they buying, Andrea? Deloitte is seeing a lower average spend for the Black Friday, Cyber Monday, but these statistics sometimes can be misleading in the sense that people will continue to spend or they've already started spending.
That's such a great question, because when we talk about the contradiction of seeing spending but customers being more selective, I like to define it as the customer isn't stepping back. They're really reprioritizing, and they're doing a purposeful reallocation. So when you think about what they're spending on, there are kind of three big shifts that are happening. One, customers are moving towards intelligent value. They're looking for things that have function, meaning, utility, longevity, so they can feel like they're really getting a return on their investment. Two, they're consolidating purchases. And so one of the interesting things we've seen in some of these Q3 earnings reports is where some of the values are going down, we are seeing higher ticket prices and higher order values on top of lower order numbers. And so this means customers are consolidating purchases, they're sticking with fewer retailers, they're leaning heavily into loyalty programs and also convenience. And then finally, customers are shopping to reduce stress. They're choosing products and services that save time, that simplify life, and add comfort.
How about availability, inventory? If I'm going to go out and get my kid the G.I. Joe with the Kung Fu grip, is it going to be in the stores?
It will be. That's one of the really interesting things that happened this year. With tariffs, a lot of companies pulled their inventory forward. So where they were planning on a shorter cycle as usual, they actually said, let's pull inventory for the next year so we can get goods into stores and online. So yes, hopefully your kid's toy will be there in store. And if not, I can tell you, with the improvement in AI and technology, they are surely going to offer you something that they think is just as compatible.
I was speaking to the CEO of a toy company just on Wednesday, I guess, and he was saying that a toy that was maybe $20 before the pandemic is now $40 for various reasons. So there was the pandemic, right? The supply chain snafus, and then inflation thanks to that, and then inflation from, fiscal spending and so on. And now we're right up to almost double what it was before. Are we seeing that? Are we seeing that kind of inflation across the board?
Yes, we are. And it's happening in more categories than others. So you're mentioning toys, disposables, groceries. We are seeing that inflation across the board. And to your point, it has to do with general inflation. It has to do with tariffs, because while companies have absorbed some of the tariff costs, many of them have actually passed it right on to consumers. And so this is why consumers are being much more selective about where they purchase. And related to that, they're starting to trade down or explore alternative options. If it's a commodity item, they might actually say, let me go explore this other brand that might be a little bit cheaper, or buy the generic version of that to help capture some of that value back.
What's the promotional environment out there these days, Andrea? Am I going to get deals when I go to the store, assuming I actually do go shopping?
You will get deals. They will be very selective deals. So as retailers and businesses are looking at their inventory, they want to be much more precise about what they're promoting. So they're going to be focused on where do they have a lot of inventory? What can they replace fast? What's going discontinued? Where are you going to get that value? And even in some areas, they are going to price promote on items where they know you will add on. So you won't find full deals across the board. You won't see 50% off site-wide as much as you used to, but what you will see is on specific categories, they're certainly discounting. But at the same time, they will be promoting those discounts because they know this is the holiday season. They know customers are focused on value. So they're still going to put those select deals right in front of you so it feels like the same velocity as it did in previous years.
What's popular when it comes to fashion and retail and department store retail in that sense? Kohl's, for example, reporting the other day, and their strategy under the previous CEO who was ousted was to focus on fragrances and petites. And that strategy seems to be working even for the incoming CEO who's now been made permanent. But it struck me as odd that suddenly fragrances are very popular.
They are, and fragrances have to do with that longevity and value. Customers want something that they know they can use over time. And so what you'll see is right now you'll see purchases in what I call functional tech. So if you need a new laptop, if you need a TV, things that you need that will have a long-term value to you. Also, fragrances and wellness, something where you feel like you'll get your return. It will last over a period of time, as well as you will feel good about yourself. And then finally, there are other areas in beauty and in luxury. In many of these retailers, especially those that have multi-brand portfolios, we have seen their luxury brands, whether it's home furnishings or apparel, actually outperform. And that still goes to the value, which you don't often see value in luxury. But what happens is customers think, okay, at least if nothing else, I have longevity and I have resale value.
Hey, Andrea, you say that share of wallet is the real battle this season, not just traffic. What do you mean by that?
Well, what we're seeing is that with these average order values going up, what customers want is they want to go to a one-stop shop. And so where retailers are competing is they're adding services, they're adding shipping, they're making sure their inventory and logistics are there so that you can add more to your purchase in one stop. One of the big opportunities that I'm seeing is bundling. We've often heard about bundling when it comes to travel and dining, but when it comes to bundling, if you were able to talk about a gift set or add the pants with the shirt or combine a whole set of items, customers always see that as an opportunity. And so you see that retailers are using that to increase their ticket values right now.
Yeah, I love all the words associated with it, bundling and a haul. Yeah. I'm going to unbox my haul today. I love getting hauls, but I never seem to be able to afford them. Andrea, thank you so much for joining us today. A fun conversation there and a serious conversation too with Andrea Vornado. Much appreciated consumer brands and retail experts. So now we are going to continue on the theme, but more on the entertainment side of spending. Disney's entertainment division is facing challenges heading into the new year. The company said its new Avatar movie and other blockbusters will weigh on results. Bloomberg Tech co-hosts Ed Ludlow and Caroline Hyde spoke with Disney CFO Hugh Johnston earlier this month. Have a listen.
I thought it was a good quarter overall, and frankly, versus Wall Street, we beat expectations by 6 cents. So, as you noted, the experiences business did very, very well. 6% revenue growth, 13% OI growth was terrific. Sports did very strongly while we were launching the new DTC product, which is off to a great start. And then in terms of the entertainment business, it was largely just the overlap of the film slate that drove the numbers. I know the linear business looked a little bit soft, but that's primarily due to the fact that we had India in the numbers last year where we made $84 million and wasn't in the numbers this year. Take that out. Apples to apples basis. Overall, I thought the quarter was good, and it actually allows us to end the year with a lot of momentum as we think about where we are right now. We grew EPS 19% for the year and 19% CAGR for the last 3 years. And that's why we both guided to double-digit EPS growth in 26. And on top of that, doubled the share repurchase and increased the dividend by 50%.
Hugh, good morning. On that momentum, the focus for a lot is streaming, right? And you have the confidence to say streaming is going to continue to be profitable through 2026. What are the factors behind that? What allows you to have the confidence to have such visibility into how that streaming business is going?
Well, of course, streaming always begins with the quality of the content that we have and the quality of the slate that we have going forward. So if you think about the film slate we have right now, number one, we obviously have Zootopia 2, followed by Avatar, followed by The Devil Wears Prada 2, followed by Toy Story 5, Moana, and then we've got an Avengers movie as well. So if I look at all of that playing its way into the streaming service, certainly feel good about those tentpole events. In addition to that, our TV side continues to perform very strongly. The ratings are great. The number of hit shows are great. And then on top of that, we're investing in the product in a significant way, creating a unified app, and in addition to that, improving our recommendation engines and improving the navigation within the DTC app. Put all of that together, and what we really see is just a huge opportunity for growth. We aspire to grow that business double digits, along with the double-digit margins we expect to achieve this coming year. And as a result, I think we're going to continue to see that business do really well and be a real growth driver for Disney.
That was Disney CFO Hugh Johnston speaking with the Bloomberg Tech anchors there. Just a little bit of breaking news. Ukraine President Volodymyr Zelensky has said that his chief of staff, Yermak, has resigned. Now, this does seem to be a domestic issue. It follows a search of Yermak's apartment by anti-graft investigators. And we know that there have been allegations of graft and so on in Ukraine in recent times. Yermak says he's cooperating fully with the investigation, and of course, Zelensky says he is going to be holding consultations this weekend with potential candidates to replace Yermak. No real reaction in the markets, but it is interesting to watch oil, Paul, because if there is some kind of a peace deal, you might imagine that some sanctions will be taken off Russia, and that could definitely impact oil. Not so far, though.
No, not so far. WTI crude oil up about 50 cents, $59 a barrel, so below that $60 threshold, which has been kind of key here. The markets, Vani, kind of holding on to these gains here towards the upper end of their intraday trading. The S&P's up 21 points, that's 0.3%. The Nasdaq's up 68 points, a third of 1%. I'm going to call out for Tom from the Upper East Side, asking for a VIX quote firmly below 17 right here.
Firmly below 17. And you know, if the S&P continues like this for today, Paul, we'll have erased all of our losses for November. So we lost 4.7% in the month, and then we crawled right back to just down 0.4%. And again, if the S&P 500 continues with some gains today, we could actually end up flat or even higher on the month. And if you look at that VIX, that certainly signals that that might happen today.
Yeah, absolutely. Also, Matt Miller calling out for a Bitcoin quote.
Gosh, no one is shopping today. Everyone's listening to us. I love it.
1.3% higher, just under $93,000 per token. That's been all over the place. We had that recent high of 126,000, I guess it was, on Bitcoin, and then we got down below 80. So the volatility.
And you see all the related stocks jumping. I mean, Cypher, the mining company, is up. You know, Coinbase up a couple of percent. All of those shares breathing a sigh of relief, at least today, but it is Friday. Although apparently seasonally this is a good time again for Bitcoin, but I feel like I heard that last month as well.
Yep.
Lots of optimism in the Bitcoin universe. Well, coming up here, higher prices putting pressure on restaurants. We'll bring you a new steakhouse in New York City that's just opened its doors. Our chat with Eugene Rem, co-founder and partner of Catch Hospitality Group, is next. This is Bloomberg.
So I know a sports team that only one team takes a lot of energy and time.
Tell me about it, yeah.
So you decided after you bought the Washington Spirits to buy some other soccer teams. So you bought stakes in a team in England, is that right?
Yes. I bought a team called London City Lionesses, and that is the only one of the two teams in the entire, potentially Great Britain, that are independent. 99% of the teams in Europe are part of the men's team. But this is one of the only 2 teams that was independent.
So now you have 2 soccer teams, one in England and one in the United States. So I would think for most people that might be enough, but you decide to buy a team in France as well?
Yes. Olympique Lyonnais Féminin is actually the best women's team in the history of women's football. In terms of how many trophies the team has won, they are the 8 times champions of the Pan-European League. And I can't even count how many times they won the French domestic league, the most successful team. I want to professionalize women's sports, right? I don't want people to think that somehow women's sports is a charity or a corporate DEI project. This is a legitimate entertainment product, and it is a business.
What is going to be the consequence for U.S. markets? We're basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back to Bloomberg Markets. Paul Sweeney and Vonnie Quinn along with you for the morning. And I can tell you, Paul, that we have a nice little modest rally on our hands.
Yeah,
We're up about
that's
0.3% a piece for all these indices.
Yeah, in the equity markets, we closed trading at 1 p.m. Wall Street time today, and the fixed income market closes at 2 p.m. Wall Street time. So a little bit of a shortened day.
Mentioning the VIX at around 17, Bitcoin just above 92,000 now. It is bouncing around quite a bit, and plenty of action in these markets, albeit a low liquidity day. Well, one part of the economy that we've been following, obviously, is the restaurant industry, especially as prices rise and diners get a little more picky. Bloomberg's Katie Greifeld and Romaine Bostic recently spoke with Eugene Rem, co-founder and partner of Catch Hospitality Group. Last month, Eugene opened his newest restaurant, the 86 in New York City.
In the heart of the West Village, nestled between the brownstones on historic Bedford Street, is one of New York's hottest new restaurants, the 86.
It's the brainchild of Eugene Wren, the owner of the Catch NYC mega restaurant, and his partner, Tillman Fertitta, the owner of the Landry's chain.
Their new project, though, couldn't be more different. An intimate steakhouse with just 10 tables, but enough star power to fill 100.
Where New York is going, and I think actually where the markets are going, is a simple situation of supply and demand. The only way, in my opinion, moving forward is to shrink the supply to increase the demand. And that's why we thought about these places. So when we look at restaurants in New York now, we look for iconic locations that are small in size so that we can create that intimate experience. That kitchen is about 15 feet from here. So this is almost like having dinner in a house with really nice furniture and 10 tables and a set of staff, but it's almost like bringing something so intimate into the restaurant setting.
How many square feet is this?
The entire space is 1,800 square feet. That's between both floors, but the actual footprint of what you see as a customer is only 900 square feet.
It's not Rem's first attempt at a small-scale, high-end, soon-to-be New York classic.
Just a little more than a year ago, he opened the Corner Store, an around 80-seat restaurant just a 15-minute walk from the 86 that has since become, hands down, one of the city's most coveted reservations.
This has been the best opening I've ever been a part of. The Corner Store was more nerve-wracking because it was a fully new concept with a fully new team. Now we've taken team members from there and brought them over here, so there's a much greater rhythm.
While the 86 undoubtedly draws aesthetic inspiration from the Corner Store, Rem sees it as a new endeavor in and of itself.
Even the building it's housed in, 86 Bedford Street, is oozing with history. The site of a legendary Prohibition-era speakeasy turned counterculture literary haunt, frequented by the likes of Hemingway, Fitzgerald, and Steinbeck.
The name 86 comes from the term 86, which during the 1920s, during Prohibition, when people wanted to sneak out the entrance, this was the back entrance at 86 Bedford Street. So when people were in there, they had a code called 86, and everyone knew to run out here.
Rem used the building's exterior as inspiration for its layout and decor.
This is a 1920s Art Deco design, and we're trying to think of how we pay homage to this space and its history, but give it its own feel. And I was sitting at home talking to my wife about what that should look like, and she was like, you should look at the Orient Express. And when we saw it, it really defined what that was.
And the Prohibition inspiration flows throughout the menu, with the restaurant's beverage program taking cues from 1920s tipples, precise martinis, and inventive cocktails.
When it comes to cocktails, though, are people still drinking cocktails and paying up for cocktails?
Cocktail culture is a big part of what's happening here in New York City. We are at the forefront of cocktail culture, the Corner Store specifically, the martini program, the idea of just not having a generic martini and making everything special. So everything we do is from scratch. We have an entire team that comes at 5 in the morning and they work on batching and creating the martini program, and that also translates to this space. So you're not getting anything that's just a traditional drink.
The recipe for restaurant success, though, is not without challenges and has been shifting fast. Take sustaining a beverage program in this day and age. A tall order as more Americans are drinking less. Data from the UN's Food and Agriculture Organization goes so far to suggest alcohol use may be in permanent decline, with beer consumption peaking in 2016 and wine consumption that's been on a steady decline since the 1970s.
People are drinking less. So people used to drink a bottle, now they may have a glass. They maybe used to have a glass, now they'll have a non-alcoholic beverage. So wine is a huge part of what we do, but in order to get the big wine sales, you have to provide all of the theater that comes around it.
Lower levels of drinking, along with the rise of GLP-1 weight loss drugs, means that restaurateurs have had to rethink traditional business models.
I have not come up with like the flat seating model yet, or the dynamic pricing model where if you want a table at 5 o'clock, it's going to be $300. If you want the table at 7:30, just like when you go on a flight, if you want to go at 8 a.m. on Friday for a weekend to Miami, the flight is 3x what it is at Tuesday at 4 p.m. Restaurants don't have that yet, and I think it's coming.
Rem's long-running career in the restaurant business means he's had to navigate changing landscapes.
Catch was born in 2011, so the idea was always to create a singular experience that connected nightlife with restaurants. So we were a nightlife group that did a little bit of restaurant, and somewhere around 2015, 2014, we pivoted to a restaurant group with a little bit of nightlife DNA. And from there, we expanded Catch from New York to Los Angeles to Las Vegas, then to our second concept, Catch Steak, which opened during the pandemic, and then we went on a spree.
And for Rem and Catch Hospitality, that spree continues.
Something that's very important for, I think, a business model is to cluster. So since we already have an amazing location in Las Vegas, we're planning on doing another one next year with the MGM group, because that's a big brand and it's a big team and we like it there. I think Dallas has also been incredibly successful for us, so we've been excited about the opportunity to expand that footprint. Scottsdale, again, only 6 weeks old, but it has just been received really well.
But it's tough to stay put in an industry that's seen peaks and pits. In the 6 months following the COVID-19 pandemic shutdown, nearly 1 in 6 eateries had long-term closures or shut down permanently, according to the National Restaurant Association. It's been a rocky recovery since, with restaurants facing higher labor costs, inflated food prices, and still disrupted supply chains. In the last year, eating out costs have risen 3.7%, according to the latest CPI data.
Up to 2019, every restaurant, didn't matter the size, it was packed, everything pre-COVID. COVID hit, disaster, 6-12 months. Then you get the influx of all the free money and everything that comes with it. So you have the blowback of that. Welcome 2023. The hangover sets in, reality sets in, that people have limited resources, that people don't want to be able to eat out as much. So then now you get into 23, 24, and 25, and every year you are starting to see that people are spending less, going out less, and doing less.
But Rem's thoughtfulness has helped him persevere and create special places rooted in one core ideology that every restaurant he's put on the market embodies.
Number one, you have to feel good when you walk in, and that's the people who work here. So they set the tone and the standard of what we do. Then we have to back it up with amazing food, and then the vibe. And the vibe in this scenario is some of the design, the lighting, the music, and everything else. And the key is being able to do all of those things equally well at the same time.
All right, that was Eugene Rem, co-founder and partner at Catch Hospitality Group. I went to the website for the restaurant. It looks awesome. It's in the old Chumley's, which is a haunt from my day back in the day when I first got on Wall Street downtown. So it's in that same space, which is a very cool part of town. All right, here's my benchmark for a steakhouse. It's a simple New York strip.
Paul has thoughts.
$86.
Oh, cheap at the price.
Oh my God. I mean, and my benchmark, folks, and I've said this on here a million times, and people ask me when they come in from out of town, from out of the country, where do I go for a real New York steakhouse? I send them to Keen's on West 36th Street. There it's $69.
Yeah, I do have to put in a little caveat here, because you're looking at the bone-in Wagyu New York strip.
Yeah, that's true.
You could, of course, go for the porterhouse for $2 if you were being generous, and that would only be $150. Wow. Or you could just get the skirt steak, 8 ounces for a cool $38.
Yep. So,
but you know, that's not what you spend the money on in these restaurants anyway.
No. And the cost of beef is crazy. You talk to Mike McGlone, who's a commodity strategist for Bloomberg Intelligence. He grew up on a farm. He knows about this stuff. And the herd in the United States is at the lowest it's been in decades, the cattle herd.
Yeah.
And what I understand is, so of course my solution was make more cows. You know, why can't we just make more cows? Just like we did when we had a chicken shortage, make more chickens. And they did, and now we have eggs. But apparently the herd is not going to be replenished.
Did you tell that to the chickens and roosters, or did you tell
yes, I told it to the farmers. Like, guys, just make more chickens. The herd won't be back to a more normalized level until sometime in 2027.
Well, we saw deer earnings. It was definitely suffering in there.
Exactly right.
Although not so much for the smaller farmers, but for big ag, definitely.
Yeah, so the farmers out there are hurting. Their costs are higher across the board, whether it's feed or just insurance or whatever, and commodity prices are at a low. So we keep an eye on the commodity prices out there for our good friends out on the Great American
stuck
Farms
on the martini menu.
Yep, absolutely. S&P 500 up 26 points, the Dow up 280, the NASDAQ up 93 points. Well, more coming up. This is Bloomberg.
In case you missed it, on Balance of Power.
Congressman, do you believe President Trump when you hear him praise Mamdani and say that he wants to help him succeed? And if that's the case, doesn't this blow a big hole in the Republican campaign in the midterms in which they wanted to use Zoran Mamdani as a bit of a scapegoat here? And now President Trump says he's ready to move back to New York.
I think it's a fair point that, the Republican political structure was really trying to set up Mamdani as the scary point of attack, essentially, for the American people. And if Trump is signaling and actually saying that maybe he's a good guy and we're going to work together, I think that does make it much more difficult for them to try and go forward with that. But ultimately, I think, as I mentioned a moment ago, it's really going to come down to the prices of what it costs to live here and who's trying to do what to fix it. That's the key, I think, for the next cycle.
Don't miss Balance of Power, live every weekday.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day, now at our new time. Only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
We're coming to you live from Kuala Lumpur. The whole world is here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Welcome to Bloomberg Markets. I'm Bonnie Quinn, here along with Paul Sweeney in our beautiful radio studios here in New York City.
Yeah. Fantastic. I mean, we're here, we're doing the radio, the TV. Don't forget the YouTube.
Yep.
So we're like all over the media landscape.
You can get us anywhere you look, everywhere you look. And these markets, as we look at them, rising today once again. So continuing this nice Thanksgiving rally that we've had. I wonder if that means we don't get a Santa Claus rally. That's something for next month. However, we are narrowing all of our losses on this month, which started out really, really rocky. The S&P 500 may even end up flat or up on this month, having dropped 4.7% at one point. Right now, it would be flat for the month. It's up 0.4%. Same for the NASDAQ 100. The dollar index, a little bit of weight to it. We have sterling now at 132.47. Of course, that budget not taken too well by the public. Sterling was weaker earlier, but it has recapped those gains. We have WTI trading at 59.19, so up about a percentage point. And yields, well, that 10-year at 4%. And of course, the 2-year yield at 3.49 as we await with bated breath what looks likely, Paul, to be cut in December.
Yep, absolutely. We'll keep an eye on that. Looking at the WIRP function, WIRP, about an 80% probability of a rate cut in December. That's been all over the place. All right, well, the CME has restarted most of its trading after an outage left investors in the dark. And most of this morning, joining us now is Bloomberg's Adam Linton in London. Adam, do we have any better understanding of what happened here?
No, still nothing really too much clear that we've kind of seen. There's clearly been some sort of cooling issue, and as I kind of mentioned earlier, I do kind of have a suspicion that maybe skeletal staffing levels due to the Thanksgiving holiday could have potentially played a role. But ultimately, let's hope the CME tightens up their practices with their data center operators, and we don't get a repeat of an occurrence like this.
Yeah, Adam, I mean, it's quite dangerous to have this going on no matter what time of the day, right? We spoke to some traders, and one said that some market participants will take advantage of possible difference in prices, but the majority might pause trading for risk reasons. Another talked about month-end flows and options expiry today. Will it have had a big impact? Will people have lost and made money on this?
I mean, it's hard to tell. We'll probably see more stories about this in the coming days. But in terms of my kind of vantage point, in Europe, we saw a bit of a widening in some of the FX spreads, which is pretty unusual. Fortunately, due to Europe's deep pools of liquidity, they didn't really get too much out of hand. I'm sure there's a lot of frustration caused for traders. But ultimately, we've kind of got through this. There's not really been a market kind of contagion story here. As you mentioned, US futures, they're a bit higher. Treasuries are steady. Of course, I think the reason why this has been such an issue for many participants is, we've got kind of this in-between Thanksgiving and weekend period. It's low liquidity, and, it's a very dangerous time for this to happen in the market.
Yeah, exactly. Adam, thank you so much for keeping an eye on all of this for us. A very tense few hours this morning because it was not a short outage. That is Adam Linton there of Bloomberg News. Let's turn our attention now to the markets and bring in Rob Hayworth, Senior Vice President and Senior Investment Strategist for Wealth Management at US Bank Asset Management. Rob, can I ask you about this outage first? I mean, when you wake up in the morning, you're maybe a little groggy after Thanksgiving and you see that something like this is going on. Does it make you concerned for your portfolios and your clients?
Well, it's certainly something that has to be paid attention to because the futures markets, especially in the off hours, provide additional liquidity and risk management for a number of managers. I think for us, we still look harder at the fundamentals. Is the economy still working? Are we still spending money? and what is that doing for earnings and earnings growth here in the U.S., which has been very solid as we finish up the third quarter earnings reporting season. So yes, it's a short-term hiccup for the market and for market participants, but in the long term, it's still about the cash markets and fundamentals that are really going to drive us forward.
Rob, a lot of the performance this year for investors at the index level has been the big cap tech names, the Magnificent Seven, and maybe a few others there. Is that still going to be the play for 2026 in your mind?
Yeah, we're still thinking long and hard about 2026. I think there needs to be some rotation, right? We do think artificial intelligence is at the core of this growth scenario. You have significant spending going on there, but you're starting to see beneficiaries of artificial intelligence emerge. We're getting early signals from improving healthcare performance, for example, that there's probably some usage here that's starting to spill over into future long-term benefits. So I think the market is looking for broadening in this AI trade, even as that core investment continues to grow as companies build out their large language models and build out the infrastructure to support them.
You know, Rob, a number of people have said to us that the opportunity now is in private markets, and you have it too. You're talking about private capital offering unique excess return opportunities. How do you get access to that, and where would you be looking in terms of private capital?
Yeah, it's an important element of the market for us as we think about it for our clients. We are using our relationships to find more niche and unique strategies that we think can drive top quartile sorts of returns through time. I think the hard part in this market is as we kind of grow private equity in general, right, kind of the average returns get closer and closer to public markets, but some of those niche strategies like kind of a consolidation of government vendors, unique kind of neighborhood business consolidation, think heating and air conditioning, things like that, sports franchises. We've seen very unique opportunities across the private equity space that we think play well into 2026 and beyond. But that's the important thing, is finding those niche strategies, getting access to them for the high net worth investor.
What do you think is a decent allocation for alternatives, Rob? Like when I talk to RIAs, I always expect to hear, 5%, 10%, but a lot of times they come back and tell me 20, 25%, which really surprises me. How do you guys think about it?
Yeah, we do think about it differently across those broad wealth tiers. We'd say less for lower wealth tiers, closer to that 5, 6, 7%, depending upon your risk tolerance, because liquidity does play an important role in your wealth, right? You need to ultimately have access to that wealth to use it to manage and maintain your lifestyle. As we get up into higher and higher wealth tiers, yes, you can get up to maybe 20%, but I think the important consideration for us is you have to pay attention to the liquidity needs of the client, because it is challenging to get immediate access to private equity funds, right? Those are 10 and 12-year investments that take a long time, have call periods and distribution periods, and so you need to have access to other liquidity sources to meet the needs of your lifestyle.
And what about the bond market and bond market opportunities then, Rob? Municipals have outperformed this year. I mean, I think they've had their best year in, 36 years or something crazy like that? I mean, would you still be looking at municipals as a place to park some money?
We would. I mean, when we look at tax equivalent yields on municipals, if we look at last year, it was tough for them to make sense if you weren't in the top tax bracket. Now that's happening at the 24% tax bracket, where municipals, the income on municipals is making sense relative to taxable bonds, both in high quality and in low quality bonds. So we'd look across that spectrum to own in municipals, not just some investment grade, but we'd add in lower quality bonds. We'd add in longer maturity bonds, unlike in the taxable bond market, because that yield curve is so steep in municipal bond land that there's a lot of income opportunity as you look out longer and lower quality.
Vonnie, I like to think of myself as the largest private creditor to the state of New Jersey, because I've owned munis for a long time. So when I call the governor, picks up on the first ring. Rob, what are we doing? How much credit risk are we taking out there in the bond market? I can sit there at a 2-year U.S. government bond, get 3.5%. Do I need to take credit risk above and beyond that?
We do think it's worth it to look at, but in maybe other places than traditional corporate bonds, right? That's still a key part of a taxable bond portfolio, but we'd look more into structured credit. And the primary reason is we think we're getting kind of niche sorts of protection in those spaces. Residential mortgage-backed securities are a good example where we've got still fairly high home prices. You've had, especially for some of those legacy bonds, you've had large home value increases, so you've got a little cushion there in terms of home equity from those borrowers in those bonds, and you're getting still those high yield like returns on those bonds. So it's fairly attractive to actually move out in the risk spectrum in certain cases. We'd still look towards high yield corporate credit, but not get too overextended there because those spreads are relatively narrow, but we're seeing more cushion in things like structured credit.
What about the credit of firms that are looking to raise money for AI opportunities? I mean, that's been such a controversial area, and yet the spread is only something like 75 basis points for many of them.
Well, and for many of them, they're early in that cycle.
We seem to have lost Rob. Maybe you didn't want to answer the question.
Maybe there's an AI issue there. But
we'll get you an answer to that.
I love Meta going out into the marketplace to sell high-yield debt to fund, in part, their CapEx, what they had just announced a couple of days before. The market did not like that CapEx spend, but yet they go out to the bond market, and they had $125 billion of demand for $25 billion worth of bonds.
Exactly.
It's just extraordinary. And I always joke with Tom, I could do that deal with 10 phone calls back in the day.
Really?
10 phone calls. You just
all right,
know.
You've got a half-hour poll.
Exactly. And they could walk in here, Bob Michael from Morgan Stanley Investment Management. I mean, just that's how much demand there is out there for some of that credit.
But is it FOMO or is it actual demand?
Yeah, it's interesting. The only analogy I make to people is when they bring you back to the dot-com bubble, which I was smack in the middle of, cranking out IPOs as fast as I could in the late 90s.
So you're responsible, is that what you're saying?
Oh, totally responsible. Just give me a .com and I'd sell it. But it was, now what's different is they have real cash earnings, real free cash flow, these companies, even though they're experiencing extraordinary growth. And they're usually like in year 8, 10, 12 of their lifespan. So they've really built up a real business and a real infrastructure, as opposed to the .com boom when they were 15 minutes into existence and we take them public. So it's much different this time around. That being said, the dollar amounts are just huge. And what does concern me is some of these circular deals that we've seen over the past several months.
And you do wonder how much the market will absorb. And it's always at the margin, right? It's always that one extra sale that doesn't go well that then sort of flips everything over on its head. And we're all like, okay, well, we saw this all coming.
Yeah, and I suspect we might very well have that moment at some point in time, but
maybe not immediately.
I don't know. And but if you're Dan Ives or some of these Uber bulls on technology, they're simply falling back in the argument that this spend here on AI, we're in the very early innings of a 9-inning game, and the dollar amounts are just extraordinary, and that's going to fuel this for the next several years, is what the bull case is right now.
And just to shift the conversation ever so slightly, I mean, it's definitely an oblique shift, but Bitcoin rising as well, you have to wonder what the next catalyst for Bitcoin are, because that's also been the narrative of the market for the last several months as well, since the new president took over, let's say, and there was a lot of optimism around Bitcoin, and it hit a record and so on, and then it lost 30% of its value, but it seems to be, floating back higher again. You wonder about all these companies and these treasury strategy companies and so on. Yeah, I like Mike McGlone of Bloomberg Intelligence, how he phrases, because I always ask Mike, is there a valuation, like a PE multiple for Bitcoin? And there's not. So he says he looks at it relative to gold and just kind of says, as a multiple of gold, because one could argue it's a store of value, one could argue it's speculative. Which is it? Is it a commodity? And I personally view it as a commodity, so I let me just benchmark it to some commodity that we really have a good sense of value, that being gold. And so you go back and historically and look at the multiple of Bitcoin to gold. Mike was saying that $125,000, it's never been at that valuation before. So Mike was always calling it to pull back. So that's kind of how I think about it. I don't know. I mean, isn't it a bit random just comparing it to gold? What, because people call it... I'm not sure what else to compare it to, because there's no base. Could be. I don't know. But I like gold because everybody knows what gold is. You can touch it, you can feel it. It's been around forever. We know where it is. It's in Fort Knox. It's in central banks. So I don't know, but that's the only way I can feel comfortable making any kind of valuation call on Bitcoin, because to me it's just a commodity.
commodity here. You know.
Yeah.
So
yeah,
anyway,
yeah.
we'll keep it on. Anyway, we got the markets trading up here. S&P 500 up 29 points, 0.4%. The Nasdaq up about the same, about 0.4%, up 100 points. And the John Farrow Dow Jones Industrials quote, we'll call it up 300 on the Dow. This is Bloomberg. Good morning.
Why would you want to be chairman of the Fed? Are you sure you want that job?
If the president asks me to be Fed chair, then I'll do it. If I'm not Fed chair, don't be disappointed for me because I love the job that I have.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly. Welcome to my workplace. Do you feel pressure? Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'd still be driving some.
Yeah. Probably very fast.
This is so exciting!
This season, we're along for the ride.
The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Bloomberg Markets. Paul Sweeney here along with me, Bonnie Quinn, and we are keeping an eye on these markets, which are determined to finish out Friday on a high note. We're actually close to our session highs now, with the Dow, as you say, Paul, up 2/3 of a percentage point. With the S&P up almost 0.5%, and the Nasdaq 100 up 0.6%.
Yeah, it's a quiet trading day. We had that little mess up there earlier, mix up with the CME not getting the futures open until later in the trading morning session here, but it seems to have all settled down here now. So we got a little bit of a lift here to the market.
Yeah, and the VIX down, almost, 0.4 at 1682, so a little calm. Let's talk something that maybe isn't going to be so calm, though, in the coming weeks. Tariffs taking their toll on consumers and companies alike. Our next guest says tariffs are now one of the biggest variables in retail margins. Joining us to discuss is Ryan Peterson, founder and CEO of Flexport, a leader in global supply chain technology. Ryan, thank you so much for joining. I would have thought that things would have calmed down a little bit. We have at least some kind of certainty, albeit we're waiting for a SCOTUS decision, but we have some kind of certainty over tariffs at the moment. What are supply chains like? Is there still chaos out there, or are we getting to some kind of ability to see the future?
Somewhere in between. I think people are getting more used to the fact that you have to operate in a lot of uncertainty, and brands are figuring out how to be agile about it, and a lot of different strategies where they can do that. But there's still a lot of, you mentioned SCOTUS, that big court case is coming. People are hoping and praying for a refund. And it's actually, there's a lot of variables here. You have to figure out how much of the duties, how much of the tariffs do you want to pass through to your customer. Goldman Sachs reporting about 37% of the duties are getting passed through. With 9% getting forced on the supplier, and the balance is just hitting earnings for these companies. So there's that. And then even just calculating the duties is harder than ever before. The nature of the stacking tariffs, where there's all these different tariffs, they just keep getting layered on each other. We've seen more traffic to our tariff simulator on our website than to the overall website.
So it's interesting, Ryan. Do we think that companies are going to try to push more of those costs through going forward as opposed to absorbing them into their P&L statement?
You only have two choices, kind of. I mean, you can renegotiate things with your factory. Yeah. That's not a choice. That's something you're going to always try to do. And then you have two choices. It's, do you pass it through, or do you eat the costs? And the good businesses will pass it through. I think that's, one of the hallmarks of a good business is your ability to pass through price increases. But a lot of companies can't. So it may not even be a choice. As much as you'd like to, the moment you raise your prices, you start to lose demand. So then longer term, you have some more options around moving supply chains, but it's become so difficult because it's not just, hey, exit China, move your factory somewhere else. The tariffs on India are just about the same as China, and they might pop up anywhere in the world with the way things have been going.
Ryan, are we done with all the avoiding certain areas because, there's drought in one canal and there's war and potentially in another canal and there's, terrorism in another part of the globe? Or, are we back to everyone can ship everywhere?
No, we're definitely not back to normalcy there. The container volumes going through the Suez Canal are still down about 75% since the Houthis started to cut that channel off at the end of a couple of years ago. And I actually just last week created a poly market on this. Now you can bet on anything. I mean, you can now bet on when traffic will return to normal through the Suez Canal. It's pretty thinly traded right now. We'll see if we get some more signal out of that. But there are some rumors that it'll start to come back to life next year and ships will return. But for now, they're going all the way around Africa, and poly market has me at 37% to return in Q1. I think that's free money. I'm taking the won't happen side of that trade.
Okay, we're ignoring that part of the conversation. What about the Panama Canal?
Well, Panama's been this ongoing thing ever since they re-engineered it. So they widened the canal back in 2015, and the Panama Canal runs on fresh water. So if you widen the canal, more fresh water flows out of the canal into the ocean than when it was narrower. And so ever since they've done that, with the same amount of rain, you've now had these periodic moments where there's just not enough water to operate the canal. We're currently in a normal period, but 2 years ago, it was really bad. They could only operate about 2/3 capacity on that. That's going to keep coming back unless they spend tens of billions of dollars re-engineering the water flows in the canal, which I don't think they're going to be able to do.
That's on my bucket list, to go through the Panama Canal. It really is. It's
you better pick your container ship wisely then, Paul, because you're not getting on all of them.
I know, exactly, but I'm ready to do that. Talk to us about inventory levels, Ryan. I mean, are retailers, are they stocking their usual amount of retail inventory, or are they going a little bit light, or what are they doing?
No, in fact, you could argue they're going the opposite. They're going heavy on this year because not so much because of the uncertainty of demand, although that always exists, but because of the tariffs. So everybody front-loaded. These reciprocal tariffs on rest of world ended August 29th, and you had a couple of months to know that was coming. And so everybody brought all their inventory in early. And what it's going to look like is you can never really predict what's going to be a hit product and what's not. And so you're going to have stock outs on certain hit products because it's now much harder to replenish. You're paying higher duties. And so you're going to have stock outs on some of the hit products. And then I suspect you're going to have quite a bit of overhead of products that didn't move. And you'll probably see some good deals coming in the beginning of next year. We may see some right now with Black Friday, but usually these things play out into the Q1 period once the holidays are over.
All right, Vonnie, here's the book recommendation of the day for you about the Panama Canal. The Path Between the Seas, David McCullough. Phenomenal book about the history of the Panama Canal.
And a great writer. I will definitely read that. I'm on my 22nd book of the year, which I guess is good, but could be better. So, Ryan, in terms of shipping companies and M&A, there was plenty of speculation that Zim, for example, was going to get bought out or whatever. That happened a couple of times this year. And some of these shipping companies have been really having a hard time of it, trying to deal with all of this uncertainty. Do you have any forecast for us on what we might see maybe next year in terms of M&A and consolidation?
No, I don't really know. We'll see. We see a few of the big companies executing that strategy. DSV is the biggest freight forwarder in the world. They've been the most acquisitive, but they just bought DB Schenker, and that deal's closed. And that is a lot to digest. They're going to be, basically doubles their number of offices around the world, almost doubles their volumes. So the main acquirer is probably off the table for the next couple of years as they chew on that one. And we'll see. There's been a lot of consolidation. When I started Flexport, there were 23 ocean carriers. major ones. We're down to 11. And I don't know, there may be some mergers, but they've all, in the past, that was done out of financial weakness where they were all kind of struggling. Well, they've all put a lot of money on their balance sheet over the last few years when the rates were going crazy. So there's not going to be a lot of the forced M&A that we saw that drove that consolidation. We'll see, though. Maybe there's some interesting strategic opportunities.
Well, we do have a little pending consolidation in the railroad industry, Norfolk Southern and Union Pacific. Do you think shippers want a transcontinental railroad, Ryan?
Probably, but I don't think they just want one. You get monopoly power,
Yeah.
so they'd like to see more than one, and that's the challenge. We've only got 4 railroads in the U.S., and if you merge the two, and you got 2 on the west and 2 on the east, so you could end up in a position where you've got 2 end-to-end railroads crossing the country. I mean, it makes a lot of sense. It's sort of silly to transfer to a different railroad just because you're crossing the country, but you will see probably who knows how it will play out if the efficiencies are passed through to the brands, to the people that are shipping cargo or not, or does it get absorbed in sort of oligopoly pricing?
Ryan, when it comes to the different modes of transportation, so ports, trains, rail, shipping, and even at one point people were flying their cargoes, right, for huge premia. Who are facing the highest premia? Or is it the same for everybody across the board?
I'm not sure I understood the question in terms of what.
If you're booking travel for your inventory, does it matter if you're a toy retailer or if you're, a clothing retailer or if you ship furniture? Is it the same price or does it depend on weight and how does that all work? Do you bid on it? Is it an auction?
Your pricing will be about the same no matter what you're shipping these days. That's the beauty of the container. Nobody cares what's inside of it as long as it doesn't, catch on fire or anything. But the tariffs will be quite different based on based on the value of the goods and what's being shipped. And so there you see big category shifts where certain products are just really hard hit and others are totally exempt. And the other factor here is if shipping prices go way up, like a container of furniture only holds about 80 couches or something. So a high shipping price there hits the goods pretty hard.
We'll have to leave it there, Ryan. Thanks so much for joining us. Ryan Peterson, founder and CEO of Flexport. The first research report I wrote, 1987, Consolidated Railroad. U.S. government privatizing the railroad. Wow. This is Bloomberg.
You missed it on the opening trade.
Kit, I've got a present for you. I know you've mentioned it a couple of times. We've got a coffee for you.
Hang on a sec.
By the
coffee
lovely Tara.
coming. There we go. So my question now is, how much froth is in there?
See, you can't tell when you look at the top. That's okay. You've got to drink it to find out.
Absolute genius. You got to take the lid off before you even figure out what's going on.
Don't miss the opening trade, live every weekday.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
In case you missed it on Bloomberg Insight.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. Our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data.
Countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Don't miss Bloomberg Insight live weekdays.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance. In case you missed it, on Bloomberg Open Interest.
It's Netflix versus YouTube.
100%. I do think in the world of more AI slop, people are going to look for destinations where they really want higher quality, curated, high production storytelling.
But YouTube is crushing it. I mean, I have both.
Absolutely. Right?
But one thing YouTube has is like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent. Consumer product is consumer tech.
Don't miss Open Interest live weekdays.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bloomberg Markets. I'm Bonnie Quinn, along with Paul Sweeney here on this Friday post-Thanksgiving, where we're seeing a nice little rally, although we are off our highs. The S&P is up about 1/3%. The VIX is at 17. We have just really nothing going on with the dollar, and the 10-year yield now at 4.02 and climbing just a little bit. Bitcoin is off its highs too. It's just above 91,000 a coin. Boy, is there volatility in that asset. All right, Paul. Well, it's been 1 year since Nike CEO Elliott Hill took the helm of the world's largest sportswear company, with the one-time intern helping blunt a long-time sales slump. Bloomberg The Close co-anchor Romain Bostic spoke with 3 key players in Hill's offensive strategy for a behind-the-scenes look at how the retailer is putting its best shoe forward once again.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
Hundreds of motion picture cameras surrounding an indoor soccer pitch. Speed sensors encircling an Olympic racetrack. Electronic pressure plates embedded in a basketball court. Biometric hookups to assess a runner's gait and posture. A hermetically sealed room that mimics the brutal heat and humidity of a Tokyo summer. All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab. An evolution from the company's experimental kitchen counter roots and a nod to its future of putting the athlete first.
This is our Nike Sports Research Lab in our Innovation Center, and this is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete, right? Phil's point, we're in this amazing building where we have dreamers building the future and work with not only elite athletes, but the everyday athlete to take those insights and understanding and build not only for the elite, what you've seen being here today, but then are able to translate those innovations through every price point.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new chief innovation, design, and product officer, overseeing ideas across the company's 3 units, Nike, Jordan, and Converse. They are 2 of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. Under Donahoe, it was a tenure that saw annual sales begin to drop in 2024 as demand waned for the brand's lifestyle sneakers like the Nike Dunks, and as relationships with retail partners soured. Elliott Hill is now trying to plug the hole with a refocus on athletic performance.
We're going to obsess sports. I think that's been, since Elliott returned, that's been a key part of our charge as a leadership team. And we're already starting to see the fruits. You know, we spend a huge amount of time bringing athletes here. We text with Faith Kipyegon, Elliott Kipchoge, LeBron James. We bring them to our home and then we go to their homes. So the origination for ideas is always the athlete. That's at the core of everything we do. And then we start to think about how do we apply those insights broadly to the 8 billion people who we're trying to invite into sport every single day.
So when it does actually go to market, are you going to target it towards
the athlete, or are you going to try to maybe just target towards the casual wearer?
Everything that we do and the focus on performance is listening to the elite athlete and capturing that data and information to help lead this amazing innovation. So we will for sure be connecting this story exactly to our athletes, which or who helped give us those insights, who we tested with, and that will be how we determine how we tell that story going forward. So it's very much about the insights from the athletes, the data we captured, the innovation we're delivering, and helping communicate that to consumers all over the world.
The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. I even got a glimpse into the retailer's future with Project Amplify, a footwear system with lightweight motors and rechargeable cuff batteries that aims to help you move faster with less effort. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. You know, there's plenty of opportunities where technology, we have to sort of burn the candle from both ends and figure out where the best opportunity is.
The ethos of the company, and particularly since Elliot has taken over, is put more a focus back on the athlete. I mean, what's the difference now between what you're doing in this building and say what Bowerman was doing, you know, decades ago and, you know, whatever shack he was working out of?
Honestly, today it's just a more modern, sophisticated incarnation of what Bill Bowerman was doing in his lab. You know, this notion of having an idea on how you might improve an athlete performance or protection, actually building it, you know, Bill Bowerman pouring into a waffle iron, modifying a shoe. That's what this building is designed to do, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka. In its latest earnings release, Nike sprinting forward, driving over 20% sales growth in the category thanks to a redesign of its three big running franchises, Vomero, Structure, and Pegasus. The Converse brand, however, a problem area. Sales there, they're declining 28% in the most recent quarter. Do you worry at all about some of the recent upstarts that have come into this space, particularly on the performance side, Hoka, On Running, Norda, etc.?
But we have three incredible brands here at the company. We have Converse, we have Jordan, and we have. So I think a lot of the work that we're doing in this new multi-brand offense that we're in is making sure that we intentionally shape the three amazing brands that we have. That allows us to, at certain times, come together to go after an opportunity in the market, but also to be more specific about what each brand represents and the growth potential of each. I think when we think about that, I think it's true. It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
And we look at innovation not just in product, like Phil's talked about, but how we tell our stories and how we deliver experiences in the marketplace for consumers. And when you think of some of maybe our latest, most innovative marketing concepts, I think back to the last Super Bowl, a male sport at a really important time around the world. And we told the story of So Win through our female athletes, right? We listened to their voice. We're deeply connected to where they were at that moment. And we're able to tell the story of the support of those athletes and what they are doing in the world of sport today. So I think that's one amazing example of we continue to innovate by listening to them where they are, where the world of sport is and sport culture, and then are able to deliver something like So Win.
Amy, I'll give you the last answer here. And this is really on what you want the Nike brand to be beyond what it already is today.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
All right, that was Bloomberg's Romain Bostic with some of the Nike top executives there as they reimagine that brand. Joining us now for a look at how some businesses are transforming former retail spaces is Michael Browning Jr., founder and CEO of Unleashed Brands and founder of Urban Air Adventure Park. This business converts large spaces like malls into adventure parks. I got to hear this one. Michael, thanks so much for joining us here. I mean, you guys have more than 400 urban air parks open or under development, $600 million in annual revenues. What do I do when I go to an urban air adventure park?
Well, we've got everything all under one roof for our millennial families who on average come in. They come in 3 times a year. They spend roughly 3 hours in the park. And every time that they come in, it's a differentiated experience because we have over 27 different attractions for a wide array of kids. And like you said, we have over 210 locations open, 175 under development, and we currently occupy over 7 million square feet of retail real estate.
Yeah, it was kind of a genius idea, but talk to us about the pricing of it. Did you get good deals on these shopping malls, and how much does it cost to outfit them and make them safe?
Yeah, safety is one of our #1 priorities because we steward today's kids who are going to be tomorrow's leaders. And, for the millennial parents that make up the vast array of parents today, experiences are so important to them. I mean, 78% of millennials say that they would rather spend their hard-earned money on experiences than things. And 55% of them are saying they're spending more today on experiences than they have ever before. So it's extremely important to us that we provide them with a safe, fun experience. We want them to have a high perceived value for their dollar with a diverse mix of attractions, long dwell times, and we build in exercise and socialization with just kids aren't getting enough of today.
All right, Vonnie, I got 2. I just went up, I looked at the map here. I got 2 close to me. So that might be a weekend. That might be a weekend thing here in Jersey, the swamps of Jersey. Michael, what's a typical, customer of yours?
Yeah, like I said, today's parents are the millennial generation, and these millennial generations, they gravitate toward experiences. And the average family has 2.23 kids. They drive a Honda Odyssey minivan. They're coming into our facilities, and what we don't sell is the what. We don't sell necessarily the attractions, although they're amazing. What we sell to families is the ability to celebrate, escape, and connect through active play. And that's why I'm so excited about Unleashed Brands, which is the platform company of 8 world-class brands and the Black Friday offers and deals that we have going today at offers.unleashedbrands.com. All of our 8 brands are leaning into learning, playing, and growing rather than stuff for these millennial families.
I see what you did there, but then why not? Because everybody is doing it. I just looked at my phone and I have about 75 offers, which I will not look at later. But talk to us a little bit about the parameters for finding a mall. What does a mall have to offer you in order for you to take on the space?
That's a great question. So the average box size of an urban air is around 35,000 feet. And so that makes it an ideal solution for big box vacancies. So we're transforming second generation spaces, whether it's old grocery stores, Bed Bath & Beyond, Joann's, and we're turning them into high energy family entertainment centers with multiple attractions, long dwell times, and exercise and socialization for the families.
Are you guys nationwide here? Are there certain areas of the country that you guys are putting capital to work at these days?
Nationwide.
How much would you want discounted, let's say? So you're taking over the whole mall, right? I'm still trying to get at the amount of money that you have to outlay in order to make this work, and what you would need from the mall operators in terms of a deal, basically.
Yeah, great question. So the average CapEx to build an urban air is just around $3 million. And that's actually come down about 12% over the last 12 months in spite of inflation. And that's come through our value engineering and us optimizing key roles in-house like engineering and construction, as well as optimizing our supply chain. So we're putting about $3 million into each of these locations. So we're absolutely asking for landlords to partner with us in the form of tenant improvement allowance, free rent, things of that nature, because we know that the 17 million foot traffic that we've brought to our over 210 locations this year gives great exposure to the co-tenants in the center.
Yeah, exactly. Yeah, well, listen, great idea, and I'm definitely going to try one, an Unleashed brand.
My kids are all grown, so I don't have to do the birthday party thing.
Oh, you don't have to do the birthday party, but that's even better.
And thing,
Yeah, we can still go, though.
Yeah, all right.
It doesn't matter what age you are, right? We're all kids when we go into an Unleashed mall. So thank you so much to Michael Browning Jr., Urban Air Adventure Park founder. All right, we're going to continue speaking holiday shopping in just a moment. We obviously are going to talk about economic concerns as well this holiday shopping season.
South Africa has really been lackluster for quite a number of years, and largely because the economy has been hamstrung by state-owned entities that have a monopoly on transport, energy, that have not been functioning for a very long time. So one of the things that give us hope, and I think we're able to be constructive with the outlook, is the economic reforms that are taking place in the country. So on energy, I think Eskom has done well to stabilize the days of load shedding, and then the energy factor and reliability factor keeps on improving. It's overdue, probably should have been done about 20 years ago, but those are things that are important to support the medium and long-term growth prospects of the country. So that's encouraging. South Africa is our primary market. We'll have operations outside to make sure that they provide resilience and growth for the portfolio. So it was quite pleasing to be able to grow earnings in South Africa about 13% in an environment where GDP growth is less than 1%. Households are still under pressure. I mean, like the rest of the world, we've seen a high inflationary environment with high interest rates, so that has put pressure on households. But even then, that inflation is starting to come down. Rates have come down. In the long run, that's very good for South Africa.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Versace in Beirut, and this is Bloomberg.
And listening to Bloomberg Markets. I'm Vonnie Quinn along with Paul Sweeney this hour, and we are taking you live for some shots of outside Macy's on this Black Friday. And there are lines, let me tell you, for all those radio listeners out there, lines round the block, and they seem to be spiraling. And it's amazing because I was outside Macy's last year for the beginning of Black Friday. I was speaking to you on the radio, Paul. It was 34 degrees on 34th Street, I'll never forget. It was freezing and it was very quiet, but it seems like now there's not a rush to get into the store. So you have people lining up at this time as opposed to at 4 in the morning.
All right, I'm going to walk past there when I go to Penn Station here today. If there's anything, I'll report back. But people are out and about.
Don't go in. That's my advice.
No. Hop on the train.
All right, well, U.S. retailers do generate 20% of their annual sales in November and December. But the holiday cheer might be looking a little muted this year. Signs pointing to a less indulgent holiday season, with overall spending estimated to be on par with last year. Joining us for more is Bloomberg Markets correspondent Nora Melinda. Nora, thanks for joining. So obviously Black Friday is one of the biggest shopping days of the year. Why are we expecting it to be a little more muted this year, particularly in light of these lines at Macy's and, some doorbuster events still?
Well, Vaughn, if we take a look at what the National Retail Federation had in terms of expectations for Black Friday this year, they're counting that as today through Cyber Monday. So that 5-day stretch, they're expecting this to be a record Black Friday year in terms of turnout. They're expecting nearly 187 million shoppers. But of course, we do have this muted feel because, of course, behind all of this is still that fractured economy that we've been dealing with. We've been talking about the K-shaped economy here, which, of course, is the bifurcation between the upper class still being resilient and still spending money, while you do have a lot of lower income consumers grappling and struggling during this time period, trying to really prioritize what's a necessity versus what is something that is worth splurging on, with a lot of consumers anecdotally saying that they're not splurging as much this year. They're looking more toward necessities right now.
Nora, what are the retailers saying about their promotional activity this year? Are they going to be offering deals to get people in the door?
Well, certainly that's what everyone is looking to them to do. It's really about which firms are able to really pull through during this time period, Paul. I mean, if you look at just the retail earnings that we've really been dissecting as of late, I mean, TJ Maxx, that was a company that did pretty well in terms of earnings. But if you think about that, it's a discount retailer. So you are seeing a lot of the companies that have massive discounts and are able to come up with entertaining or more interesting ways to lure shoppers. Those are the ones that are performing really well during this time period, because it's about how you can actually grab the attention of the U.S. consumer right now, as they're being quite picky this season.
Nora, what about hiring and holiday hiring in particular? It's seasonal, it's usually short-lived, but, we've been keeping our eye on, any kind of hiring data we can find. Are you hearing anything about holiday hiring?
Well, of course, on Black Friday, the excitement is all the people that you're around, but of course, it's not that great when you have too many crowds here. When we look at hiring, specifically in the retail space, we're seeing an expectation for this to be, for retail seasonal hiring to fall to its lowest level since 2009. So that's in more than a decade. So the expectation that I'm hearing from analysts, economists, is essentially if you're a U.S. consumer going out into these stores this holiday season, expect long lines and maybe a little bit less help without as many employees there to help with that.
All right, Norma Linda, thank you so much. We appreciate that. That's Bloomberg Markets correspondent Norma Linda with a lay of the land on retail spending on this Black Friday. Well, it is high stakes for retailers this winter, with inflation and tariffs pressures front of mind. Bloomberg at the Close co-anchor Romain Bostic recently called up with the CEOs of Bloomingdale's and Burberry to see how they plan to weather this holiday season. Let's take a listen.
'Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season, from personalized stockings to a Labubu tree and even a visit from a very familiar face, all in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences, not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, you know, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic Made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by J.P. Morgan shows that consumer demand for luxury goods in the U.S. is largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
All right, that was Bloomberg's co-anchor Romain Bostic. You're recently sitting down with CEOs of Bloomingdale's and Burberry to see how they plan to weather the holiday season. I don't know. We had Dana Telsley in here earlier, Vonnie, and she's obviously one of the top retail analysts on Wall Street. Optimistic by nature, but she expects sales to grow year over year, maybe low single digit holiday sales. But it's a pretty solid environment, she was kind of saying out there. There is that K-shaped economy, so you have to price your product really well.
I feel like we're always talking about the bifurcated consumer, right?
Yep. It seems like maybe, I don't know, you're right, we certainly have, but it just seems maybe it's more pronounced in the last 10, 15 years. So it just seems like a lot of companies and a lot of their products and services, you better price it correctly. So, all right, we'll get back to it. S&P higher. This is Bloomberg. Good morning.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Some people travel to see the world.
I travel to question the forces that shape entire nations. How is it possible? My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver. We do see opportunities that allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day, now at our new time. Only on Bloomberg.
Well, good afternoon, everybody, and welcome to Bloomberg Markets. I'm Bonnie Quinn, along with Carol Masser. We're with you for the next 2 hours, and we're lucky, Carol, we're having an update. It is the last trading session in November. Can you believe that?
Yeah, it's pretty amazing, and we are looking, at a market that's been bouncing around a lot. Interesting to see certainly some gains on this Black Friday. Having said that, it's been a volatile market ride, and we're looking at a monthly loss that we haven't seen maybe since April, so there's a lot going on.
Absolutely. We could make up some of that loss, though. We were down at 4.7% of the S&P 500. If we stay where we are, we could actually end up on the month, so we'll have to see if traders do that. Low liquidity, as you said. Bitcoin has been bouncing around quite a lot as well, and of course those December rate cut expectations creeping ever higher, and that has the 10-year just about 401 right now, the 2-year yield at 349.
All right, so we are going to go to, I don't have a rundown that's actually up.
Yeah,
so
no, let's get
you
to
do it.
Denitsa Zakova, who is right here beside us and has been keeping an eye on all things market moving and, of course, all things as well, consumer and what's going on out there. So, Denitsa, what have been your takeaways so far this Friday?
I think that after a very volatile month, we're seeing one of the strongest weeks in terms of cross-asset rally. Like if we look under the surface, it's actually stocks, bonds, bitcoins, commodities, everything is up. Of course, it's coming after a lot of volatility. But there were so many worries about AI bubbles. We even had a outage today. There is so much going on, but still there is definitely a lot of strength in the market in a week that was very low liquidity and absent of many big events. But as we mentioned, cryptocurrencies, Bitcoin is up 9% from its November low. It's always a really good sentiment, a really good way to see retail sentiment, and that's definitely showing some of this relief. Of course, it fell 30% in the span of just a month, so that's definitely weighed on sentiment, but we're seeing relief there. Alphabet is the big winner of this week. It jumped 6%, just as NVIDIA was down. But what we're seeing here, and a lot of people are talking about, is that, the AI trade continues to be strong, even if there is some rotation under the surface. But if someone is investing in an index fund, like, for example, VU, which took 120 billion record amount this year, that rotation doesn't really matter, and that fund is actually up 17% year to date. So it's been a very strong year for passive investors. Even someone buying U.S. Treasuries, it's actually the best year since 2020. U.S. Treasuries are up almost 7%.
I love that you went to Treasuries, because I think what we need to think about is the reason we've seen a pop in the S&P 500, right? I'm looking at it up about 4.5% since late November, just a few days ago. I feel like November 20th. Yeah. A lot of it has to do with the expectations on what the Fed will or will not do.
Yeah, it's all about the Fed. And because we're seeing silver rally, we're seeing gold rally. It's really all across the board. It's about the Fed. And investors are pricing in more rate cuts. When it comes to the December Fed cut, it's more than 80%. So it's certain that it's happening. It's coming off Kevin Hassett being the front runner for the Fed chair seat. Of course, everyone has been listening to Donald Trump, who's for a very long time has been calling for much lower interest rates. And now that we have that front runner for the Fed chair, traders are pricing in those rate cuts, and they're pricing in more aggressive rate cuts. We also had, of course, Governor Stephen Miran talk more, reiterating his view that he wants bigger rate cut, not just 25 basis points, and he has previously hinted at 50 basis points and bigger. So that's definitely helping. And economic data has been a big part of it. We had some data showing economic market weakness that perhaps will make it easier for the Fed to cut rates going forward. But yeah, it's been all about rate expectations.
All right, we're going to leave it there. Denitsa, thank you so much. Denitsa Sikova joining us right here in our Bloomberg studio. All right, everybody. As we know, high stakes for retailers this holiday season as Burberry and Bloomingdale's look to attract buyers amid inflation and tariff pressures. I mean, this is what we're watching. Macy's, take that. It's up about 32% year to date. It is home to its namesake brand and also Bloomingdale's. And the company's CEO, Olivier Braun, says the company is bringing back the golden age of the iconic department store. He caught up with our own Romain Bostic.
Tis the season for holiday shopping, and despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing, and we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season, from personalized stockings to a Labubu tree and even a visit from a very familiar face, all in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Braun, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, where it was really the place to go. And actually, you know, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationships, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic Made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. has largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
And that was Bloomingdale's CEO Olivier Bon and Burberry CEO Joshua Schulman speaking with Bloomberg's Romain Bostic ahead of the holiday shopping season, which is now in full swing. And if you go to the terminal, you'll see the anxiety of the consumer front and center in our coverage with this headline, quote, "Skip the TV, buy the dog food. Americans cut holiday wish lists as everyday essentials become the hot ticket items amid economic anxiety about job security and the cost of living." But is that what stores are actually seeing this morning? Let's bring in somebody who has been out and about. Bloomberg's Madison Muller has been visiting storefronts in Illinois this morning. So Maddie, are we seeing lines? Is it busy?
We are seeing lines. It is very busy, even here in Chicago, where it is 20 degrees outside, so it's very cold, but shoppers were braving the cold weather to go out to the malls here, and it was a lot of teenagers, a lot of groups of teens that didn't have parents with them, a lot of teens and their parents, and it was mostly these stores that cater to that age group that were seeing the biggest crowd. So stores like Addicted, stores like Kendra Scott, which is a jeweler. There are a couple of those, Aerie, Abercrombie, stores like that have been around for a while, but that really cater to that teenager tween brand. And that's what we were seeing the biggest crowds for this morning.
I got to say, Madison, I was so sure we were going to be talking about microdosing of GLP-1 drugs after Thanksgiving, and we might get there. But I want to stay with retail. Did you see a lot of signs for sales? I'm just curious about discounting early on. I've gotten a lot of emails, and a lot of it has to do with like 30% off, 40% off, 50% off if you kind of do some shopping early.
So that was actually, in terms of the actual storefronts, we were seeing lower deals, so more like 25%, 30%. And from talking to some of the shoppers at the mall that I was at this morning, they said that they were disappointed that the sales were lacking, that they, in past years, were hoping for that same 40 to 50% that is typical for Black Friday. And so that was one of the things. Talked to a family from Milwaukee, Wisconsin this morning that was in town visiting relatives, and they were saying, the sales were okay, but they were expecting better. They were expecting that 50% off, really good Black Friday sales. And so they were spending a bit less, buying a bit less than in past years.
Really briefly, Maddie, we always think of Macy's, I think, for Thanksgiving. And I remember I was outside Macy's last year when it opened and there was no line. But then later on, there was lines. And we just saw the same thing again. There are lines outside Macy's right now. Is it just that consumers are a little more relaxed because they know there's not going to be so frenzied an attack at the beginning of the day?
I think that's definitely part of it. I mean, I was out at the mall at like 8:30 a.m. and there was really no one there. And in past years, I mean, my family was a family that used to get up at like 5 a.m. to go Black Friday shopping. And I think the fact that there's now online shopping and that, it's cold out, people aren't expecting huge crowds like in years past. People were trickling in a little bit later, at least from what I saw. And I think the same goes from our other reporters across the country. The lines weren't really picking up until later in the morning, but they were still there. It was just happening happening a bit later.
I'm so glad everybody's not lining up Thanksgiving night. I think that was crazy, personally.
That could be dangerous at times too, couldn't it?
Exactly. All right, Madison, we're going to be back to you a little bit later on. Madison Muller of Bloomberg News out there in Illinois. Coming up, improving customer relations through AI. We'll talk about that with Dan O'Connell. He's the CEO of Front. You are listening and watching Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
In case you missed it on Balance of Power.
Congressman, do you believe President Trump when you hear him praise Mamdani and say that he wants to help him succeed? And if that's the case, doesn't this blow a big hole in the Republican campaign in the midterms in which they wanted to use Zoran Mamdani as a bit of a scapegoat here? And now President Trump says he's ready to move back to New York.
I think it's a fair point that, the Republican political structure was really trying to set up Mamdani as the scary point of attack, essentially, for the American people. And if Trump is signaling and actually saying that maybe he's a good guy and we're going to work together, I think that does make it much more difficult for them to try and go forward with that. But ultimately, I think, as I mentioned a moment ago, it's really going to come down to the prices of what it costs to live here and who's trying to do what to fix it. That's the key, I think, for the next cycle.
Don't miss Balance of Power live every weekday.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Didn't really think I had a problem.
I would isolate, self-medicate. Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/finds-treatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/finds-treatment.
Welcome back, everybody. You are watching Bloomberg Markets across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals. I'm Carol Master along with Vonnie Quinn. Well, retail spending is certainly front and center. As you know, it is Black Friday, everyone. So the holiday shopping season officially off and running. Spending, when we think about spending over the last year, actually the last 3 years, it's all been a lot about conversations around AI. Really top of mind, the AI industry awash with concerns, though, of circular deals and whether the multi-billion-dollar spending is sustainable. Let's get a closer look at the AI money machine and some of the key Asian players involved.
We're thoughtful, along with OpenAI, thoughtful in aligning on and taking into consideration visibility of demand and their financing capabilities. And so I think the ambition's large, but the execution is disciplined.
As tech firms ramp up spending on advanced chips and data centers, concerns are mounting that the AI boom is being propped up by a wave of circular deals. At the center of it all is NVIDIA, the company often described as selling the shovels in today's AI gold rush, as it strikes mega deals to invest in the very companies that buy its products. With capital flowing into companies that have yet to turn a profit, cycling back into data centers and ultimately returning to NVIDIA as revenue from their chips, trillions of dollars are rapidly being spent on technology that remains somewhat unproven as a business model.
If we're not going to find $2 trillion of revenue to justify the AI revolution, which I think is impossible by 2030, the likelihood is we're going to have a significant correction.
Many of Asia's largest tech firms are exposed to the AI boom as they play a critical role in the global supply chain. SoftBank is positioned primarily as a financier, with active investments like OpenAI feeding into its profits. Its stakes in chip companies also provide real cash income. In November, the Japanese conglomerate revealed it had sold off its entire stake in NVIDIA for $5.8 billion to bankroll founder Masayoshi Son's AI ambitions. This has amplified market anxiety over an industry bubble. Meanwhile, South Korean heavyweight Samsung Electronics Netflix and SK Hynix have seen margins rising on a commodity that NVIDIA's GPUs can't function without, high-bandwidth memory chips or HBMs. Bloomberg Economics sees demand for Korean chips surging by 45% next year, almost twice the current clip.
If you are in the players, then I don't really see that there was that much bubble. There's a lot of potential.
And TSMC's results are often seen as an impartial barometer for the real demand underneath the hype. It's the go-to chip maker for NVIDIA and its competitors AMD and Qualcomm. In October, when TSMC posted its slowest monthly revenue growth in more than a year, it fueled fears that the AI rally itself had become unhinged from fundamentals. Relative valuations of Asian markets suggest that companies in this region are generally more protected by real earnings expectations compared with U.S. counterparts.
As we get forward into this bubble-like period, it becomes an even more difficult question as a capital allocator in terms of whether you continue to shovel cash into this potential inferno.
And while some skeptics continue to warn of an overdue correction, others remain confident in AI's long-term potential.
The bubble is merely that it's gotten ahead of itself, not the likelihood of growth in the future. Okay, not saying it's worth its price, but there's absolute substance under the foam.
Sherry-Ann there on the narrative that is dominating right now. So let's stick with that narrative. More retailers turning to the new technology, AI that is, this holiday shopping season, but balancing the efficiency that technology can bring with the trust customers place in human interactions can be tricky. Dan O'Connell is the CEO of Front, an AI customer service platform. Dan, welcome and thanks for joining us today. So how does Front differentiate itself from other purportedly AI-dominated customer service platforms?
Yeah, great question, and thanks for having me today. So Front's really the only platform that combines traditional email, help desk, and chatbots together in a single platform to deliver exceptional AI-driven customer experiences for incredible depth and breadth of customers.
Okay, sounds interesting. So who are your customers and what do they pay you for the service?
Yeah, so our customers today are really focused on two things. One, they want to automate low-value, repetitive tasks to deliver exceptional customer experiences, and they've got high-value relationships that they want to have a human touch for. And so our customers are B2B customers, specifically in mid-market and lower enterprise, that leverage us, again, as a way to go and communicate and manage the relationships with their customers.
All right, I'm going to just cut to the chase because CEOs, they understand and the terminology, but what is it that you really are getting to for one of your clients in terms of the customer information and what you're doing for them?
Sure. Every business out there needs to manage customer relationships. And so, again, that can be how do we go and respond to customers over chat or over SMS or over email. They need to understand the insights that are coming from those conversations so they can better route them. And, again, really focus on just these wonderful customer experiences across really any channel that's out there, voice, video, SMS, text, and email.
Dan, I have to say, I think it's either the control rooms around here or everybody around us are like, come on, we've all had a customer experience where we either don't get the answers or get into kind of a chatbot that doesn't ask the right questions and says, hey, are you all done now? So how do we make it better so that really, is this about, customers, companies gathering information, or is it really about making the customer experience easier and more productive?
Well, I think it's a balance. Like the earlier segment, we're all incredibly excited about the opportunity for AI to deliver faster responses and instant answers. We know that every consumer out there wants to get an instant answer to any question or problem they have around an order. And I think there's also a balance of, look, like we're in this holiday season, it's really emotional. If there's a shipping delay or an issue, you want to be able to go and talk to a person. And so I think the balance of finding this opportunity is incredibly important for every brand that's out there. You can't just automate away the people. You can't just automate away every task or workflow. And so I think the best businesses are going to strike that balance. And I think we're in this real-time experiment right now in this holiday season, given kind of the excitement around AI.
So what do you use for large language models? Whose AI do you use? And, where is all that data stored?
Yeah, so in terms of, we've got a multitude of partners that we leverage to provide our AI. We do some work in-house. We obviously leverage OpenAI and Mistral, who are foundational large language models. I'm sure most of the audience is familiar with some of them. And one thing that's really important as we talk about this data is making sure that our customers have full control to that data. Again, and then when we talk about the customer experiences, nobody wants to be tricked out there in terms of when they're engaging with AI. And so I think this is also a fundamentally important focus for us at Front, which is make sure that the users have full control, make sure that we're very clear around where there are experiences with an AI or an automated or automation, and when you're actually engaging with a human.
So software as a service, your AI chatbot just brought me over to your pricing page, which thank you very much, and is asking me if I have any questions. And you can get a starter pack for $25, and it goes on up to $105. But I imagine it's small and medium-sized enterprises mainly that you're targeting, right? Because the bigger companies are doing it themselves.
No, you would be surprised. And so I think every business on the planet is going through a platform shift right now around customer experience. And so we are working with some small businesses that might have 5 or 15 seats, and our largest installs are upwards of 1,000 seats. Some of the largest brands that are recognized, Uber Freight, for example, is a business of ours that leverages us. And so again, I think what's interesting at this moment in time is everybody are picking new platforms around customer experience. And again, that's because of what AI is already demonstrating and has real capabilities and real revenue traction. But I think also people are excited about what are the opportunities that AI can deliver in the near future.
Hey, Dan, just got about 30 seconds here. You have so much data on your platform. We all care about what the U.S. consumer is doing. In 30 seconds, how would you say the U.S. consumer is doing and faring?
Yeah, I think what we see is I am expecting us to have one of the biggest Cyber Mondays and holiday seasons that we've seen. We already know that people are shifting and making more purchases online and through mobile. Again, that increase in volume obviously leads to there's going to be some increasing frustrations and breakdown, and they're going to want to have these exceptional customer experiences across any channel. And so again, I'm expecting us to have a pretty big holiday season here.
All right, so it sounds like you're going to be pretty busy going ahead. Hey, Dan, thank you so much. Dan O'Connell, he is the CEO of Front. Funny?
Yeah, fun segment, but I do wonder about these chatbots. Sometimes, when that box pops up, it can get a little bit annoying, right? I mean, it takes up some of the space. Anyway, we'll see how it all pans out. You're watching and listening to Bloomberg Markets.
Summit, bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
And a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Burden in Florence, Italy, and this is Bloomberg.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard, oh boy, can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that. And the speed of the business has never moved faster.
My career might stop, but I'll still be driving some.
Yeah, probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
what is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Why would you want to be chairman of the Fed? Are you sure you want that job?
If the president asks me to be Fed chair, then I'll do it. If I'm not Fed chair, don't be disappointed for me because I love the job that I have.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
We are back on Bloomberg Markets. Carol Master along with Vonnie Quinn. We are live here at Bloomberg headquarters in New York City. We have got a holiday shortened trading session. The equity market's closing in about 30 minutes. The bond market closing in about an hour and a half. Having said that, very thin volume, although stocks across the board, yes, indeed, they are higher today. Keep in mind that stocks still on track for their first monthly loss since April, following President Trump's Liberation Day. Remember, tariffs, trade policy, pressure on stocks back then. It led to a sell-off. Today, though, you can see S&P just up about 1/3 of 1%, NASDAQ 100 a gain of about 0.5%, so seeing certainly some buying there. If I look at some of the other aspects of the market, spot silver hitting a new record high, surpassing the peak we saw back in October, and we do see oil headed for a fourth monthly loss as traders look ahead to an OPEC Plus meeting, and really kind of consider what's going on between peace talks or lack thereof between Russia and of course Ukraine. Brent crude right now 63.37 a barrel. New York crude just up about 1.25% here. And as I mentioned, silver on a run. It is up, Vonnie, about 5%.
Yeah, fascinating trading session. And that's since the market opened, but there was a whole drama before the market even opened.
Was.
That's what we're going to get to now. Let's bring in Bloomberg's market reporter, Natalia Knichevich, for more. So this CME outage this morning, it was already out when I woke up. It was out when I got to work. We really didn't see it up and running again until 8:30 Eastern, Natalia. How did traders react?
Exactly. So we did see some impact, of course, on global cross-asset markets, right? So we saw this hold in futures and options trading. It lasted for about 8 hours or maybe even 10 hours. One trader told me, on the one hand, we do see this short session today. Liquidity is thin, as you just mentioned. And we, as he said, we couldn't have asked for a better day for this to happen. But at the same time...
Unless you were trying to trade the market.
At the same time, it really caused some frustration. But overall, as you can see, the market is very positive and looks like everyone is just busy upgrading the S&P 500 targets as we are approaching 7,000 level for the S&P 500 very quickly.
I think it's just fascinating because we are living in such an increasingly data center world, whether it's markets, whether it's AI, and this whole idea about these data centers when they go down. Like, you know, this was a good day, right? Because not everybody trading, but just fascinating to see this, fascinating in kind of a terrifying way. All right, so how does, here we are getting ready to kick off the last month of 2025, December. So how does it look at this point?
Right. So on the one hand, we never know what happens next. But if we look at technical seasonality, looks like the setup is bullish right now. So for example, if we look at the market breadth, it's improving. One metrics, which is 5-day average of the S&P 500 gainers versus decliners. It was at trading, hovering at minus 150 level earlier this month. And now it quickly bounced back to 150 on the positive territory. This is a very big round trip. And to Goldman Sachs trading desk, this is not a short squeeze. This is a very healthy sign. Then we also look at Goldman's volatility panic index. It was trading at above 9, one of the highest levels ever. Now it's about at around 5. So this is also a good sign. And we are keeping an eye on the so-called trend following systematic funds. They have have recently switched to buyers, and that could also support the stock market.
So that's into year end, pretty clean setup, it seems like. What about 2026? What trades are we already seeing for next year?
Right, so we are working on one big global story with a global equities team for Bloomberg, and we are talking to the world's biggest buy-side managers. Couple highlights that I've already noticed. So most people are bullish on the U.S. They still think that the U.S. will outperform.
Wait, so U.S. exceptionalism is back?
Is back, and people don't want to fight that. They don't think that there is any bubble in AI. Really bullish on the U.S. stock market. In terms of some specific sectors, I would like to highlight financials. I keep hearing it over and over that people like that. It's an interest rate story, and people don't want to be positioned across defensive sectors, right? So, for example, this month we saw healthcare as one of the maybe it's still the biggest gainer in the S&P 500, but for the next year, people don't want to be positioned across staples and healthcare sectors.
Yeah, it's really funny. Like, as much as everybody's like pushed back on some of those high-tech flyers or some of the momentum trades, that ultimately investors come back to them as soon as they see some signs of optimism in a big way. All right, Natalia, thank you so much. Bloomberg's markets reporter Natalia Kenijevich joining us with the latest on what's going on in the markets and what's to come. Hey, obviously, AI is something we are probably going to be talking about still in 2026, and it is certainly, AI is a big part of what we, are talking about in terms of Black Friday and the shopping experience. Meantime, in addition to large language models and chatbots and more, another aspect of technology that's starting to get some attention, and that is quantum computing. Billions of dollars are now being invested in that space to turn what was once a theory into a reality. So let's get to the latest installment from Bloomberg Wall Street Week with Bloomberg's David Weston. He is the host. He takes a look at this revolution in computing that could be larger even than generative AI.
Companies like Google, Microsoft, and Intel are all exploring the potential of quantum computing. But there's also a new group of contenders, startups, that are betting it all on the hope that quantum tech will one day become profitable. One of those firms is Maryland-based IonQ. Its CEO is Niccolo De Masi, who believes he has the best horse in the race.
We supply quantum computers to our both federal, state, and commercial customer partners. We also provide quantum key distribution, and we do that both on the ground and up in the heavens. Quantum key distribution is effectively quantum cyber security. And we're very focused on this not being just proof points in the lab, but doing useful quantum advantage examples for our customers and embedding ourselves into their workflows on an ongoing basis.
So what will it look like as we go beyond showing so-called quantum advantage in the lab and embedding it into real-world workflows? One place people look to first is in the life sciences, work like Dr. Garcia is doing at the Cleveland Clinic.
An example of something that we've done is we've taken some of the algorithms that we've worked on for chemistry, and alongside Cleveland Clinic, we've started looking at different chemical processes that they really care about. So you can think about this in the larger context of, therapeutics design, drug discovery, that kind of thing. And really what we're doing with Cleveland Clinic is pushing the boundaries of algorithm development, methodology, of using quantum computers, again, in concert with classical computers to come up with solutions to problems that they care about. Protein folding is definitely one area, mRNA, secondary structure understanding, how things like come together and how they look in sort of 3D is a very interesting area, as you can imagine, as you're trying to understand how these things fit together in a biological system.
It isn't just life sciences that could be revolutionized by the addition of quantum computing. Financial markets are another target of opportunity. IBM scored an early advantage this year when HSBC said it used the tech company's Heron quantum processor to make a 34% improvement in predicting how likely a bond will trade at a given price.
I think there's a lot of excitement in the market space as well, right? Especially because optimization is certainly in another area which we know is a classically difficult problem. And from the point of view of actually using a quantum computer to address optimization, there are many threads there in terms of leveraging this kind of large exponentially computational space to handle problems such as portfolio optimization, right, or risk management, right? So there's a lot of interesting ideas there that are being looked at by various financial institutions.
And that was David Weston there for Wall Street Week. Check out the full episode of Wall Street Week online at Bloomberg.com. Now, we want to turn to Washington, D.C., where Wednesday's tragic shooting has resulted in at least one life lost after the president announced yesterday National Guard member Sarah Beckstrom passed away, while U.S. Air Force Staff Sergeant Andrew Wolf remains in critical condition. Janine Pirro, the U.S. Attorney for the District of Columbia, said the suspected gunman in the shooting will be charged with first-degree murder.
Are certainly many more charges to come, but we are upgrading the initial charges of assault to murder in the first degree. And we are hoping that the more information we can get, the more we will find out about what actually happened in terms of this individual even being in this country.
Joining us from Washington, D.C. now is Mario Parker, Bloomberg Managing Editor. Mario, what can you tell us? What are the latest details surrounding the shootings?
Well, the latest details, as you all outlined, is that the suspect that the government has identified will now be charged with first-degree murder, given the unfortunate death of Beckstrom, one of the National Guard members. The president of the United States last night spoke to reporters from Mar-a-Lago, in which he announced that she had passed, and he said that the other guardsman was fighting for his life at the moment. What's happened since then is that the administration, particularly President Trump, has intensified its rhetoric and regulations around citizenship and immigration, particularly from what they deem to be high-risk countries.
Well, that's what I want to go into, Mario. Like, the president has called specifically for what he says is a reversed immigration crackdown. This is an administration that, accurately we can say has been pretty stringent in cracking down on immigrants and certainly illegal immigrants when it comes to crossing borders. What does he mean by a reverse immigration?
Honestly, that's unclear right now in terms of just the details as to what the president is looking at. One of the things that we do know is that back in June, the administration issued a travel ban on roughly 19 countries. They also, at that time, stepped up some of the scrutiny of individuals applying for access to the country or traveling to the country as well. What we saw come from the administration over the last 48 hours or so is that some of the factors that they use that's used to, if you will, vet or consider the green cards or the immigration statuses of individuals from some of these countries, those will be much more stringent now as well. The administration says that it will consider factors related to that country, negative factors is what it said, related to that country in the consideration of some of those applications. In terms of reverse migration, how that works, especially given the naturalization process, that part is unclear right now. The law states that typically, in order to be denaturalized, someone has had to be very dishonest on their vetting, their background checks, and their application status.
Yeah, how does the administration balance these calls, Mario, given the suspected shooter here was actually formally granted asylum just this April under the Trump administration?
Yeah, well, the Trump administration, President Trump's response to that question last night was that it's very tough to deport individuals once they've come over here through asylum. He didn't have a clear answer, but that was the answer that he gave reporters yesterday at Mar-a-Lago.
All right, safe to say that this will continue certainly into next week, and we will certainly be following along with our team in Washington. Mario, thank you so much. Bloomberg Managing Editor Mario Parker joining us from the nation's capital. Hey, coming up, we're going to get back to the markets. We've got just about 18 minutes to go. Kevin Mon is Chief Investment Officer at Hennian & Walsh Asset Management. We'll talk Black Friday.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back, everybody. A special Black Friday holiday edition of Bloomberg Markets. Carol Master along with Vonnie Quinn. We are live at Bloomberg headquarters in New York City, just about 15 minutes away from the equity close on this Black Friday. Hey, with that underway, people are out there shopping. We want to get a check on how retailers and also travel providers are doing so far. Bloomberg's Rachel Puat joining us now. Rachel, where shall we begin? How about the retail sector?
Yeah, that sounds good. So this morning I went to Macy's, and it opens at 6 a.m. on this special day. But it was actually pretty quiet. There was a line at 6 a.m., but by 15 minutes later, it was gone. Like, customers were still trickling in, but the mall was actually pretty quiet except for Christmas jingles. Like, most of the concessions. Yeah, like most of the concessions didn't have any customers, and a lot of the staff were just walking around, manning their booths. I think the thing that surprised me was there wasn't those huge discount signs I was expecting. It was just a lot of small stands, a lot of tags on top of clothing racks. And one fun thing was, I saw the Pop Mart store, and I was like, oh, this is the place that sells Labubus. I'm sure there'll be a ton of people, but there were actually more workers and customers that early morning.
Well, what's funny, Rachel, though? I did that last year. I did what you did, and it was freezing last year, and there was nobody there as well at that time, and there was a couple of vouchers being given out for the first customers and so on. But later on, there were lines, and we saw that today as well. There were lines later. I think, are people just getting a little lazier? They don't need to get there for the doorbuster deals?
I think so. I mean, you will also hear about how deals are now all week long. I think people are just seeing it more as a vibes thing than actually something where they're actually trying to fight for discounts. A lot of the tourists, when I was there, like most of them were tourists who actually woken up early, and they said like they were just there to kind of soak it up. Like they said that Black Friday at Macy's seems like a holiday tradition on its own right. So they just wanted to go see what it was like at the store.
All right, I want to ask you about airlines real quickly. Travel, there's a lot of folks I know still traveling around to see family today and into the weekend. Looking at airlines as a group overall, just up a hair, up about 1/4%. What can you, or what have you heard when it comes to the nation's airports and roads and what we're hearing?
I think it's it's a crowded time. People still want to travel. People still want to see their families. The shutdown is still having some effects on travel. So I think get to the airport early if you are still planning to go back to your city, or you are planning to travel out to see family.
Well, Rachel, I'm glad that you're wrapped up, and I hope that you get to stay warm for the rest of the day, because it was a cold one out there this morning. That is Rachel Puat of Bloomberg News, who is outside Macy's in Herald Square today. Let's get more in the markets now with Kevin Mann, Chief Investment Officer and President at Hennion & Walsh Asset Management. So, Kevin, what do you make of the fact that we've been in shutdown data vacuum mode for a while? Today is really and this whole weekend is really a day where we should get some valuable information about the U.S. consumer and about shopping patterns and about how healthy hiring is, right?
Yeah, we're going to learn a lot about the health and the confidence of the U.S. consumer this holiday shopping season, as it's estimated that between the months of November and December, there's going to be over $1 trillion spent on holiday shopping between in-store and online, an all-time record. As it relates to online today, we're looking at just under $12 billion approximately spent online on Black Friday, and another $14 billion estimated to be spent on Cyber Monday online. But here's the interesting twist to all of this. According to surveys done, 75% of all shoppers indicated that price will be a key factor in their purchasing decisions this year. So if that is true, expect the big online retailers to benefit, where consumers can do all of the research necessary before making that final decision. And where do you start? Of course, with the hub of the AI ecosystem, or rather the e-commerce ecosystem, that being Amazon.
Yeah, and we are seeing some of those companies benefit from today's little rally. What about the smaller, or maybe the more specialized companies? We saw earnings from Dick's Sporting Goods, for example, this week, Kohl's as well, and investors really punishing the stocks that didn't do well and rewarding the stocks that did.
It's a great question. Obviously, Walmart, Amazon, they should continue to do well for a variety of reasons, using AI, expanding their online footprint, and even everything Amazon is doing now with U.S. government agencies around AI supercomputers. But let's talk about those three other names that you mentioned, because they really do need a good holiday shopping season. Dick's, who recently announced the closure of several Foot Locker stores, they need a strong kick in this holiday shopping season. Target, which his stock is actually negative over year to date, 1 year, 3 year, and 5 year. I don't think this holiday shopping season is going to be enough. We need more of a turnaround across the board and throughout the year for Target. Kohl's, on the other hand, perhaps we're at the beginning of a turnaround there. As they surprised in their recent quarterly earnings release, their stock bumped up. I believe it's still positive now year to date. And I was actually in the store recently myself. It was alive with activity, a lot of shoppers in there taking advantage of the discounts and the deals there. Perhaps Kohl's will be a turnaround stories, but I still see all the leverage and all the strength this holiday shopping season in two areas. That's Walmart and that's Amazon.
You talk about leverage, and one of the things that we've been watching so closely, Kevin, is what's going on with the buy now, pay later companies. Yeah. And so I've talked to the CEO, the CFO of a firm. I mean, these guys have been busy, business has been good, but it also says to me that people are not able to pay for things fully, that they've got to buy now, pay later. And I do wonder what that says about the consumer. So even if we see strong sales, if they're doing a lot on leverage, that is not necessarily a good indication.
Great question, Carol. Big concern for me as well. Right now, it's estimated there's just under $19 trillion in total household debt, an all-time record. Now, only a portion of that is credit card debt, with the balance being student loans, car debt, and of course, mortgages as well. But if the consumer continues to follow this buy now, pay later type of environment, which I call credit cards, or other different means of actually buying goods for their family and their friends without having the money necessarily in their bank account today to support those purchases, eventually they're going to have to service that debt. And if the consumer shifts from spending to servicing their outstanding debt, the economy has to slow, because 70% of our economic growth comes from consumer spending. So while we may not see that in this particular quarter, we certainly didn't see that in the third quarter, we may start to see that in the first 2 quarters of next year. But hopefully the Federal Reserve will continue to lower at least short-term interest rates, and that will have a longer-term impact on the interest rates that people are paying on their credit cards. But recognize, just because the Fed cut short-term interest rate, that doesn't mean your credit card rates are coming down over the short term.
Hey, one of the things I want to ask you on that front, and we talk about the K-shaped economy, Kevin, so much, is that when it comes to consumer spending, the top 10% of U.S. earners account for nearly half of all consumer spending. Many of them are in the market. They felt wealthy by the AI spend, markets hitting records, and so on and so forth. But if we start to see some pullback in some of the luxury names, might that say, wait, we've got a broader problem here?
That would be a very strong forward-looking indicator right now, because of all the purchasing power of the upper shape of that K-shaped economy. If we see a slowdown there, or even if it's just a gradual restraint, And then we know that the bottom part of that K continues to spend, but is putting more and more leverage on their own household balance sheets. Well, there ultimately will be a day of reckoning for the U.S. economy if, in fact, they have to start servicing that debt and slowing down on their purchases going forward. I'm not forecasting that. That's not my base case right now, but that is certainly something to pay attention to.
Sorry to be such a Grinch here when it comes to retail shopping.
You on the Grinch theme, because I'm curious about the very younger
on a high note.
cohort, so the 25 and unders who aren't getting jobs out of school, whether it's graduate school or regular school, and I mean, what's going to become of them, and how do these retailers and these brands bring them in when they have very little disposable income right now?
Yeah, I mean, again, that's another area of the economy that's a concern right now. It's very difficult for that 20-something demographic to find work and find work at reasonable salary levels. That's an important part of our economy right now. As you mentioned earlier, the top part of the K does account for the majority of consumer spending and economic growth right now. And what has really lifted up the U.S. economy, at least over the first half of this year, wasn't the consumer, but it was all the money being spent on AI infrastructure. In fact, during the first half of this year, AI infrastructure investment matched the contribution of consumers towards GDP growth during the first half of the year. If that AI investment spend does start to slow, again, not my base case, but if that starts to slow as well, then the economy is only going to slow further. So there's multiple different things to look out for here. I anticipate AI infrastructure investment spending to continue. Jensen Huang has told us by the end of this decade, it should amount to somewhere between 3 to 4 trillion. Strikes me as a portfolio manager, that's where you want to invest into those infrastructure plays, recognizing that the ROI on all the semiconductors and chips may take years to come, but there's still opportunities there.
All right, good to check in with you. Enjoy the rest of the weekend. Kevin Mond
You as well.
of
Thank you.
Hennian and Walsh Asset Management. Folks, we are just about 3 minutes away from the closing bell. We've got stocks a little bit higher across the board. The close coming your way in just a moment. This is Bloomberg Markets.
You missed it on Bloomberg Insight.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing prices. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. Our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depends on the new data.
Countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Don't miss Bloomberg Insight live weekdays. In case you missed it on the opening trade.
Kit, I've got a present for you. I know you've mentioned it a couple of times. We've got a coffee for you.
Hang on a sec.
By the
Coffee
lovely Tara.
coming. There we go.
Thank you.
So my question now is, how much froth is in there?
See, you can't tell when you look at the top. That's okay. You've got to drink it to find out.
Absolute genius. You got to take the lid off before you even figure out what's going on.
Don't miss the opening trade live every weekday.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
In case you missed it on
Bloomberg Open Interest.
It's Netflix versus YouTube.
100%. I do think in the world of more AI slop, people are going to look for destinations where they really want higher quality, curated, high production storytelling.
But YouTube is crushing it. I mean, I have both.
Absolutely.
But one thing YouTube has is like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent. Consumer product is consumer tech.
Don't miss Open Interest live weekdays.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Everybody, we are back on Bloomberg Markets here at Bloomberg headquarters in New York City. We are across Bloomberg platforms, radio, TV, YouTube, Bloomberg Originals. I hope everybody had a good and safe Thanksgiving. Hope you did too, Vaughn.
I had a lovely Thanksgiving. Take out Chinese. It was just amazing. I know, I was a bit of a rebel. But you know, look at the market today, Carol. We have to point out that in this last trading day of November, we've actually turned positive on the month for the S&P 500. We're finishing the session up more than 0.5%, and we only needed to make up 0.4%. So my math tells me that we are in the green, having dropped 4.7% earlier on this month, a really, really rocky month. The Nasdaq 100 is up 0.8% to continue this nice Thanksgiving rally. The Dow up 0.6%. Not much movement for the dollar. Equity indices, as I say, higher. Equity markets closed. The bond market has another hour to go, but not seeing too much movement there either. The 10-year yield just above 4.01 right now. The 2-year yield just below 4.50. And a little bit of addition to oil. So we're about 59.47 for WTI. Brent crude, really no change at 63.37. But plenty of interesting moves today in the S&P 500. Carol, energy was the best sector.
Yeah, really fascinating to see that outperformance today. If you're thinking about what performed best in the month of November, folks, healthcare at the top of the pack. It is up about 8.25%. All right, let's get more on the market trade for you. Let's bring in someone who watches it day in and day out for us here at Bloomberg. She's Bloomberg Markets correspondent Nora Melinda. She joins us right here. Nora, where shall we begin here? What kind of caught your attention, first of all, for today in what was certainly a light volume day?
Certainly light volume, but what I've been hearing from a lot of analysts is the fact that actually in holiday shortened weeks, we do tend to see a lot of outperformance. If we're just looking at how the week ended, the S&P 500 saw its best week since May. And of course, as we're looking at a lot of the monthly scopes here, but I was hearing an expectation for us to see a bid in the energy sector, especially if we're continuing to see a lot of focus on the geopolitical tensions in Ukraine, Russia, that development there. So I was talking to some sources over at Integrity Asset Management who did expect that to see some boost today. So it's interesting that was the best performing sector on the day today, Carol.
And then, of course, for the retailers, Nora, we had a double whammy of a week because we had a lot of earnings out. Some of them were very amenable to the retailer's stock, let's say, A&F included. And then consumer discretionary doing quite well today, too, as the group up 0.9%. How important is the holiday season for these retailers to keep their stock prices where they are into the year end?
Well, certainly a deluge of earnings that we've really been seeing from retailers, and it's really painting a mixed picture. But what we are still seeing to be underscored during this time period is the consumer is really strapped right now. We've been talking a lot about this K-shaped economy where essentially we are seeing the upper class continuing to be resilient, still spending money, but we are seeing the lower income consumer really being a lot pickier during this time period, looking for spending more on necessities instead of splurging during this time period. So while we did hear the National Retail Federation saying that they expect this to be a record year in terms of the traction that we're seeing on Black Friday, which is Black Friday today through the 5-day stretch through Cyber Monday, we still are seeing a resilient but cautious consumer. And as we think about what that means for stock prices for the retail space, if you look at consumer discretionary index in the S&P 500, it's up only about 4%, so clearly lagging the double-digit gains that we are seeing from the broader market in the S&P 500. And the majority of the holiday sales account for about 20% of the sales sales more broadly for the retail space between November and December. So this is a very critical time period in terms of seeing how this develops and how much consumer appetite we can see during this time.
Yeah, you talk about, Nora, critical periods. I mean, hard to believe that we've only got 1 month left here in 2025. It's been quite a year, a lot of volatility to say the least. I'm looking at an S&P that's up almost 17%, a NASDAQ 100 that's up 21%, and Russell small caps up about 12%. So, what are traders focusing on at this point with only another month to go until we wrap up the year?
Just about a month to go to wrap up the year. And you are seeing traders, of course, trying to really just settle their books as we're heading into year end. Of course, the focus still remains on the Federal Reserve and what they're going to do next, especially with us seeing a lot of the stocks levitating off of this idea of a potential Fed rate cut ahead. And we are really just seeing a lot of people just grappling with how we can really end the year on a positive note and see what are the opportunities in the market right now, given the fact that tariffs have still remained a concern through this entire year. We've been seeing geopolitical tension still remaining in focus. So you are really seeing the traders right now just trying to figure out what sectors and spaces make the most sense in terms of just having a defensive position.
I love that, Nora. Stocks levitating. What an idea. But they are, though, and indices, too. Nora, Melinda, always a pleasure. Thank you so much for joining us this Black Friday. Well, retailers are heading into the Black Friday, the official start of the holiday season, looking to attract budget-conscious shoppers amid continuing inflation and, of course, tariff pressures. Bloomberg's Romain Bostic sat down with Bloomingdale's CEO Olivier Bron and Burberry CEO Joshua Schulman to get their expectations ahead of the holiday shopping season.
'Tis the season for holiday shopping. And despite U.S. inflation holding above historical averages for 4 years and tariff tumult upending global supply chains for the past 5, the CEO of Bloomingdale's, he says consumers are ready to spend.
Actually cautiously optimistic. The trend over the past few months has been amazing at Bloomingdale's. We feel pretty strong about our customers' feedbacks, about our partner feedback, about the current trend that we're experiencing. And we're building such a great event for this holiday season that we're convinced that it will resonate very, very well with the customer.
And he's not kidding. Bloomingdale's is betting big on the holiday season. From personalized stockings to a Labubu tree and even a visit from a very familiar face. All in an effort to reinvigorate the department store shopping experience with emphasis on experience.
This is what we're really focusing on right now, is bringing experiences. Not only great products, but really bringing experiences that create the conditions of relationship. People want to connect, and we want them to connect at Bloomingdale's.
The Bloomingdale's flagship store on the east side of Manhattan has for decades been one of the crown jewels of New York City retail. But behind that grand facade was a company struggling to adapt to the times. Now, after years of sales declines, Bloomingdale's, a division of parent company Macy's, has found its stride, posting 4 consecutive quarters of same-store sales growth heading into this holiday season. And Bloomingdale's has reason to be bullish. The National Retail Federation estimates that 44% of consumers will do their holiday shopping at department stores this year. And Olivier Bron, he's confident it will extend his company's rebound.
It's really about rebuilding the next golden age of Bloomingdale's. We heard a lot about Bloomingdale's in the 70s, in the 80s, when it was really the place to go. And actually, right now what we're trying to build is really recreating this destination, Bloomingdale's. And we're an icon, but we have to reinvent ourselves. It's also what Josh is doing with Burberry. This is what we're aiming to do at Bloomingdale's, with one key focus is actually bringing back customer experience, customer delight in our stores, and really based on building relationship, connections, etc. This is what is making us different.
The New York retail giant joining forces with the iconic brand and plaid, a relationship that goes back decades.
This is a relationship that Burberry and Bloomingdale's have had for over 70 years. So it's the perfect place to bring our timeless British luxury brand expression to all of Burberry customers and all of Bloomingdale's customers, and frankly, to all of New York City.
To celebrate that partnership in the spirit of the holiday season, Bloomingdale's has literally wrapped their flagship store in a giant Burberry scarf.
It was a little bit emotional, I have to say, seeing this uniquely British, uniquely Burberry, uniquely Bloomingdale's story come to life on the streets of New York City. There's only one New York. We are really really thrilled to open our arms and wrap a scarf around New York City and bring a little bit of warmth and joy for this holiday season.
And since Joshua Schulman took over the helm of Burberry in July 2024, shares of the London-based brand, well, they've rallied 50% as the American-born CEO leans into the brand's Britishness.
There are many luxury brands that have wonderful, beautiful heritages, and they celebrate their heritage, whether it's Italian or French. But Burberry is unique because we are the only luxury brand of scale that has a uniquely British heritage.
Burberry, remaining true to its roots, is highlighting the products that cemented its status in the luxury space, while also branching into new directions.
Everyone knows and loves a Burberry scarf, which is the perfect gift for anyone in the family, around $520. But we have a range of products. You know, you can buy a candle for $130 to one of our iconic made in England trench coats for $3,000. Burberry has always been at its best when it is a luxury brand with broad universal appeal. What we love about Bloomingdale's is they really share our values. And this is a brand that also has broad universal appeal.
A recent report by JP Morgan shows that consumer demand for luxury goods in the U.S. has largely held up despite the economic headwinds. The S&P's Global Luxury Index, which tracks 80 of the biggest names in that space, including Burberry, Prada, Dior, LVMH, that is showing no sign of slowing down.
The momentum that we're seeing didn't start for holiday. It started, months and years ago, and we just keep the pace right now. So we have new events, we have new marketing activation that are coming, we have new brands coming in the store right now, we have new ideas. So I think it's just a kickoff of what's coming.
And though Bloomingdale's has only just unveiled their 2025 holiday display, they're already looking ahead toward the future.
We already know what's going to happen in 2026. We're already working on what's going to happen in 2027.
All right, that, of course, was Romain Bostic sitting down with Bloomingdale's CEO, Olivia Braun, and Burberry CEO, Joshua Schulman. All right, as we think about shopping going on or not going on, we will certainly get a tally next week. There's a great story in the Bloomberg about this specifically, about the anxiety that a lot of consumers are seeing who just may, quote, skip the TV, buy the dog food as Americans cut holiday wish lists. And we are seeing a lot of consumers having to make decisions as everyday essentials become the hot ticket items amid economic anxiety about job security and cost of living. So we keep going back to our team who are on the ground, who have been checking out various retail environments around the country. Let's bring back Bloomberg's Madison Muller. She was out earlier today hitting storefronts in and around Illinois. Madison, come on back. We know you were out there early. Give us some more color in terms of what you continue to hear and the feedback you are seeing.
Yes. Well, I, for one, am still defrosting because it is absolutely freezing here in Chicago. And so the shoppers that are out there today are brave. But what I'm hearing from a lot of them is that the discounts that some of these stores were offering were not really enough to make going out into the cold worth it this morning. We were mostly seeing, and this is true kind of across the country from what I've heard from other reporters, a lot of teenagers. The teenagers are really luring or sort of boosting the Black Friday sales this week. They're the ones that are lining up at a lot of these stores. It's the teen retailers that are seeing the biggest crowds, brands like Addicted, Aerie, Abercrombie, Hollister, things like that. And those were the ones that really had the line out the door, crowded storefronts, lots of teenagers. So that was sort of the theme.
Yeah, what are they getting right, Madison? Because we saw, Abercrombie, for example, have great results. It was their Hollister brand, I believe, that did the hard work for them. What are the teenagers wanting to buy all of a sudden?
So my colleagues over on Consumer are talking about this haul economy, that there's just sort of this fun element that these brands are able to tap into, going and doing a haul at one of these stores. It sort of is coming from TikTok. A lot of people on TikTok make these videos after going to a store, getting sent clothes by a brand of, this is my haul. These are all of the different things that I got from this store. And so that's sort of helping to draw these teenagers to some of these retail brands. And then it's just, the clothes are cheaper. There are discounts. Some of the biggest discounts that we were seeing actually were at some of these teen retailers as well.
Yeah, I don't know, these holes, I mean, you can't really return some of this stuff, right? Because it's on sale.
Yeah.
Maddie, thank you so much for getting out there in the freezing cold for us in Chicago and having a look around. That's Madison Muller of Bloomberg News. Next up, we're going to be speaking with BDO's Natalie Cutler. She's joining us to talk about the unique retailers, the unique approaches even that retailers are using in their holiday promotions. This is Bloomberg.
Some people travel to see the world. I travel to question the forces that shape entire nations.
Wow, is it possible?
My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, Mondays on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome back. You are watching and listening to Bloomberg Markets. I'm Vonnie Quinn along with Carol Masser. And equity markets are closed already, not just for the day or the week, but for the month of November, Carol.
Yeah, they are indeed. Yep, we are wrapping up the week. So another month in the books, if you will, for 2025. If you are just joining us, though, the equity market finishing up on the S&P 500, just about 0.5%. We did see some buying, though, into the close. Very, very thin volume here on this holiday shortened trading week and the day after Thanksgiving. NASDAQ 100 just up about 0.8%. And we still have about 45 minutes to go until we see bond trading wrap up, Bonnie, right here in the U.S.
Well, let's get back to retail because that's what we're really concentrating on today. And it's been more than a year now since Nike CEO Elliott Hill took the helm of the world's largest sportswear company with a one-time intern, helping blunt a long-time sales slump. It feels less than a year, but there we go. Bloomberg TV's Romain Bostic sat down with some of the key players in Hill's offensive strategy to get the retailer back to the top of the podium.
In the heart of Western Oregon lies a 750,000 square foot plus complex. So secret, few are allowed past the lobby.
If you love sports and you love product, this is kind of Disneyland.
All told, more than 800 pieces of testing equipment under the roof of the LeBron James Innovation Center, home to the Nike Sport Research Lab.
This is the home to dreamers, creators, makers, engineers, some incredible teammates of ours who are all dreaming about serving elite athlete problems.
Yeah, what Nike as a brand is founded on, really at the core of our history and heritage, is listening to the voice of the athlete.
Amy Montaigne is the new president of the Nike brand. Phil McCartney is the new Chief Innovation Design and Product Officer. They are two of the key players in CEO Elliott Hill's full court press to reinvigorate growth following former CEO John Donahoe's reign. It was a tenure that saw annual sales begin to drop in 2024.
We're going to obsess sports. I think that's been since Elliott returned. The reason that we start with elite athletes is when we solve those discerning problems, those milliseconds, micro millimeters, we can create products that then translate down for athletes every day all over the world.
Speaking of the everyday athlete, I put on my running shoes and geared up for an afternoon under the microscope of some of Nike's best researchers for a head-to-toe consultation. Nike's Chief Science Officer, Matt Nurse, providing some words of encouragement along the way.
So we have an expression, if you have a body, you're an athlete.
Yeah.
And a lot of what we learn from elite athletes does trickle down and help everybody, but a lot of what we learn from everyday athletes does trickle up. Honestly, today it's just a more modern, sophisticated incarnation of what Bill Bauman was doing in his lab, but allow more sports, more athletes, full speed, full motion, but we're solving the same problems, doing the same thing.
A little different this time around. Mounting pressure in the running space, under threat by competitors like On and Hoka.
It's fair to say that the distance between ourselves and our potential is a little bigger than the distance between ourselves and our competition.
What I believe and want for the Nike brand is for us to always remember our roots and to honor our founder, to really come in every single day obsessed with serving the athlete, listening to their needs, not only meeting their expectations, but taking them somewhere new. And when we do that, there is all the opportunity in the world for our future.
All right, that, of course, was Bloomberg's Romain Bostic there with key members of the Nike team, including the Nike president, and going for a run. So kind of love that one. All right, with consumer sentiment overall this month falling the most since the month of April, there are questions about how holiday shopping and retailers' full-year earnings will be impacted. So there's a lot going on this holiday season and expectations, too, around it. We're joined now by Natalie Cutler. She's BDO's National Retail and Consumer Products Industry Leader, and she joins us on this Black Friday. Hey, Natalie, great to have you here with Vani and myself. What are your expectations around this holiday shopping season?
Well, great to be here. Thank you. You know what? I think this holiday season is going to be challenging, yet I do think it's going to ultimately be okay. I think there's going to be winners and losers on the retail side, just like we would expect to see in any year. Those retailers that really understand what their consumer is looking for, whether it's value, convenience, or experience, those are the retailers that are going to be successful.
Natalie, one thing that caught my attention this week, Citi coming out and saying that Black Friday performance is overblown as a metric for retailers, going on to say the Thanksgiving weekend shopping event is given too much attention as the season is, quote, typically won or lost in the weeks leading up to Christmas, with the post-Christmas week becoming more important to most retailers. That's Citi's view. Does Citi have a point, though?
So I do think that the weeks leading up to Black Friday certainly are an indication of what will happen on Black Friday, the entire weekend, and then certainly for the rest of the month of December. Black Friday used to be the turning point and the key day for most retailers. And we know now that it is so much more than that. It is now beginning November, and even Amazon as early as October. So the holiday season has really stretched out more so than it has been in years past. So it's kind of difficult just to nail down a particular day. Having said all that, I do think that Black Friday or this entire weekend, and including Cyber Monday, are still critical days for retailers, because that is the day that the consumer's mindset is, oh, I have to go out there and get my shopping done.
Natalie, are there any new approaches when it comes to marketing? I picked up my phone a little while ago and there must have been about 50 emails offering me things. And obviously these are people I've given my email to already and they think of me as a loyal customer, but for many of them I'm not.
So let's dig deeper a little bit on that whole concept of loyalty. So loyalty programs are super important, and retailers are doubling down on the loyalty programs. So in the past, probably as you did and so many others, as did I, you wanted a 5%, 10% sign-on discount. Lots of consumers signed in, got their initial 10%, and that was the end of that. And then we're all continuously getting these emails. But good retailers are doubling down on the loyalty programs, and they're offering either tier discounts. Buy X, get a discount of 10%. Buy Y, get a discount of 20%. Some loyalty programs are offering exclusive promotions. They're offering those promotions early. And then they're also offering exclusive drops or exclusive products. So I do think that the old loyalty program that we've seen for many years, where you just get that initial discount, are no longer the case, and retailers are not only providing those discounts, what they're really doing is actually getting information, and they're gathering data about us as consumers, what we're buying, when we're buying it, and utilizing AI as to how they can offer us better and more targeted and personalized promotions.
And I imagine they're turning some shoppers away with the volume of these emails. I want to ask you about omnichannel, because it used to be that was sort of in person or online somehow, but that's expanded as well now, given that we can all shop through our social media apps should we want to.
Absolutely. So it used to be just as you said, used to be either in store, you used to have online, now we have mobile commerce, and we have social commerce. And retailers really need to have a very strong omnichannel to capture all of those different channels. So not to lose the consumer, if you have a promotion in the store, but you don't have the promotion available online, or vice versa, or in social commerce. And I think social commerce actually opens up a whole nother area of opportunity for retailers, and that's through influencers. Buying through influencers is someone that you can relate to, someone with your interest, perhaps in your age bracket, someone you can really connect to. I think influencers are certainly driving the sales and the interaction on social commerce.
Hey, Natalie, just to wrap up, because we've talked a lot about the consumer, but you obviously work with a lot of companies and businesses that sell stuff to the consumer. Just got about 30 seconds left here or so. What are they saying about the environment right now? Are they optimistic, or are they more conservative about the outlook? Just quickly, if you could.
I think you're really seeing a mix of all of that. Some retailers are optimistic, the ones that have a very strong front and back end in terms of how they view the consumer, whereas some retailers that are not as comfortable or do not have all their processes in place, they didn't buy the inventory at the right time or at the right price, and now are therefore will be offering significant discounts in Q4 and beyond.
All right, Natalie, thank you so much for joining us. That is Natalie Cutler from BDO's Retail and Consumer Products Industry Group. Next, we're going to return our attention to Washington, D.C. after, of course, the deadly shootings in the U.S. Capitol. Do stay with us. This is Bloomberg Markets.
Regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizons Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizons Middle East and Africa every trading day, now at our new time. Only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
In case you missed it, on Balance of Power.
Congressman, do you believe President Trump when you hear him praise Mamdani and say that he wants to help him succeed? And if that's the case, doesn't this blow a big hole in the Republican campaign in the midterms in which they wanted to use Zoran Mamdani as a bit of a scapegoat here? And now President Trump says he's ready to move back to New York.
I think it's a fair point that, the Republican political structure was really trying to set up Mamdani as the scary point of attack, essentially, for the American people. And if Trump is signaling and actually saying that maybe he's a good guy and we're going to work together, I think that does make it much more difficult for them to try and go forward with that. But ultimately, I think, as I mentioned a moment ago, it's really going to come down to the prices of what it costs to live here and who's trying to do what to fix it. That's the key, I think, for the next cycle.
Don't miss Balance of Power live every weekday.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
This is Bloomberg Markets. I'm Bonnie Quinn along with Carol Masser. And of course, the equity market is closed. It is Black Friday, in case you hadn't noticed. And we did make up our losses on the month, which is kind of crazy given that we were down 4.7% at one point for the S&P 500. Right now, though, we have made up those losses. And I'm just looking at the SOX index, interestingly, all but one of those members positive. So it was a really fascinating day. Carol just pointing out to me that Intel was up 10% in the session. The NASDAQ 100 then up 0.8%. I wanted to point to the VIX, which is just above 16, so not completely calm, but way calmer than it had been when it was, closing in on 25 there just earlier in the week. And then Bitcoin as well. We rallied up to $93,000 a coin. I'm just looking at it now, though, and we were back below $91,000 a coin. So a lot of volatility for Bitcoin.
Yeah, no, absolutely. Hey, and also expectations as the Fed will cut interest rates faster than initially anticipating, definitely fueling that late month rebound in U.S. stocks, capping off what's been a very choppy November. A 7-month winning streak, though, in the S&P 500. Let's bring in Bloomberg cross-asset reporter Denitsa Sukova. She's been all over this. Let's talk about the market close. We did see some buying, actually, into the close today, even if it's light volume.
No, it's incredible week. 3.7 gain for the S&P this week. We were headed for a loss this month, and now it's a small gain.
Yeah.
Big reversal. We actually saw JP Morgan has great data on retail traders, and they were serious last week, but going into this week, sentiment is going up, and people are buying the dip, and we can see that happened this week. It's really a cross-asset rally. It's silver, it's gold. Crypto was up. Obviously, today the gains faded, but still on the week, we're still looking at a gain. Some of the speculative corners are really scoring big gains. Goldman Sachs has this basket of most shortest stock. It's up 12% this week. So those small speculative names are really rallying. Retail is active. It was supposed to be a thin liquidity, quiet week, and it is, but clearly there is some buying. As we said, Intel is up 10%. We have TF International Securities saying that the company is expected to begin shipping Apple's lowest end M processor. We had a great week for Alphabet. 7% jump on the week, extending a 70% year-to-date rally. Big tech, American exceptionalism, all those trades are back, and they're delivering strong gains.
Google's really cool, right? Because of the AI trade. All of a sudden, everybody thought they were behind, and then everybody's in love with Gemini and so on and so forth. They have just been on a tear.
NVIDIA is down the week, though.
Yeah.
But still, you see what happens to indices.
But that's
S&P,
the scary thing, though. This AI trade turns on a dime. Like, NVIDIA could do no wrong there for a while after stagnating for some of the year, and then suddenly it's down again. This Chicago Mercantile Exchange outage, which lasted for hours but was resolved before the market opened, did it have an impact on the trade?
Yeah, initially we had impact, but it's kind of incredible how fast it got reversed, and we're at a record for many of the metals at the end of the day, which is really, really impressive. It didn't really deter sentiment going into after it was resolved. So even that really didn't help. All the AI bubble fears also, which were so strong for a long time, clearly it wasn't that much of an issue this week. Even as we mentioned, the NVIDIA loss, it's less than 1% this week, and the year-to-date gain is really, really strong. So yeah, investors are not worried. We saw volatility raise across stocks, bonds, high-yield bonds, and everything. And this week, across the board, we've seen sentiment increase, and then volatility is falling. So investors are not too jittery, are not too worried. And
are they too complacent? I'm looking at a VIX at 16 and change. I mean, we moved down a bunch this week.
But it's been painful. It's been very painful to hedge. Like, as you saw in April, everyone was so scared, everyone was building that protection, and then just a few weeks later, the rally was so strong that perhaps if you took a bearish stand, it's been such a painful thing. We look at a few leveraged ETFs that actually have bearish exposure. So 3 times leverage bet on the S&P 500, it's down 80% this year. Of course, that means being invested constantly, but still, it just gives you, it's just a very painful.
It's hard to fight the momentum, right?
Yeah, it's really painful, but unless you time it perfectly well, but who can do that?
That is terrifying. That just is terrifying. Denitsa, we have to leave it there, but thank you so much, Denitsa Tsakova. Do look out for her stories coming out on the Bloomberg, and we will be back with her at some point very, very soon. I do want to take a look at some UK assets, though, because we obviously had the Chancellor Rachel Reeves' budget earlier this week. FTSE 100 ended up the session up about 0.25%. Sterling had a bit of a round trip right now versus the US dollar, trading at 132.37, so unchanged, but it was weaker for a time, although with the spot trading affected by the outage, it's difficult to know what was affecting what. And then I just want to point to a further bid into gilts. So we saw that bid after the Chancellor gave a budget that the market seemed to like. Yields down across the curve today, but just about a basis point. So holding on to those declines, they already obviously dropped substantially following the Chancellor's budget. So then Chancellor Rachel Reeves announcing that £26 billion worth of tax increases in the budget aimed to balance the demands of both bond traders and Labour backbenchers. Bloomberg's Lizzie Burden spoke with the Chancellor in an exclusive interview about the budget and its early leak earlier this week.
Last year, I had to close the black hole in the public finances left by the Conservatives. In the budget last year, I lived within the forecast set by the OBR. They have now changed their forecast around productivity, and they are very clear that's nothing to do with the policy of this government, but that does mean they forecast lower tax revenue coming in. And I was always clear that I would never play fast and loose with the public finances, because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services. And that is what this government's plan for growth is all about, whether it's pensions reform, planning reform, the changes today to help make Britain the best place to start up, to scale up and to stay, with the changes to stamp duty for shares for companies newly listing in the UK. I'm determined that we get the growth that our economy has been sorely lacking for too long, and we do that through the reforms that we've set out.
Well, no confirmation of no new tax rises,
well,
Chancellor.
No Chancellor can write future budgets. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
All right, that, of course, is UK Chancellor Rachel Reeves there with Bloomberg's Lizzie Burden. All right, back here in the U.S., we continue to get some updates on the shooting of 2 U.S. National Guards, which happened, of course, on Wednesday. That resulted in at least 1 life lost. President Trump confirming that yesterday. National Guard member Sarah Beckstrom passing away. She was 20 years old. U.S. Air Force Staff Sergeant Andrew Wolf, age 24, remains in critical condition. Janine Pirro, the U.S. Attorney for the District of Columbia, said the suspected gunman shooter in that will be charged with first-degree murder. She spoke on Fox.
There are certainly many more charges to come, but we are upgrading the initial charges of assault to murder in the first degree. And we are hoping that the more information we can get, the more we will find out about what actually happened in terms of this individual even being in this country.
And that, of course, is the U.S. Attorney for D.C., Jeanine Pirro. All right, let's get more, though, on that shooting that happened on Wednesday. Let's get an update. We head back to the nation's capital. Bloomberg News Managing Editor Mario Parker. Mario, still obviously an open investigation, one would assume. We have learned a lot about, though, that suspected shooter since Wednesday, an Afghan national who previously worked with U.S. forces and the CIA in Afghanistan before he arrived in the United States in 2021. What more are we learning or looking to learn? And I'm just curious if we've gotten any indications about a motive here.
In terms of motive here at all. As you mentioned, he was part of U.S.-Afghan efforts in the Afghanistan war a few years ago. He came to the country as part of a Biden administration program that allowed for the people who worked in the so-called zero units to come to the U.S. after the Taliban took control of the country.
Yeah, you have to wonder what kind of an impact it's going to have on, what's already a pretty stringent immigration policy these days, Mario.
Yes, absolutely. And we see that that's exactly the way where the president is pivoting, right? So overnight, we saw the president and the administration increase or tighten restrictions on immigration from Afghanistan, but also 18 other countries. This was telegraphed during the summer with the president saying at the time, the administration saying at the time that it would increase or tighten some of the restrictions or limit travel from some of these countries. What we've seen since then is that the administration has said that it will consider negative impacts from what it characterizes as negative factors, I should say, from those countries as it considers green cards or immigration, some type of immigration statuses at all.
Mario, you've got to think about how the administration, the White House handles all of this. I mean, how do they balance some of those calls when the suspected shooter was formally granted asylum just this past April under the Trump administration? I mean, it's a tricky situation for them, some would say, to manage as well.
Somewhat, right? So President Trump's response to a reporter's question about that was that it's very tough to essentially deport people who have come over under the auspices of programs like those when they're already here. We've seen the administration say that it's going to revisit some of the revisit or re-examine some of the green card statuses from nationals from Afghanistan, but also some of these other countries as well. We saw the administration say that it's going to try to figure out a way, though details are unclear, let me say, how to stem some of the federal benefits that individuals from these countries have received as well. But largely, to your point, even as the asylum was granted under the Trump administration has said, in addition to it being tough to expel folks from that are already here, they've also pointed the blame squarely at the President Biden, his predecessor.
Mario, what can we expect out of President Donald Trump this evening, if anything, and over the weekend? Are we waiting on any events?
No, that's unclear right now. The president, obviously this unfortunate incident took place on the eve of the U.S. Thanksgiving holiday. The president is down at his Mar-a-Lago golf estate in West Palm Beach, Florida right now. We're unsure whether or not we will hear from him at some point again, either today or over the weekend. At this point, it's unclear.
Mario, just one last question. The other National Guardsman, we know in critical condition. Do we know anything else, any more updates on his condition?
No, not at this time. Outside of what President Trump has said, that he's fighting for his life. Obviously, as you all mentioned, Sarah Beckstrom, the other National Guard member, unfortunately passed. But as far as the last thing that we know about Wolf was that he's fighting for his life.
All right, Mario, thank you so much. That is Mario Parker for us, managing editor in Washington, D.C. Well, do stay tuned, because even with this Government shutdown over. It is having a lingering impact on Americans' holiday travel plans. We'll see if we can get you some deals. We're going to be talking with Clint Henderson from The Points Guy. You definitely don't want to miss that conversation. That's next. This is Bloomberg.
Here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Didn't really think I had a problem.
I would isolate, self-medicate.
Like 48.5 million Americans, they didn't choose addiction. Go to shatterproof.org/findstreatment. Watch the film No More Secrets and find out how you can get help. That's shatterproof.org/findtreatment.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Versace in Beirut, and this is Bloomberg.
Welcome back to Bloomberg Markets this Black Friday. Well, this year an increasing number of Americans apparently are trading the traditional holiday buzz for something a little greener. And the plant is finding its way into everything from appetizers to after-dinner relaxation. Bloomberg's Charles Garvin takes the deep dive.
More Americans are opting for a different kind of buzz this holiday season. As state laws around cannabis and other drugs have eased up, it's spread into everything, including the holiday dinner table.
It's more accepted. It is becoming more normalized.
Cannabis's newfound place at family functions speaks to how far the category has come. The move fits the lifestyle of people who describe themselves as California sober, abstaining from or barely touching alcohol, but open to substances like cannabis or psilocybin. Alcohol consumption has fallen to its lowest level in decades, according to a recent Gallup poll. Over half of respondents to a recent Bloomberg Intelligence survey said they now substitute cannabis for alcohol at least weekly. That might take the form of gummies, extracts, and even infused seltzers. Cannabis on Thanksgiving is a quiet tradition for some. The day before Thanksgiving is the second biggest sales day of the year for the U.S. legal cannabis industry, behind only April 20th, or 4/20, which is the de facto holiday for cannabis celebration. The industry was valued at just over $30 billion last year, according to industry estimates. The cannabis market tracker BDSA forecasts growth in the total market this year of 4% to $31.6 billion. It expects the market to reach $39.1 billion by 2029. For the big Thanksgiving meal, some chefs are getting experimental. Miguel Trinidad, a New York-based chef and founder of the cannabis dining club 99th Floor, is infusing THC into his Thanksgiving menu.
Our mission statement at 99th Floor is to destigmatize cannabis through the language of food. The way I do that is by micro-infusions. What I'm making today is going to be a rack of lamb.
Trinidad infuses lamb fat and clarified butter with cannabis flour before sealing and cooking the lamb sous vide, a slow water bath method that keeps the meat tender and evenly cooked. He then finishes it off in a scalding hot pan.
So here you have it, the infused rack of lamb. It's 5 milligrams of THC. Over the course of the time that I've been doing 99th Floor, things have changed. There's a lot of people that are coming out of the cannabis closet. It's something that's becoming normalized, and people are starting to understand and respect it more.
While a few dozen states have legalized cannabis, it's still considered a Schedule I drug, putting it in the same category as heroin and LSD. Uncertainty at the federal level looms large, limiting access to banking, investment, and broader legitimacy. In August, President Donald Trump said he was considering reclassifying cannabis as a less dangerous drug, but no announcement has followed. The divide between state legalization and federal prohibition remains one of the biggest hurdles for an industry still finding its footing. In the meantime, the cultural shift is making its way into some holiday dinners.
All right, everybody, that's Charles Gorovin of Bloomberg News. Got to say, when that story hit the Bloomberg, definitely among the most read. Well, keeping up with that holiday theme, holiday travel, you know, is often stressful. Another place, maybe gummies and cannabis may come in handy, some might say. Hey, this year, travel may be a little bit different, though, as many Americans made changes to their plans during or because of the U.S. government shutdown. Even so, it is expected to be one of the busiest travel seasons in years. Let's get more on what to expect with Clint Henderson. He's Travel Insider, managing editor of the travel media platform, The Points Guy. Always knows so much about what's going on and where the deals are. First of all, Clint, just look back. How much do you think, or how much are you hearing that the government shutdown may have impacted holiday travel this year?
Yeah, so we did a poll with YouGov at The Points Guy, and we found that 40% of those planning to travel for Thanksgiving or Christmas were reconsidering their plans, changing their plans, or canceling their plans. So in the end, because the government shutdown ended when it did, I don't think anywhere near that number ended up canceling. I do think some people chose to drive instead, and maybe some people were scared off of traveling for the Thanksgiving holiday. That said, there's still record crowds, so it didn't really dent the numbers as much as it could have, but I definitely think the air traffic controller shortage thing got a lot of publicity. That's an ongoing problem that I think a lot of people hadn't heard about before. So, you know, we did see an impact to pricing for Christmas flights. So we did an analysis with PointsPath, and we found prices dropped around 6% year over year for Christmas, which is really unusual this time of year. Usually it's only up for Christmas. So
yeah, I've noticed some great deals to some European destinations that I definitely didn't notice when I was speaking with you last year, because I remember well. Give us the skinny. Where are the best destinations? Where are the best discounts when it comes to Black Friday shopping?
Yeah, so pretty much every single airline has a Black Friday sale on right now, or is planning one for Travel Tuesday, Cyber Monday next week. It's a great time to shop for travel, especially if you have some spring break trips that you're going to plan, because that can be really expensive. But round trip under $500 is common this week. From everyone from Singapore Airlines, Aer Lingus, American Airlines launched a huge sale today. So lots of good deals to Europe, for example, out there. Also, American Airlines has flights under $100 one way all over the country, including transcons between San Francisco or LA and New York. So really good deals out there. Alaska Airlines 30% off. And then all the hotels are 25 to 30% off today. So take a look around. We have a whole write-up at The Points Guy that I've been updating frequently. And so there's lots of good deals out there. So much so that I think travel has replaced sort of merchandise as the best deal during these Black Friday holidays. It's pretty remarkable, because when I started out in this business, it was really a gimmick. Travel Tuesday was not really a thing, and now it really is.
I agree. I definitely have had good luck on this particular weekend, actually, booking travel. Talk to us about some of the domestic and international places that people are booking most.
Yeah, Europe is good. Remains hot, and it's always the case. Florida, Las Vegas is still hot. New York City, crazy demand in New York City. If you've been out in the city, you know what it's like out there. I just can't believe hotel rates, $800 to $1,000 a night in December. Yeah. It's just crazy to me. But Europe is hot, and then of course Japan. The U.S. dollar remains strong, so places like Japan are a relative bargain for Americans, and that's really where everyone wants to go. I don't know if it's Instagram. I don't know, that seems to be the hot spot.
Really fascinating. One of the things I want to go back to, though, Clint, is in terms of deals. You talked about 30% off or this percentage off. What about for people who use miles?
Yeah, I'm not seeing as many mileage deals, though they are out there. I think you just have to be really flexible and you have to be nimble with booking mileage deals right now. You know, last year, that's what we were seeing more was mileage deals. This year, it seems to be cash deals. So very interesting trend to watch. I use tools like Seats.aero to find cheap business class flights. And, you know, there's explanations of all this stuff at the Points Guy, but you have to be a little tricky these days to get a really good deal on flights.
That is so true. Hey, listen, the other thing I want to ask you about is cruise lines, because I've seen a lot of commercials for the cruise companies, and they do seem to be saying sign up now and a big percentage off. How much of that is kind of amping up to bring in consumers?
Yeah, it's really interesting. The cruise industry was the last to recover coming out of COVID, and we saw some extraordinary deals. I just am not seeing a lot of deals in the cruise space these days. So if you see something in an ad that looks really good, jump on it, because cruises are selling out. It's remarkable, the comeback in the cruise industry. I haven't not seen a ton of deals. I'm sure there's a few out there, but yeah, if you see something on sale, grab it.
Clint, just remind us, you said Seats.aero, and are there other websites that we should know about? Because I feel like these websites change all the time.
Yeah, they do. We've got a guide to all the best travel tools at thepointsguy.com, but Seats.aero is good, PointsBath, Point.me is another good one. There's all kinds of really fun tools out there where you can beat the airlines at their own game.
Yeah, or at least, you know, spend an hour or two and have fun dreaming. Yeah. Clint Henderson, thank you so much. Always wonderful to speak with you, and actually can be very profitable to speak with you as well. So thanks again. That's Clint Henderson. He is managing editor at The Points Guy, and do check out the Points Guy website as well for all of those deals. Carol, the bond market, 4.5 minutes left, and we didn't get any Fed speak today. We weren't expecting any, but the blackout period starts tonight, so if anyone wanted to say anything, they've lost their chance. We see that yields across the curve were higher, but just by a basis point or two. The 2-year yield about to finish the session at 348.93 right now. The 10-year yield at 401.32, so not breaking that 4% barrier, and the 30-year yield 466.38. What will next week bring?
Yeah, what will next week bring, especially as Fed speakers stop speaking, because folks, we are just about a week and a half away from the final Fed meeting, FOMC meeting of the year. The narrative has switched dramatically, with expectations pretty high right now. Markets expecting another cut by the Federal Reserve. All right, that's going to do it for Vonnie and me in this special edition of Bloomberg Markets on this Black Friday. Have a good and safe weekend, everyone. This is Bloomberg.
is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly.
Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
no, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop. I'll still be driving some.
Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
We're coming to you live from Kuala Lumpur. The whole world is here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Why would you want to be chairman of the Fed? Are you sure you want that job?
If the president asks me to be Fed chair, then I'll do it. If I'm not Fed chair, don't be disappointed for me because I love the job that I have.
In case you missed it on the opening trade.
Kit, I've got a present for you. I know you've mentioned it a couple of times. We've got a coffee for you.
Hang on a sec.
By the
Coffee
lovely Tara.
coming. There we go. So my question now is, how much froth is in there?
See, you can't tell when you look at the top. That's okay. You've got to drink it to find out.
Absolute genius. You got to take the lid off before you even figure out what's going on.
Don't miss the opening trade. Live every weekday.
All right, so we've taken this show many places, but this is our first time in Dallas at the Star. This is the brainchild of the Jones family, and we're talking to the man himself, Jerry Jones.
Good to see you. Jerry's my North Star as an owner, and what he's done with this franchise, taking it where he bought it from to where it is today, pretty incredible.
No one's done it better. Literally, no one has built a more valuable sports franchise on the planet. $13 billion is the estimated value of the Dallas Cowboys. Lots of lessons that we're going to learn from Jerry Jones.
I can't wait.
Let's do it. Jerry Jones, thank you so much for having us here in Texas.
Well, first of all, I'm proud you are here. We're overlooking the field. And I'm kind of proud of what's around the field as well with our stars. So thanks for coming to the Star. Great to be with both of you. And Alex, I'm so proud to see my old neighbor back here in Dallas.
That's right.
So, Alex, I'm going to let you kick it off.
Yeah, so, you know, Jace, when I first decided that I wanted to own a team, this is something I've been dreaming about for forever and ever since I was a teenager. But, of course, I come from very humble beginnings. But I said there's one owner I must talk to. And that's Mr. Jerry Jones. And I made a call to Charlotte. This was around COVID time. We were taking a run at the Mets.
Jerry's daughter, Charlotte Jones.
Charlotte Jones. I said, boy, but I tell you, maybe in a couple of weeks, she'll get Mr. Jones on because he's very busy. And Charlotte hits me up right back. Jerry would love to talk to you. How's Wednesday at 2 o'clock? I said, done. And I thought it was going to be 15 minutes. And boy, I tell you what, 90 minutes later, I have like pages and pages of notes. And you gave me the most incredible advice that I'll never forget. And for that, I'm very grateful. So that call really meant a lot to me. And a lot of what you told me, along with what I learned from George Steinbrenner and others that I respect and admire, I think about that as an owner today of the Minnesota Timberwolves and the Minnesota Lynx. So thank you for that.
Well, congratulations. And, the minute that you told me you were going to get involved at the ownership level, it just made all the sense in the world. The fact that you had always wanted to be in ownership says it all as well, because in my mind, there is a connection. It's of passion. You can call it competitiveness. but it's accomplishing things that are hard to do. But you know, A-Rod, you mentioned George Steinbrenner. And my early days with the Cowboys, I'd get a nice note, and I always look forward to it. And it would be from him. And he would give me, I call them my sweet nothings. I put them in a file that I had that for. But it were daily encouragements because there was a lot of criticism because of the way that we bought the Cowboys, changed the coaches out, and frankly did a lot of changes. Well, of all the people in the world to be getting those nice, encouraging notes that, boy, stick in there, keep it going. I've got a legacy there, and we, George Steinbrenner, the family, and my family, set up a company called Legends.
Yeah.
And that was, of course, many years later. And I got to meet with him several times as we were talking about Legends. And Legends serves many, many sports, and it serves facilities and the process of really fan engagement. I'll never forget, though.
Yeah.
George Steinbrenner told the group when we met, he said, I don't need anything written down. You don't spend any money or time on that contract over there. He and I'll shake hands and we'll have all we need to make this business work.
So, Jerry, you mentioned you getting into ownership and a lot that led to that. When Alex calls you and says he's going to, buy into the NBA and the WNBA, no one would doubt that that was a good deal. When you bought the Dallas Cowboys, people thought you were insane. People thought it was a bad business and that you were overpaying. What gave you the certitude that this was a good deal?
Well, it truly was passion. And just as passion can help you in many aspects of life, I really didn't see those obvious obstacles. I just didn't see them. Now you say, well, can't you see losing $1 million a month? Are you blind? How much were you drinking when you bought the Cowboys? Well, the point is, I looked for ways, and this is common. I looked for ways that were maybe a little ambitious, but I looked for ways to solve every one of those problems. And while there may have been long odds, there may have been a little imagination in those ways, I took those problems and I thought I had a solution as to how to address them. That's what you will do when you want to do it real bad. And yes, the Cowboys, it was daunting, but the point is that it was always there. The interest in becoming involved, and becoming involved in a way that, let's say, unlike A-Rod, becoming in a way that didn't swing the bat or didn't make the block, which I certainly appreciated as a great fan, but becoming involved in a way that would make it better. I found no sports franchise anywhere in the world that was making any money. You see, sports had been a great, great portrayer of what sports is about. It's called publicity. Well, the difference in publicity, in my point of view, than marketing is that publicity has great audiences, it has great, if you will, interest, and can create interest. Marketing is when you take that publicity and you bring it home and set up a plan to monetize some of it and go out and get that and have enough coming back in to go again. That's called a business model.
Yeah.
Well, sports had not only the great passion and the natural instincts of competing in everybody and the appreciation of people that do, but sports had this massive, massive publicity and massive understanding, but yet it had no business model to make it called marketing where you could bring back a little and go again.
Right.
That was totally necessary for me because I couldn't go again. Now, what happened with me was, candidly, is that the amount of money I had wasn't what was needed. But because the NFL and the Cowboys were really slow, we were really down and out financially, frankly. Because of that, then the NFL knew they had a problem.
listed on Bloomberg Insight.
From a Bank of Korea's perspective, we don't believe that monetary policy alone can control the housing crisis. But on the other hand, we are mindful that ample liquidity wouldn't throw the fire to the real estate market. Our official position is that we will maintain the easing monetary cycle, but the magnitude and timing of the cut or even the change of direction will depend on the new data.
Countries around the world are pulling away from U.S. assets. Do you see debasement happening?
No, actually. I think we have discussed this quite a lot. But actually, if you look at the actual capital flows in the last 6 months, I don't see that there's a lot of talk, but there's no real movement away from dollar.
Don't miss Bloomberg Insight live weekdays. What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
The bankers didn't worry about me because they didn't loan anything on the Cowboys. The bankers loaned it on a receivable that I had. And so the approval of me getting through the door and still not having any money left to go buy the general partners that I had agreed under contract to go buy out, but I didn't have the money to go do that.
So, Jay, along those lines, so go back to 1989, you're losing $1 million per month. Now, I heard you also say that you may have wanted to buy a business that was cash flowing to offset some of those losses. As you think about filling those holes, was that stressful? And what was your strategy? Walk us through that.
On a personal basis, I had such pride and such an experience in sport when I was in college. And my senior year at Arkansas, we won the national championship. Well, I had been schooled in selling insurance. I could gnaw that leg off the chair selling. But what I hadn't done was been really schooled in financial. And so I thought because I could tell a good story and could borrow all that money, that was the way to go. And so my first year or two out of college, I borrowed more money than you could even count. And my first year out of school, I think my commissions were $30,000. My interest was $150,000 to give you an idea how over my skis I had gotten. It took me years. It took my Jean, my wife, getting her purse taken out of her hands and credit cards cut in two. It took the bill players coming. So I had really gotten a lesson in how not to do it as far as buying something. Well, I managed to come through that, and it was the greatest education that I'd ever had. Well, then I was very fortunate and got some real finances with the oil and gas business. After all that butt kicking that I got for getting out over my skis, after all of that, to show you how passionate or crazy I was, after going through that, of thinking that the old financial death had been at Ray, I turned around and bought the Dallas Cowboys. That shows you how much passion was involved. Right. But I remember when we talked, Alex, I said, listen, I said, nothing can stand in the way of passion.
So I think Alex would probably validate this, that when he goes to buy a team, part of the advice that he gets is sit, don't make any big moves, no sudden moves, don't get rid of a bunch of people right away. You didn't follow that advice. Basically, the minute you come in, you get rid of this legendary coach. You fired everybody from the guy announcing the public announcements to the head of publicity and the general manager. Why? What did you see that was so wrong with them that you felt like you immediately had to act?
You have to assume when you buy something that who you buy it from knows what it's worth like it is. Give them credit, or certainly their creditors might know, they know what the business is. So a big mistake is not to automatically know that you've got to change the scenery if you pay what you're going to pay assume they're getting top dollar and have taken it when they got your money. So you have to really go in thinking change. When it was as dramatically out of kilter as the Cowboys were, I had to have radical change, and I had to do it yesterday. So there was an urgency. You didn't have time to have a good time, so to speak. That plus, again, the fact that I can't emphasize enough, I felt like Herschel Walker running through the line. It was just bouncing off of me. There were all kinds of hurdles that were popping. And of course, where was the bad day? Well, I couldn't have a bad day because I was getting to do something that I'd wanted to do all my life. And that ruled the day.
So one of the other most seminal deals that you make is, you mentioned Herschel Walker, got rid of him. You traded him.
Yeah.
It turns out to be arguably one of the most brilliant trades in the history of football. Did not seem that way at the time. Talk us through that decision.
If you look at making change, and certainly Herschel Walker was a change, the best player we had, and it was well known. In this particular case, you were kind of new on the block, so you automatically didn't know what you were doing. Always, when it's an accomplished name, whether it's sport or otherwise, always when you get a divorce there, it's going to look bad for the one that made the decision. Always. There's no question. If you can't handle that, then don't make the trade. Or if you can't anticipate that, don't make the trade. That's alive and well. But what it calls you to do is not just the tangible consideration you got, which at that time were draft picks. You didn't have a cap at that time, but you had those draft picks, and that was the tangible. What those trades did, what those picks did, was allow us to use them not only for using them in the draft, but we used them to trade. And we did it with, I'm not going to say randomness, but we did it with reckless abandon, if you want to. It caused you to be more of a player, because it was like going to Las Vegas with money in your pocket. And I don't think there's any question that I'm willing to take risk in those early days after having acquired the Cowboys, that we built players, built our roster. I think the ability to cut and shoot was a big deal.
I've heard you talk about ambiguity. I think about it from the lens of sports. Jerry, there's some guys that I've played with that are free agents, and they don't know when that next check's coming from or where it's coming from. And you create a 300 hitter, becomes a 215 hitter. A guy that hits 30 home runs hits 18 home runs because of the nerves. The same is true in business. But you have this ability to, not knowing what's going to happen next, to perform at a high level. Do you believe that's true? And where does that come from if it is true?
Well, I know it's true in my situation, but I think it's very true. And some of the greatest people that have ever been involved in the professions or business, they don't function as well if they don't know what's going to happen at the end of the week, especially financially.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
In case you missed it on the opening trade.
Kit, I've got a present for you. I know you've mentioned it a couple of times. We've got a coffee for you.
Hang on a sec.
By the
Coffee
lovely Tara.
coming. There we go. So my question now is, how much froth is in there?
See, you can't tell when you look at the top. That's okay. You've got to drink it to find out.
Absolute genius. You got to take the lid off before you even figure out what's going on.
Don't miss the opening trade, live every weekday.
In case you missed it on Bloomberg Open Interest.
It's Netflix versus YouTube.
100%. I do think in the world of more AI slop, people are going to look for destinations where they really want high
quality, curated, high production storytelling.
But YouTube is crushing it. I mean, I have both.
Absolutely. Right?
But one thing YouTube has is like, I don't have to pay for YouTube. Are these real threats to Netflix?
Netflix is the luxury equivalent consumer product, it's consumer tech.
Don't miss Open Interest live weekdays.
They need to know that so that they can get on with their business of being as excellent as they are. On the other hand, there are some people that the ambiguity that's out there of not knowing what your check is, they're better than if they knew what the check was going to be. They're more clever. They're more cunning. They've just got more skill and are willing to exert it. I call that tolerance for ambiguity. Tolerance for ambiguity. And the classic, at least known story, was the famous riverboat gambler. Charming mustache sitting there. The next card up is going to get him thrown off the boat or he's going to own the boat. Now, that's when he's the best that he is in his life. And, of course, he's gotten thrown off that boat before, and he's won the boat a few times. The difference is, though, I'll bet you not a one of those charming son of a guns didn't know how to swim. Now, you can play that hand, but you better know how to swim because you're going to get thrown off the boat a little bit.
You've gotten thrown off the boat.
A little bit.
I have too.
I was going to say, you guys have been thrown off some boats together. So I do want to, move ahead a little bit chronologically because one of the ways that you step out is with your deal making. You come in, you're part of this club, a club that a lot of people, especially now, want to be a part of. And NFL has its way of doing business. And you at some point decide that you might be able to do this a little bit better. And I'm thinking specifically the Nike deal. Yeah. This is a Nike athlete right here. Everybody remembers you and Phil Knight walking out on that field. How does that deal come about? How do you decide to do that knowing that the NFL, they've got Reebok, they're good. You decide you can do something better.
I had known a great coach named Eddie Sutton, and he had told me about Phil Knight as a young man bringing his things to where he was coaching in college and selling it out of the trunk, that Phil Knight had that path to where he was. But the thing that was obvious to me was that he took a shoe, or he took performance or prospective performance mentally in a shoe. And he did such a good job of telling the story with it that he made me think if I could put the shoe on, I could run faster.
Right.
And that so hit home with me relative to what sports is about, but really can be accentuated. It truly is the story. When you see a rare player, a rare athlete, there's so much more that's going on there with that rare athlete. And just the story of what's making him rare, comparing him to the other players or other competition. I call it 1 and 1 is 3. And I apply that to everything, whether it's a business decision. 1 and 1 is 3 in sports, not 2, but 3. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run or having yourself there when you're watching or thinking about it. That area right there is an intangible. Because it is an intangible, that's where the biggest margins are in business. Not down here where everybody's doing it and the engineers are working on it. They've got it whittled down to right there. This area right here, that imagineering, that imagination part that makes 1 and 1 3 is where the margins are and, frankly, where the glory is.
I spent my 25-year career with Nike, and Phil Knight was just the most amazing partner. And it delighted me when you made that move. But my question is, when you come up with that idea at home, you're thinking in the couch or wherever, from the time you call Phil Knight, how long did it take, and how do those conversations go? Are you pitching your idea of why this is a great marriage? How does that go, if you can give us a little color?
I visited with him. My wife, Jane, and son, Jerry, went to their headquarters I'll never forget, I was visiting with a couple of his folks about what this might look like. And he came in, and we had gotten pretty far along. And he looked over at me, I'll never forget it, and he said, I have never paid so much for nothing in my life. But he said, this thing is something about it I like. When we initially made our deal, he couldn't use Cowboys or he couldn't use the Star. We just did the deal with the stadium. Now, as Charlotte said, she Niked to the stadium. We made that stadium look like it was Nike headquarters out there. But we didn't do it with the team. We basically brought the team out in no colors and no sponsor at all. But when we got to New York, we were playing the Giants, and that's when we made this announcement. And at that time, when we walked out on the field, I had a suit on, but I had the Nike tennis shoes on. And Phil walked out with me, and I had the Nike hat on. And we had met earlier with Al Michaels, and we had met with Dan Deerdorf, and we had met in the dressing room. And I explained to them what this was about and where the edge was regarding the NFL and where it was regarding Nike and the Cowboys that made it a contentious thing. I'll never forget Al Michaels said, now, we may have, if we have a close game here, we might not get much to this in the second half. Well, we had quite a lead, the Cowboys did, going into halftime. So they spent that entire half talking about this relationship in the NFL and what might occur. That next morning, Phil called me, and he said, I have never had such a bang for my buck in your life when he called. And I'll tell you, from that time on, I could walk down the streets in New York, I could be in Chicago, and you'd have drivers in cars and whatever, just point to Nike and say, go get them. So the controversy, if you will, look out now. The controversy created also a huge interest when otherwise it might just been some commercial issue, but created a huge interest. And of course, the potential result relative to my relationship with the NFL and that type of thing, that got a little touchy there for a little while. But in general, I can't say enough about Phil and his buying into the idea of taking a team. Now, he obviously, to this day, wants to be a part of Nike and the NFL, and it's as it should be. But when it's the thing to do, you can do both, team, league.
Take everything you say, right, and I believe it. And yet, Paul Tagliabue, the commissioner at the time, was like, "What's Jones doing down here? We've got this deal. What makes him think that he can go and do this?" Did you have that in your mind?
Well, I had and have all the respect in the world for Paul Tagliabue, but I was operating on different gasoline. I had the ultimate. They had to come through me. It was my fanny that was going to get put out on the street. If the Cowboys didn't make more sense financially. And if something happened to the Cowboys, frankly, it had a good chance of happening to others in the NFL, other teams in the NFL. And so I didn't see a solution to get in line, get in sync, get right in with the other, at that time, 29 teams, 30 teams. I didn't see that answer either because I hadn't found that answer to do that. And so, candidly, it wasn't comfortable. I'm not going to say it's comfortable. But it was inspirational to think that I was doing something about the problem. And the way that I was doing something about it, maybe for everybody, maybe not. First, I was interested in what it did for the Cowboys. And I knew good and well some of the things I was suggesting that I was getting criticized for were in the best interest of the Cowboys, and I really thought they were in the best interest of the NFL. I think the clubs and the great markets they're in around this country, They have all of the ability in the world to promote their brands and to be imaginative in terms of involving fans in products or services. And I think they have the ability to get involved more than you do at one central place. But on the other hand, I thought the NFL as a whole had a fabulous inventory of things to engage companies and services, and they do very much. It's called Super Bowl. It's called the game itself. And so picture, if you will, a circle that's got all of the clubs in it, and then you have the NFL. Well, I could see each club in their areas of marketing and making their deal with Nike, and then I could see the NFL having a deal, if Nike, yes, but maybe with a competing entity. That fundamentally was what it was all about.
Right, because, I mean, essentially what happens, you know, for those who aren't as familiar with it is they sue you, you counter sue. I mean, contentious, it gets real contentious, it gets litigious. Did you know that was how this was ultimately going to get settled? You knew there would be a fight.
The theme here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need, because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global economic news whenever and wherever it happens. I'm Lizzie Vernon in Florence, Italy, and this is Bloomberg.
Well, first of all, frankly, and I had no other way to think about it, the amount the league sued me for, immediately they own the Cowboys.
Right.
And
$300 million, right?
$300 million at the time. And I told you that I'd spent it all and didn't have the ultimate figure was to buy the Cowboys. And so it was dramatic for me and traumatic for me, but caused me to certainly grow, if you will, buck up, sleep less, but sharpen up. And it was an experience that I think we used as a platform again for in years as years have gone by, and really have benefited from that more ways than just a shot of juice for the sponsorship area. I didn't know that buying the Cowboys, by the way. I didn't see that at all. I did see and say, look, I'm going to have to find something or I'm going to have a lost leader of millions of dollars for the rest of my life. So I'm going to need to go get something to associate the Cowboys with that can help me toe the freight for owning the Cowboys.
Jerry, we were sitting at a Cowboy game, maybe 3-4 years ago, and you said to me, Alex, I'm around 79, maybe 80. And I work harder today than when I was 39 or 49. Where do you get that work ethic from? Because it's remarkable. You haven't slowed down one bit.
Well, first of all, we were talking earlier, and when you bought the team, you were 50. If you could possibly, from 50 to my age today, if you could have 10% of the fun that I've had over the last 30 years.
I'll take 5.
10%, okay, take 5 of it. I promise you. There's no way to measure what life has been since touching sport and touching the Dallas Cowboys. But it's given me such an inspirational base that has caused me to do things and really things that aren't necessarily directly associated at all with the Cowboys. And the moral of the story, the lesson is, if you got a dream or if you've got something that you're passionate about, boy, give your passion a whole lot of value in terms of putting your assets together to go do it.
And so, Jerry, to that point, for those of us who've watched you more closely over the past, call it 10, 15, 20 years, certainly the last 5 or 10, we see someone who is very comfortable with risk, very comfortable with controversy. What becomes clear in watching your whole history is this is a feature, not a bug. This is who you are. What gives you such comfort with risk? Because you seek it out. You run toward it, it feels like.
Yeah. Well, I think that the experience, if you've taken risks, then certainly you have failed. I think as much as anything, it's the ability to deal with the failure. And ask the question, okay, when you get up a month from now and it's gone totally the other way for you, look around at your relationships, look around at what you're about in life. Now, can you live with how that's going to feel when it didn't work? It's that test. It's that next day test, that next week test. Can you go? If you can do that, then you go back over there and say, okay, now, what do I have to do, and financially, what the work you have to do to put it together. The one thing I've always been able to do is borrow more money than I should have. And I'm real good at it. And it crippled me when I was much younger, just getting out of college. So I've really never seen something that I didn't think that I could figure out a way to financially make it happen. Ever. Now, what I also, though, have in these cobwebs back there, and if you ever cut me open, that's what you've got in there, is all of those times when I couldn't pay. When I first got involved with the Cowboys, it was pretty, frankly, very negative in this area. And I had a reporter come up, and we won one football game our first year. And the reporter asked me, said, these have got to be the lowest days of your life. I said, about 15 years before I bought the Cowboys, I came in Love Field, at that time the airport here in Dallas. And I went up to a little stand. It was a rent-a-car stand, small by today's standards. Put my card out there and said, I need to rent a car for my work down here. They looked down a list, took my card right in front of me and just cut it in two. They said, young man, you need to know how to learn how to pay your bills. You don't have any credit. That's a hard day in Dallas, Texas, not just winning one football game all year long. Those are the hard days right there. And so, again, not to overemphasize the point, the thing we're talking about, the interest in extending, the interest in sport, and certainly the years I've been involved when it didn't quite work financially. Now, we're doing some good lately about how to make it work financially. And we're seeing that is more there than we might have thought were there. I didn't necessarily see that. I really didn't. I found it out pretty quick that it was there. So looking back, seems like, well, you know, that ought to have worked. That should have, if you're sitting out here now, social media and all of the eyeballs there, you ought to be able to figure out a way to attach that affinity to a product or a service. You should be able to do that. Well, we hadn't done that.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, you know, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and the downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, you know, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, you know, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, you know, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
Some people travel to see the world. I travel to question the forces that shape entire nations. How is it possible? My name is Professor Hannah Fry. I want to meet the people with unexpected stories to tell and dig up the peculiar and wonderful treasures that reveal what a country is made of.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
And to me, that's there today, and it's there more so than it's ever been.
Well, and one of the things that, to your exact point, Jerry, around the value of sports and the value of teams that has become very apparent, private equity coming into sports and specifically the National Football League has been a seminal moment for the league. What do you make of private equity so far in the league?
I think that, first of all, let me clear this up. I'm a Main Street guy, not a Wall Street guy. I was raised with a family that was the heart of the customer. The customer is right. That approach to things. The thing that is so important is to take your critical associations, and that can be products, service, companies. It can possibly be those very investors. I'm going to call them minority investors, although I don't accept a minority investor. I don't want to say that about an investor. Anybody that wants to put hundreds of thousands or $1 million in the team, boy, I want them to be just as entitled, frankly, as I feel about it to get that done. And I want to treat them that way. And I want them to think that when they walk out here, if they come out here, I want them to think they're a part of this team because they are. They're critical. Name me any business that when they have great capital sources, don't really have a lot of energy and a lot of success. And so sports today is getting real capital sources as other investments would. And that capital resources, a part of that is not some dividend check or not some plaque on the wall. A part of that is being involved and getting to be a part of the team. I think that's critical. I've had people involved in our team, the Cowboys, not a direct ownership, but as a valued sponsor. And let's say a beer sponsor. Well, that's Jerry Jones out at the floor of that warehouse at 6 in the morning. And you'd think I was talking to the football team at halftime. Instead, I'm talking to the drivers And I'm talking to the drivers about how when they go in a 7-Eleven, talk to the manager about product placement and putting it to where more people will buy the beer. I'm explaining that to them. So consequently, I'm as interested in the Cowboys helping them be what they want to be as they are in being interested in the Cowboys. So that's not exactly the relationship that somebody might think if they were sitting there as an investment in a fund or something like that. There's more to being an owner in sports.
Right.
And it can be very rewarding.
You told me that in that phone call. And you said, Alex, it has to be you. You got to be the chief marketing officer, the chief revenue officer. It's got to be you, not anyone you hire. They want to see you. And you're going to open doors for that team. And it's got to be you. And you said it like 3 times. You said, don't forget that.
So, Jerry, would you, you have held on to this as your family business for all. I have to think you've got people knocking on your door, especially with these newly approved private equity firms. They'd love to buy a stake in the Cowboys. Would you consider that?
Well, I know that I asked one person. His name was Don Tyson of Tyson's Chicken. He's a great friend of mine. He sat with me at 2 Super Bowls. But when I bought the Cowboys and I lived in Arkansas, I asked Don if he'd like to join me in buying the Cowboys. And Don said, I'm going to buy Holly Farms here in a few months. And I'm not quite into the sport thing like you are. So he said, I'm not going to do it. But he said, Jerry, is it possible for you to do it by yourself? And I said, well, yeah, but I'm talking to you because it'd be a lot more comfortable, a lot easier to have with you as a partner. He said, if you can do this without a partner, okay, you should do it because partners are expensive. That would be from the eyes of, let's say, the majority owner.
Right.
Well, of course they're expensive. They're your partners. They own the team like you own it. And they should be involved and be included and be made to not some kind of fictitious thing, but be made to be involved. And candidly, I feel that way about our key sponsors as well. To me, that's wearing it. Now, you and I both know all owners don't get involved like George Steinbrenner did. All of them don't get involved like I get involved. But candidly, if you want this thing to be what it can be for you, A-Rod, that is the way to engage. And what you've ended up with is almost a family of your own involved with the Cowboys. In my particular case, I've gotten to spend this journey directly with my family. And as it's turned out, they have become not the ones we started the journey with. And we have evolved. We've all evolved together. And I get credit for most of the credit I get are their ideas and their execution. But my whole point is, it is the journey. And it is the being involved. And the good news is that we can step up there and win a championship. Have all of this reminds me of The Godfather. Now I'm going to provide the protection, the money, and everything else. Tell me why I deserve this good deal.
And so when you talk about your family, Jerry, what I hear you saying, and I want you to keep us honest here, is that this will be the family business. You're not looking for partners at this point. Is that a fair statement?
Yeah, and I think the best way to make my point is that I alluded to it earlier. I didn't make an investment. I did not make an investment. I invested in a job. And that's why from the very get-go, I said I was going to be involved in every way. My children, buying through me back in those years, were not a part of an investment. We bought the team, but what we got were jobs. And we got a career. And guess what? We got a life. And I can't tell you what the most rewarding thing, of course, has been really working with them and having them involved as well. So under those circumstances, because they've spent a lifetime working with the Cowboys, I don't see that changing. And, of course, there's no succession plan here because they've been doing it anyway.
And so I would imagine, just to put a fine point on it, people must knock on your door wanting to invest in the Cowboys, and you just say, no, thank you.
Well, I've had wonderful opportunities, frankly, yes, to have partners almost almost from the time I bought the club. As a matter of fact, the next morning, I got up after we had had our announcement that we were going to buy the team and make the changes. I get a call from Bum Bright, who had sold me the team. And he said, I just got a call from probably the most qualified people you could ever imagine. And said they've seen where I had a handshake or whatever we got. And they said to tell you that you can, whatever's on the piece of paper we sign, which wasn't much, they'll take it, give you $10 million to go home to Arkansas. That morning, I said, Mr. Bright, I said, tell them that's thanks for their offer, but no, I'm on this thing now, and we're going with it. But the bottom line is that the time spent, the commitment, the being involved, it really hadn't been work.
Right.
Been some worry now, been some serious what-ifs, but principally early financial, very early financial. I could really have envisioned a disaster. And frankly, I had gotten to a point to where I shouldn't have risked that regarding my family, especially after what I'd been through and knew better. But I did it because I wanted to be involved, but I was very aware. It's like being operated on a little bit while you're still awake. I was very aware the whole time of how an embarrassing thing it would be to have to leave Dallas and leave the Cowboys here, or whatever's left of it.
Right.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day, now at our new time. Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. The multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ. Mondays on Bloomberg.
And so your succession plan is essentially, you said there's no succession plan, but the succession plan is your kids.
Yes, and it's in place. And the truth is they could operate today if we decided we want to go someplace.
So, Jerry, I have two daughters, and their North Star is Jeannie Buss, great Dr. Buss's daughter, and Charlotte. And, you know, they want to be involved with sports one day. So they watch, they admire. Just like I have studied you over the years, they're studying Charlotte and Jeannie Buss.
Yeah.
So I hope to have that one day.
I can't tell you how much I think that women are such a part of the future of sport. We know it in the NFL. We're so proud of our percentage of women that are involved in sport.
We're going to get to our lightning round in a second, but there's one thing that just sort of strikes me, you know, sitting here with both of you who are larger than life characters, if I can say this about my partner, and characters who have had to deal with a lot of stuff coming at you over the course of your careers, from when you were a player to now, from all through your ownership. What's your advice